Stock futures too have tumbled this morning as investors weigh on the new tariff on goods from key trade partners and their potential impact on the economy and corporate profits. The futures tied to the Dow Jones Industrial Average are down over 500 points. The S&P 500 futures are down almost 2%, while the Nasdaq 100 futures are also down close to 500 points. And that is because U.S. President Donald Trump's tariffs on Canada, Mexico and China has triggered fears of a broad trade war and a hit to global growth. The U.S. has imposed 25% tariffs on imports from Mexico and Canada and a 10% tariff on goods from China. Now, Canada and Mexico have retaliated with counter tariffs, while China has announced plans to challenge the U.S. tariffs through the World Trade Organization. NBC's Brian Shung has more details on this.
Companies across the country bracing for tariffs, with a warning that it's the consumer that's going to pay the price.
It's everything that is at risk of becoming more expensive.
From Mexico, importers will now have to pay 25% more for items like fruits, vegetables, beer, liquor, and electronics. From Canada, 25% more for potatoes, grains, lumber, and steel. And from both, a big increase on pharmaceuticals and on auto parts. At S&S Automotive in Secaucus, New Jersey, more expensive imported parts means even pricier routine fixes.
Oil changes mainly. That'll be the first noticeable one. An average oil change on most vehicles now anywhere between $50 to $80. It's probably going to end up over $100.
And that means that you've got to raise the cost just to make sure that you can keep the lights on.
Right. And I don't like to do that because I've been in this town, like I said, 38 years. So most of my customers I know.
Experts believe it won't just be auto stores passing on the prices, but supermarkets as well.
So we could see upward pressure for meat prices, upward pressure for dairy prices. Those are the types of categories that directly hit consumers' wallets.
Tariffs are paid for by the importing country, meaning S&S Automotive suppliers would bear the costs. President Trump's tariff announcement targets America's top 3 trade partners, who accounted for 42% of all goods imported into the U.S. The president suggesting further tariffs are on the way, meaning those price increases may just be beginning.
It's just another headache, because now I have to explain to somebody else why we're raising them even more.
Well, now following this move, Mexico's president and Canada's prime minister issued sharp retaliatory tariffs on the U.S. In fact, let's listen in to Canadian Prime Minister Justin Trudeau's comments.
Tonight, I am announcing Canada will be responding to the U.S. trade action with 25% tariffs against $155 billion worth of American goods. This will include immediate tariffs on $30 billion worth of goods as of Tuesday, followed by further tariffs on $125 billion worth of American products in 21 days' time to allow Canadian companies and supply chains to seek to find alternatives.
Retaliation by the economies of Canada and Mexico. Let us also listen into what other market experts and economists have to say on this tariff action and its likely impact.
The Fed should not react to the first round effects of the tariff, so the sort of the direct tax effect on the US consumer, because this is like any other sales tax. Or a VAT increase in Europe, for example. There's nothing the central bank can do about it. And of itself, this is a one-off price increase. But if we see some of those second round effects that I was talking about, profit-led inflation, reduced competition in the United States, leading to more inflation pressures, those long, complicated chains of price increases coming through, that the Fed needs to respond to, because that potentially is a longer-lasting inflation shock.
I'm one who thought that it was very unlikely that Trump would follow through with 25% tariffs on Canada and Mexico. But now I think we have to accept that even though I still believe longer term that Trump will use tariffs as a negotiating tool, at least in the short run, this is going to be very disruptive.
That's the global market action, and it's been full of action, I must say. But how will all of these overnight cues impact our own markets? Our research team is joining in with how the trade setup looks like, the stocks that are likely to be in focus, and of course, the scheme of things on the FNO side as well. Firstly, Vinny joins in to get all the market cues that we need to watch out for. Vinny, good morning. Well, it was a mixed reaction to the budget on Saturday, also because the FIIs were absent most probably. But what's the setup looking like now that we are bracing for a gap down start?
Absolutely, bracing for a gap down start. But just a recap in terms of what happened last week, an extended week that we had. So market actually snapped the 3-week losing streak that we saw, and specifically on budget date, like you were mentioning, it's a volatile trading session that we saw coming in for the markets. Benchmark indices specifically took a bit of a breather and ended quite flat in the trading session. We saw sector specific Nifty FMCG that was buzzing away in trade on a Saturday. We had consumption sort of reliefs that came in, and that is why FMCG was buzzing. We had the tourism sector that was also holding on to good gains, and auto that was also holding on to good gains in terms of a move that came in on Saturday. What didn't do well was defense, PSUs, capital goods, the capex side of story that didn't do that well and saw a decline of almost 3% in trade. Key factors to watch out for, and was highlighted previously as well, global sentiment that seems to be weak, and that is why that gap down start. Now overall, obviously we saw those tariffs that have come in from Donald Trump on Mexico, Canada and China, creating some bit of an issue in terms of tariff wars that could begin between countries, and that is a concern that is keeping the markets a bit jittery. RBI MPC meeting for India is going to be a key focus area this week, as well as corporate earnings continue to be on focus, and that is why we're keeping an eye on the markets. A bit of a gap down start because of the global sentiment is what we're watching out for, Hormas.
Oh yes, we'll keep an eye out on the RBI policy, of course. Despite all of this global action going around, that'll be the big event of the week, domestically at least. Over to Vamakshi now, who would list out the stocks that you need to watch out for in today's session. Vamakshi, good morning. What's on your list?
Well, good morning, Hormaz. Let me first start off with Aarti Industries. The company is seeing a margin contraction from 15% to 12.6%. The net profit too is seeing a very sharp fall of almost 63% on a year-on-year basis. GR Infra is the next counter we're watching out for. Revenue is down nearly 20.6%. The margins too have contracted from 23.8% to 21.8%, and the net profit, however, is seeing an uptick of 7.8%. Anant Raj reported very strong growth in its revenue. The revenue saw an uptick of almost 36.3%. The net profit too has seen a very sharp jump of almost 53.6%. Neogen Chemicals, when you look at the revenue, they've posted a revenue growth of 22.5%. The margins have expanded substantially from 12.3% to 17.2%, and the net profit has surged from 1 crore to 10 crores. As far as some auto companies are concerned, Hero MotoCorp reported a total sales uptick of almost 2% for the month of January. Eicher Motors, on the other hand, when we talk about the Royal Enfield sales, that saw an uptick of almost 19.6%, and VST Tillers saw a decline of almost 17.6% in its total sales. MOIL is the next counter we're watching out for. They've also come out with their January update, and they say sales have seen an uptick of almost 17%, and they've taken price hikes across various manganese grades between 3.5% to 8.2%. And lastly, keep an eye out on Coal India, because coal production is down 0.8% at 77.8 MT, and the offtake on the other hand is seeing an uptick of almost 2.2%.
Still falling short of that FY25 guidance that they have given. Vamakshi, thanks a lot for that list. And lastly, over to Mangalam, who joins in with cues from the FNO space. Mangalam, good morning. Potential gap down, but what's the FNO data suggesting on the downside?
Well, if you look at, Saturday's move, it wouldn't feel like it was a budget, because the frontline indices were a lot more consolidatory, but the sectors actually shifted. So we saw big gains in the form of, consumption names, consumer discretionary, in particular, the likes of Trent, Jubilant Food, Avenue Supermarts, ITC did well as well. And the money was shifted away from L&T, BEL, ABB, the capex heavy and defense, etc. sort of names itself. But remember, it was on low volumes itself. FI sold about 1,300 crores in the cash market, but gross volumes were just about 3,000 crores, which is, pittance. You had the DIIs as well, buying about 824 crores in cash. Again, gross volumes just around 26,000 crores, a lot lower than what we are used to seeing. And remember, between that and now, we had the Trump-related issues as well. The GIFT Nifty indicating a near 200-point downtick. FIs are 88% short in the index futures itself, nearly 1.74 lakh net contracts on the obverse side. Lower levels will be extremely crucial to track, because the 23,200 put has been fairly active, premium of 50 rupees. we were expecting around 23,150 to be a support, but now the market opens closer to 23,000. And on the way up, 23,500 call equally active as well. We were hoping to at some point cross past the 50-day moving average, but now it's the 20-day moving average which stands under risk for the Nifty. All eyes will be on the Nifty Bank because not only did we have the budget, this Friday we have the new governor's first RBI policy outcome, so we'll keep an eye out on that. Nifty Bank is above the 20-day moving average again, with the sort of impact that we're likely to see on the rupee because of the strength in the dollar, etc. The Nifty Bank may also be weak. We open lower. The question is, how much lower do we go from there? Or is there a case for us to see some support at lower levels for our market?
The bulls will definitely be hoping for some support at the lower end. Mangalam, thanks a lot for that. Well, time for a short break. Up next, we get you all the highlights from the budget on the other side. Stay tuned. We'll be right back.
$5 billion worth of American goods. This will include immediate tariffs on $30 billion worth of goods as of Tuesday, followed by further tariffs on $125 billion worth of American products in 21 days' time to allow Canadian companies and supply chains to seek to find alternatives. Canadian energy powers American manufacturing, businesses, and homes. Of America's top 5 trading partners, Canada is the only one with whom the United States runs a trade surplus in manufacturing. And Canada buys more goods made by Americans than China, Japan, and Germany combined.
I think, listen, I think we've had pre-budget.
Back with us here on Power Breakfast. Now, the union budget looks to drive consumption by putting more money in the hands of the middle class. The budget also saw only a minor increase in government capex as it calls on states and the private sector to do their bit. Now, the government also stuck to the fiscal glide path. India's top industry leaders welcomed the tax cuts and to boost to consumption. They also believe that the demand stimulus was much needed to prepare the pitch for consumption story to flourish and waved a thumbs up to the budget. Listen in.
Relief to the middle class is very welcome, and it's going to certainly provide impetus to consumption and therefore, contributing to the virtuous cycle of investment and employment. And this was much needed at this point of time. Of course, we do expect interest rates also to come off in February to reduce, and that should provide some further impetus. But the larger point of this also would be that this is the immediate relief. But a lot of sectors that have been touched upon in the economy are areas that employ, which are very labor intensive.
Right.
and the economic activity increasing in those areas will have larger impact on employment generation.
Three key takeaways for us. One is a demand stimulus that was much needed and very well delivered. Second, a focus on making India the manufacturing hub of the world. The focus on ease of doing business, on enabling capital goods to be imported at lower rates, and importantly, addressing the duty inversion that we've seen. These are all things that will help make in India in a much more significant way. And the third is inclusive development, which is also something that is important for us as an economy. So on balance, a very good budget. The capex from a government standpoint stays on course, which is something that we ideally would have liked. And the fiscal discipline stays on course as well.
India Inc. there welcoming the union budget. Take a short break. Up next, we get your cues from all the commodities that are in action this morning. Stay tuned. We'll be right back.
Everyone was expecting relief for the lower and middle income. But this extent of relief, I don't recollect, has been given 1 lakh crore in personal tax, which is almost, about 7 to 8% of the total personal tax collection that the government has. So I think it's a very significant relief. And overall, if you look at the overall theme from a tax standpoint, I think a lot of it is based on just simplification.
Right.
From the new income tax, 50% of the provisions coming down in the new income tax bill, that will be tabled next week. All the other things that they have also done, whether it's on TDS, TCS, all the other areas that have been laid out, a lot of that is on simplification. Also in continuity, no significant changes anywhere except addressing some, minor tweaks here and there. Unless if something is there in the fine print, then we don't know. But this government generally, whatever there has is on the table. IFSC always gets, they're trying to encourage and project IFSC more. That's there. And overall, the emphasis, whether you look at the economic survey or you look at the budget, this ease of doing business. And I think it is so important to unleash the spirits and to ensure that India achieves its full potential. I think that, setting up the committee, coming out with in the next 1 year, setting up some competitiveness among states, clearly recognizing that a lot of these things have to happen in states. I think that's a big change. And the pillars that they have identified, and focusing, some of which Sanjeev mentioned, focusing on those 4 or 5 pillars that are so critical for growth in the next 10, 15, 20 years, including nuclear power and making changes in the act. I think that was quite good to hear. Identifying the critical growth drivers for Viksit Bharat, ensuring that there is, as he rightly said, that there is a focused approach, interministerial approach for that, including ensuring that there is good state-to-state collaboration and identifying all the levers, even AI, deep tech, global value chains. So at least the thought process of growth, the growth levers are very clear, and how you take that through.
Relief to the middle class is very welcome, and it's going to certainly provide impetus to consumption and therefore, contributing to the virtuous cycle of investment and employment. And this was much needed at this point of time. Of course, we do expect interest rates also to come off in February to reduce, and that should provide some further impetus. But the larger point of this also would be that this is the immediate relief. But a lot of sectors that have been touched about on
Investing.
Welcome back, and Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. Big action seen in all commodities now post Donald Trump's actions.
Oh, well, absolutely. We've almost forgotten the Indian budget in this, and tariffs really taking the front seat right now. So I'll start with the crude oil prices, Hormuz, which after 2 weeks of decline have seen sharp gains come in today. With the U.S. imposing tariffs on Canada, Mexico, China, there are fears of trade war and crude oil disruption as well. Well, energy products from Canada are priced at a 10% duty, while Mexican energy is to be charged at 25%. This has led to crude oil prices gaining in U.S. and the rest of the world as well. But there's a big arbitrage that we are seeing happen in the metals as a sector. 25% tariffs on Canada and Mexico on metals is really making prices higher in the U.S. markets there. U.S., remember, is a net importer of copper, aluminum, and zinc. And U.S. imports 36% of its copper, 82% of its refined demand in aluminum, and almost 67% of its zinc requirement. So we are looking at higher prices for all of these metals in U.S., while there has been a price decline in these metals on the London Metal Exchange and many markets in Asia.
Boy, we'll keep an eye out on all of these metal names back in India as well, if there are any potential reactions. Manisha, thanks a lot for that. But with that, it's a wrap on this edition of Power Breakfast from me and the team that put this show together. Thank you so much for watching. Bazaar Morning Call up next to set you up for what promises to be an action-packed day.
Are areas that employ, which are very labor intensive.
Right.
And the economic activity increasing in those areas will have larger impact on employment generation.
Footwear, toys, tourism, all being identified as sectors.
Even agriculture.
Yeah.
It has enough people, but
healthcare.
Income can improve. Income can improve. So all this itself actually feeds into the virtuous cycle of, therefore, consumption and investments. So there are measures for the immediate and measures that will also unfold over a period of time. First of all, many of the specific interventions that are there, you alluded to some in tourism. Then there are others, for example, in exports. I think the integrated approach, cross-ministerial approach, I think is absolutely the one that is required, because in the morning also we spoke about some of the issues that have to be dealt with, which requires a cross-ministerial approach. And something CI has also been talking about, having an integrated approach. Looking at setting up this committee on ease of doing business.
Right.
And taking an integrated and focused approach on agriculture, 100 districts, all-round development.
Yeah.
Taking an integrated approach on rural, the non-farm development. Really sending some development and resilience hubs for rural areas. So these are very fine ideas, very good ideas, and certainly will unlock the potential in many, many areas. Creating a framework for GCCs. GCCs are already, doing well in India.
And massive job creators.
Massive job creation, and the world has demographic challenge. So it's a great opportunity for India, and to provide impetus to it, to make some, today it's happening on its own. Without really any impetus or for specific interventions. So right now, to create a facilitative framework for this, I think it's going to provide further impetus to it. Then the whole idea about the strong point of reforms and collaborating with states. I think this will provide a lot of impetus, because a lot of reforms now need to be done at the state level. Right? So a lot of the right things are there. And I think what I'm very happy to note also is that there is a lot of clarity on the mechanisms that will be used to do it. It is not just a statement without an institutional mechanism.
Sure.
I think what you've heard in terms of consumption and demand is a big amplifier. CapEx itself is a big amplifier. There was very clear mention of the MSME sectors and continued focus on that, more so on the labor-intensive MSMEs, special mention of footwear, leather, toys, service sectors like tourism, because employment generation is not just employment generation because it provides jobs, but because it will be the accelerator through demand and consumption. So for me, these are very important aspects. I would just add on the point of infrastructure, almost a relief that the funding plans for the Jal Jeevan Mission and Swachh Bharat Mission.
Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC-TV18 Motilal Oswal Budget Headquarters.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. I mean, it's a grand studio. We're still working out of. We get to work out of here at least for maybe a day, 2 days more, and we're loving it. But this is also, of course, the CNBC-TV18 Motilal Oswal Budget Headquarters. So welcome to all. You know, the budget was last week's story. This week, the story looks like it is going to be tariffs. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, good morning.
Hi, morning.
Hi, morning. Didn't much feel like a weekend Sunday or whatever it was, because even on that Sunday, there was so much news flow on the tariff front, and we are getting some pretty severe reactions right now across global market, US futures. You know, buckle up.
Well,
It's that Monday.
budget, Trump's tariffs, the RBI policy, and earnings ongoing as well. Guys, we've got our hands full. Prashant, let's get straight to the action.
You know, markets move so fast. I was thinking, what was last week's big story? It was DeepSeek. Right? It's moved.
Yeah,
the
it's
budget
gone.
is gone. Now it's tariffs. Anyway, you know, let's just quickly run through the big talking points, right? So the tariff missile has been fired, and Trump has done it as he has promised he'll do it. You know, these are effective tomorrow. That is Tuesday. So not very much time left. 10% tariffs on imports from China, and 25% tariffs on imports from Mexico and Canada. I mean, these are the basic headline tariff rates. And this is, remember, 10% is not, and 25% is not just it's on top of the existing tariff. So it's whatever plus 10, whatever plus 25. In terms of energy imports from Canada, it is 10%. So basically oil, etc., it's 10%. Canada and Mexico, as expected, have promised retaliatory tariffs. China's response is the important one. I mean, that has been very mild so far. They've not gone all out and said that we're going to do this, we're going to do that. It seems like we're going to go to the World Trade Organization, this is unfair and things like that. They seem to be not wanting to escalate the situation at this point. And that's important to note. The other thing, and I've made this point earlier as well, the motivation, as written in the executive order, seems to be fentanyl and immigration. This is the motivation. There is no sort of, you know, resolution or standard by which, you know, there's no cutoff by when these tariffs will be removed. But the point is, these are, you know, especially fentanyl, etc., these are relatively easy to do. What stops Canada tomorrow from saying, well, we'll do everything we can to stop the fentanyl flow? I'm surprised no one has done it. They're threatening sort of tariffs on the US, etc., but these are not structural issues. It's not, you know, the US trying to correct 30 years of trade deficit, although Trump has promised that as well. But at least for now, what has been mentioned in these orders is, of course, you know, this fentanyl and immigration issue. So I think at the very margin, maybe a little bit of silver lining. What it leads to think, you know, one to think is that maybe this is not permanent. This is a situational thing which may get corrected as the situation is resolved at the border. Now, the market reaction is clear. Dollar is up, is bid 1% to about 110. Mexican peso, the Canadian dollar, those are getting sold off. US stock futures, the S&P E-mini is down about 1.7. NASDAQ futures are down. Oil is slightly higher, but nothing very dramatic. So you got a bit of a global uncertainty, but you also have the budget boost to consumption, which came through on Saturday. And this kind of puts the focus squarely on local-facing stocks, which is consumer stocks, economy-facing stocks, stocks which are cut off from whatever happens elsewhere in the global market. You know, there is a lot of debate whether this 1 lakh crore is going to be big and how much is it worth, etc., etc. But keep in mind, there is 1 lakh crore. It's not one time. It's recurring every year. And second, you know, this is more than just a number. It's also a signal, right? It's a big signal. Last 4-5 years has been big 20-25% growth in capex allocations. Of course, it's moderated over the last 2 years. And for the first time, the government is spending on consumption, putting more hands in the putting more money in the hands of consumers. There is, of course, rate cuts expected on Friday from the Reserve Bank of India. That will add to, I mean, this mood that I'm talking about. Nifty, just to circle in the levels here, Nifty ended lower, but above the 40-hourly exponential moving average at 23,306. We left off at 23,482. The downside level is 23,110 if the 40-hourly exponential is broken. And on the upside, I mean, the high that we saw on Saturday perhaps is the resistance level, which we need to clear. That is 23,632. Similarly for the Nifty Bank, you know, just to quickly wrap up the levels, So we hit the 40-day exponential moving average and the Bollinger Band. These are levels we highlighted on Saturday morning. And then from there, the market sold off, ended slightly lower. And here, you've got downside level at 48,671 and then the high of 49,993, or you can even go with the Saturday's high, which is higher than 49,993, which will act as a bit of a resistance level. This morning, of course, straight up at an index level, GIFT Nifty will give you an indication of how we're likely to start. But, you know, it's going to be very, very stock specific, and, you know, people are going to look for ideas within the consumption basket. I think that's what's to take note of, and we'll tell you where exactly, which areas as we go along over the next 1.5 hours or so. Surbhi.
And look at that. Nifty is just getting into a jinx. So every time it's going to that recent high of the trading range, 23,500 thereabouts. So today's jinx is tariffs. Very quickly, let's get to the reactions playing out across Asia, and they're pretty severe. Remember, the Chinese market, equity market has still not come back. The Lunar New Year holiday continues up until tomorrow. But you're getting a sense of the reactions in Taiwan, in Hong Kong. Look at how Japan is reacting. That's Hang Seng down about 1.5%. Taiwan's down almost 4%. But even some of the larger markets, like I said, Japan's down over 2%. The Australian market's been down about 1.5%, 1.7% thereabouts as well. So the equity reaction is quite severe. The currency reaction is playing out in the offshore yuan. We'll probably have a more fuller reaction come through once the Lunar New Year holiday gets over. But even there, the yuan has touched a record low versus the dollar. We're talking about levels of around 7.376, so almost going up to 7.38 on the yuan dollar. Now, talking about the yen reaction, relatively speaking, the yen hasn't fallen as much as a lot of the other currencies, including the euro. By the way, the euro's tumbled to a one-year low versus the dollar as well. Even the Swiss franc is weak. The reason why the yen, you can see some green over there, that it's working as a bit of a safe haven right now. And that's because the BOJ policy has been to hike rates. So right now, not too bad on the yen compared to the kind of slide that other Asian currencies are seeing. Finally, I just want to mention crypto as well. Considering the mood is risk-off, Bitcoin has fallen about 6.5% in the last couple of hours, and it's trading below the 95,000 handle as well. So that's just overall sense. What did China say? The official response that we have so far, they're taking this to the WTO. On fentanyl itself, the point that Prashant raised, this is about fentanyl, so why don't countries just say that it's okay, we'll stop the supply? Even Mexico's response has been very, very strong and staunch on fentanyl. Mexico is calling out the US, saying you cannot stop the sale of these harmful substances on your streets. On China, the Ministry of Commerce is saying that the tariff seriously violates international trade, and a frank dialogue and cooperation would be, much more warranted. And they're saying fentanyl is America's problem. The Chinese side has already carried out extensive anti-narcotics cooperation with the US and achieved remarkable results. Japan has noted this, again, because it's a large trading economy and a trading partner. I'm taking a note of Japan's reaction as well. Japan says that we're deeply concerned about how the tariffs could affect the world economy. We will have to closely look at how Japan would be particularly affected and take necessary steps in response. Similar, statements out of South Korea, because remember, a lot of South Korean companies, giants like Samsung, have, manufacturing capacity in Mexico. So South Korea is watching as well. And we have the Indian Finance Minister's response, which is going to come up on your screen in just a bit. I mean, she was asked by, obviously, journalists over that Sunday that, what happens if India is next. And the Finance Minister is saying that we're not worried, looking at India's position fairly. The US may not benefit with high tariffs in certain sectors. So the world is reacting. This will take some time to play out. Right now, markets are nervous. That's the short point. Just very quickly to top this off, on the flows picture, guess what? Even on that working Saturday, there were FIIs in the market. They were watching the budget and even trading, and they did what they've been doing, which is selling about 1,300 crores in the cash market. So budget may be over. We have other problems to deal with.
Well, and let's state out the top 3 points that I'm looking at. With regard to the FIs, they were virtually absent actually on Saturday because the gross volumes are down by close to 80%. So today the FIs react to budget, which has a consumption boost. Can they taper down on their selling? That's the hope out here. So we'll keep an eye out on that number. Next up, the derivative data suggests the total open interest is much higher than what we see on averages at the start of a series. In fact, if you compare February with January, on the Nifty, it's nearly 50% higher. So this market is heavy as of now. And finally, the next cue we're looking at is monetary policy easing, which is at the during the week. And the hope is that the RBI goes ahead and injects liquidity. They've done some bit in the recent past with regard to those OMOs. So liquidity, putting in some liquidity, that's something that we're looking at. How the FI is placed on index futures? Well, the short positions are at around 88%. This is the highest we have seen in the last 15 months. And getting into a budget, we have never ever seen the FIs with 88% of their positions on the short side. Those are the couple of data points with regard to the index futures. Moving to, the absolute numbers, the FIs, yes, they're net short, the clients are net long. Both of them at the opposite ends of the spectrum. But a quick check on the options data. Two strikes I'm looking at. 23,500 call on the upside, the 23,200 put on the downside. Both of them were active. And if you're looking at levels, well, you have a couple of, goalposts that you're looking at. So on the downside, the 20 DMA comes in at around 23,270. So that's a mark you should be looking at. But going by the options data, you don't want the 23,150 odd mark to break. That's the downside level. On the upside, the swing high was closer to around 23,650. So that becomes the important resistance mark. The Nifty Bank, well, close to around 1% away from here, around 550, 600 points away from here. You have the 20 DMA. You don't want that level to break out. Stocks that I'm looking at, some of these chemical-related names, PI Industries, UPL, as well as Jubilant Ingredient. And the reason that I'm looking at them is because of these tariffs that have been imposed. A high percentage of their molecules go into the US market. There was the fear that Chinese will produce more. That fear gets a little bit of a pushback. So in that sense, valuations as well are relatively attractive in comparison to their 5-year averages. Put all this together, Equaris has come out of the note and they're saying these are the stocks that could be in for a bit of a short squeeze. We'll keep an eye out on that. And finally, guys, is looking at a lot of those budget numbers, the STT collections are expected to go up by close to around 40%. That would mean that the government is factoring that the equity markets could remain buoyant. Because from around 55,000 crores, they're talking about 77,000 crores.
Yeah.
So a glimmer of hope out there. Even Delhi believes that maybe the equity markets should remain buoyant, and that's why they're factoring in these collections.
Will they do anything to help it, right?
Important, and that's the hope.
Absolutely.
They did to an extent, but now I think we have to see if the markets are not happy with all of it, I guess.
Absolutely. Let's get Samir back on, right? Samir Arora, founder and fund manager at Helios. Samir, good to have you with us here. Thank you for waiting. Appreciate it very much. So what is top of mind to you, tariffs or the consumption boost here, and what will drive markets from here?
So on a relative basis, it will be the budget, in the sense that actually the budget was good and we'll talk about it. But if the overall markets are down a lot, then India may outperform because A, it's not directly affected, and B, don't worry about markets like Taiwan because they have been closed for a week. So if you just look at how TSMC ADR was trading during this period because of NVIDIA and others, and then the TSMC local fall. So don't get totally carried away. A little bit you're allowed to get carried away. But the point is that the budget was good and this tariff situation is bad. But the tariff situation doesn't look as if it's going to be there for 6 months and 9 months. I mean, these guys have to be able to demonstrate a little bit about the demands of Mr. Trump on fentanyl and all. And I read that Canada is saying, see, we bought these 4 helicopters and we bought some guns and whatever else they can demonstrate. At least this doesn't look like this itself is a trade war forever, because the ask is not related to trade as of now. It is related to reducing immigrants and drugs, which actually in theory are easier to show by saying we have, more forces, more tracking, more inspections, whatever.
So it's not permanent, and that's exactly the point that I was making earlier as well, that it's easier to do. I'm surprised why they've not done it. Put out a statement, strong statement saying that we're going to do everything, all of this. I don't know what's the problem.
And I think it's because they are upset in general with each other. But actually, it's not started yet. It is supposed to start tomorrow.
Yeah.
And I think Trump has just tweeted or whatever has commented that he's meeting them or talking to both these guys today. And China, realizing that this is just a bit of drama, has not said anything back.
Yeah.
So it is bad, of course, but it's not like this is it and now, therefore, this is like 1930 when there were trade wars and markets fell. But right now, part will overshadow the fact that it was a good budget.
But the Mexican president's statement was quite hard-hitting and frank and fair. I mean, like I said, Mexico has been calling out U.S. right back, saying that you're not able to police your streets and what's going on there. We are doing enough. And she went on to say that cooperation is fine, but essentially bullying is not. And I think that's why these countries haven't immediately buckled under pressure.
Yeah, exactly. That's what I'm saying.
Yeah, it's about the tone tonality.
Now. It's a bit of ego. It's a bit of ego, but obviously Mexico was at fault. There is a doubt on that. But of course, U.S. also has to control. But obviously, I mean, you don't believe all these guys are coming in and drugs are coming in because there is demand. Obviously, the other side has not been. Otherwise, how can you have these cartels and people running those cities and whatever movies you've seen?
So,
So it is both ways, but I agree with you that this, if they want, can be done. I think plus, let's see.
Absolutely. Yeah. So let's see if some of those ego issues can be resolved in these, parlays that will happen. Now I'm sure the diplomatic channels are, working in overdrive. And the best part is that China hasn't taken a very strong stance, an anti-stance. They're saying we'll take it to the WTO. WTO disputes run in years. So we all know how that goes. But Sameer, having said that, there is the immediate reaction to play out. Sort of how do you look at that? Because for us, now I was trying to find silver linings. The only silver lining I could see for India was that finally the US market is buckling. Maybe for a short...
That's also one positive.
Yeah, so your thoughts on that?
No, so that is that is one of the points, but I thought we were talking budget first. But that is, of course, important because this obvious thing that you will sell emerging markets and go, of course, they will say even more it proves because currency has strengthened. US and Indian currency right now looks like 40 basis points down, about 86, 90 or something. So these things are now, you can spin it both ways. But in general, beyond a point that the fact that you can't put everything in one basket, particularly for A, global investors, B, long-term investors, and C, there are fund managers who cannot put it in US, they themselves. They will not go to their investor and say, please take my money and put it in US. So the emerging market fund, the Asian fund, the Asian emerging market funds, global fund, and then there is this other side of people saying US has gone up so far, too much, exceptionalism, US will not last. Ruchir Sharma keeps saying that there'll be some followers of that thesis also. So beyond a point, that trade is not so important that, people will take money from India and go to US. I think FI selling is not beyond a point a big negative. It is that whether India is doing well or not. And then there is some correction of excesses and stuff like that, which clearly seems to have been done.
All right. Hi, Sameer. Good to see you. And Sameer, since you spoke about FI selling, do you think it's getting to the fag end? That was the hope at the end of 2024. And bam, 2025, they're selling even more. Do you think,
so actually, if you look at it, you look at it, September was a massively positive month for India, some 7-8 billion positive. And October was negative, some 10 billion. Then November was sort of zero-ish, 1-2 billion minus, and December was plus.
Yes.
And again, Jan is big negative. So now we have to make some story. We can't say random. So the story which has to be consistent is that in October, they were thinking that US positioning and, Trump winning and dollar strengthening and all that, which happened. Then December, they were positive again. And Jan, again, negative. One reason has to be India related. That Indian results came out very bad. Because if you see, Taiwan was not negative. It's an emerging markets. It is an anti-US. I think Korea was negative, but not a lot. Basically, the entire emerging market negative in January. I think January or maybe a little, February just started. So must be January. Was I think some $7 billion negative, and all of it was India. So now if India improves or it corrects, or generally some stable thing is found, this continuous selling does not have to happen. Then it'll turn to buying also. So I'm saying the default in general is not that foreigners sell. The default is they buy and sell, but in the end, they mostly buy. Mostly means last 25 years, even if you see last year, there was sort of net zero. Now, why were they net zero? Because they sold in secondary and they bought primary. Now, why did they buy primary? Because the primary stocks are different. They are not the old banks, the consumer, the Reliance, the whatever. They are these IT type companies or tech companies, whatever, this consumer tech or fintech or whatever tech. And so out of your $800-900 billion, you have switched some $10-12 billion to the new age kind of stuff. So what is so unreasonable about it, except that is done between secondary and primary? If it was done between secondary and secondary, you would have said flows have been flat for last year.
Right. Got it. Sameer, so for viewers who are watching, right, there is a boost to consumption. People are still invested in capex, infra type of names. There is one view which says that this could be, 6 months down the line, we could look back and say, well, this was the inflection point. Not because it is 1 lakh crore and is going to do, but basically it was a shift in focus, it was a shift in message. So the style factor will change from what you should look and do here. So I just wanted you to your comments on that, whether it will really be so.
overall, I think it is one of the best budgets that we've seen in many, many years. And I tweeted it's a dream budget.
Yeah.
So first thing is that you normally want money with the public rather than with government. It should just be the general thumb rule of looking at anything, that money with public is better than money with the government. Number two, you have not taken money from one group and given it to the other, which would make it, that, you are deciding. Here they are saying, you just give us less money. It's not that you've taken it from one, given it to the other. Third is, you have not said that, you've cut a tax rate across the board, therefore the rich will get much more. It has come to the correct audience in that sense. Other than that, on infra and all, so then one more issue people I see in the reports that I get and on Twitter and all, only 3% people are affected, only 4% are affected. So if the government announced that there'll be a new road being made between, I don't know, say Faridabad and Meerut, only 2% of Indians will use it. The South guy will say, how do I care you made a road there? Everything that you do, only 2-3% people, 5% people are affected. But the reality is that there is no capacity to invest more in a road because the big roads are being made. And if anybody believes that a road that is not doing well, is not made well, is because of money, or is it because of management, or is it because of corruption, or is it? So learn from the US. I'm telling you, Donald Trump is going to be a massive positive influence everywhere in the world, including in India. Because you will realize that tax cuts and efficient government and cutting expenditure and all that. And secondly is, for whatever reason, which is now history, this year money could not be spent on infra and could not be spent maybe a little bit on defense. So now next year, what is the point of saying I will give 25% more budget to that section? It is better to say I will implement what has been done. But the reality at the end of the day is that money with the public is the best way. And in this case also, since there is a temporary or cyclical or short-term slowdown, it is better to deal with a temporary or cyclical or short-term up by saying, hey, take money. Or
no, but Sameer, this
instead of saying, I will make an infra which will take 5 years to implement.
And this is
which
now
also is needed, but separate.
The point is, this 1 lakh is not one time, it's recurring every year.
Yeah, exactly.
Hopefully.
So you get 4-5 times that the spending. Because you can buy a car, you can buy durable.
Absolutely. So briefly, Sameer, if you can, but the point is that you said they're not taking money away. Actually, I'm not sure if that is true because capex growth, right, capital allocation is expected to, be
10%.
10%. And if you look at tax assumption growth, right, income tax collection growth is assumed at 14%. If you add back that 1 lakh crore, it's 22-23%. So generally, it's very possible that expenditure will slip. And where will it slip? Mostly in capex again. So the question is, will we see some derating in infra type of names? And switching is always difficult to try and it's because capex, infra, etc. has worked for so many years. But
of course it derate. Yeah. That is why I'm smiling. I have been betting against that because those companies don't deserve 40 and 50 multiples because nowhere in the world, consumer also don't deserve, but consumer have had it for 50 years, so what to do? Or 30 years, higher multiples in India and in other countries also, higher in consumer than in infra and road building and water treatment. So that is just the reality. And therefore, I read some report, which is a good report, that you can move a little bit from value to growth. There has been too big a difference on winning an order, you make a stock go up. So that will definitely happen. The derating will happen because the money is ultimately fixed. Even FIIs will simultaneously try to churn even if there is net positive, if there is. Absolutely.
So Sameer, let me ask you this because, in India, we always swing from one extreme to the other, right? It's always extreme pessimism, then extreme optimism. Let me ask you this. Now, as the street starts chasing these consumer stocks, what is the PE you are willing to give and pay for to, say, a consumer staples company? And then let's talk about one of these internet consumer companies. The question is, how long will you buy them? At what price?
Consumer staple company, so we will not buy only.
Oh, okay.
Because consumer staple is ultimately, you may say they have more money, less money, but most of these guys could afford those consumer staples that they are supposed to buy more of. And it's still a very small percent of the audience that buys consumer staples. But consumer durables they could buy, and cars and all they could buy. But we don't like the sectors, but they could buy. But in other sectors, which is these food and all, the growth rate is too high. So if you just change the growth rate by one more year, or you change the fact that the margin is a little bit better because more people are doing, and then suddenly these valuations can change a lot. But again, remember, we only have 12-14% in all of them together. And we consider that as being like aggressive, and you also, and world considers that we are aggressive. So within that constraint, I mean, that context, it is still highly bullish. Actually, the number one most bullish, may I add, was actually Zomato, because not one person in the country has understood except me that what was that one line that was said. So Mrs. Sitharaman in the interview said that these gig workers, and I panicked. I said, shit, now they're going to say something about, treating them as employees or whatever. She said that all these guys can enroll in some system, whatever she said.
Yes,
we will give their insurance. So please remember, 2 hours before or 5 days before or 1 month ago, we were saying, these workers are exploited. These companies are competing with kiranas. These companies are creating this distress and that distress. And now you are saying the employees that these guys have hired, or not even employees, whatever you call them.
But Samir, many of those,
recognized.
Well, let's see. I mean, many of those things and those actions can always happen outside the budget. We'll have to wait and watch this space. But we've understood your point.
No. Yeah. That way, if I say if anything can happen, tomorrow there can be war between India and Pakistan, so we should sell. Tomorrow China can do the if. Don't say anything with if.
Okay,
Today is what has been done.
Samir,
if you can add anything in life. So
Samir,
may I just tell you a joke before I go?
Yeah.
So one guy asked another guy, how are you feeling? He said, I'm good. He said, what if a truck hits you? Then he said, I will not be good. So if you can add anything in life to be circumspect.
Samir, 30 seconds, where will that money go? Where will people send their money, you think? Cars, flying, foreign vacations, this 1 lakh crore, where will it go, you think?
Oh, 1 lakh crore. No, I think some of it will go into savings, say 20%. But before that, there was nothing negative on financials, and in fact, maybe positive, independent of this US issues now, that you would have had an interest rate cut or liquidity. There was nothing done wrong to IT guys, but those stocks fell to 2%. So I'm saying generally, the good thing about this budget was that nobody was harmed in the making of this budget. Like we say in a movie, that no animal was harmed in the making of this film. Nobody was harmed and some were benefited. So that's okay.
Well, Samir, we are going to remember this because it's not very often.
1 minute. He's not answered the question. Where will this money go, Samir?
So I'm saying,
three sectors.
No, it could go. See, it's a little bit of an upper end benefit. So it has to go into things which are not so very basic also. Because you will say that the guys up to 10 lakh or anyway, or 8 lakh or anyway not paying or paying very little. So the benefit is a little bit upper middle, whatever you want to call it. So it has to be travel. It has to be savings. It has to be these car consumer durable types. As I said, we are not buying those, but they could. But we are not going to, for this basis, buy some soap and shampoo maker as if they were, waiting for this.
All right, fair enough. Samir, thank you very much for joining us. Great speaking with you, as always. And, come back again, because this tariff thing will continue and there'll be lots of headlines.
Just one point, guys, I wanted to make with regard to this capex. We're all talking about the capex spend. It's been increased only by 10%, right? But if you look at the inclusive number, that's including the state as well.
PSU capex, yes.
CLSA has pointed this out in their note that actually for this year, if you take the inclusive number, then it's a 19% growth in comparison to last year. Last year it was around 15%.
No, I know, as I said, but the point is, it's like shifting the goalpost. I mean, still now we are saying, look at the state. Now you're saying, look at 8%. I understand that I like, and I think Shireen asked that question to the secretaries as well, and they said, well, there's no shift away from focus. But the point is, if you look at the number they've been talking about for the last many years, there is a clear sense, and I think, they've assumed, as I said, some 14% income tax growth.
Yeah.
And you said they are assuming very buoyant markets.
Indeed.
I mean, it doesn't happen like that. Markets wish and government wishes and the market
income
obliges.
tax number, I think a lot of people have
so
put out
there will be
that
some
14%
slip as far as capex is concerned. And I think that's the reason why we'll need to wait and watch. We'll take a quick commercial break here. We'll come back and we'll just quickly tell you what the lineup is as well over the next 2.5 hours or so. Gautam Duggad is with us of Motilal Oswal. He's coming up in just a bit. We'll talk about budget impact, various sectors, etc. 9 o'clock, you'll hear from Neelkanth Mishra of Axis Bank. And of course, that's the top voice, macros plus markets. 9:15, S. Narain of ICICI Pru AMC joins in to decode the budget. At 9:30, we'll have the management of Indian Hotels. Samir just said travel is one area where people will spend. Then we'll have Rhythm Desai come on of Morgan Stanley. So that's a top equity strategist who comes in. And of course, before the budget, he put that note out saying that keep the faith. This is just one of those phases that we're going through. At 10:15, it's the economy. Lata will be discussing the big numbers and putting the focus there. So we'll have B. Prasanna of ICICI Bank and Kaushik Das of Deutsche Bank come on.
see focus, because these are very critical urban deliverables for health and also for the way we keep our rivers clean. And all the sectors, I was just seeing the numbers and the increases then, whether it's the National Ganga Plan by 13%, River Basin Management increase of 70%, Jal Jeevan Mission by 198%, Swachh Bharat 145% increases. So the success government has had in the implementation of these projects is giving them confidence to be able to spend further, because the absorptive capacity of these sectors has demonstrated that they are able to spend this in a meaningful way, even while we push to be part of that export chain. I just think if I can come in on finance and related areas where there's been some stress, as you well know, in microfinance, and I'm glad to see that that got mentioned in this budget with the Grameen Credit Scores framework for SHG members being looked at, because we really don't want to get into the situation we had many years ago in microfinance, or indeed in personal loans, where the credit data does not allow us to capture multiple loans by the same individual. So focus on that, focus on revamping the KYC registry. These are all going to be helpful in terms of the financial infrastructure that we need to help that growth and consumption. And I think if we can also look at what the advantages on the mergers and acquisitions, FDI and insurance bring, these are significant for those industries specifically and should not be forgotten.
Yes, I think, the tax relief up to
Welcome back. Still deep cuts across most of the Asian markets. By the way, the Chinese PMI numbers also came in. The Kaishan manufacturing PMI slightly lower than estimates, just around the 50 handle. Markets are still down 2.5%. Japan, Hong Kong's trying to cut its losses to an extent. The implied open is telling us that we'll start obviously around 200 points lower, and then let's see what happens from there. There are, of course, lots of stocks to track as well on the back of budget-related news flow and other company developments, and of course, auto sales that have been trickling in. So let's straight away get to our team. We have actually Sudarshan joining in first up. We had some numbers come in from the two-wheeler guys, I think, Sudarshan, on Sunday. Tell us more.
So I have two companies that have reported numbers post-budget announcements, and one is Eicher Motors, which continues to report a strong set of numbers. For the month of January, it has reported numbers more than 91,000 units, and it was much above our estimate, and that was above 4%. So total sales have come at 91,132 units versus estimates of 87,005 units, and all the segments have seen a double-digit growth. Bike up to 350cc capacity has seen a growth of 17%, and more than 350cc capacity has seen a growth of 44%, and exports have seen a growth of 79%. Coming to Eicher Motors, total sales were in line with estimates of 4.42 lakh units, and it's up 2% year-on-year, and that's supported by exports. Domestic sales, though, remain under pressure. It was down 2% at 4.13 lakhs unit. Now, growth was supported by two major markets. The first one is Bangladesh, and second is Colombia. Also, the budget announcements related to rural sentiment boost will be supporting the entry-level segment, and that will be positive for Hero MotoCorp.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's hop across to Vivek. He's here to tell us about this airport tariff paper that's come out. Vivek, tell us more.
Good morning. Well, that's right. What we need to keep in mind is that companies like GMR Airports, that are airport operators, they get a fixed return on the kind of capex that they go ahead and put for generation as well as development of airport facilities and airport infrastructure. Now, this particular tariff is determined for a 5-year period. So what's in the latest update is that the consultation paper has been published for the tariff period between 2024 to 2029. Now, this particular tariff is for the airport of Indira Gandhi International Airport, where the airport operator is GMR Airports. What is the new tariff that has been advocated in this particular consultation paper? It is at 370 rupees per passenger versus the existing rate of close to 143 per passenger. Almost 2.5 times increase is what is being advocated. What is the matter under consultation? A higher regulated base because of the new capex that was undertaken at Delhi, and also the Supreme Court judgment as far as aeronautical taxes are concerned. What is the way forward? Stakeholder comments are invited till 31st March 2025, and the company has said that they expect the tariff order to come through in the next 2 to 3 months. Jefferies has reacted to this particular development. They've cut the target price to 92 rupees from 100 rupees. What they're saying is that the aero tariff proposed at 370 rupees a passenger is actually lower than their estimate of close to 500 rupees per passenger for 2024 to 2025. On the back of that, they believe, while it is slightly negative versus estimates, it believes a significant uncertainty and overhang around the quantum, given the fact that there was quite a lot of delay in the determination of tariff. They've cut their, they estimate FY24 to FY27 EBITDA CAGR of 25% now, versus the 30% that they were earlier pegging in. But overall, a positive development and an important development as far as GMR Airports is concerned.
All right, Vivek, thank you very much for that. So keep an eye on that one. Commodities in focus. I think Canadian imports into energy imports into US now tariffed 10% more. Manisha, what's happening? What's top of mind?
Oh, well, yeah, absolutely. Prashant, I'll quickly take you through commodities. Crude, for one, has snapped 2 weeks of losses. We are looking at 1.5% of gain in crude oil prices. After these tariffs coming in, well, there is crude oil disruption concerns as energy products from Canada are tariffed at 10% duty, not 25%. But Mexican energy is to be charged at 25%. And U.S. does import a huge quantity from both of these countries. So we have seen that premium come back in case of crude oil prices. In gold, we are trading very close to all-time highs after this uncertainty and inflation concerns. For base metal prices, well, it's a big arbitrage that the global markets are trading with. You have seen the base metal prices decline on London Metal Exchange and in China, but the U.S. Metal prices are trading at a premium right now. Well, remember that U.S. imports 36% of its copper requirement, 82% of its refined demand in aluminum, and 67% of its zinc requirement. So you are going to be looking at these metals trading very, very volatile until we see this whole tariff war settle down.
All right, Manisha, thanks a lot for that. Well, time to slip into a short break. Up next, as promised, Gautam Durga, Motilal Oswal, is waiting for us. He'll give us his first take about the budget and how is he seeing markets pan out from here on.
Till 12 lakh, that's a very welcoming step, from the finance minister. Yes, it has been the expectation from the industry as well as, our recommendation from FICCI to the government that yes, we should give some relief on tax for the middle class. But yes, we were not expecting, to the level of 12 lakhs. So it's a very welcoming move and certainly it will help the overall consumption. I believe, because this has the potential to bring the money in the hand of the consumers. But yes, it might not happen immediately from next month. I would say maybe, at least we need to wait for another month, another quarter or so before we see the impact of this on the consumption. But apart from this step of the tax reduction, there are many other areas, which has the potential to improve the consumption, the things that she has done for the rural, the agriculture. So it's a very inclusive budget, where again, if the income at the farm level, at the agriculture level increases, so that also has the potential to boost the consumption. These things also, if the consumption increases, it will help in improving the private investment, which we all are talking about, it's not growing or it's not happening as per the expectation. So I think this is a big move and this has the potential to impact in many ways in the economy.
I think the budget has delivered a lot on the operational front, Shireen. I think, you spoke about exports and, the export promotion mission between the Finance Ministry and the Commerce Ministry, as well as the Bharat Trade Net, allowing people, rationalization of rates across TCS and TDS. there are a lot of operational improvements which I think really improve the daily work of an exporter who's meaning to do more and crack open new export markets.
Welcome back. We're continuing our coverage on what this budget, of course, means for stocks and the market as a whole. And now we have with us Gautam Dugar, Head of Research at Motilal Oswal Financial Services. Gautam, good morning. Great to have you on. So you've had a Sunday to now go over the details and, get down to the stock level reaction. And we were just looking at some of the, the top picks in the portfolio. Obviously, lots of consumer names out there. We'll put that up in just a minute. There's Trent, there's Titan, which has been one of your long-standing favorites. There is M&M, Maruti. So just run us through the thought process. What is the allocation shift in favor of consumers?
Good morning, Subhi. Thanks for having me. So yes, on balance, I think it was a pretty decent budget print. Numbers are quite believable as they've been for the last 4-5 years for this government's budgets. Second, without impacting the fiscal consolidation territory, they've shifted the scales away from consumption, capex towards consumption. If you look at the percentage numbers between FY21 to 24, the capex compounding was 31% in terms of allocation, but the next 2 years now is about 9%. As far as the actionable portfolio-related changes are concerned, I think there is going to be a imminent shift from consumption to capex. Reverse capex consumption. Yeah. Now, what has happened is if you look at the portfolios of the top domestic funds, which are public, you would notice that most of the top 20-25 mutual funds in India, as of their last disclosed portfolio, are overweight on industrials. And almost 80% of the domestic institutions are underweight on consumption. So there is definitely going to be some realignment which will happen. Of course, people will not immediately move from underweight to overweight, but more closer towards equal weight and slight reduction or trimming in the capex portfolio. Second, generally what market does is the multiples change first and numbers follow later. So capex multiples have already corrected if you look at the last 3 months of the capex stocks behavior. Even big names are down 30-40% now. So large part of multiple contraction is already underway. Some more can happen. And then numbers actually will continue to remain strong. This quarter has been very strong for capital good companies in terms of earnings growth. Maybe it will continue for a quarter or two. But what market will start factoring in is the reduction in the order book growth, say in the second half onwards for FY26. And that's why you will see multiple contraction happening ahead of that. And I think the exact reverse can happen in consumption names. The consumer companies' numbers have been absolutely weak. This quarter, there is actually a decline in earnings for consumer companies. Very rarely you see consumer companies post a cumulative earnings decline. So that is happening right now in third quarter. I think the earnings can continue to remain weak for a quarter or two. But the multiples have been derated over the last 3-4 years for staple names, basically, not for discretionary names. Now that reversal can happen, and numbers, again, as I said, for capex can follow after 2 quarters in terms of moderation. For consumption, it can accelerate after 2-3 quarters. But typically in consumer staple companies, you see growth averaging somewhere close to 10-15%. Volume growth is a more important number.
So
as
Gautam,
far as we are concerned,
Gautam, just to complete that point, this is exactly what I was trying to ask Samir Arora, who was with us a couple of minutes back, that as this shift plays out from capex back to consumer stocks, what sort of a multiple re-rating and a multiple expansion would you expect from where these stocks are? I mean, let's say if you're talking staples from the mid 50s or so, can they go back to 75 plus 80 times forward earnings? Where would you expect the maximum delta in multiple expansion? Durables, jewelry stocks, staples, travel and tourism, hotel stocks, where will it come?
So Surabhi, it's very difficult to pinpoint a number specifically because consumption again is a very, very diverse ocean, right? There definitely is going to be some re-rating in staple companies because that is where the maximum de-rating has happened in the last 4 years. If you look back at the multiple of Hindustan Unilever, I'm just taking that as a representative because it's a bellwether consumer stock for staples. The multiple used to hover around 70 times in 2020. Now it is somewhere close to 48-50 times.
Exactly.
So can there be some re-rating there? Definitely. But the number delta, and I think the earnings delta is far more important than just the valuation multiple delta. And I think that delta will play out more in non-staple stock. So see, look, the total bounty is 1 lakh crore. Some of that will definitely get saved. There are various estimates, 20, 30%. And some of it will definitely be used to deleverage the household income balance sheets, because that's where we've seen some strain in the last 2 years. So then if you work out the number, you roughly reach a number of 50, 60,000 crores, which is left for consumption. Of course, it will have some multiplier effect and all, but that will take longer time to play out. In the interim, you will see discretionaries benefiting much faster, much in a much bigger quantum than just pure staples, because the category of the taxpayers which is getting this benefit are not bottom of the pyramid, absolute bottom of the pyramid, they're middle class, right? Where the staples had not gone down completely in terms of consumption. The staples decline that you've seen over the last 3-4 years was manifested more in very low income households. So we think retail, some bit of auto, consumer durables, jewelry, hotels, those are the companies where you might see probably slightly better, performance. And that's why in our model portfolio, we're still underweight on staples. Maybe we will also realign a little bit of a weight within the consumption pack. But at the moment, we are heavily overweight on discretionary or staples.
Yeah, got it. It's pretty much in sync with what Samir also just told us, that the discretionary consumption, that's where the bigger boost will come.
And Trent has provided a good entry opportunity, right, Gautam, as per y'all?
Yeah, I mean, see, Trent has had a very fabulous last 3-4 years in terms of both earnings and stock price performance. I remember in April 2022, when we upgraded the stock at 1,200 rupees, the valuations were not cheap. And since then, they've become even more expensive. As you rightly said, the stock has corrected somewhere close to 25-30%, which is, by the way, broadly in line with what most of the other discretionary stocks have also corrected recently. But the earnings growth in Trent is at least 2x to 3x of rest of the peers in the same segment, both on top line and bottom line. And top line delta is far, far bigger, because in bottom line, you can still manage margin, play around with the cost. But top line being 30-40% versus 15% or 10% of the rest of the companies in the same category essentially means that your execution on the ground is far, far superior to your contemporaries. So I think, therefore, they get that multiple that they're getting right now. And we think the growth can continue for a couple of more years, because all their subsegments are firing very well.
Gautam, also wanted to ask you about a couple of other names. You know, one stock that was notably strong, which had corrected, getting to the budget, was Angel One. That stock, I think, on budget day was up close to around 5% or thereabouts. From the capital marketplace, that's your top bet?
Yes, along with a few other names, Nigel, as you said, we right now currently have a very vast coverage on capital market. We cover every single listed capital market play. So our bets are on BSE, Angel, and HDFC AMC. Basically, we are trying to play the whole spectrum of the capital market story out there through exchange, through asset management company, as well as a broker. Now, to particular point, in Angel, stock is down somewhere about 35% from the top of last year's January 2024 price. Multiples have also corrected. There have been a lot of changes in regulations that we are all aware of. There is roughly a 20% impact on their earnings, but the stock has corrected 35-40%. And therefore, the multiples as we speak now are somewhere closer to 15-16 times, with ROEs upwards of 25%. It's a very pure play, digital market play. So we continue to like the name, and we still have it in our model portfolio.
Right, no, absolutely. Gautam, if infra has to derate and consumption has to re-rate, right? First of all, do you think it will happen? It's going to be painful, isn't it, for portfolios? Because point is, as they say, if you have to panic and sell, you must sell early. Stocks are already down. Now everyone is waiting for, chalo, let's hold, we'll see, it'll come back. And now this government is saying focus on consumption, not on infra in terms of spending. So it'll be a tricky and painful for portfolios, for money managers, isn't it?
Yeah, absolutely. It's not going to be easy. You don't just wake up one day and change 20% of your portfolio. Because for all said and done, consumption is somewhere close to 15% of the portfolios, and industrial somewhere about 5-6%. I'm talking about a very broad top-down level. Of course, individual portfolios are very different weights. So you don't just wake up in the morning and change 20% of your portfolio. It's going to take some time. And it's of course going to be painful because everyone else is trying to do the same thing. So, right, if you were lucky and you would realign your portfolio a few months back, that's a very different thing. But what has happened, Prashant, also is a lot of time the portfolio changes also involve a non-tangible element. Like, you play on the psychology, because when most of your peers are going to do that, and you're also thinking that has the government changed this view just for 1 year, or is this going to continue for next 2-3 years again? If that were the case, then of course the capex multiples will take a long time to re-rate back to the levels where they were trading at till about 6 months back. So therefore, it's a call you have to make, that do you sell into the bonds, which will definitely happen at some point of time. Because if you look at the data, the December month capex data of government is very strong. If that continues for Jan, Feb, March, and if there is some rebound in stocks possible, that lot of realignment again can happen into that strength. But that's like speaking in terms of too short-term of behavior. Broader point is, if the government is changing its focus, I'm not saying that they're defocusing on capex, but the 30% growth that we have seen for FY21 to 24 is now veering around to 10-12%. And of course, there is an element of execution as well.
Sure.
You cannot just look at more and more, because the underlying state governments, the rest of the government apparatus has to also be able to spend and execute
Absolutely.
on that.
And they're waiting for the private sector to do it as well. Sorry, Gautam, we're very short on time. 10 seconds. Top 3 consumer discretionary stocks that you would have a buy on. Top 3 consumer discretionary stocks. Just the names.
So we've just spoken about it. Actually, it's Trent, Indian Hotel,
Indian
and
Hotels.
Titan. Yeah.
And sorry, the third one?
Titan. So all 3 are part of our model portfolio, just from a point of view of disclosures.
All right, Gautam, thank you very much for joining us. Great speaking with you. It'll be interesting to track this and how it plays out over the next many weeks, and we'll come back to you. We take a break, we're back, and we'll get you some trading ideas as well. So our experts will be with us on the other side. We'll have Mitesh Thakkar join us, and we'll have Sudarshan Sukani as well. So that's coming up in just 2 minutes.
Including the announcement by the FM on the fact that, on transfer pricing, you don't keep provisional assessments open for beyond 3 years. I think these are very major steps in relieving the lives of a daily businessman from very many hassles that he has to undergo today. I think there's a huge focus on manufacturing. I think, as Anand said earlier, the focus on the nuclear sector is, apart from the labor-intensive sectors that you spoke about, the focus on the nuclear energy is big. I'd like to also draw your attention to the focus on the shipbuilding and the shipping sector. Extending the tonnage tax relief to inland ships is a big benefit, as they want to focus more on inland water transportation. Focus on import relief for equipment in the shipbuilding sector. Again, I think the marine sector has got huge potential in India. We have just a very small portion of the world trade today as far as ships go, hardly 1 or 2%. And I think the finance minister has focused a lot on that sector.
Very much in line, right? This is following the rhyme and rhythm of previous budgets. I think conservatism is the needed was the buzzword here. The deficit number is very similar to what we thought. 4.8 goes to 4.4. Nominal GDP assumed quite conservatively at 10.1%, to this year is below 10. And the question was, and we had also said that capex to GDP would remain in line with what is achieved this year, and that's panned out as well. Capex is rising in line with nominal GDP.
Three key takeaways for us. One is a demand stimulus that was much needed and very well delivered. Second, a focus on
Welcome back and hope you're having a good morning. Well, as promised, let's get our technical experts on the show. Good morning, Mitesh, as well as Sudarshan, and thanks a lot for joining in. Mitesh, you go first. We had this range-bound sort of day on budget day, and we ended more or less flattish after moving quite a lot intraday. Your take on the Nifty from here on? Where does support lie? Where's the resistance? And what would your trade be?
Good morning, Alan. So first thing on the upside, I'll start with that because the high which you made on Saturday was 23,630. And that's an area where a couple of modified moving averages are placed, and they've turned flat, indicating one, lack of volatility. Two, I think the declining trend might be over. So despite the fact that we'll open gap down today, I expect more of a sideways kind of a consolidation. The first level to watch out on the downside is 23,350. If that holds, and we might open about around those levels. So if 23,350 holds, then we'll do a range of 23,350 to about 23,630. In case we start breaking below that, then I think we might have a maximum downside of 23,000 to about 22,800, which will be retest of the earlier. So doesn't look like a market which will go into a bigger fall. But yeah, I think with the global events and the way GIFT Nifty is indicating, we might see a gap down. But in case, as I said, I think the first thing is that if we hold or if we don't show strength to break below 23,350, then I think it's a market which I would want to buy into.
All right. Okay. Got that. Mitesh and Sudarshan, good morning. Thanks very much for being here. Sudarshan, what would you do? I mean, budget day morning, you were saying stay out of the way, right? And I came to you by saying, well, on budget days, even if you're right, you can be wrong, and vice versa. And it was a big move up and down, really inconclusive. This morning, it's more conclusive, and it's on the way down. What levels and what's the trade?
Yeah, good morning. And you're quite right. And that was the trade, not to do anything and just enjoy the budget. See, what has happened is that we've had one leg of the up move from 22,800 to, let's say, 23,600. That's 800 points. That's a decent up move. Now, the chances are that the markets will have a correction of some kind of this up move. That correction will have two different aspects. First is a normal correction. And the second is, we made a low of 22,800. Was this a bear market rally, or is this a real thing that's beginning? That we will find out when the market tries to go down near 22,800, the final low. If that low holds, then we have a big message, and that message will be that the bull market has resumed its journey. This process will take many days. It's not going to happen in 1 hour. But the view is for today, I don't think there's a trade in the Nifty. We really want to find out what are the lows at which the Nifty finds support. I can't give you a number. The market will decide that. Till then, it's best to focus on stocks and step aside.
So you're stepping aside from the index, Sudarshan, but what about individual stocks?
Well, it's a mix of sell and buys. SBI Life is an intraday short, stop above 1485. Angel One is an intraday short, stop above 2550. Crompton is a buy. That is a buy on dips. It's gone through a decent correction. Buy with a stop under 360. And M&M Finance is making a very attractive pattern on the upside. So it's a positional buy. Don't expect some drama in a day or two, but it's worth buying and holding on to. Stop under 255.
Got it. Sudarshan, thanks very much for that. Mitesh, let's come to you. Good morning. Your stock picks for the day.
Good morning, Subi. So I have a mix of buys and sell calls. On the buying side is Eicher Motors, made a fresh high, all-time high, and the chart pattern looks very strong. So in case you get a morning dip around 53.60, buy here with a stop at 52.90. 5500 is my first target, and a buy on Indigo with a stop at 44.25 for targets of 46.20. And on the selling side is HCL Tech with a stop at 17.11 for targets of 16.60, 16.55. And Gujarat Gas, that's a sell with a stop at 4.67 for targets of 4.41.
All right. Come back to you, gentlemen, soon with more questions. Thank you for joining us at this point. There's 3 minutes to go for the pre-open session to kick off. We're back in just a bit.
Into the manufacturing hub of the world. The focus on ease of doing business, on enabling capital goods to be imported at lower rates, and importantly, addressing the duty inversion that we've seen. These are all things that will help make in India in a much more significant way. And the third is inclusive development, which is also something that is important for us as an economy. So on balance, a very good budget. The capex from a government standpoint stays on course, which is something that we ideally would have liked. And the fiscal discipline stays on course as well.
overall, it is positive for the market. As Madhu just pointed out, the most important thing to me is that there's a genuine intent and effort. It comes through very clearly to increase the ease of doing business. So it's directionally very positive. There's no material negative, snippets and negative, and there are hardly any on the negative side. Whereas on the ease of doing business, the underlying spirit of the budget is to simplify rather than to complicate things, which is often the problem with budgetary speeches.
I think we are missing the point on the number of new opportunities in terms of increasing the limit for both micro enterprises as well as small enterprises. I think a lot of microfinance companies and unsecured lending, stroke even secured lending businesses with small ticket loans have gone through an immense amount of stress in the last 6 months. You can see the delinquencies, you can see the challenges in collection, and therefore you can see that several companies are either reeling under pressure if they're listed, or many that had filed for DRHP are not getting listed because of the environment. Increase of limits over there and providing insurance on a larger base, I think is
Okay, welcome back. I think we got the first pre-open rates, etc., coming through, which we'll let them settle and come back and look at the prices in a bit. But let me welcome in Neelkant Mishra, Chief Economist at Axis Bank and Head of Global Research at Axis Capital, who's now with us. Neelkant, of course, is the number one voice that people sort of look to after the budget, and he's with us. So we're very pleased. Neelkant, good morning. Great to have you with us here. Thank you very much. There's so much to discuss. Let's keep it, sharp and pointed. First up, is the interpretation that the government is moving away from infra and focusing on consumption correct? Because it's got implications for markets as such. Go on. You're on mute, Neelkant. You'll have to unmute yourself, please.
Yes, we can hear you.
We can.
Okay, sorry about that. So I disagree with that because the limitations on how much the government can do on capex was clear even last year. Remember that out of the 11.1 lakh crores, 9 lakh crores was stuff that the government could control. There was 2.1 lakh crores that they had no control over. So we are hitting the limits on what the government can directly do in terms of capex, and therefore the guidance from the government was that we will maintain capex as a percentage of GDP year onwards, that the scope for us to do more is now gone. So now they're experimenting with, for example, this 1 lakh crore that they've decided to spend on urban infrastructure, but through a competition mode, so the states need to compete for it. They have to find such avenues so that capex continues, but there is very little more they can do at the central level. So I don't think this is a stepping away from capex.
Absolutely. Neelkant, in fact, if you could just elaborate on that point, another sort of, statement that's been doing the rounds, or calculation or thought process that's doing the rounds, is that if you add up capex from the states and the capex that will be done via PSUs, and maybe we're still talking about 20% growth, almost 19 to 20% growth, and not the 10%, which is direct capex, which is in line with nominal GDP. So how would you read into this, the form and format that capex will take from here on?
No, I think those are also very interesting points, but we need to take a step back here and figure out that if gross fixed capital formation as a percentage of GDP in India is 32%, and the central government spending is about 3.7%, or say 3.5%, 3.4%, how much more can it actually contribute? So this is effectively less than 10% of overall investment to GDP in the country. Investment activity in the country is going to be a lot more dependent on how well the real estate cycle turns, how well the power generation cycle turns. And I think this almost obsession with waiting for the government to spend an extra 30,000-40,000 crores, in the larger scheme of things, these are all rounding errors. Remember that the fiscal space for the government was very limited. In fact, in the preview session that we had in your studios, we had discussed this, that, all said and done, there is only about 1 lakh crores, which is less than 0.3% of GDP in FY26, is that the government has discretion on. I think it is unwise to expect the government to be doing everything. And I don't think it needs to be doing everything. If the real estate cycle turns, if the power generation cycle turns, and both seem to be turning, we will not be dependent on the government to drive up, say, the industrial stocks or the earnings for industrial companies.
Hi, Neelkant. Good morning and good to see you. And you're sounding pretty satisfied with regard to what the government has done on the capex spend front. But what about the approach to markets? How would you alter the approach to markets given the consumption push? They've maintained capex reasonably, but we also have this threat coming in from Trump's tariffs. So your take on the equity markets from here on post the recent correction?
Absolutely. I was waiting for someone to say that. So the budget is now in history, right? Budget was largely as expected. There was a 1 lakh crore of tax cut for the middle class. But remember that the government is still shrinking its fiscal deficit. And therefore, the aggregate impact or the demand on aggregate impact on aggregate demand is actually still negative. The Trump tariffs, on the other hand, are going to be, they have triggered something which is very substantial. See, normal wars, especially if they are being fought in other jurisdictions, can actually be accretive to earnings, and sometimes they support stock markets. Here, there are political objectives being met through economic damage. So knowing fully well that this will hurt the US economy, and that if there is retaliatory action, it will hurt many parts of the economy. And on top of that, to potentially escalate it to Europe and other parts, I think all of this creates significant uncertainty for the economic forecast. And that, I think, is terrible for markets. So over and above what is happening with the DXY, over and above the 0.8 to 1.5% seems to be the first cut impact on US GDP because of the decisions announced. The reason why the markets are not reacting even stronger is that everyone expects that this is temporary and will be withdrawn. But this adds a very different layer of uncertainty to economic forecast.
All right. And I'm sorry, we'll be sort of jumping here and there, but allow me to jump back for 1 minute. So focus away from info. That's wrong interpretation you said. But you would agree there is focus on consumption now, right? That you would agree with, Neelkant? And this is after some time putting more money in. And it's not just 1 lakh crore. It's not one time, right? It's recurring. And there is a broader, I don't know whether there's messaging or it's kind of, it had to be done. The move itself is one time, and whether we'll see more moves, etc. So from stock market point of view, consumption, where will this money go according to you? And is there anything investors can do based off this?
Yeah, so that is somewhat easier to quantify. So if you look at the number of people who disclosed income to taxpayers, see if you're earning that much but you're not paying tax anywhere, you're not impacted. So we have to look at the people who pay taxes, so that this eases our job. The biggest impact is for people disclosing earnings between 12 lakhs and 50 lakhs. The number of people affected, because the last data we have is for FY23, was about 58 lakhs. If you extrapolate it to say FY26, maybe about 75 lakh. That's the number of people who will be the biggest beneficiaries of these tax cuts. And most of these people would be in the 90-95 percentile, maybe even higher. The higher ones, maybe the percentage impact will be lower. What is their discretion? What is their incremental demand going to look like? And that's mostly going to be discretionary. So I think that the impact of this directly will be mostly on the discretionary items. So jewelry, retail, and somewhat, the market has responding rightly to this on Saturday, cars, two-wheelers, etc. So at an aggregate demand level, remember that the deficit is still shrinking. So, and a large part of the space that is being created for these tax cuts are actually also coming from personal income taxes. Absolutely. So whatever you are seeing in terms of better compliance, more people disclosing higher incomes, is now the government has decided to take some bit of that and give it to what was becoming the pillar. So if you compare India's central government's fiscal math, FY19 to FY26, over 7 years, the government has so far seen a very sharp increase in personal income tax to GDP, A large part of that has actually gone into increasing capex because primary deficits are more or less back to where they were in FY19. And so going forward, if you have another lakh crores and there is no ability to spend it directly on the on the issues that you can control, on the areas that you can control as a central government, then you might as well give it back to the taxpayer, which was actually funding a lot of this capex. So that seems to be the political economy equilibrium. I would expect direct impact on the segments which are affected by this, but overall, the questions on whether this increases inflation, whether this increases the current account, I don't think there will be any impact.
So, Neelkant, and the next question is that do you expect this to be a recurring and long-lasting kind of impact, which means that, it is the capex, it is the consumption side of the economy that suddenly gets turbocharged? Because I'm trying to understand from a portfolio shift point of view, what immediately happened on Saturdays, immediate herd mentality, right? Everybody is rushing to consumption, trying to sell out of capex. Now, do you see that only as a short-term market trade, market move, or do you think this will lead to structural shift in portfolio, especially for long-only funds, bigger institutional investors, where they need to now unload on capex a bit and go back to consumption, because you see that is as a medium-term 2-3 year cycle, perhaps?
Look, 1 lakh crore, which is less than 0.3% of GDP, being shifted or to tax cut should not drive a change in portfolios. I think that we have to keep in mind that, one, the impact of this can potentially be higher. So some amount of this will be saved. Remember that this is the segment which also provides a lot of financial saving. But the likelihood of, say, buying a car on EMIs, using this to buy an apartment, a bigger apartment, and therefore pushing up the real estate cycle, and that then driving another investment activity. So I think there are many ways in which this can be spent, and it would be quite myopic to actually limit it to just saying, oh, let's buy all consumption stocks. Frankly, there are other parts of the economy which are also likely to get affected. And I don't think this necessarily swings the government towards more profligacy, or this is a sign that the government is starting to become more profligate. I think what the government has signaled through the medium-term debt to GDP paths that it has disclosed, it shows that if the year is looking good, if tax to GDP is looking good, they may consolidate by 10-12 basis points going forward. If things are looking bad, they may even raise the deficit by 10 basis points. But they are continuing to focus on fiscal discipline and also acknowledging that there is a very limited space that they have. So I think extrapolating this to mean that the whole economy shapes up because of 0.3% of GDP moving this way or that would be very unwise. So I would recommend that we remain focused on because this is going to be an investment-driven recovery. Okay. The way you drive growth going forward, the only way to do that is to accelerate credit growth. If credit growth has slowed from 17 to 11, somehow getting it back to 14, 15% by using all the monetary tools available, macroprudential tools available. Those will be the channels through which growth happens. And therefore, if I was thinking 6-12 months out, those would be the areas I would focus on.
That's fantastic nuance. Excellent points, Neelkant. Nigel?
Well, Neelkant, I'm in the mood to look ahead. So the budget we have discussed, it appears it's pretty satisfactory for you. Trump's tariffs could add an element of uncertainty, and for the time being, maybe the markets are ignoring that just for the time being, hoping that things don't get too bad. But let's talk about the RBI. That's the next big cue for the markets as well as for the economy. What are your expectations from the RBI? In this uncertain backdrop, you have the rupee that suddenly moved to around 87 odd. It's showing some kind of weakness. Your take, expectations from the RBI?
So, I think the RBI's job is unenviable. There is significant volatility in global financial markets, and I think that will only intensify because now that once you've fired a salvo, it will be very hard for the US to backtrack. And if their closest allies in the NATO or in NAFTA, basically Mexico and Canada, they also retaliate, and they're threatening to retaliate. It actually emboldens everyone else that the US goes after this to actually do the same. So I think the economic uncertainty has just gone up dramatically. The US dollar appreciating, because that's a classic response when there is de-risking. everyone jumps back into the US dollar, makes it much harder for the central bank. But let's look at what they should be doing. I think it is very important to inject back the durable liquidity that they took out, or they were forced to take out because of the FX intervention. So if there is, give or take 5 trillion rupees, 5 lakh crores that was sucked out because they had to sell dollars, at least that amount of liquidity has to be injected in one form or the other. They have started strongly with about 1 lakh crores last Monday. I think more needs to be done. Second, there needs to be maybe some moral suasion, maybe some backing off on, say, the restrictions on the credit deposit ratio, maybe even changing the macroprudential risk weights to target credit towards areas which are relatively safer today, like real estate. So these are areas where that RBI can and perhaps is likely to act.
All right, Neelkant, lovely conversation, lots of perspective. As always, thank you very much for joining us here on CNBC TV18 and wishing you all the best of luck. Well, I think we've got the market rates coming up in just a couple of seconds from now. And we'll look at the indices and then we'll go into stocks. 160 lower on the Nifty in the pre-open, 23,300. So what do we have? First, rates are up, so about 190 lower on the Nifty on the index, and the Sensex, of course, is lower. I think we'll just refresh this because we'll just have the rates come up. 200 points now lower on the Nifty is what we have. Okay, let me just quickly look at the large sort of indices and stocks, etc., and how they're starting. I mean, Hindalco, BEL, L&T, Tata Motors, BPCL, Coal India, these are the 2% kind of cuts which are coming at this stage. Maruti is up 3%, it's the top gainer, but there is Titan, Eicher, Nestle, etc., which are up as well. But very few stocks, about 5 names out of the 50 names are higher. And I think we should be able to put up the heat map now as well. So 200 lower on the Nifty to begin the day. Surabhi.
Well, the Indian market's showing a fair amount of resilience in the backdrop of the whole global sell-off. Talking about the Nifty, the losers right now include Hindalco, BEL, L&T. There is Tata Steel also slightly lower, Tata Motors, BPCL. So it's across the board really. Trends are hard to find. But yes, you can say some of the more global-facing names, for instance, metal stocks, they're coming under more pressure. And there is some continued selling in the CapEx names at this point in time. L&T, for instance, down about 1.5%. Maruti, Eicher, Titan, Nestle. This is exactly the commentary you've been hearing over the last 1 hour. The market expects, at least in the near term, discretionary CapEx companies and stocks to do better. And that's where the buyers are gravitating. Let's see how it plays out. ITC, Lever are absolutely at the flat line. Let's check some of the bigger banks. HDFC Bank, down about 1.5%. Bank Nifty itself is down about 1.2%. ICICI Bank is also lower, about 1% lower, and SBI also 1% lower. So, little cautious, but let's see if we can kind of recover from the lows.
Well, the Nifty Bank is at a very, very crucial mark. It's moved to the 20 DMA, and as we speak, is just flirting with that 20 DMA. So that's the very, very important mark that we're talking about for the Nifty Bank. Keep an eye out on that. Stocks that are moving around. Oncology-focused hospital chain, Healthcare Global, that's up close to around 5%. So good up move is what we're seeing on that one. KPI Green, from the top, the stock had corrected close to around 50%. The last few sessions, it's been moving from circuit to circuit. Commissioning of units is what we've seen now there. So that stock, in fact, is up close to around 5% as we speak. On the flip side, you have Dreamfolks. That stock is open, gap down. So keep an eye out on that one. Blue Star as well is down close to around 5%. Volumes as well fairly large for the first couple of minutes. Persistent Systems, that's another stock that's lower in today's trading session. So just keep an eye out on that one. And Zensar, I recall that stock, in fact, it went up big time on budget day. I think it was up 7-8%. And last week itself, it had a very, very good run. But Zensar today is giving up some part of the weight that it's put up. A few more stocks to note. RVNL, some of those railway-related plays, that stock is a little bit lower. IRFC as well is down close to around 3%. And I think the oil marketing companies, you had HPCL, IOC as well as BPCL, all of them pulling back a little bit in, quite a bit actually in the pre-open. And that's what the rate stats are as well.
Absolutely. And 200 points lower on the Nifty is what we have. We are at 23,256. So lots of stock-specific moves. It's early, but declines to advances is 6:1. 6 down for 1 up. That's essentially the tally that we are looking at. Well, let's welcome in our market master of the day, is one of the largest fund managers and equity side in India. S. Naren, Executive Director and Chief Investment Officer at ICICI Prudential AMC, is joining in. Naren, it's a great day to have you with us here on the program. Thank you very much. Great day not for the market, but important day, let me rephrase. Naren, how are things set up according to you? The budget, what were the two big sharp points that you took away from it? There's this tariff bit. Expectation is it'll blow over. It's not permanent. And of course, there's monetary policy ahead. Where does all of this leave markets?
No, clearly it was a budget which was focused on consumption for the middle class, and they gave money to the middle class. Whether they'll choose to save it, repay loans, or consume, this is the question for which we don't have the answer. But having said that, that is what the budget is about. And of course, today it has been taken over by what has happened in US on Saturday night. So we have a situation where the budget is no longer the central piece at this point of time. It has been taken over by that. But that's where we are. But having said that, this was needed because over the last 3 to 4 years, we have had a situation where the infrastructure and capex side of the economy has done very well, but the consumption side of the economy had not done well. So, as contrarians, we have always believed that, you will always have these cycles, and therefore the consumption side of the economy had to do better, and the budget gave that shift. So it's a very positive budget from that point of view, and it is the right thing to do at this point of time.
Naren, we had Neelkant earlier, who you know well. And I asked him whether the messaging from the government is shifting away, taking the pedal off infrastructure spending, because maybe that's all. I mean, the government can only do that much, the central government. Definitely it is focusing on consumption. As a money manager, Naren, what does it mean for portfolios, you think? You think there will be a difficult shift away out of these infra kind of names to consumption names? You've complained about the very high valuations, infra, capex, etc. kind of stocks have traded at.
Yeah, actually, for us, it was very logical that, for example, there was a time when we used to complain about very high valuations, consumer stocks. And for a change, we do have consumer stocks in our value fund, for example. So I would say that, this kind of shift was very logical on the part of the government. And so we don't complain. And I don't think it's a total shift away. It is just that you have to always, I think both the government and the regulators have to keep on doing things to help the areas which are not doing well, and actually to not give further support to the areas which are doing too well. I think that is the role of the government and the regulator, and that's what they've been doing. Last year, for example, the regulator actually slowed down personal loans. That was again a very good step. So I believe these kind of steps have to be done on a continuing basis. And as fund managers of public money, we also have to be very cautious in sectors where things are very costly. So we have been cautious on small and mid cap. And we have been more positive on sectors which we used to be very negative on, like consumer staples, etc. So I think that's the way things should be. And that's the way I think long-term money is made, actually.
So, Naren, hi, great to have you with us this morning. So this is exactly what we were sort of discussing with Neelkant as well. The question is now, what is the change in the portfolio? And I'm not talking about short, tactical trades here and there. I'm talking about someone who's looking at least a 1-year portfolio, 2-year portfolio. Would you recommend that that person cuts down on capex a little bit and loads up on consumption, discretionary consumption? Or no, because you yourself are saying that it's not like the government is taking the focus totally away from capex. From a portfolio stance, 1 to 2 year view, what is the kind of directional change that you would recommend, if any?
See, I think from a portfolio stance, what we've been saying is it is actually small and mid cap, which is really very costly. And that is the area where over the last 1 year, we've been advocating people that they have to be cautious. So we closed our small and mid cap for lump sum investment as a result. And that is the area where I would say that even today, after the correction, valuations are still much higher than large caps. So that is the area where we would be even more careful. And I would say across various sectors, small and mid caps have got overvalued. And that is the bigger problem in the market than even large caps across. If you look at large caps, I would say there aren't too many large caps in the infra capital goods space itself, so that for us to actually really think about. And that is where we are being careful. And still, I would say you have to be careful in small and mid caps in various capital goods space or infra space. In all these spaces, you have to still be careful wherever the valuation has gone up too much. But I would say you have to be careful in capital goods, in small and mid caps across sectors.
All right. Hi, Naren. Good morning and good to see you in. And you've been making this point, right? Cautious on the broader markets in comparison to the large cap names. Naren, earlier this morning, we were highlighting a few of those stocks, like the chemical stocks, some of those molecules in the US, that they export out there, that could get a bit of a booster shot because if these tariffs are imposed on China. In that backdrop, I wanted to ask you, what is your contra play you're looking at? Is it chemicals? Is it metals? There's a lot of uncertainty out there. Or is it cement? Some of these sectors haven't done well. So that's why I'm just pointing out a few. But what would be the big contra theme that you're looking at?
See, clearly our contra theme over the last 1 year has been asset allocation because people are just not willing to invest in debt. Clearly, chemicals was one such contra theme also, but it is not a very large sector. But chemicals has done very badly in the last 3 to 4 years. So that it was a contra theme, if you ask me, but not a large sector from that point of view. But our contra theme has been asset allocation because no one was willing to invest in debt. And it was such a trouble to get people to think of even asset allocation and hybrid funds in a big way because people said we'll invest in small cap, we'll invest in micro cap, we'll invest in SME IPO, but we will not invest in asset allocation. So our big contra theme actually was to choose people to invest in asset allocation. And today, as we speak, it's very heartening to note that today many of the hybrid funds that we run have delivered as well returns as many of the small cap and mid cap over the last 1 year, primarily because of the last 1 month. And that's been a happy feeling because most of the time we used to be questioned as to why you are recommending cautious stances all the time. And that has worked luckily in the last 1 month.
Naren, just to come back on consumption, where you've said that you've recently started taking a little more positive stance on the sector. I'm just trying to understand what kind of re-rating or multiple expansion can we expect? Because the other argument is that, how much do you want to pay for, say, 4 or 5% volume growth? I'm talking about consumer staples. So do you see those multiples going back to the heydays of 60 times, 70 times? And again, if I talk about the other end of consumption, where growth is visible, now whether it's Trent or Zomato, these new age consumer stocks, discretionary consumption, jewelry companies, hotels, what is a reasonable level of PE expansion that you would be comfortable with?
This is a complicated question, and this is what we keep debating. Frankly, yet we are not yet in a situation where it's possible for you to actually bet that things will zoom up from here in consumption side. I think because the sectors have got re-rated already in 2-3 days significantly. So, we have to do a fair amount of bottom-up thinking. And I don't think we are in a situation where you can get big returns from the market at this point of time, which is why our recommendation has still been asset allocation over everything, large caps over mid cap and small cap. Clearly avoid SME kind of areas, avoid unlisted kind of areas. This is what we're saying. We're not in a phase where you can make mega returns. That doesn't mean that these stocks are going to fall from here. I don't think that is also true at this point.
Right. What about Naren? Asset allocation has been such a big talking point for you over the last year and a half, maybe 2 years. Gold has done so phenomenally well, Naren.
Yeah.
This is amazing. Almost $3,000. What's your view from here, Naren?
It's impossible to tell people at this point of time when you're doing asset allocation, invest in gold on just like that. Because gold is a phenomenal asset when you see the geopolitical problems at this point of time. That is why multi-asset is the only way in which we can think of gold now, because there's just too much of problems on the geopolitical side. Each country wants to levy duties on other countries. So at that point of time, some investment in gold is okay. from an asset allocation standpoint. But would we like to recommend standalone investing in gold and silver at this point of time? I don't think so. I think that phase is over. That phase of being very positive on gold and silver standalone is over for us in our framework.
Okay, but relative and part of the portfolio basically, right?
Yes,
continues.
exactly.
Naren, I think about a year ago you said for the next 5 years, actually maybe it was 2000, late 22, you said we are entering a period of macro markets for the next 5 years, maybe even longer. Do you still believe that, Naren?
Actually, you see the Saturday night's event, that itself shows that we are in a macro market. And in a macro market, asset allocation works. And that has been our central thesis under which we have been working. And I think we are in a macro market. And it is only good thing is that India's macro is in good position. So we are less volatile than the world because our macro is in good position. That is all that we can say. Otherwise, I would say that we are in a macro market, and if your country's macro is in bad shape, then the volatility will be very high. If India's macro is in good shape, so the volatility is lower in all the asset classes. That's all. That's how I look at it.
At a broad level, Naren, what about global-facing companies? Those are what's the view? We've spoken about consumption, infra, etc., all sort of local-facing. What about the ITs and the pharma and metal mining? Those what's the view there?
See, obviously, IT is a more defensive. IT and pharma are more defensive global-facing companies. They are therefore slightly less volatile. Global-facing, not so defensive sectors like metals, they're going to be very volatile. But if you see over the last decade, they have not done that well. So they've actually got derated over the last decades. You can't say you will never look at them because they, as it is derated over the last decade. So if you're prepared for volatility, they'll be more volatile than the market. But is it bad to consider them for some small investment? May not be. You can consider small investment, but at the same time, they'll be more volatile. IT and pharma will be less volatile, but they are not as cheap as the global cyclical sectors.
All right, Naren, if you could spell it out for us, what should the asset allocation be as of now? I recall in Diwali time, I'd asked you what would your view be on fixed income, and you said it very, very candidly at that point of time. And at that point of time, you were in minority. You said maybe fixed income does better than small and mid caps, and that's the way it's played out. So at current reckoning, what would your asset allocation be? How much of it would be towards equities? And within equities, what would your top bet be?
See, compared to Diwali at this point of time, due to the savage selling done by FIs in large cap, we are clearly more positive on large cap than we have been in September, October, November. And I think the time has come for you to do systematic investing in large cap and systematic transfer plan in large cap, because there's been so much FIs selling in large cap. But small and mid cap, we are still very careful and cautious at this point of time. And gold and silver is no longer an asset class where you can put big money in at this point of time because they've done too well. We are not that positive on dollar. We are not that positive on US NASDAQ at this point of time because those two have done very, very well at this point of time. That is where we are in asset allocation framework.
So, Naren, okay, let's just simplify this to wind up. I mean, if I have 100 additional rupees to invest today, what are you saying? How would you divide it? How much gold? How much equities? How much maybe cash or fixed income?
Such numbers. You can't put such numbers so easily. But I would certainly say consider large cap, consider debt, consider anything else other than NASDAQ, small cap and mid cap. That is all.
Safety first. I think that's the takeaway from this discussion. And just as we wind up, Naren, I mean, on this whole tariff piece, this whole global situation, do you expect this to be a slightly more longer lasting risk? Because some of the experts this morning have been saying that this will probably blow over. This should be a temporary phenomenon. They'll get to the talking table and it should blow over.
I don't consider myself an expert. I didn't know it will come on Saturday night, for example. So I believe that it will come, it will go, it will come, it will go. I think we have to be prepared for volatility, and volatility is good provided you know how to handle it. And that is why we believe in asset allocation, which allows us to play volatility.
I got that. Naren, one sector, usually I don't ask sectors with you, but oil marketing companies, right? Look at HP, BP, IOC, the stocks will all come up. They're all down 6-7%. And the question many investors are asking is, I mean, looks like from what the numbers have been presented, they'll have to bear the LPG burden, the subsidy burden. Any thoughts? Have you looked at that? I mean, that risk is back. It was
anything which falls off a cliff, and companies with good amount of assets and oil marketing companies like that, if you take a view that oil is not going to shoot up, I think those are all sectors which are not that bad after a big correction. That is how we look at things from a contrarian framework. So if a sector has fallen off a cliff, and these are all companies which can't be created in India any longer. So I believe that's why we wouldn't be so negative after a big fall, clearly at this point.
Okay, well, that's the framework, and always contrarian, one of the few true contrarians out there. Thank you very much, Naren. It's a pleasure having you with us here. Thank you for joining us here on the program. Well, markets have recovered, I must say. We're down about 160, which means about 50 odd points off the lowest point of the day. Nigel, that middle class tax cut, will it go into spending on travel and hotels is the question. Right?
Well, even with the high taxes, people were still spending on hotels and travels and luxury. So now maybe more.
Indeed. Before we get to the discussion, I just want to point out the sector of the morning actually is chemicals. Because the markets are down, but just take a look at the chemical companies. Your PI Industries are at the high point of the day. UPL as well is high. I think Aarti Industries was down close to 5%, and that stock is on the verge of moving into the green. And this was a sector that we highlighted at the start of trade. It could be the sector of the day. And the top three factors were there are key molecules that are being exported into the United States. China was a bit of a threat, particularly like for a company like PI Industries on pyrosulfone, that particular molecule, where people are saying that, China's adding capacity, that could be a bit of a risk. Now, that seems to have taken a bit of a back seat. And if you compare the current valuations with the 5-year average, it is at a bit of a discount. So that's why you're seeing some of these stocks that are doing very, very well on very large volumes. UPL, PI Industries, Jubilant and Griva. I think we should pull some of them up for you on the screen. But let's get to talking about the hotel space. In an effort to boost tourism in the country, the finance minister in the budget, the budget speech announced that the government will develop the top 50 tourist sites in partnership with states and also extend the Mudra loans to homestays. To talk about this in detail with regard to these developments, we are joined by Mr. Puneet Chhatwal, the Managing Director and CEO at Indian Hotels. Hi, Puneet. Good morning. Always good to see you in. Well, the infra status has been given to around 50 new tourist hubs. Is it a start? How happy are you about this? And also, if you could tell us, do you know what these 50 places are? And do you have any properties out there?
So good morning, Nigel. Always good to be with all of you on Monday morning, especially. And just listening to Naren, firstly, I have to say we are not suffering from any Saturday night fever. It was quite positive in our hotels. And I would like to believe that this week we will also benefit from hotels and not just from chemicals on a Monday morning.
You're in a mood. Puneet, you're in a mood.
Puneet, Saturday Night Fever, the song is ringing in my ears. John Travolta, doing that dance, and you seem to be in that sort of a mood.
See, that's what I was saying, that even without this 1 lakh crore rupees of extra consumption boost, Puneet's hotels and resorts and, the convention centers, all of them were chock-a-block. But now, to get back to Nigel's questions, now more of it?
More of it. So now, of course, definitely more of it. See, we are going through a positive balance in terms of demand in, outpacing the supply. So that is driving growth in your like-for-like portfolio in the sector. And for companies like us, which are very strong, not like-for-like growth, we are witnessing a good increase on both the top line and the bottom line, and I don't see that changing. Now, over and above that, I would say some of the mention of tourism sector comes up in the budget, and which pleases me a lot. It's definitely a lot more that needs to be done. So let me start with the macroeconomic. The macroeconomic story is good because, as the previous speaker said, if your macros are on the good, then your disposable income, your discretionary spend will stay on the good side. There'll be less volatility. So I think keeping the deficit in check, kind of giving a stimulus to consumption, which means a lot on food and beverage, and especially on our portfolio at the lower end with the Ginger brand, and also incentivizing some of the growth in the new 50 destinations is very good. for those who would want to, take benefit of loans and higher a moratorium period. However, when it comes to the direct recognition, besides the 50 new destinations, I think tourism and hospitality is a very strong beneficiary of the UDAN scheme. It is a big beneficiary of the skilling. It is a big beneficiary of the Mudra loan, especially on the homestay business, and also the ease of travel. Having said all these positives, the one negative is I would have preferred, or two negatives, that the infrastructure status was extended to entire India and not just to 50 destinations. It should not have been taken out at all way back in 2012, which is 12 years ago. Because it is very strongly linked to the UDAN scheme and other investments in the infrastructure. So hopefully we'll get there during the course of this year. And second is marketing India as a destination outside of India. We should have had a significant increase in budget, and that budget has been significantly reduced. So with the foreign tourist arrivals still behind the pre-COVID level, I think it would have sent a very good message, not just from a financial and foreign exchange earning point of view, but also the positioning of the non-economic value, the soft power of India across the globe.
So, okay, let's talk business now that we've understood the bigger backdrop. Puneet, given the demand, and that demand push has only gotten bigger, like you said, right? What is the increase that you think you can undertake in pricing, ARRs, even on the sort of the corporate demand side, conventions?
No, Surbhi, don't ask.
Shareholder question. Shareholders will say there's so much demand, will Puneet drive up prices? By how much?
See, it depends. Actually, first you all have to, align yourself. You want an increase or you don't want an increase?
No, we don't want. Actually, let me rephrase the question. When are you cutting prices?
I think that's what my whole point on infrastructure was. With the change in the landscape, with the addition of facilities like Bharat Mandapam, with the Yashobhumi, with the Geo, there is a lot of demand coming into the capital of India and the commercial capital of India. What we have today gets filled up very quickly and it's not going to change, and that is going to drive the prices only one way, and that is up. With the change in consumption, with so much money coming back into people's pockets, I'm sure a lot of them would want to travel both within India, and unfortunately some might even go outside of India. So I think rate stability and increase in rates is definitely in for the next few years to come, with limited addition in supply, but an increase in demand. And that is good for our sector.
Puneet, I'm a realist, and I know it's painful, and I think, Prashant was trying to wish it away, but I'm a realist. So therefore, I want to hear the truth up front. How much of a price increase over the next 2-3 quarters do you think you'll be able to push through with demand being so buoyant? 10%, 15%, less, more, some range? So we're prepared.
I think anything which is double digit is the right way forward, and that by saying that I'm also being realist, which means 10, 12, 14%, definitely not 20 or 25%. Some destinations will benefit because there is nothing that exists out there. Even now, as we speak, for Mahakumbh, for that shorter duration of time, you could have 25, 50, 100% increase or 500% for a few days of Coldplay. But that's only a few days in a year. So I think the average across India, definitely we are in for a double-digit growth for the next few years to come.
Now when they announce price increases and we ask them why, they say, Surbhi ne pucha tha, Surbhi ne manga tha price increase.
Abhi sach hai, sach ka samna to karna padta hai, like they say.
All right, Puneet, let me ask you this. And you've seen this on social media, it's not new, right? All these posts complaining about, if you want to take a 5-star holiday in India, and if, say, a 5-star holiday overseas, right? Many Southeast Asian destinations, the cost is substantially lower. Don't you think that eventually will start to hurt demand? Just pricing, staying and sort of even going higher from here?
You see, Prashant, markets are, efficient in terms of the correction always takes place if you get totally out of control. I think if you look at the pricing point of view, a lot of other factors have to also balance out in terms of exchange rate for dollar versus rupee, in terms of GST that is levied, we still have a slab of 7,500 rupees plus at 18%. That 7,500 was fixed 7 years ago. So I think there's certain things which are beyond our circle of control. And there the fiscal policy helps. It's the airport taxes, it's the cost of travel, is all kinds of other things. I was talking to somebody very senior, and there are places where we have renewed our contracts. Let's say in Taj Mahal Hotel in Delhi, where we are paying 32.5% as revenue share in terms of lease to the government. So every 100 rupees, going back to you gave an example of 100 rupees where it would be spent, 32.5 goes straight to our landlord, which is a part of the government organization. On top of that, you have GST collection. On top of that, you have income tax from so many employees who are working in the property. So I think taking just one dimension view of just the price is not the right measure, because, and also somehow we tend to only talk about this sector in pricing. I don't think anybody else talks about pricing in any other sector. This I've not understood. Since so many years,
No, I complain equal opinion. I mean, look at these flights, right? But Bombay and the Kumbh, I mean, 45,000 rupee flights, right? I mean, a family of 4 or 5 will spend 2-3 lakh rupees on flight. I mean, people are going, but so I think there's just generally, it's not just hotels. I mean, the airfares also, I think, at least in some sectors, etc., have gone up. But take your point that it is, of course, markets at the end of the day. More supply needs to come, and hopefully with government support in terms of building out some of these destinations, the private sector will also invest, because, I mean, if the basic infrastructure is there, hotels will, tourists will come. You build, they'll come. I think take that point. Nigel, you want to come in?
No, I mean, I just want to ask, something with regard to this infra status that's given. Puneet, could you tell us how will this infra status help in lowering the cost of funds? Give us a brief idea. What is it and how much lower could it get?
Your basically cost of funds, you're able to borrow marginally cheaper up to 100 basis points, and your payment period or repayment period of the loan is extended. So basically that's what it is. And that puts you at par with other sectors. See, way back, as I mentioned, in 2012, a demarcation was made, and projects north of 200 crores and convention centers north of 300 crores were excluded, which I think is wrong, because when you're building such great infrastructure in major metros, you actually need more beds to come in and more hotels to come in. And this being a very capital and labor intensive sector, it would be more aligned with the government. And the same thing on, I know you asked for infra, but I would still like to add international marketing fund for marketing India in various destinations abroad is a positive step over the next 10, 20 years.
All right, Puneet, it's good going for your sector. And obviously, I mean, there is extreme buoyancy in demand as well, plus the government help coming through. So I guess it's, all going in the right direction. Thank you very much for joining us in the conversation today. Great chat. We look forward to talking again very, very soon. By the way, thank you so much. Prashant, did you hear what he said? The revenue that they're sharing with the government on the Taj Man Singh property in Delhi, that's gone up by 30%.
Right.
So to go back to your earlier concern about lesser collections with the government, GST that we're going to pay in the hotels will go up. The revenue collection, the airport hike, again, Delhi airport, the tariff increase, government is earning, it seems like. No problems there.
Absolutely. And, it's more expensive for you and me. Well, 240 points lower on the Nifty is what you have. So basically, there's another round of selling which has happened. There was a 50-60 point recovery. We were down 150. We're down about 240 points now. So almost at the day's low. We'll take a quick commercial break here. You'll hear from the top equity strategists in the country. Ridham Desai of Morgan Stanley will join in to decode the macro and the micros from the budget. But it's not just the budget, right? There's tariffs and more stuff which has happened since. So all of that coming up.
Welcome back. We're continuing the coverage, decoding the impact of Budget 2025 and also looking at markets right now, which are reeling with the other issue, which is the whole tariff situation. Right now, the Nifty is down about 250 points, and we're not that bad off, and markets have kind of tried to hold this ground. Rhythm Desai is our next guest on the show, and of course, their latest note is out. Managing Director and Chief Equity Strategist, India at Morgan Stanley. Rhythm, great to have you on the show. There's so much to talk about: tariffs, budget, capex, consumption. But you know what really caught my eye in that note of yours, that contrary to large pockets of the market, where people are saying go to safety, go to large caps, you are still retaining your bias for small and mid caps, and you still see scope in that side of things. So let's open with that, why you don't think that mid caps and small caps are flashing red.
Hi, thanks, Subi, and great to be on CNBC. So this has to be contextualized. And we have to bear in mind that the news from outside India is not so good. So keep that aside. We'll come back to that subject a little later in this conversation. But the news from India is going to get a whole lot better in the coming weeks. So we've gone through a mid-cycle soft patch, which has, I think, lasted for about 5 or 6 months. It was rather idiosyncratic, led by extreme weather in August, elections in the first quarter, lack of spending by the government, and a little bit of tightness on the monetary side. So all this has assimilated into a slowdown in growth, which hurts SMIDs the most. And of course, at the starting point, the SMID valuations were looking a little extreme, and that correction has happened. I think we are now getting into a phase where growth will surprise to the upside. The budget reaffirms that. I think this is a growth-oriented budget. In fact, the phrase I've used for this budget is that it's a magic budget, and I'll come to that in a moment. And my expectation is that the monetary policy will back this budget, and the monetary policy will also become growth-oriented. So as far as India is concerned and what we control, I think things are looking up. Of course, as I said at the outset, the caveat is what happens in the rest of the world, and we can come back to that conversation. So that's the reason why I think that after this steep correction, now SMIDs are looking better than they have been for almost 7 or 8 months.
Well, Rhythm, you've retained your bullish view, and you've been the outlier bull on India throughout the last 4 or 5 months where we have been going through this correction. And you're saying things are looking up, you're expecting growth to pick up, but up for what side of the market? Consumer or capex? That's the current debate.
So, I mean, if we take it only in the context of the budget, this budget has actually given a fairly strong fillip to capex. So the total capex as a percentage of GDP from the central government is going up from 4.1% to 4.3%. The 4.1% was already an all-time high. So we're making a new high in the subsequent 12 months. And unlike the trailing few months, I think this 4.3 looks a bit more achievable. You must bear in mind that the government capex in nominal terms in the central government's budget has more than tripled in the last few years. And they did, I think, hit a bit of a capacity constraint. If I would simplify this, this is like if, you are given tons of money to spend and told no wasteful expenditure, but go and spend it. There's a limit to how much you can spend. And that capacity only builds over time. So we have kind of tripled our railway spending. We've significantly increased our road spending. And as I said, overall, capex is up more than 3 times. So I think that's where we hit a little bit of a wall in the past few months. And the government is overcoming this by opening up new sectors for capex. And 3 new sectors stand out in this budget. So one is water, the second is distribution, and the third is housing. So the capex is moving away from what we saw in the last 2-3 years in terms of subsectors to new sectors. So if I were to use one word, I would say it's a capex-oriented budget, but of course it also has a big consumption stimulus via income tax cuts. So it has achieved both, which is why I call it a magic budget. and also actually achieved fiscal consolidation slightly more than what the market was anticipating. So that requires a lot of work, which I think the finance minister has done. And the budget numbers look quite good, actually. So it's not like these look, a little outrageous and there are some, crazy assumptions. Absolutely not. If anything, I think they'll probably surprise to the upside. Again, caveated by what happens in the rest of the world.
Hi, morning, Prashant here. And good to see you back after a while. I think you've given us the headline. It's a magic budget. The piece on consumption really, Rhythm, how much will this help in your opinion? And what will see that lift and that help? Which subsectors within consumption, in your opinion?
That's a good question, Prashant. It's not as obvious as it seems. So let's contextualize this. This is about 10 million people, 1 crore people who are getting this tax break to the extent of 1 lakh crores. And it's not necessary that they will take this tax break and buy soaps from it. Okay. So I think consumer staples is certainly not the place where we go to. Consumer discretionary, I think, is a much better bet. And even there, I think at the higher end of consumer discretionary is where I think you will probably see some of this tax saved being spent. Some of it can actually also come into the stock market. All of it will go to the banking sector. So this is how I would break it up. And that's, the dilemma always with tax cuts. It's hard to predict what people benefiting from a tax cut will do with that money. They could just simply deposit it in the bank, or they could go and buy shares, or they could use it to buy some high-end goods. And I think you'll get a mix of all of that. Now, the exact mix is very hard to predict, but it'll be a mix. And all this is actually auguring well for the economy. When you've hit sort of a spending capacity limit and you don't want to do wasteful expenditure, and again, we should highlight this point, and I'll come to this in a second. So just give me a second. When you don't want to do wasteful expenditure, this is the best next alternative you have, which is give it to the people to spend. And that's what the finance minister has done. So kudos to her for that. Now on wasteful expenditure, again, yesterday's newspapers had no mention about this. The subsidy spending of the government has gone back to pre-COVID levels. It's now back to 1% of GDP. And we had achieved a multi-year low in 2019 at 1% of GDP. So it's, I think, 1.07 if I remember correctly. So the wasteful expenditure is, it's almost you're wringing the neck of your spending options. It's like you're tightening your purse strings. And at the same time, you're getting the private sector to increase its participation in the economy. The way I characterize this is that the government, and I think this is common knowledge now, the government did the heavy lifting coming out of COVID because private sentiment was weak. It is now stepping away and reconsolidating the fisc, in a way preparing for the next crisis moment. Because when another crisis moment arrives, if it ever does, you need spending capacity in the government. So you need to be always prepared for it. And now the private sector takes over. This is incredible, actually, if you think it from a stock market perspective. Very few countries in the world have this flexibility which we have, which is we can take the foot off the pedal, consolidate our fisc, and create capacity to address any upheaval that can happen in the coming years. And that is why this budget is magic. I mean, just one of the reasons, there are plenty of reasons why it's magic, but this is one more reason why it's magic. And I'll come to a third reason a little later, which is the fine print of this budget.
And we'll just come to that in a bit, but and I think that's very beautifully put, sort of explained in that sense. Just to go back to what we began the conversation with, small and mid caps, right? Now, Rhythm, but what about valuations? Because if you look at Nifty, this is data as of Friday's close. We were doing, I don't have the numbers now, but we looked at the Nifty 1 year forward multiples are slightly below the long-term average. If you look at mid cap multiples are relative to Nifty and small cap relative to the Nifty, they're still, even after this 18-20% fall that we've seen, they're still very rich compared to historical averages. So how should one put this in context?
So see, Prashant, I hate to look at valuations in PE terms. If I were to make this really simplistic, PE is nothing but price expressed in form of earnings. Like you would say price in INR, price in dollars, price in earnings. It doesn't tell you anything about what the value of a stock is. Ultimately, the value of a stock is the future cash flows discounted at your expected rate of return. The future cash flows from a stock is dividends, which come out of earnings. So that is a very different thing compared to what PE is. And PE can be very misleading. So there are many moving parts to this and why Indian stocks trade at the valuations they do. So the first and foremost thing is terminal value. There are very few countries on the planet that have any terminal value. Take the case of China, where I think the terminal value is close to zero now, which is why stocks in China seem so cheap. They are not cheap because ultimately equities require long-term growth to drive their value up. And India is again one of the few countries where long-term growth seems to be quite good. The second is the rate at which you want to discount future cash flows, right? That has fallen in India. Why? Because India's economy has become more stable. One of the messages from this budget is that we're not tinkering with macro stability. And not tinkering with macro stability makes our returns or growth more predictable. And what more can be sweeter for equities than predictable growth? If I tell you that a company's earnings, come what may, will compound at 20% in the next 5 years, you will pay up for that stock. Because predictability is the best news for equity investors. And by pursuing the type of policies that this government has done for the past 11 years, it is actually making India's growth more predictable. And that is why equities trade where they trade. They're not going to become significantly cheaper. And trust me, when they do become significantly cheaper, you will not want to buy them. Because it will happen in this moment where somebody comes in and disturbs this macro stability.
Hi, Rhythm. Good morning and good to see you. When you're sounding very, very optimistic about prospects, and that's good to hear. And in the finance minister, with regard to the budget, the expectations, they are factoring in STT to be much higher as well. So maybe they are factoring in a buoyant stock market as well. Give and take everything, Rhythm. How do you change your portfolio from here on? What are your top ads? What have you all deleted as well? I'm looking at it. I think HAL is something that you'll have pulled out, while Titan, Jubilant, those are the ones that you're relatively more optimistic on. So give us a portfolio construct.
Sorry, so I won't go into single stocks, but from a sector perspective, I think you want to buy the banks, particularly the private sector banks. I think that's the easiest trade in the market right now. The stocks are trading relatively attractively, and I think the environment is going to get more constructive for banks. So that'll be the easy one. Then I think you want to buy some discretionary consumption. As I mentioned to Prashant, this budget is, I think, built for an uplift to discretionary consumption, especially high-end discretionary consumption. I would still continue to back industrials. Though within that portfolio, you have to realize that there are some shifts that are happening with respect to the subsectors in which CapEx is taking place. So you may want to orient yourself to that. I think technology looks quite okay. We are getting into a period where spending cycles seem to be going up. Everything else, in my view, can be underweight in a relative portfolio. But this is one point that I will make, is that this market is transitioning from a macro one to a micro one. So since COVID, we've been driven by macro factors. And I think increasingly this is becoming a stock pickers market. So it's really not about the Nifty and where it heads. It's about individual stocks. And I think the dispersion of returns across stocks is likely higher in the next 12 months than it has been in the last 2 or 3 years.
Absolutely. So just reiterating for the benefit of our viewers, Rhythm, you're saying that private banks are an immediate trade. You also like consumer discretionary. I want to go back to the three new lines of CapEx that you outlined. You said water, housing, and you said distribution. I think you're talking about logistics over there.
No, electricity.
Oh, electricity. Okay. So then the same question, how would you place stocks along these lines? Because you're still, relatively not too negative on CapEx.
Yeah, so CapEx spending in nominal terms in the budget is up 17% to around 15.5 lakh crores. So that's growing faster than their normal GDP assumption, which is why capex share in GDP by the central government is rising. What they've done in the budget is they've transferred some of this spending power to the states. So the allocation of grants to the states for capital spending is up almost 1,30,000 crores on 3 lakhs, so nearly 40%. And that is that's the gist of this budget, that the states are now being incentivized to undertake capex. And you think about the macro context here. There has been a growing risk of greater revenue spending by states for subsidy programs or for distribution. You want to reorient that spending. So the government of India is using its resources to help the states reorient that spending to capex. Another reason why I call this a magic budget. I mean, there are so many reasons. We didn't even go into the fine print. Allow me to go there. So all these years, 35 years of doing budget, the fine print has always contained bad news. I've never seen a budget with fine print that had good news. This budget actually had some really good fine print. It has diluted permanent establishment rules. It has created safe harbor rules. If you think about Make in India, I think this is a budget that really powers Make in India. A lot of multinational companies will be looking at this fine print and saying, oh God, we can now come in, it looks safe.
Okay, and I think it needs a proper fine print discussion, but we're always on the clock. You know, somebody's a large individual investor has messaged me and said, please ask Rhythm about when FIIs will return in the context of all the changes made in the GIFT Nifty. Quickly, if you can.
GIFT City. GIFT City.
GIFT City, yes.
GIFT Nifty.
Yeah, sorry.
Every morning at 9:15, there's a $100 million bid that comes from domestic investors. To do a trade, somebody needs to sell. Either corporates sell through IPOs, and then they'll allow FPIs to buy, or the FPIs sell. So this is the technical point. Okay, the GIFT City changes, I think, are very encouraging, and it should assuage a lot of foreign portfolio investors with regards to taxation, and should encourage them to step in. And these are changes that market participants were pressing for, and the government has delivered. So I would be very optimistic, but I think you need a bit of supply of paper for foreign portfolio investors to turn. Mind you, this selling that we have seen over the past few weeks has little to do with India. It is largely an emerging market problem, and the emerging market asset class does look very vulnerable. We actually did not get to that at all. But what's happening over the weekend and what's likely to happen over the next few weeks is going to create volatility. So people have to be prepared for it. And India may outperform in this volatility, but the Nifty will struggle. If the world is not going up, it's impossible for the Nifty to do its own jig. It's a very large market now in a global context. So it cannot do its own thing if everything else is falling.
Absolutely. A longer fine print budget conversation soon, Rhythm. You're calling it the magic budget. Thank you very much for joining us here this morning. Lovely conversation. As always, lots of insights and perspective. Take a quick commercial break here. See you on the other side.
Tonight, I am announcing Canada will be responding to the U.S. trade action with 25% tariffs against $155 billion worth of American goods. This will include immediate tariffs on $30 billion worth of goods as of Tuesday.
Welcome back. Let's straight away take the focus to the commodity markets now and see how they are reacting to the tariff wars that have been unleashed. Manisha, good morning.
Morning, and thank you for that. Well, I'm looking at copper, aluminum, zinc, and most of these metals are trading 1 to 3% on the lower side on the London Metal Exchange. Well, that's the major market that you watch out for in the global markets. We have seen US announce tariffs on Canada, Mexico, and China as well. Well, 25% on Canada and Mexico and 10% on China. Importantly, when you look at all of those numbers there, Mexico and Canada support, or rather export to US is around 75% of their total exports. But when you look at the US exports to both of these countries, that stands at around 16 to 18%. So we can see it's very lopsided in sense of numbers there. But I quickly want to come to individual metals here and talk about copper. And US is the net importer of copper, aluminum, and zinc. And that's the reason you are looking at very strong premium in case of the US markets for many of those metal prices there. When you look at the copper numbers at it itself, the US is importing 36% of its copper from Canada and Mexico. 36% actually is exactly the number that US actually imports in sense of copper. And when you look at the prices right now today in Asian markets, we are looking at 6% of a premium reigning in case of the US markets versus the London Metal Exchange. So you are looking at a lot of hoarding, buying coming in, and that tariff impact already showing into the prices there. Talk about aluminum, and US imports 82% of its refined aluminum, and much of that really comes in from Canada and Mexico to the tune of around 60%. So we are looking at aluminum prices also trading at a huge premium when it comes to the US markets there. Talk about zinc, and US imports nearly 67% of its zinc requirements also coming in from the Canada and Mexico markets there. Canada supplies 50% of its zinc to US, and we are looking at zinc prices in the US markets trading higher, but zinc prices on LME right now are trading at around 2-month lows. We've seen a 3% of decline come in for the zinc prices in the Asian markets right now. Steel is yet again an important commodity, and we do see steel imports represent 17% of total imports in sense of US there, and 40 to 50% of steel comes in from Canada and Mexico into US, and we're looking at perhaps tariffs coming in for this one as well. Importantly, the US president has said that he would have a conversation Monday morning with Mexico and Canada as well. Remember, these tariffs come into being from 4th of Feb, so we still have today in sense of negotiations and conversations, but the market's already taking cues from these tariffs, and we've seen big arbitrages coming in for US, LME, and the Chinese markets there.
All right, Manisha, thank you very much for that. Commodities in focus. Up next, my colleague Latha will be in a conversation on the budget implications. She'll have B. Prasanna of ICICI Bank and Kaushik Das of Deutsche Bank to take you through, of course, the latest, which is tariff announcements, implications for global markets, rates, currency, all of that coming up. Interesting conversation.
Followed by further tariffs on $125 billion worth of American products in 21 days' time to allow Canadian companies and supply chains to seek to find alternatives. Canadian energy powers American manufacturing, businesses, and homes. Of America's top 5 trading partners, Canada is the only one with whom the United States runs a trade surplus in manufacturing. And Canada buys more goods made by Americans than China, Japan, and Germany combined.
Presently, taxpayers can claim the annual value of self-occupied properties as nil only on the fulfillment of certain conditions. Considering the difficulties faced by taxpayers, it is proposed to allow the benefit of 2 such self-occupied properties without any condition. To streamline the process of transfer pricing and to provide an alternative to yearly examination, I propose to introduce a scheme for determining arm's length price of international transaction for a block period of 3 years. This will be in line with global best practices.
Welcome back. Before the rupee or the bond markets could react to the budget, these markets have got shaken by the tariffs imposed, or at least threatened to be imposed, by President Trump on Mexico, Canada and China. The dollar index up 1.25% from where we left off on Friday, and the rupee is at a new low. It's fallen 0.75%. I mean, I've not seen this kind of a sharp fall in a long time. It's about 75 pies cheaper than where we left it on Friday. 87.20, it even went to 23 per dollar. The government borrowing for FY26 is very marginally higher than this year's and versus what the market was expecting, but that's really a rounding error. Despite this prudent budget, will the Reserve Bank have the guts to cut rates in the face of so much external uncertainty? I have with me 2 guests, B. Prasanna, the head of global markets at ICICI Bank, and Kaushik Das, the economist from Deutsche India. Gentlemen, good morning and thank you very much for joining me. Prasanna, I'm cutting the budget for the moment and going straight to what is, a huge issue on the currency markets today. Do you think this uncertainty can impact RBI decision-making in a big way?
So I think, yes, Lata, markets being markets, budget is already history, and within a day we have got so much of information that markets are now reacting to other kinds of movements. Yes, I think the uncertainty is increased to some extent. I think all of us in the markets were expecting some kind of announcements from Trump on the day he was actually taking charge as president, or in the first 1 or 2 days through executive orders. But the kind of bonhomie that was there between him and Xi and the other presidents kind of, got some complacency into the international global markets again, basically with the view that Trump might not go all the way. But I think clearly what has come yesterday has surprised the markets, I would say a little bit on the shock also. And the fact that it's not just announcements, but they're actually going to start collecting tariffs from tomorrow. So I think the natural reaction for currencies would be to depreciate. The non-dollar currencies will depreciate against the US, and what's happening in INR is also more of the same. As far as your question on RBI is concerned, I would say that in a normal situation, maybe RBI would not be cutting rates when the currency is depreciating. But what is happening right now is a part of a global move where the dollar is strengthening and all the other currencies are depreciating. It's not because India's current account deficit is weak. It is only India's balance of payments are weak only because of the capital flows, which actually means if you actually cut rates and can get better earnings on the corporate side, you can get better growth and hence hopefully a better flows going forward. So I don't think it derails the rate cut, but at the same time, I would also have to admit that the uncertainty is killing. So, I mean, the odds, I mean, we'll have to see what the RBI does.
Okay. Well, there is one argument which is constantly put that after all, India has not got so much of bond inflows. It is not interest rate differential that foreigners are vying for. Foreigners come to Indian equities because India is a growth story. And there the rate cut will actually help. So will that cut, at the moment, what are the odds, therefore, for a rate cut?
So, Lata, the question is to me. What
Yes,
I would just say that the argument is sound, but I also would have to say that we are not out of the woods as far as the global dollar strength is concerned. I think we need to see it playing out, and I don't see international investors returning to India in a hurry, unfortunately. While I think the budget is very good and it is played within all the parameters of fiscal conservatism, while at the same time pushing consumption, not compromising on capital expenditure. But the thing is, it has to start reflecting into corporate earnings into India, which might take maybe a couple of quarters. And the dollar strength will have to play its course, and we'll have to see it peaking. And then only I think international investors will even start looking at, the rest of the investing asset classes.
Fair point. Kaushik, that straight away lobs the ball into your court. Do you think that given the kind of noises the budget has made, push the pedal on consumption, are you changing your growth forecast at all for next year?
So, Lata, we already have a growth forecast of 6.5% for next year, FY26, which is somewhere in between 6.3, 6.8, which the economic survey has kind of indicated. So we don't need to change that forecast, but the point is that 6.5% growth is probably below the potential growth rate of the economy. And this year also, we are supposed to get something in between 6 to 6.4%. So you need some support. Now, the point is the budget has done the maximum that it could do given the fiscal space. Beyond that, we should not have expected more. But then I've always maintained two things. One is you cannot depend solely on the fiscal to support growth, given that they have to keep on consolidating. Therefore, monetary policy has to play a bigger role. And RBI has been on hold for 24 months. When the maximum in the past has been 11 months of a wait period. So we are already late, and RBI has started these liquidity easing measures, which will help, but they need to do more. And rate cuts, there's no point delaying it because today you have this uncertainty because of US tariffs. If you decide to, kind of wait and go in April, even in the first week of April, you could have the same uncertainty and, you could keep on delaying this. So the second important point is that you cannot, link interest rate and FX policy at this point of time. FX has to, have its own course. It should be a risk, absorber kind of a, objective. So if the rupee has to depreciate because globally dollar is strong, that should be the path. RBI can, modulate that move, but it cannot use the interest rate policy as a defense for the FX policy. The interest rate policy should, kind of focus more on the domestic. Demand, fundamentals. And over there, we think some bit of rate cuts are required in February and April, along with liquidity easing measures.
Okay, so there, I'm glad you brought up the liquidity point. Prasanna, should we expect a CRR cut? Because clearly what is given is not enough. That's,
Yeah, Lata, I think till end of the year, our estimate is around 1 lakh to 1.25 lakh crores of further liquidity infusion is required at the minimum. But the fact is, RBI did not really wait for the policy to implement some of the liquidity measures, and also they have been pretty aggressive in their in commencing their liquidity operations. You have seen them announcing auctions of 60,000, 20,000 has already happened, and not only that, they are now also more aggressively buying in the secondary market on the screen in government bonds. So the sum total of all of this will give you around 1.5 lakh crores. But like you rightly said, it's just not enough. And one call that the RBI would need to take, obviously, is that since they have moved from withdrawal of accommodation to neutral, and maybe they don't move the stance from neutral to accommodating stance, but at the same time, they can take a call that they want to keep liquidity flush with the banking system rather than making the banking system borrow from RBI using whatever tools like VRR. If that is the case, then they will need to give more than 1.5 lakh crores also. So that's a call they have to take. But since they have already announced a lot of measures, I'm still not willing to rule out a CRR cut, but the probability has come down, Lata, of them doing a CRR cut. They'll probably use a combination of OMOs and buy-sell swaps going forward to, infuse this liquidity. Because somewhere I feel that at 4%, they feel that 4 to 3 cushion which they want to keep. I think they want to keep it for a crisis situation. I won't call this exactly a crisis.
No.
Yeah.
No, I take your point. We are nowhere near taper tantrum or Lehman kind of. We are not at all in a crisis. Kaushik, therefore, what's the in-house view on the dollar rupee? Are we at the low, like 87.5 thereabouts? And what kind of a bond yield range are you looking at, Kaushik? I thought you're factoring in 2 cuts.
Yeah, so Lata, a couple of things. One is dollar rupee. I think this year you will see more two-way movement. It's not like obviously now rupee is under pressure, it'll depreciate, but there's a point of time when DXY will also peak and you'll see other currencies appreciating when all this fear factor is over. I think at that time, RBI will allow INR to appreciate as well compared to the last few years when INR never used to start depreciating from. So taking all that into consideration, I think, rupee could be at 88 by the end of this year. So it could move to 88 first, and then you could see a appreciation at some point of time back to 86.5, and then again go back to 88. So I would say 88 would be the range for rupee going forward. As far as bond deals and interest rates are concerned, just to, add a little bit more on liquidity, I feel that RBI will not be cutting CRR anymore. They have done it already in December. Beyond 4%, they would not like to move. As Prasanna said, this is not a crisis-like scenario. They can do more buy-sell swap, another 5 billion. They can do more OMO purchases. And, once they have started OMO purchases, already it will be about 90,000 crore this year and maybe more this fiscal year, and more would be coming in the next fiscal year. I would assume more VRR, more OMO, more FX swap, but not CRR at this stage. And if you've seen carefully that the 56-day VRR is supposed to happen from 7th February. That is the day when RBI, if it delivers a rate cut, people would be willing to take that money. And you'll see that 56-day falls on the next policy on 4th April rollover period. So I would expect 2 rate cuts on February 7th and April 4th, coinciding with the 56-day VRR rollout. Bond deals probably would be somewhere around this same levels because market has already priced in 50 basis points rate cut. If there are more expectations of rate cut going forward, then you could see bond yields falling more than where we are. But more or less, we are at that level. But the negative side is also not that much because we have...
that. Yeah, got that. No, I got that. And that's good calculation to show exactly why you are expecting a rate cut. If you do a 56-day repo before February 7th, obviously you bankers will not buy it because you will be expecting the rate cut. I take your point over there. That kind of seals the rate cut. Very quickly, Prasanna, something which I think equity analysts are not speaking about much. I'm going to ask you an unfair question. Do you think banks' retail loans will go up now? This is a pro-consumption budget. A large number of people have 1 lakh rupees more or are going to pay less tax. Isn't this a pro-retail loan budget?
So I think, Lata, I think it's too early to comment on that. Yes, it is a fact that the 1 lakh crore of giveaway on tax will probably lead to something like 75,000 to 77,000 crores of incremental consumption, assuming a marginal propensity to consume in that region. But and that also happens on a recurring basis, adding to every year's GDP. But that's too early to say at this point of time. I think what the Reserve Bank does in terms of signaling, in terms of risk weights, in terms of what happens to EMIs, I think some of those things are also going to be important in terms of what happens at the credit growth level. And just to quickly, complete the circle on the rest of the things that you asked,
rupee and bond.
was basic. Yeah, so it's basically on the bond deal side, we believe that there will be a bullish steepening with now the rate cuts starting to get priced in at the shorter end of the curve, while at the medium end, at the long end, maybe not as much. So because the absolute level of yields are also on the lower side, and it doesn't make it too attractive for banks to keep buying at lower and lower yields. So I would say 660 on the 10-year by 31st March and 650 to 660 kind of range for the calendar year at the end of the year. And on the INR, I would say I would agree with what Kaushik had to say, which is that this year we are going to see a little bit of two-way movement. Hopefully, RBI allows the rupee to appreciate also when the dollar has peaked. We haven't seen them allowing the rupee to appreciate because they were very keen to pick up reserves when rupee was appreciating. But this time around, since they are also allowing the depreciation, like you rightly said, 0.75% depreciation today compares favorably with some of the other EM currencies which have depreciated 0.5% today. So from that perspective, if you allow the rupee to depreciate, you should also, kind of allow the rupee to appreciate as well. So a little bit of more two-way movement, little bit of higher realized volatility in the FX market, which will then also encourage corporates to hedge. So those are all the good things. And frankly, monetary policy should not, the currency movement should not come in the way of what they want to do for monetary policy, because that will be focused on supporting growth, and India's CAD is still very strong.
Okay, point taken. Thank you very much, gentlemen. Unfortunately, out of time, but very important takeaways. We have to wrap up on Bazaar on that note. Chartbusters coming.
View to reduce litigation and provide certainty in international taxation, the scope of safe harbor rules is being expanded. A number of senior and very senior citizens have very old national savings schemes accounts. As interest is no longer payable on such accounts, I propose to exempt withdrawals made from NSS by individuals on or after 29th August 2024. I am also proposing to allow similar treatment to NPS Vatsalya accounts as is available to normal NPS accounts subject to overall limits. The middle class provides strength for India's growth. This government, under the leadership of Prime Minister Modi, has always believed in the admirable energy and ability of the middle class in nation building. In recognition of their contribution, we have periodically reduced their tax burden. Right after 2014, the nil tax slab was raised to 2.5 lakhs of rupees, which was further raised to 5 lakh rupees in 2019 and to 7 lakh rupees in 2023. This is reflective of our government's trust on the middle class taxpayers. I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees. So, detail the indirect tax reforms and changes in direct taxes in Part B. Financial sector reforms. The FDI limit for the insurance sector will be raised from 74 to 100%. This enhanced limit will be available for those companies.
The Street opens lower as investors weigh the new tariff slab by Trump on goods from key trade partners and their potential impact. Mid-caps relatively underperform. Chemical stocks gain on the likely positive rub-off, while metals decline.
Meanwhile, the post-budget moves continue. FMCG stocks, Nestle, ITC, Nykaa, they climb as the government expects the union budget to drive consumption. On the other hand, the budget had no mention of LPG subsidies, putting OMC stocks under pressure. Capital goods also likely to face growth challenges, dragging stocks lower.
Hindustan Aeronautics Brain-based solutions under pressure after Morgan Stanley changes their focus list of stocks. On the other hand, we have Titan as well as M&M doing a lot better along with Jubilant Foodworks as they get added to the list.
Eicher Motors thumping ahead on the back of its January auto sales data. The company reports strong monthly sales, 4% higher than estimates.
UPL climbs nearly 4% after brokerage firm Investec upgrades the stock to buy from sell, raises its target price to 700 rupees from 450 earlier, citing the company should be able to bring down its overall debt levels in FY25.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. Hey Mangalam, market's a little bit under the weather, but I think it has more to do with regard to Trump's tariffs. So if you look at it from the morning itself, there are select pockets which are seeing buying and the markets are continuing to defend lower levels. So I'll take heart from that fact.
One would take heart from that. And also, the sectoral shift that happened on Saturday is continuing today with a lot more gusto. So we are seeing urban consumption names do a lot better. Case in point, something like Avenue Supermarts, which saw a big gain on Saturday, continues its gain right now as well. Jubilant Foodworks, Indian Hotels and Zomato, all these urban consumption plays are doing a lot better. But let's talk about earnings, because not only did we have news coming in from the global front, we had news coming in from the budget. The earnings season is underway as well. Equitas Small Finance Bank, the bank saw its deposits rise 25% year on year, and the third quarter slippages too have seen a rise on a sequential basis. P.N. Vasudevan, who is the managing director and CEO of Equitas Small Finance Bank, now joins in to detail those earnings itself. Thanks a lot, sir, for joining in. Let's talk about your growth going forward, largely because your AUM grew by about 15% year on year. I remember the conversations that we had earlier. You had that 25% advances growth target. Where do you stand on that right now? And by when do you return to that 25% target?
Morning, and thank you for having me here. The growth for the 9 months has been 20% for the rest of the bank, and microfinance, which is 14% of the book, has actually been degrowing. It's degrown by about 11%, and that's why overall we have a 15% advances growth. The 25% that we had indicated earlier was at a time when microfinance was not seeing any kind of a stress, and microfinance would have grown, and the rest of the book also would have grown. But today the scenario is quite different, so we don't really expect the 25% growth to come in the very near term, but that's something that we should look at it from a more medium to long-term perspective. Right now, we are actually not guiding for the growth for this current financial year, but definitely microfinance will continue to degrow, which means that overall the bank's growth will be to that extent impacted.
Okay, all right. Hi, Mr. Vasudevan, and good to see you, Ben. But as the microfinance degrows, that's impacting your NIMs as well. As a percentage of your total mix, I think MFI has come down to roughly around 14%. So what is the outlook on the NIMs? And also, I recall the last time you joined us, you had said that you're expecting the pain in MFI to continue. How far are we away from relief?
Yes, so as far as the NIM is concerned, we had a 30 basis points drop in the third quarter, largely contributed by the fact that microfinance share of contribution has been coming down. Two things we expect to kind of support that in the next few quarters. One is that the micro loan against property, which we give for small business people secured against their house property, has shown a very good trend of growth, and the disbursement actually doubled in the current year compared to the last year 9 months. And from a yield perspective, micro LAP is kind of similar to microfinance. So as we kind of fill up that gap with more and more of our secured product, the yield pressure might come down over the next few quarters. That's one thing. The second thing is that about almost 80 to 83, 85% of our book is a fixed rate loan book. Only 15, 17% is a floating rate book. And so last year and the previous year, we had a negative impact when the interest rates were going up, and we were not able to pass on that to the existing borrowers because our books was fixed rates. Now, if the interest rate cycle starts turning and the interest rates start coming down over the next few quarters, Our earnings may not be impacted because, again, as I mentioned, large part of the book is fixed rate. We might actually see the reverse effect, and that might again support the NIM. So I think a combination of these two, we think that in another 2 quarters, I think the NIM pressure should ease.
What should the NIMs look like in the near term from around the 7.3, 7.39%?
Yeah, it might settle down around the 7% level.
All right, it'll settle down around that 7% mark itself. On your CD ratio as well as credit cost, you said that you'll have better visibility once we move into the second half of this year. What is, are we any wiser?
See, from a credit cost perspective, the rest of the book, which is our 86% of the book, the credit cost continues to remain very comfortable at around the 1 to 1.1% level. So we don't see any challenge as far as that is concerned. As far as microfinance is concerned, we had a 10% credit cost in the third quarter, largely contributed by the fact that our second and first quarter, there was a amount of slippage. See, in microfinance, what happens is it's a 6-month lag from the time you have a X bucket slipping into overdue to the ultimate period when the credit cost hits the book. It's a 6-month lag. It takes 3 months to become NPA and then 3 months for it to get 100% provided. So it's a 6-month lag. So our Q2 and Q3, our X bucket slippage was 98.2. At 98.2, microfinance continues to be a loss-making business for the bank. It has to reach a level of something in the range of 98.6 or so, at which the earnings and the credit cost will kind of even out and the product becomes a break-even. And when the X bucket goes to beyond that 98.6, when it goes to 98.8 or 9 or 99, that's when it comes back to some level of normalcy. So we have put a lot of effort in the third quarter and second quarter, and there's been an industry initiative to also bring about some discipline in lending. And we are just hoping that, the fourth quarter and maybe the first quarter of next year should see an uptick on our X bucket. If that happens, then I think somewhere by second half of next year, things should try to come back to normalcy.
Okay, all right. Quick couple of points, sir, before we let you go. Your slippages, from around 500 crores on a quarterly basis, it's moved closer to around 600 crores. In the coming quarters, how do you see this number to move? And I understand that the problem is in the MFI basket. So how do you see things moving on a quarterly basis? Point number one. Point number two is as you scale up your non-MFI part of the book, the expectation is ROA will improve. So what is the targeted ROA?
Yeah. So as far as the gross slippage is concerned, there was an uptick, largely contributed by MFI. But if you see the net slippage for the rest of the book, the net slippage actually sharply improved in the Q3 because Q3 generally is a season of, better season from a collection perspective. And Q4 will continue to be normally a good season for collections as well as business. It's an industry-wide phenomenon. So we expect that the slippage should continue to improve in the Q4 and, going forward.
All right, you expect situations to improve in Q4 and going forward. Wish you good luck, Mr. Vasudevan. Thank you so much for joining in and being so candid about the stress in the MFI business, but your points of moving away from that and improving your own business as well. With that, we'll step into a short break. On the other side, we have the management of another financial organization. Ashok Chandra, the MD and CEO of Punjab National Bank, joins in to discuss their third quarter numbers.
Invest the entire premium in India. The current guardrails and conditionalities associated with foreign investment will be reviewed and simplified. The services of India Post Payment Bank will be deepened and expanded in rural areas. NABFID will set up a partial credit enhancement facility for corporate bonds for infrastructure. Public sector banks will develop Grameen Credit Score Framework to serve the credit needs of SHG members and people in rural areas. A forum for regulatory coordination and development of pension products will be set up. To implement the earlier announcement on simplifying the KYC processes, the revamped Central KYC Registry will be rolled out in 2025. We will also implement a streamlined system for periodic updating. its efforts to A. Accelerate growth, B. Secure inclusive development, C. Invigorate private sector investments, D. Uplift household sentiments.
Welcome back. The pain in the Capco's name continues to extend. So we have Hindustan Aeronautics, which is currently at the low point of trade. And also, other names like NHPC, we have Tata Power, all of them under a wee bit of pressure. A couple of stocks from the consumer space, which are also not doing too well. We have something like a Colgate, which has moved to the low point of trade. Why is that? Because a higher proportion of their revenue as against the others comes in from rural India. And one of the growth push for Colgate itself was likely to be for rural India itself. Not that rural India is doing too bad, but the budget focus was more on urban, discretionary, middle class, etc., which is why the nature of stocks which are moving. So pull up something like a Nestle, which has moved to the high point of trade. They get about 80% of their revenues coming in from urban India as well. So that stock's doing well. Alongside that, we have names like Trent, etc. So we'll keep an eye out on all of this. But let's again, focus on earnings. Once again, we have Punjab National Bank. The third quarter slippages came in at a 38-quarter low. Net interest margin too came in at a 10-quarter low itself. Deposits, however, have risen sequentially. Ashok Chandra, who's the MD and CEO of PNB, joins us to discuss the numbers. Thanks a lot for joining in and taking these questions. So let's talk about both slippages and the NIMs itself. Slippages at a multi-quarter low. Where do they go from here? And NIMs, they've fallen to a 10-quarter low as well. The question is, with the RBI expected to cut rates in the upcoming policy, where do these NIMs go from here?
Good morning, and just to give me some time before I move forward, I express my sincere thanks to my 1 lakh plus employees, starting from armed guards to service staff to my entire officers community, customer service associates, 18 crore plus customers and all the investors for supporting us and reposing faith in Punjab National Bank. Now, coming to your specific point, one thing which you have already mentioned is the slippages have come down. And this slippages, which is around 0.68% of our total portfolio, I think definitely this ratio is going to continue and we will be below 1% in the slippages front. We have robust slippages monitoring system in place, and I don't think any further the improvement or further drop will be there in the slippages thing. I think we will be able to contain our slippages. Second important part of coming to the NIM part, before that, the recovery front also, and the recovery which is happening in the interest component and the TW recovery, that has also picked up very well. Yes, in this particular quarter, Q3, there has been some drop in the technically written off account, but still we are able to maintain our NIM between 2.9 to 3%. And there has been a drop of around 7% TW recovery if you compare to the previous quarters. And I am expecting that in Q4, there will be substantial recovery will happen in the TW front. And definitely we will be in a position to maintain that NIM between 2.9 to 3%. I'm very confident about it.
All right. Hi, sir. Good morning and congratulations on a good set. Where do you see your NIMs headed, though? I'm reading a brokerage note. They are looking at the improving asset yields and the potential to grow faster than the system. So, say for FY26, where do you see your NIMs headed to? Point number one. Also, if you could tell us, what is the credit growth outlook for you? There has been some slowdown for the industry at large. For you, what should you end this year with? And on that base for the next year? Please go ahead.
Yeah, first I will touch our credit growth part. The guidance which we had given, it was in the range of 10 to 11%. But we have already grown up to this quarter by 14.68%. And I'm very hopeful with the credit growth and the credit sanctions in pipeline. We have 1.15 trillion sanctions in hand, and definitely some disbursements are going to happen in this quarter and taking forward in another quarters. So with that momentum in place, I'm expecting that credit growth for the entire year will be in the range of around 12 to 13%. And deposit front also, bank has done very well, and we are one of the few banks who have grown in the deposit higher than the credit. That was one of the concerns for the regulator also, but the absolute number also, if you compare that, there is a growth of 70,000 crore in absolute number in this particular quarter in the deposit front, and in the credit growth also in the absolute number, 50,000 crore growth is there in the credit. So we have grown faster in the deposit and overall, if you see the overall business growth also, it is around 15%. So I'm very hopeful that the credit growth 12 to 13% and the guidance which we have given in the deposit also 9 to 10%, I think we will outbeat that. And we will be growing at a speed of around 11 to 12% in the deposit also.
All right, 11 to 12% growth in deposits, 12 to 13% in advances. NIMs maintained between 2.9 to 3 odd percent. Could you give us a sense on where you are looking at asset quality? Because we have seen a decent improvement quarter on quarter in both your GNPA and your net NPA. Where is your intended target for these two ratios?
See, we had a very long legacy issues of the NPS, and for the last 3 years, we have brought it down. And I'm expecting that by end of this particular quarter and end of this financial year, the guidance which we have given in the GNPA is 3.75%. I think we will be able to achieve that. And the net NPA also, the guidance which we have given is below 0.5%. And already we have achieved a 0.41, and I think we will be below 0.5%. So we will be achieving all the guidance which we have given in the asset quality front.
All right. Mr. Chandra, it's not just your 1 lakh employees that will be sharing this commentary. Your shareholders as well will be quite happy. But they'll also want to know, what is Mr. Chandra going to do? Does he require more capital? Do you all have any fundraising plans as of now to fuel growth from here on, or are you all comfortable?
See, if you see our CRAR, we are already at 15.43%. And in that CRAR, we have not factored the net profit which has happened in the system up to 9 months. Already around 12,000 crore of net profit has already happened. And I think the end of this financial year, somewhere I think around 11 to 12,000 crore of profit, which will be plowed back in the capital. And we will be very, very comfortable in the capital front. This year already 5,000 crore of QIP we have raised and 3,000 crore of Tier 2 bond we have raised. And as of now, I don't see any challenge on my capital front. With the growth which is we are planning at 11 to 12 to 13% in the credit front, I don't see any challenge in this particular quarter. And going forward also, I don't think any capital raising is required at this moment.
All right, just before we let you go, if you could give us two numbers. One is your outlook on your CD ratio when it comes to rather cost to income ratio, not the CD ratio. And the second one is if you could give us a sense on your return on assets as well. If you could give us the aspirational numbers on both cost to income and ROA.
Yes. Cost to income ratio, yes, I think PNB is a little bit higher among the 12 public sector bank if I compare. We are at around 54%. And I don't think immediately in this one quarter I will be able to reduce this. But I think going forward in 25-26, definitely we will see that we come out with some strategy wherein we can reduce this cost to income ratio. And I think that is one aspiration which we are all having at that top management level also, that can we bring down to below 50%, and it is a very, very ambitious goal, and we will come out with the action plan in the 25-26 financial year. But this year, I think we will be holding to between this 53.5 to 54%.
Oh. And ROA?
ROA, yes, we are at 1% plus, and I am very confident that with the recovery measures in place, the activity which we are happening in the recovery front and containing the slippages and the 97% PCR, which the bank is holding it. So today, any recovery which we are doing it either in the gross NPA or in the technical write-off, I think this is adding to my bottom line. And I'm very hopeful that ROA definitely it will be 1% plus.
Okay, all right. Appreciate you joining in, sir. Thanks a lot for joining in. You're sounding very optimistic about the future. We're going to hold you at all these numbers. We wish you well, and we'll catch up with you sometime during this quarter or the end of it. Well, for the time being, we slip into a short break, come back, continue to focus on markets and stock-specific action.
Power of India's rising middle class. Together we embark on a journey to unlock our nation's tremendous potential for greater prosperity and global positioning under the leadership of Honorable Prime Minister Shri Narendra Modi. As we complete the first quarter of the 21st century, continuing geopolitical headwinds suggest lower global economic growth over the medium term. However, our aspiration for a Vikasit Bharat inspires us, and the transformative work we have done during our government's first 2 terms guides us to march forward resolutely. Our economy is the fastest growing among all major economies. Our development track record for the past 10 years and structural reforms have drawn global attention. Confidence in India's capability and potential has only grown in this period. We see the next 5 years as a unique opportunity to realize Sabka Vikas, stimulating balanced growth of all regions. The great Telugu poet and playwright Gurujada Apparao had said, "Deshamante matti kadoy, deshamante manushuloy," meaning a country is not just its soil, a country is its people. In line with this, for us, Vikasit Bharat encompasses zero poverty, 100% quality good school education, access to high quality, affordable and comprehensive health care, 100% skilled labor with meaningful employment, 70% women in economic activities, and farmers making our country the food basket of the world. In this budget, the proposed development measures span 10 broad areas, focusing on Garib, youth, Annadata, and Nari, spurring agricultural growth and productivity, building rural prosperity and resilience, taking everyone together on an inclusive growth path, boosting manufacturing and furthering Make in India, supporting MSMEs, enabling employment-led development, investing in people, economy, and innovation, securing energy supplies, promoting exports, and nurturing innovation. For this journey of development, our 4 powerful engines are agriculture.
Welcome back. Well, the markets are recovering as we speak, and that's good news. We have come off close to around 80 points on the low point of the day. Bajaj Finance came out with a rather good set of numbers, and the street seems to be quite optimistic on the prospects. I'll tell you what, the stock has been a relative outperformer in comparison to what the Nifty has done. We're talking about the markets being weak. Guess what? The stock is up close to around 10% in the last 1 month or so. Even metal stocks, yes, the metal index is under pressure, because there is uncertainty. But from the day's low, I think the metal index itself has cut its losses. It was down, I think, close to around 4%. Now it's down 2.5% or thereabouts. The problem is ITC Mangalam, it's put on a good amount of weight in the last few sessions. It's giving up some part of what it's put on.
Just
a little
bit. Weight shedding is what's taking place out there. But if you look at, a couple of names, you spoke about Bajaj Finance, it could also be a proxy play to the urban consumption theme.
Indeed.
Because if you're, buying some electronics, etc., consumer loans is something that the street keeps an eye out on. And if you're buying consumer discretionary, you have Voltas. Just look at Voltas. It's a 5% up move that we've seen in the stock. It's a bit of an underperformer from the past itself. And if you have to play this theme, and Whirlpool is a seller when it comes to the promoters itself, then how do you play it? You play it via Voltas. That's the only player.
Just one more quick stock, Mangalam. Aarti Industries and the chemicals pack as well. From the word go itself, Aarti Industries actually was underperforming. It was down close to 5%. That's recovered. That's in the green as we speak. Tells you the kind of move about some of these chemical-related names. PI Industries was doing well, UPL was doing well, and now you have this one as well joins the list. We'll wrap up on this edition of Chartbusters. Don't go anywhere. The Team of Trading Hour comes up next.
Investments and exports, the fuel, our reforms, our guiding spirit, inclusivity, and the destination, Vikasit Bharat. This budget aims to initiate transformative reforms across 6 domains. During the first 5 years, these will augment our growth potential and global competitiveness. The domains are taxation, power sector, urban development, mining, financial sector, and regulatory reforms.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen. We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy?
Good morning. Welcome to Trading Hour, live from the CNBC TV18 Motilal Oswal studio. I am Reema, and with me is Vivek, and markets are troubled by the Trump tariffs. We're down close to about 0.5%, 0.6% on the benchmark indices, but there is an intraday recovery. The Nifty, in fact, has pulled back more than 100 points from the day's low of 23,222. Even the mid-cap index is still down about 450 points, but from the day's low, there has been a recovery of close to about 1%. The sectors which are taking a hard knock today are the defense names. The Nifty Defense Index is down more than 5%. PSUs across the board are selling off, and metals is under pressure. We've seen the dollar index surge to nearly levels of 110, and base metal prices are down about 1 to 3% in absolute terms.
Good morning, Reema. Most of the headlines today, while they were expected to be dominated by budget, actually quite a lot of headlines and quite a lot of stock moves are actually being impacted by the kind of tariff moves that we've seen overnight. First set of stocks that are doing quite well are the entire chemical pack. Remember, they stand to benefit from increased tariffs as far as Chinese players are concerned. Have a look at names like PI Industries, UPL, Jubilant Ingreva. All of these stocks doing very well in the session. Like you mentioned, some of the consumer discretionary names continue to do quite well. Look at names like Nyla, Charlotte Hotels, VBL, Titan, even a Voltas for that matter, especially in the last 15-20 minutes of trade, has surged to the day's highest point. OMC's significant disappointment in terms of no announcement coming in for LPG under recovery. BPCL, HPCL, IOCL, all of them, HPCL in fact down over 5% in the session today. You spoke about the defense names, but the other set of stocks that are taking a very hard knock today, actually the capital names pack. No incremental capex, so worries in terms of order inflows, how will order books be replenished. Look at the entire pack, L&T, Siemens, Thermax, all of these stocks, even a name like a CG Power today seeing significant selling pressure. And the auto ancillary space, that is the other set of stocks that are seeing quite a bit of a hard knock. Motherson Sumi, Samvardhana Motherson, and Sona BLW. These stocks too under pressure. Again, worries of implications in terms of, remember, they do supply components to quite a few Mexican companies, and these stocks today taking quite a hard knock, Rima.
And not to forget railway stocks. They continue to bleed. Even on Saturday, names like RVNL, Ircon, IRFC were down 7, 8, 9%. And today as well, the correction has continued for these names. RVNL leading the losses with a cut of about 7%. And now from its 52-week high, these stocks are down more than 35%. But let's get to Inox Wind. They reported numbers. To discuss the numbers and way forward, we have Devansh Shen, Executive Director at the Inox GFL Group, joining in now. Thank you very much, Devansh, for joining in. This is Rima here. First, very quickly, if you could tell us, were there any announcements in the budget which impacts you positively or negatively?
Look, I think it's a very forward-looking budget, and I think they've been very clear about the national clean manufacturing mission. So I think they've reiterated their commitment to setting up a very large domestic ecosystem for wind turbines, for solar, green hydrogen, electrolyzers. And I think that that shuts out a lot of the noise which has been created over the past couple of weeks, I would say, around the US president's statements around renewable energy. In any case, on the wind side, we're fully domestically focused. So I think we're looking forward to a very, very strong renewable outlay as we move forward.
Devansh, that's right. Quite a few worries, and quite a few of the wind energy stocks actually saw quite a bit of a sell-off on the back of those statements coming from Trump himself. Well, let's talk about the quarter itself. A very strong quarter for you, especially in terms of operating margins. Can these margins sustain? What is the margin outlook for the rest of FY25? So where will you end FY25 at, and what is the targeted margins for FY26?
Look, yes, I think it's been another strong performance with 190-odd megawatts this quarter. It's been the highest ever EBITDA and PAT for Q3 in the company's history. We've done about 290 EBITDA and 112 PAT. Having said that, I was fairly clear in saying that we maintain our 800 megawatt guidance for this year and our 1200 megawatt guidance for next year. Of course, with the caveat that we could further upgrade it for next year. We had given out a margin guidance, which we had kind of upgraded twice over the course of the past 3 or 4 quarters. And, I don't think we wanted to just keep revising our margin guidance every quarter and just make it a normal affair. So effectively, I think we didn't want to give out any specific indicator for Q4, but I think we are on track to beat our margin for FY25 substantially. And I think it's just common sense for people to be able to kind of extrapolate and see where we are headed for FY25. For FY26, while our current margins, which we've guided for, was 17% plus, with the caveat that we would further upgrade as we move forward, the fact is we're adding a lot of new things to the portfolio. One, we're bringing in, internalizing all our crane requirements, which start ramping up from Q4. We also have a transformer manufacturing line, which is going live in Q4. And I think these, along with some of the new products, our 4X turbines, which we're launching next year, a lot of these should aid our margins further as we move forward. This is again, besides the fact that within the group, we've now launched Inox Solar, which is only going to lead to more and more opportunity for Inox Wind by partnering and taking part in many of the FDRE and hybrid tenders. Plus, it increases visibility and profitability from our EPC arm and the O&M arm, which is under Inox Wind.
Okay, so you've maintained a couple of guidances that you had given. The other, what we have to keep an eye out for is the fact that when you're talking about execution, 140 megawatts per quarter was the kind of execution you were actually doing. You've maintained your execution guidance for FY26 as FY25 as well as FY26 with an upside risk as far as the margins are concerned of 17%. So going forward, what will be the quarterly run rate we can expect in terms of execution? And number two, is order book accretion a bit of a worry? H1 was slightly muted. How is H2 panning out and how is FY26 panning out?
Look, I think, as I mentioned, in terms of execution, typically it's not a uniform quarter, this business, right? We typically do about 35-40% in H1 and about 60-65% in H2. Yes, it's not lopsided to Q4, as it used to be historically under the feed-in tariff regime. But yes, given it's been a fairly massive ramp-up year for us, where year on year our volumes have grown almost 96%. Obviously, Q4 is fairly large, but given the fact that we've publicly guided for about 1,200 megawatts next year, I think, and looking at where we are headed in Q4, I think that should be a large indicator of what every quarter broadly should look like in FY26. In terms of order bookings, honestly, we've taken in about 1.4 gigawatts of orders over the course of the past couple of months in this financial year. Our current order book is 3.3 gigawatt. And what we've guided for was about 1,200 in FY26 and say 2 gigawatt plus from FY27, looking at the market expanding. Now, the longest order book you can build in this sector is 2 years, because that's the longest lead time you get to execute a project, be it CII, IPPs or PSU tenders. There is no point in us announcing orders which are, over 7-8 years, which are MOUs, which are just LOIs, which no binding agreement or no firmness or not credible parties. I think that is the difference between us and some of the other players in the sector. Having said that, I think I've always said in every, taking in orders has been the least of our worries. We continue to build on our order book. We've just added a couple of orders from Continuum and Hero this year. We've recently got Serentica into the books. We are very selective in terms of the quality of customers we're now adding. I think there's a very strong visibility. There are multiple PSU tenders. Some of them had been delayed, given this was an election year. I think we should see a lot of them coming out also over Q4 and Q1. So honestly, given that we're sold out, if I may say so, over the next 2 years, that's probably the least of our worries.
Completely sold out for the next 2 years? Is that what you said?
Broadly, if that's the terminology, given our current manufacturing capacity, which of course we are ramping up. But yes, in terms of guidances,
there are a lot of PSU tenders upcoming, right, in Q4 and Q1 of FY26. Could you give a ballpark indication of the size? What is your estimated success rate in that you anticipate?
Look, I don't think I'm going to spell out success rates. I think we're selective in the tenders in which we participate. But I would expect over the next 2 quarters, we should see at least 7 to 8 gigawatts of hybrid FDRE tenders being awarded out. And, wind would be about broadly half of that at least.
Okay. All right. Just a quick word, Devansh. There is a lot of concern globally about Trump, and he seems to be targeting renewable energy and particularly wind power in particular. What have you made of those headlines, and will there be any impact on a company like yours?
Look, first and foremost, I think rather than just getting carried away with headline statements, first and foremost, there is no impact of Trump's policies on players like us, which are fully focused on the Indian wind sector. We do not depend on exports. We are not, 100% of our business over the past, I would say 10 years or the past 5 years has all been India. So we have zero impact of Trump's policies on India. Having said that, I would like to reiterate the recent budget maintains heavy focus on RE capacity expansion. There has been enough and more noise around Modi ji's targets, around the clean manufacturing sector, around our net zero targets, and I think all the policy movements have been very positive and reduced this entire uncertainty. For various other parts of the renewable pie. As I mentioned, the wind sector is completely domestic, so we have zero impact. But with respect to other pieces of the pie as well, I think India focusing on its domestic requirements and getting in place what I would call domestic content requirement kind of policies would completely insulate the Indian market to a great extent. Of course, the export markets are a different ballgame, but like I mentioned, in Inox Wind, we are fully focused only on the domestic wind market.
Right. Thank you so much, Devansh, for joining us on an important day just post-budget. Your views on the budget, quarterly performance, as well as the way forward for FY26. Love to have you soon for another quick chat. Let's now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC.
Welcome back to Trading Hour. Well, let's now shift focus to the commodity space. Manisha joins in, and today we are focusing on precious metals.
Thank you for that, Vivek. I'm looking at gold prices, which hit an all-time high at $2,817 an ounce on the higher side. I mean, 2,800. The last time we made an all-time high was last year at around 2,790. So we've done 2,817. It's an all-time high until now. We have seen gold prices gain up for the month of January by nearly 6 to 7%. This has been the best monthly gain since March 2024 that the gold prices have put forth. Well, the gains come in on the back of tariff concerns in the global markets. The expectation is that the 25% tariffs on Canada and Mexico and 10% on China would mean that you could be looking at a slower global economic growth and higher inflation. That means there is safe haven buying coming in for gold. The only reason that the prices have come off those kind of highs is that there is also an expectation, one, of course, the dollar index is gained up, and second, an expectation that the US interest rate cut may not happen at the same pace that the markets were anticipating. So it continues to be quite volatile in case of gold. When you look at the silver prices, well, we are looking at a 1-month highs onto this one as well. Interestingly, before these tariffs came into the market, a lot of gold seems to have shifted within US. When you look at gold, there are COMEX reports suggesting that nearly 14 million ounces gold has been taken into the US markets, and around 45 million ounces of silver also has been bought. And this is all in physical. This has been converted from futures into physical and taken into US before all of these tariffs came in. So clearly, a lot of volatile moves and a lot of movement on the physical markets as well when you look at the gold prices. Interestingly, when you look at the Indian markets, we are trading at a $35 per ounce of a discount because there are not too many buyers on the global markets, rather the physical markets right now.
Thank you very much for that. By the way, Asia is stumbling hard and fast now. The Japanese market, Nikkei, is down close to about 3% We should pull up some of the others. The Taiwanese market has a cut of more than 3%. Korean markets have stumbled 2.7%. So there's global uncertainty on account of Trump tariff. He following up on his campaign pledges about imposing tariffs on China, Canada have spooked global equity markets right now. And the Dow futures too is down nearly about 700 points. That too will come up for you on your screen. But our own markets held up by the strength in some of these consumption names, the Bajaj Finance twins, Bharti Airtel. We're still holding above 23,300 in the red, but off the lows. But let's get to the oil marketing companies because these stocks are under severe pressure. HPCL, IOC continuing with the losses from Saturday. Sudarshan joins in for more. Sudarshan.
So oil marketing companies are sharply under pressure, currently down around 3 to 4%. So now this LPG under recovery story has two parts. So first, talking in detail about LPG under recoveries. As of 9-month FY25, total under recoveries were of more than rupees 29,000 crore. Now, there was an expectation that in budget of 2025, government would announce the payment for under recovery, and that should be more than rupees 30,000 crore. Now, as of 9-month FY25 for IOC, LPG under recoveries was of rupees more than 14,000 crore. For HPCL, it was of rupees 7,600 crore, and for BPCL, it was of rupees 7,300 crore. Now, budget did not have any mention about LPG under recovery. So now everyone is asking, will there be any payment or there won't be any payment? So Oil Minister did speak to CNBC-TV18. He said, unlike petrol and diesel, LPG is regulated and government is committed to make the payment for the LPG under recoveries. So it is two parts total about under recoveries. Now the second part is the statement by Oil Minister saying that payment related to LPG under recoveries will be made. So listen in what exactly he had to say while he was speaking to CNBC-TV18.
Very clearly, we are committed to that. Even when we got it from 28,000 crores, there was an under recovery on LPG. We gave them 22,000 crores. You don't need to make a budgetary provision. We can go to the finance ministry. Otherwise, if somebody behaves like a good corporate citizen in the OMCs and they've had under recovery, we will compensate them. We are committed to that.
Also, the subsidy for PM Ujjwala has trended down, what we have witnessed so far, despite an increase in the number of beneficiaries. Also, do you feel there is going to be an increase in discretionary spend post the budget?
No, there is going to be enough provision for both LPG and that. Don't worry about it at all. You see, two things are happening. Insofar as natural gas is concerned, prices are coming down. Insofar as LPG, which is a product of a refinery, etc., we will look at that. There's no issue of no anxiety on that score.
All right, on that note, we'll slip into a short break. On the other side, we'll invite the management of Med Plus Health Services to stay in for that discussion.
Weeknights at 7 p.m.
Tonight, I am announcing Canada will be responding to the U.S. trade action with 25% tariffs against $155 billion worth of American goods. This will include immediate tariffs on $30 billion worth of goods as of Tuesday, followed by further tariffs on $125 billion worth of American products in 2020.
Welcome back. Let's shift our attention, as promised, to MedPlus Health Services. The company recently reported a good set of Q3 numbers. Revenue growth came in at a little more than 8%, but the margin performance was higher than street expectations. To talk about the way forward, Gangadi Madhukar Reddy, MD and CEO at MedPlus Health Services, is with us on the show now. Thank you very much for joining in, Mr. Reddy. So the first question is on your top line. The top line has gone up by 8.3%, but this is a slightly moderated, growth rate compared to what we've seen in the past. What would you attribute that to? Some say it's on account of a rising contribution of the private label generics, which is now more than, I think, about 11.3% in terms of an overall contribution. So what explains that? And two, what can you guide for Q4 near term and even FY26 in terms of a top line?
Sure. You're right, actually. Part of it is explained by the growth of our private label. Our private label, sells at a discount of 50 to 80% discount. So what would otherwise, on a 100 rupee MRP, bill at around 82 or 83 rupees, now bills at around 45 rupees. So that definitely has an impact. Outside of that, this year we've been really focused on getting the, overall private label and a couple of other things right. And we have not, put in as much effort into growing our number of stores. And I would say, given the fact that we have actually grown by 3,000 stores in the last 4 years, we're also seeing a little bit of, I would say, need for making our supply chain slightly more robust. And we're doing that right now. And that, could explain the slightly, I would say, lackluster kind of growth.
So your got that. So your FY26 store count addition guidance was 400 to 450. In the first 9 months, you've done about 205 stores. Now that you're going slow on it, as you said, what could you end the year with in terms of a store count addition for FY25? And will FY26 pick up that slack? Or will this continue in terms of a moderate store count addition?
Yeah. So it looks like we'll most likely end up adding 300 stores net. We've also closed around 70-80 stores. So the actual gross addition is slightly more than that. But net addition, unfortunately, is going to be only 300. And as I said, part of the reason is this, that in some of the states in which we have grown significantly, there are states in which we have over 1,000 stores, in Karnataka and Tamil Nadu and all. We have seen the need to actually put in additional warehouses in the smaller towns to kind of, take out some of the burden on the main warehouses and to also get the product out properly. And so for that reason, till everything gets functional, we actually decided that we'd go a little slow. But I expect almost everything will come online in this quarter and we'll actually be back to normal in the next year as we go forward. I don't want to, commit to a number right now, but, once the AOP is done and all, I fully expect that we'll get back to the usual 600 stores a year kind of number starting next year.
So FY26 onwards, Mr. Reddy, 600 stores a year is what you intend to add. Couple of numbers with the slight moderation in terms of store addition. Will margin profile now incrementally move higher? Can we expect a higher margin profile? So FY25, where will you end EBITDA margins at? And FY26, what is your aspiration?
See, obviously, there are two reasons for the margin profile to go up. One, of course, is, we are adding a lesser number of stores on top of a larger base. We have 4,500. Even if I had 600 stores, that's still going to be a much smaller addition than what we were seeing in the last couple of years, in which we are adding 1,000 on top of 2,000 stores. So that impact is going to be there. So you'll definitely see a slight growth. I can't, give you a number right now. The other thing, of course, is the growing private label. For us, if you look at the volume terms, our private label sales would be around 18 or 19%, only the pharmacy side. And on a net sales basis, it's around 11.6. So what this does is, every 1% growth in net sales increases our margin by around 0.4 to 0.5%. So we definitely see, this is one of the key drivers for, profit growth for us. and we continue to will continue to push on this lever.
So since that's the thrust of your focus, increasing the contribution of private label from the current 11.6%, how much do you think you will be able to scale it up, say by the end of FY26?
I expect that we could do roughly around 0.5% every quarter. Once you have the initial, early adopters and all, and once you get the initial thing out, growth is not going to be as easy. So I expect we will grow at least 0.5% on net sales every quarter. And that basically means 2% for the year and maybe 1% extra margin.
Mr. Reddy,
So what gets pulled down because of the increased number of stores is a different matter, but the private label alone will at least add that much.
Understood that. Mr. Reddy, one thing we understand about the industry that you're in is that it's extremely competitive by nature. And along with that, we also understand that discounting practices have actually intensified. So keeping that in mind, number one, give us a sense of the current discounting that you're seeing. And number two, is it now a challenge to add stores given the fact that it's so fragmented? And also, along with that, branded, consciously, are you trying to bring it down even further, given the fact that private could be, priced higher for the end consumer?
No, it's nothing like that. So, as everyone knows, there's zero difference between the branded product and what we sell. They're made in the same factories, at the same quality, and given the fact that we don't have the marketing costs which the other guys have, and it is also sold through our own distribution channel, we're able to give a substantial discount on these. So we just present that to the customer. We tell him, okay, we've got everything which you require in the normal process, and that is at a 20% discount. And our own product is at a discount of anywhere between 50 to 80%. It is for the customer to make a choice. For us, we are completely neutral on that. While we make a slightly higher margin on our private label, we really don't. We still value the label of being a one-stop shop for all medicines. When they come to MedPlus, they get genuine medicines, they get everything they require, and they get it at the best price. So we don't really, avoid selling any branded product. Far from it, we try to increase the fill rate on those products as much as possible.
Got that. Thank you, Mr. Reddy, for joining in. It was a great conversation and wish you all the very best. Get into a break. On the other side, we'll talk market technicals. Soni Patnaik from JM Financial Services joins in with the top trading bets.
to allow Canadian companies and supply chains to seek to find alternatives. Canadian energy powers American manufacturing, businesses, and homes. Of America's top 5 trading partners, Canada is the only one with whom the United States runs a trade surplus in manufacturing. And Canada buys more goods made by Americans than China, Japan, and Germany combined.
Presently, taxpayers can claim the annual value of self-occupied properties as nil only on the fulfillment of certain conditions. Considering the difficulties,
Welcome back to Trading Hour. Well, Sony Patnaik from JM Financial Services joins in for a quick technical check of the market. Thank you so much, Sony, for joining us. Give us a sense of how you're looking at markets currently, especially the indices that are seeing quite a bit of a knock today.
Hi, good morning, Vivek and Reema. Thank you for having me on your show. So if we talk about the indices, I think both the indices, Nifty and Bank Nifty, are pretty much range bound. If you look at the Nifty's range, it has to be somewhere between 23,100 on the lower side, which is a good support. On the high side, 23,500 to 23,550 is the resistance area. So I think as long as it's not holding or breaking either side of the range, further trend could be ruled out for some positional days that one can see. Bank Nifty is quite crucial because Bank Nifty right now is still holding above its support of 49,000. However, for any fresh upside in Bank Nifty, it has to cross 50,200, which is a 200 exponential moving average resistance. So only above that level, we can see fresh upside in Bank Nifty towards 51,500 odd levels. Knowing that the event is lined up for this week, the possibility that Bank Nifty may also remain range bound within a 1,000-point range until the event is played out. So I think both the indices quite range bound. Stock specific action could be the best strategy to go for the next 2 to 3 days.
Sony, you want to tell us the stock-specific trades then, since that's the best strategy?
So, Reema, we'll have a buy and a sell recommendation as a balanced approach. The buy comes in for Bharti Airtel today, which is sustaining above all its major short-term moving average on daily charts. One can buy Bharti Airtel around 1655 odd levels, keeping a stop loss of 1625 and a target of 1700 to 1720 can be seen for the coming days. The second sell recommendation comes in for Canfin Homes, which has broken below its major support levels, below 650 odd levels. So one can sell Canfin Homes in future around 645 to 648 on small rise, keeping a stop loss of 660 and a target of 630 to 620 can be seen.
Thank you so much, Sony, for joining us, giving us a sense of both the market levels to watch out for as well as your individual stock picks. Time now for a short break. We'll get you a slice of our conversation with Neelkan Mishra of Axis Bank on the Union Budget 2025 on the other side. Stay tuned.
Payers, it is proposed to allow the benefit of 2 such self-occupied properties without any condition. To streamline the process of transfer pricing and to provide an alternative to yearly examination, I propose to introduce a scheme for determining arm's length price of international transaction for a block period of 3 years. This will be in line with global best practices. With a view to reduce litigation and provide certainty in international taxation, the scope of safe harbor rules is being expanded. A number of senior and very senior citizens have very old national savings schemes accounts. As interest is no longer payable on such accounts, I propose to exempt withdrawals made from NSS by individuals on or after 29th August 2024. I am also proposing to allow similar treatment to NPS Vatsalya accounts as is available to normal NPS accounts subject to overall limits. The middle class provides strength for India's growth. This government, under the leadership of Prime Minister Modi, has always believed in the admirable energy and ability of the middle class in nation building. In recognition of their contribution, we have periodically reduced their tax burden. Right after 2014, the nil tax slab was raised to 2.5 lakhs of rupees, which was further raised to 5 lakh rupees in 2019 and to 7 lakh rupees in 2023. This is reflective of our government's trust on
testing.
Welcome back. It's one day after the budget and it's time to get your opinion. And this time it's an important one coming in from Neelkant Mishra, the chief economist at Axis Bank and also the head of global research at Axis Capital. His view is that it's incorrect to say that the government is moving away from infrastructure. The government had limited capacity to spend. They had a discretionary of about 1 lakh crore rupees and they chose to do so on the consumption. So listen in to what he had to say as he weighs his opinion on the consumption versus the capex debate.
Is the interpretation that the government is moving away from infra and focusing on consumption correct? Because it's got implications for markets as such. Go on.
I disagree with that because the limitations on how much the government can do on capex was clear even last year. Remember that out of the 11.1 lakh crores, 9 lakh crores was stuff that the government could control. There was 2.1 lakh crores that they had no control over. So we are hitting the limits on what the government can directly do in terms of capex. And therefore, the guidance from the government was that we will maintain capex as a percentage of GDP year onwards. That the scope for us to do more is now gone. So now they're experimenting with, for example, this 1 lakh crore that they've decided to spend on urban infrastructure, but through a competition mode, so the states need to compete for it. They have to find such avenues so that capex continues, but there is very little more they can do at the center level. So I don't think this is a stepping away from capex.
Absolutely. Neelkant, in fact, if you could just elaborate on that point, another sort of, statement that's been doing the rounds or calculation or thought process that's doing the rounds is that if you add up capex from the states and the capex that will be done via PSUs, and maybe we're still talking about 20% growth, almost 19 to 20% growth, and not the 10%, which is direct capex, which is in line with nominal GDP. So how would you read into this, the form and format that capex will take from here on?
No, I think those are also very interesting points, but we need to take a step back here and figure out that if gross fixed capital formation as a percentage of GDP in India is 32%, and the central government spending is about 3.7%, or say 3.5%, 3.4%, how much more can it actually contribute? So this is effectively less than 10% of overall investment to GDP in the country. Investment activity in the country is going to be a lot more dependent on how well the real estate cycle turns, how well the power generation cycle turns. And I think this almost obsession with waiting for the government to spend an extra 40,000 crores, in the larger scheme of things, these are all rounding errors. Remember that the fiscal space for the government was very limited. In fact, in the preview session that we had in your studios, we had discussed this, that, all said and done, there's only about 1 lakh crores, which is less than 0.3% of GDP in FY26, is that the government has discretion on. I think it is unwise to expect the government to be doing everything. And I don't think it needs to be doing everything. If the real estate cycle turns, if the power generation cycle turns, and both seem to be turning, we will not be dependent on the government to drive up, say, the industrial stocks or the earnings for industrial companies.
You're sounding pretty satisfied with regard to what the government has done on the capex spend front. But what about the approach to markets? How would you alter the approach to markets? Given the consumption push, they've maintained capex reasonably. But we also have this threat coming in from Trump's tariffs. So your take on the equity markets from here on, post the recent correction?
Absolutely. I was waiting for someone to say that. So the budget is now in history, right? Budget was largely as expected. There was a 1 lakh crore of tax cut for the middle class. But remember that the government is still shrinking its fiscal deficit. And therefore, the aggregate impact or the demand on aggregate impact on aggregate demand is actually still negative. The Trump tariffs, on the other hand, are going to be, they have triggered something which is very substantial. See, normal wars, and especially if they are being fought in other jurisdictions can actually be accretive to earnings, and sometimes they support stock markets. Here, there are political objectives being met through economic damage. So knowing fully well that this will hurt the US economy, and that if there is retaliatory action, it will hurt many parts of the economy. And on top of that, to potentially escalate it to Europe and other parts, I think all of this creates significant uncertainty for the economic forecast. And that, I think, is terrible for markets. So over and above what is happening with the DXY, over and above the 0.8 to 1.5% seems to be the first cut impact on US GDP because of the decisions announced. The reason why the markets are not reacting even stronger is that everyone expects that this is temporary and will be withdrawn. But this adds a very different layer of uncertainty to economic forecast.
All right. But is there you would agree there is focus on consumption now, right? That you would agree with, Neelkan? And this is after some time putting more money in. And it's not just 1 lakh crore, it's not one time, right? It's recurring. And there is a broader, I don't know whether there's messaging or it's kind of, it had to be done. The move itself is one time and whether we'll see more moves, etc. So from stock market point of view, consumption, where will this money go according to you? And is there anything investors can do based off this?
Yeah, so that is somewhat easier to quantify. So if you look at the number of people who disclosed income to taxpayers, see if you're earning that much but you're not paying tax anywhere, you're not impacted. So we have to look at the people who pay taxes. So that this eases our job. The biggest impact is for people disclosing earnings between 12 lakhs and 50 lakhs. The number of people affected, because the last data we have is for FY23, was about 58 lakhs. If you extrapolate it to say FY26, maybe about 70-75 lakh. That's the number of people who will be the biggest beneficiaries of these tax cuts. And most of these people would be in the 90-95 percentile, maybe even higher. The higher ones, maybe the percentage impact will be lower. What is their discretion? What is their incremental demand going to look like? And that's mostly going to be discretionary. So I think that the impact of this directly will be mostly on the discretionary items. So, jewelry, retail, and somewhat, I think the market was responding rightly to this on Saturday, cars, two-wheelers, etc. So at an aggregate demand level, remember that the deficit is still shrinking. So, and a large part of the space that is being created for these tax cuts were actually also coming from personal income taxes. Absolutely. So whatever you are seeing in terms of better compliance, more people disclosing higher incomes, is now the government has decided to take some bit of that and give it to what was becoming the pillar. So if you compare India's central government's fiscal math, FY19 to FY26, over 7 years, the government has so far seen a very sharp increase in personal income tax to GDP. A large part of that has actually gone into increasing capex because primary deficits are more or less back to where they were in FY19. And so going forward, if you have another lakh crores and there is no ability to spend it directly on the issues that you can control, on the areas that you can control as a central government, then you might as well give it back to the taxpayer, which was actually funding a lot of this capex. So that seems to be the political economy equilibrium. I would expect direct impact on the segments which are affected by this, but overall, the questions on whether this increases inflation, whether this increases the current account, I don't think there will be any impact.
Okay, interesting conversation as always, but consumption stocks continue to do very well. ITC Hotels up 5, Swiggy up 4, Nykaa has advanced about 3.5%, Vishal Mega Mart, an affordable retail play, that's advancing nearly about 2.5%, and Varun Beverages is adding on to its gains from Saturday. Get into a break. On the other side, another corporate discussion lined up. Green Lamb Industries, the company reported a soft Q3. Saurabh Mittal joins in next.
Taxpayers, I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees. indirect tax reforms and changes in direct taxes in Part B. Financial sector reforms. The FDI limit for the insurance sector will be raised from 74 to 100%. This enhanced limit will be available for those companies which invest the entire premium in India. The current guardrails and conditionalities associated with foreign investment will be reviewed and simplified. The services of India Post Payment Bank will be deepened and expanded in rural areas. NABFID will set up a partial credit enhancement facility for corporate bonds for infrastructure. Public sector banks will develop Grameen Credit Score framework to serve the credit needs of SHG members and people in
Welcome back to Trading Hour. Well, Greenlam Industries recently reported their Q3 numbers. The company delivered a weak performance in the quarter gone by. Revenue growth was soft while EBITDA declined. Profit after tax halved on a year-on-year basis. To discuss more on this, we are joined by Saurabh Mittal, MD and CEO at Greenland Industries, who joins us now. Thank you so much, Mr. Mittal, for joining us now. First up, give us a sense on the outlook as far as FY25 and FY26 revenue targets are concerned. And in this, what will be exposed as a percentage both of sales as well as margins?
So FY25, we were targeting like a 18 to 20% growth earlier. And I think 9 months, we're at about close to slightly above 12% growth. So my sense is FY25, we will be in a 12-13% kind of a top line growth, this FY. FY26, we should be, I think, again, back to a 18-20% kind of a growth and a target for FY26. On domestic to exports, I think the domestic market share will keep going up because several of the new capacities, new products are largely domestic market oriented. I think currently it's about 55% domestic revenue and 45% export revenue. My sense is in the coming year, probably will be 60% domestic and 40% international revenues. While exports will keep growing, but because the two new categories of particle boards and plywood are largely going to be domestic market oriented, the percent shift will happen.
Got that. Saurabh, what according to you are the reasons for the miss versus your expectations? You'll end the year with 12-13% versus your earlier anticipated growth of 18-20%. So what were the headwinds to your mind?
So one is the new plant got delayed from Q3 to Q4, which is the particle board plant. So those revenues got deferred. And I would say the second would be the domestic market offtake has been slower than expected, and even the international growth in Q3 slowed down a bit. So I think just maybe demand situation in both domestic and international markets, and the shift of the production startup of the new plant in Andhra Pradesh, which began on 23rd of Jan. While growth might have slowed down a bit versus our expectation, I would also want to say that we've taken more market share. So we believe we've grown market share in both domestic and the international markets. The new categories of floor and door have started delivering results, and we see a good traction in that segment. The plywood business has also been growing well because we were new in the business, and we've also improved realizations there. So I would say it's a mixed bag. So certain areas we've kind of slipped a bit, mostly demand-led, but versus the market, I think we've taken more market share.
So Saurabh, what's the evidence that you've gained market share? Do we have numbers?
Well, I don't have the numbers off my hand, but if you see records like data of listed companies of H1, so clearly our market share in laminates in both domestic and international has gone up. We do get some data on the international market, but that's a later point of exports from India. So there too we see our growths been higher than the competition, and we've gained market share.
Okay, Mr. Mittal, one thing we want to understand, while you've gone ahead and moderated your FY25 revenue growth guidance, give us a sense of the volumes you're targeting, because the quarter gone by, there's been volume growth and there's been better realization growth. So FY25 and FY26, give us a sense of volumes that you anticipate in the various segments, and also what will be the realizations that you will be able to garner.
So going category-wise will be hard for volume, but I think we have had volume growth in 9 months across categories, I think, other than the veneer segment. And we've said this earlier, volume in laminates in the core category should grow at about 10-12%, every year. And on the realization front, I think in last quarter and 9 months, I think we've had a lot of pricing discipline. Value mix has been pretty decent. So realizations have been well maintained or slightly have improved. Raw material costs have also been by and large stable. Whatever cost increases happened, we had passed on the increases to the market. So I think from those parameters, things are looking pretty good. We just need to push up a little bit of volume sales to improve our growth and our profitability.
When do you expect the decorative veneers segment to grow?
So if you look at that entire category, the veneer, the flooring and door, they have grown in Q3 and 9 months. And the veneer, the decorative veneer business is still running a slight degrowth on a 9-month basis. So I expect the flooring and veneer to grow well in Q4. The veneer business might be like flattish versus FY24. So Q4 and Q4, we expect some growth coming in. But as a category together, all three products, I think will grow in FY25.
Mr. Mittal, talk to us about both capacity expansion plans at Andhra as well as Gujarat. Both of these plants you expect to increase capacity. When do they come on stream? Any delays over there? And what is the peak performance that we can expect from these new capacities when they come on stream?
So as we talk now, all the new capacities we were building have come into commercial production. So we have no capacities pending to be put to production. While we've said in the past that we have brownfield capacity possibilities in both Gujarat and Andhra Pradesh, they remain the same. On these capacities which have been invested on a near full utilization, I think we should be like a 4,000 crore kind of a revenue, over the next 3 FYs, which is up to FY28. So that's what I can say at this moment.
And a quick word on how we should expect margins of the company to trend going forward?
Well, if the revenues come in, margins should keep improving. You see gross profit, despite all the challenges, have slightly inched up in Q3. We've been able to maintain gross profit in 9 months versus 9 months. So clearly pricing discipline, value mix, RM costs are stable. So I think we just need to ramp up a little bit on volumes, and I think margins should keep improving as revenues and volumes keep moving up.
Thank you so much, Mr. Mittal, for joining us, giving us a sense of how Q3 panned by. Some moderation as far as FY25 revenue growth is concerned, but a more positive outlook as far as FY26 is concerned. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.
A forum for regulatory coordination and development of pension products will be set up. To implement the earlier announcement on simplifying the KYC processes, the revamped Central KYC Registry will be rolled out in 2025. We will also implement a streamlined system for periodic updating. Speaker, I present the budget for 25-26. This budget continues our government's efforts to A. Accelerate growth, B. Secure inclusive development, C. Invigorate private sector investments, D. Uplift household sentiments, and E. Enhance spending power of India's rising middle class. Together, we embark on a journey to unlock our nation's tremendous potential for greater prosperity and global positioning under the leadership of Honorable Prime Minister Shri Narendra Modi. As we complete the first quarter of the 21st century, continuing geopolitical headwinds suggest lower global economic growth over the medium term. However, our aspiration for a Vikasit Bharat inspires us, and the transformative work we have done during our government's first 2 terms guides us to march forward resolutely. Our economy is the fastest growing among all major economies. Our development track record for the past 10 years and structural reforms have drawn global attention. Confidence in India's capability and potential has only grown in this period. We see the next 5 years as a unique opportunity to realize Sabka Vikas, stimulating balanced growth of all regions. The great Telugu poet and playwright Gurujada Apparao had said, Deshamante matti kadoy, Deshamante manushuloy, meaning a country is not just its soil, a country is its people. In line with this, for us, Vikasit Bharat encompasses zero poverty, 100% quality good school education, access to high quality, affordable and comprehensive health care, 100% skilled labor with meaningful employment, 70% women in economic activities, and farmers making our country the
Stocks slide across the world after US ups tariffs on imports from Canada, Mexico and China. In India, mid-caps feel the heat. Capital goods and utilities are the biggest drags.
The rupee falls to 87.23 against the US dollar, even as most Asian currencies fall between 0.5% to 1% in response to imminent tariff threats by President Donald Trump. Trade uncertainties trigger flight to safe havens in global markets, leading to a sharp surge in gold and the dollar index.
Market mavens Ridham Desai, Neelkant Mishra, S. Narain and Samir Arora welcome the budget and point to a strategic shift towards consumption as scope for government's capex spend slims. They see tax cut as a better way to distribute revenues versus wasteful expenditure.
Bajaj Auto and Hero MotoCorp see a decline in domestic sales in January, but strong growth in exports helped save the blushes. Premium bike makers Eicher Motors, however, revs up at home as well as overseas.
Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu. With me, Hormaz Fatakia. The Nifty down about 200 points. The Sensex down about 550 points. But the Nifty Bank down by about 0.75% as well. One would call this a weak day for the bulls. But the good part is that we are saving on to levels at lower levels. And at the same time, we've seen some amount of recovery from the lows as well. We have a couple of pockets of the market which are trying to outperform today. Obviously, post-budget announcement, we've seen that shift to consumption. Urban consumption in particular is seeing some traction. And now, just as we speak, a couple of these IT names are also picking pace. So we have Infosys, which has moved to the higher point of today's trading range. Wipro as well, doing well. So we'll keep an eye out on, a bunch of stocks which are doing well. There is a broad swathe of red, but there are islands of green. So not all is bad, Hormaz.
Not all is bad. And considering the futures in the US, are we seeing the kind of sell-off that they are? We are being fairly resilient considering the drop that we have seen so far. And as you mentioned, there are islands of green, and most of these islands of green, as you mentioned, are these urban consumption names, be it the likes of Westlife Foodwork, Metro Brands, Voltas, Devyani International. All of these names are seeing a surge of anywhere between 5 to 7% in today's trading session, carrying on from where they left off on Saturday. As you can see there, Westlife Foodwork at the highest point of the day now, 8% higher for that stock. Metro Brands too, trading with gains of around 6.5%. Voltas is trading with gains of 6%. At one point, Blue Star on Saturday was up 13% after the budget announcement. So urban consumption, discretionary consumption, that is one theme that is seeing a big tick of green in today's session as well. But what is not doing very well though are the railway names and the PSUs. The railway names, the defense names, they continue to see a very, very sharp sell-off in today's trading session, be it the likes of Rights, which is down 8.5%. Jupiter Wagons is down 8.5%. Rail Vikas Nigam is down 8%. Bharat Dynamics is down 7%. So there is absolutely no let-off for these PSU names. They were down 7 to 8% on Saturday, and they are continuing that move in today's session as well, Mangalam.
Take that point completely. If you look at the BSE Capcodes Index, it's down about 4.5% in today's trading session as well. So we have a bunch of stocks which were doing well over the last few trading years, so to say, are now coming under a bit of pressure. Maybe it is because of that sectoral shift that we're speaking about in terms of consumer too. But let's talk about Sun Pharma, the first management on the show. In their India business, they've seen outperformance versus other markets. India formulation sales actually grew by about nearly 14%. US formulation as well declined by about 0.7%. Our colleague Winnie caught up with CS Muralidharan, who's the group CFO, spoke about the results. The stock currently at the low point of trade, but here's what the management had to speak about the numbers.
So as we stated earlier, all our therapeutic segments are doing well as far as the Indian market is concerned. We have already shared that we would like to grow in line or faster than the market. Along with the market performance, I would also like to share that approximately 50 to 55% of the growth is led by volumes and new products. And we are well positioned to grow in line or above the market going forward.
Okay. You've highlighted that all your therapies are doing well. I want to also understand, given that, recent deals that we have seen in from the company side focuses on a lot more new therapies as well. Maybe you could see derma, ophthalmology or oncology side, derma onco side. Could you explain us the strategy of the company going forward? Do you think these newer therapies is something that will see a better growth?
So our transactions, what we look at, as we said, is more towards oriented specialty, and at this point of time, not India focused.
Okay. Sir, I also want to understand in terms of US business, obviously that impact of Revlimid has started coming in, but I want to understand on the long-term basis now, what is the growth driver for the US market for the company? Where do you see the company's US business growing in the next couple of years?
See, all our products in the specialty portfolio perform well in the quarter. Overall, the outlook for specialty business remains very positive, and we expect our key specialty products to continue to grow in the coming quarters. As such, we do not give any specific guidance for any particular segment of business. However, it's pertinent to note that any specialty revenue growth is part of the overall revenue guidance for the group.
Okay, so actually I just want to understand, like you were mentioning also, specialty side of the business, US business has grown very well. So any specific focus in terms of drugs that could be leading the growth going forward? Do you think anything on that front? If you could give us any name or anything that you think will drive the growth there.
Our key products continue to do well. For example, in the current quarter, we saw good growth in Ilumya, Cequa, Winlevi, Odomzo, and it has been a broad-based growth across our key specialty products.
Okay, broad-based growth plus with, the key brands which you mentioned are also seeing good growth. So, moving on, I want to understand in terms of R&D expenses. I believe in the con call you spoke about R&D expenses lowering the guidance to less than 7% for FY25 versus previously 7 to 8%. FY26 also, would this trend continue? Would R&D expense continue to be sub 7%? Or, this was just those one-off cases where we are seeing sub 7% and then move back to 7-8% what we have?
See, what we stated in the earnings call of 6 to 7% of sales for the current year FY25. As far as the R&D guidance for FY26, we will be giving the guidance later on along with the annual results.
Okay. And any update on Lexiliv? What is the current update in terms of litigation? Expected timeline of launch? Any clarity on that terms if you could get?
As far as Lexiliv is concerned, we have filed the appeal against the injunction. The oral hearings are expected to commence in the month of April, and we shall await for the outcome of the decision.
Okay, waiting for an outcome of decision somewhere around April. Okay, and so overall outlook for the emerging markets as well as the rest of the world managed to see growth this time. The formulation side, this good growth that we're seeing in both these market side, is that expected to continue?
See, emerging markets and the rest of the world, both markets are very key markets for us. and we continue to perform well in these markets. And we got a good pipeline in these both the markets, and we expect to continue to do well in the respective key geographies where we participate in these markets.
All right, so that's the management of Sun Pharma. With that, we'll take a short break. On the other side, we have B. Vijay Kumar, who's the CMD at LG Balakrishnan and Brothers, joining in to discuss their third quarter numbers. A lot that the street is expecting from this company in the near future. We will get chatting with the management.
The world. In this budget, the proposed development measures span 10 broad areas, focusing on Garib, Youth, Annadata, and Nari, spurring agricultural growth and productivity, building rural prosperity and resilience, taking everyone together on an inclusive growth path, boosting manufacturing and furthering Make in India, supporting MSMEs, enabling employment-led development, investing in people, economy, and innovation, securing energy supplies, promoting exports, and nurturing innovation. For this journey of development, our four powerful engines are agriculture, MSME, investments, and exports. The fuel, our reforms, our guiding spirit, inclusivity, and the destination, Vikasit Bharat. This budget aims to initiate transformative reforms across 6 domains. During the first 5 years, these will augment our growth potential and global competitiveness. The domains are taxation, power sector, urban development, mining, financial sector, and regulatory reforms.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
Markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Back with us here on Halftime Report and continuing with corporate conversations. Then LG Balakrishnan reported a steady quarter. Revenue surged over 13%. The margins contracted marginally though. And we are being joined by B. Vijay Kumar, the Chairman and Managing Director at the company, who is joining us now to discuss the road ahead for the company. Mr. Vijay Kumar, good afternoon. Thank you so much for joining in. Now you look set to meet your revenue guidance for the year. What about margins though? You projected a 17% margin for FY25. For the first 9 months, you are at 16.5. You think you'd be able to meet that 17% target and even surpass it by the fourth quarter?
Yes, sir. We will surpass it. We will maintain 17%.
All right. And, a couple of things I wanted to know, because we understand why the margins were lower as well. Gross profit was at an all-time high, but EBITDA margins were lower on account of increase in headcount on account of the industrial chain facility. You had other expenses which were higher as well because of the trial runs of some of the new businesses. Let's talk about those businesses itself. The key triggers that the street believes for you would be the ramp up of LGB Steels and the ramp up in industrial chains businesses. From levels at where they are right now, What is your target for both of these businesses for the next 12 to 18 months, sir?
We are looking at a total growth of 10%, all inclusive. And if you look at steel alone, we are looking at touching about 200 crores.
That is in FY26.
Yes, FY26.
And industrial chains business, how much will that be as a proportion of your sales? How will that grow?
Industrial chain, it's a little slow, but we will reach about 50 crores.
What about the new generation facility, Mr. Vijay Kumar? What was that contributing to your business in the third quarter? Because you're targeting revenue of around 100 to 125 crores in this fiscal by the from this new facility. Do you think you'll be able to achieve that? How much has it contributed already in the first 9 months?
This year we will we'll have a contribution of about 30 crores. Next year we will have a contribution of 50 crores. That 125 is an objective, but we are a little slow reaching that.
How much is the utilization currently of that facility, sir?
About 10%.
All right. Do you think you are...
We are still in the process of training workmen, and so it's a little slow.
Right. Do you think you are under promising when it comes to growth for the next year? Because I'm looking at the last 7-8 quarters, you've outperformed the industry, the motorcycle industry, by at least 200 to 300 basis points on a regular basis. Next year, the street believes that the two-wheeler industry will grow in double digits, and you are expecting just 10% revenue growth. Do you think you can do about mid-teens with all the triggers that you have in place?
See, if the two-wheeler industry grows phenomenally, it's very good for us. We will also grow, but we are looking at being a very stable outlook. We are giving a 10% flat growth.
Okay.
We have a lot of divisions, metal forming, we have steel, we have by consolidating, we have also the US business. And you know that there is a lot of confusion with the international business, both in Europe as well as in the US. And
which is why I was getting to my next question, Mr. Vijay Kumar. What is the export picture looking like? You mentioned there is a lot of confusion with regards to business in the US and in Europe. Now with this latest tariff war concerns that have risen, would you want to increase your business more towards the domestic front, or what is the picture that you're witnessing on ground overseas right now when it comes to demand?
See, if you look at it on a blunt basis, any tariff from Mexico and on China is bound to help India. So if that happens, our export will improve, definitely. The export last year has been flat.
And yes. How much is this part of your business, sir, the domestic to exports mix?
The export is about 13%.
Okay. On the key customers, one of the other expectations is that you are increasing your share of business with the key customers, and you are looking at higher share coming in from aftermarket as well. If you could give us a sense of, what your average revenue per key customer is, how are you looking to grow that? And in terms of aftermarket, what is your share at right now? What is your target?
The aftermarket would be about 32%.
And what is your target here, sir?
We'll maintain the 32%. No, the market, it's a mature market. It's not going to suddenly grow. It depends upon all the vehicles which have already been sold for the last 10, 15 years. So we will maintain what ratios are there. Competitors are also going to be very active.
All right. And what about the RSAL NCLT approval that has come by? I remember us having a conversation. You said that this new product line could actually add sales of almost 1,000 crores when you first spoke to us around this acquisition. Now the NCLT has, I suppose, approved it. When does that come onto your books, and by when do you reach the promised 1,000 crore?
The NCLT approval has been obtained. It's already there. We've changed the name of the company to LGB Steel. And we are already operating. We've done about 1,500 crores of domestic turnover. Sorry, 1,500 tons of domestic consumption. We've also sold about 1,000 tons to the market. So beyond the capacity would be about 7,000-8,000 tons. But to reach that, we need a lot of capital addition, and the capital addition again takes time.
And at peak, what is the revenue that this can do?
We will currently, next year, we should do about 200 crores from this unit.
All right.
1,200 tons is possible, but over a period of 3-4 years, because getting the equipment and installing it is going to take me about 2-3 years.
All right, Mr. Vijay Kumar, thank you so much for spending time joining us today. Wish you good luck for the rest of the year as well. That's the management of LG Balakrishnan, confident of meeting its margin guidance of 17% for FY25. Take a short break, more on the markets, and we focus on the F&O setup at midday on the other side. Stay tuned.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
We are hitting the limits on what the government can directly do in terms of capex, and therefore the guidance from the government was that we will maintain capex as a percentage of GDP here onwards, that the scope for us to do more is now gone. So now they're experimenting with, for example, this 1 lakh crore that they've decided to spend on urban infrastructure. They have to find such avenues so that CapEx continues, but there is very little more they can do at the
Welcome back. Even if you're looking at the indices right now, they're lower, but not much lower from what they were in the earlier part of the day itself. If anything, we've seen some bit of recovery from the lows itself. Good time to get you the update coming in from the F&O space in the market right now. Why is this important? Because even as the Nifty and the Nifty Bank are lower, the mid-cap index is underperforming. They're holding on to crucial levels. The Nifty Bank is holding above that 49,000 mark. The Nifty itself is holding above that 23,270 mark. Why are they important? Because 49,000, closer to 49,000 is the 20-day moving average for the Nifty Bank, and closer to 23,270 is the 20-day moving average for the Nifty itself. So long as they hold about this, bulls would feel slightly better. All eyes will be on the Nifty Bank because the RBI policy outcome under the new governor is on Feb 7th itself. And amidst all of this, the urban consumption plays. Nestle, for instance, has 80% of its revenues coming in from urban India, holding on to the green. Voltas does about 5% in terms of gains today. Nykaa is doing a lot better. Jubilant Foodworks is doing well as well, and Bajaj Finance. If you're looking at buying urban consumer discretionary on finance, etc., the consumer loan growth for Bajaj Finance likely to be better as well. So those are a couple of factors that we'll keep an eye out on. The fact that the Nifty is holding on to important levels has had the put writers excited. So you have the 23,200 put, 23,300 put rather, fairly active for a premium of 100 rupees, telling you 23,200 would be an important support. We've also seen some writing at 23,250 put. Again, so between 23,178 to 23,200 is where the bulls see some support at the lower levels. But on the way up, there is some supply coming in, no two ways about that. We saw writing at the 23,500 call in the previous trading session as well, and that continues even now. So upwards of 23,550 is a level where, there could be some more supply, even if we do recover from current levels itself. A lot of long positions added again on urban discretionary names. We have United Breweries and Phoenix Mills, both of them in focus. Whereas the capex names, they are being beaten out of shape. So we have Torrent Power, Hoodco and NCC, all of them down anywhere between 6 to 9%, seeing a lot of short positions being added out there.
And you spoke of Hudco is almost now halved from its peak, which was around 353. So the PSUs continue to sell off, and all of these names, be it Hudco, Bharat Dynamics, the shipbuilding companies, all of them seeing significant pressure in today's session. What's also at the day's low, though, is Samvardhana Motherson. That too is trading 8.5% lower now amidst these Trump tariff concerns. We take a short break. On the other side, we connect with Saugata Gupta, who's the MD and CEO at Marico, to discuss the quarter gone by and the road ahead. Stay tuned. We'll be right back.
Investment activity in the country is going to be a lot more dependent on how well the real estate cycle turns, how well the power generation cycle turns. And I think this almost obsession with waiting for the government to spend an extra 30,000-40,000 crores, in the larger scheme of things, these are all rounding errors.
Welcome back. As we're seeing a bit of a sell-off in staples, just keep an eye out on Marico. The stock is at the low point of trade, but the company reported a third quarter which was better than its peers. Margins were under pressure on account of increase in key raw materials for the company. Let's connect with Saugata Gupta, who's the MD and CEO of the company, to get more sense on their third quarter performance, the outlook on that as well. Saugata, always a pleasure speaking with you. But before we speak about the performance, everyone's talking about this being a consumption-led budget itself, a consumption-focused budget. The cut in income tax expected to give a boost to urban consumption in particular. How do you see this as a move from the government, your comments, and how does this benefit a company like yours?
I think this will be a very big game changer, because at the end of the day, I think if you look at the overall consumption situation, there was some stress in urban. It was a combination of inflation, the fact that real wages hadn't increased significantly, and also the fact that there hadn't been tax breaks in the last couple of years. So this will definitely spur consumption, and just not in FMCG, but if you look at, it could be QSR, apparel, some retail, two-wheelers, entry-level cars. So I think it's a overall good thing for the economy, and also I think it also improves sentiment. Sometimes sentiment also somewhere curtails consumption. So I believe this will be very good for the economy and a lot of sectors, and this will also drive, therefore, more demand, and leading to further investment if there is more demand and capacity creation.
Right. Saugata, with this boost in consumption that is expected, will you upsize your growth outlook as well going forward?
It will be, I would say there will be tailwinds to drive our aspirations. As you know that even in a difficult quarter, we delivered a 15% revenue growth, and in spite of significant input cost inflation, we delivered a decent bottom line growth. So what we have said in the outlook that we'll continue to deliver double-digit revenue growth, top quartile volume growth, and of course there would be some maybe transient profit in the couple of quarters, but that over the medium term will sort itself out. So I think this will just aid the consumption, and fortunately for us, if you look at our diversified portfolio, which is completely urban, Saffola is completely urban, so 70% of our portfolio is urban centric, so this will help.
All right, 70% of your portfolio urban-centric. This will be a tailwind in your double-digit revenue growth aspiration. But margins, that's been the pressure point, right? Let's talk about that. Oil prices, copra prices saw steep hike year on year. How low can your margins go from here on, and by when do you expect them to improve?
Look at copra cycles is usually a 18-month cycle, 15 to 18-month cycle. We are at the fag end of the cycle, so things will obviously sort itself out sometime towards the end of quarter one. And as we said, that we will be able to deliver margins around 20. So maybe there would be some transient headwinds at the beginning of the year, but it will ease itself out, and as we go through the year. I think our entire endeavor is to ensure that we continue to invest. We'll obviously have very, very institutionalized cost management programs that drives efficiency, but we're not going to, if you notice, we are one of the very few companies who have not cut A&P to manage margins, and therefore we'll continue to invest to grow. And I think the biggest tailwind for us is a combination of two factors: our diversification strategy, which is of foods, digital brands, and premium personal care, and our international business continues to do well. So it somewhere, gives some air cover.
And since you spoke of diversification, Saugata, if you take a look at your diversified portfolio, what is the difference in your overall portfolio margins compared to the combined margins of your diversified portfolio?
I think we have had significant improvement in margins, and we believe that, to give you an example, with scale, our oats portfolio is near about the company EBITDA. If you look at Beardo, we are already hitting a double-digit EBITDA. Plix is a brand which is expected again, is in the positive territory. There is very little, bleed in the two other digital brands. So the digital business is expected to hit 10% EBITDA in in the next 3 years, even we have if you look at our journey of margin expansion continues in the international business, especially in the Middle East and North Africa, where we are aggressively getting shares from competition. So there are enough levers to drive the margin. And I think the effort has been to that we have been extremely conscious of the fact that we will not drive disproportionate growth at the cost of margins in the digital business, and therefore having a lot of cash burn, which we have not been doing. We have been extremely prudent. We are happy with the 30% growth in the digital business, but doing it profitably.
Right, that's about the digital business, but let's talk about international business. You briefly mentioned into it. You were also looking to diversify away from Bangladesh. Where does that number stand at right now, and what's your target in terms of margin expansion or margin aspiration in the international business from here on?
We have been aggressively driving diversification on two fronts. One is that how do you have a business beyond Bangladesh? Bangladesh business now contributes to around only 40%. Some time ago, it was 50-55. Secondly, what we have been driving is reducing our dependence on coconut oil and some of the core brands. So there has been a huge journey in that diversification also. We are now present in categories like, if you look at shampoo in multiple countries, we are into body care, we are into multiple categories across some of the markets. I think 2 or 3 of the markets that are delivering significant growth one is being Middle East and North Africa, where we have been gaining, where we had a slightly under index presence, and the profit pool and the pool for top revenue was very high, and therefore we have been rapidly gaining market share as well as growth, and we are extremely confident of delivering 30% plus growth in that market. South Africa has played well. Our new country development has been also doing well. We have been extremely careful about expanding in Africa with less capital and less boots on the ground, because we believe that's a smarter way to expand. We are also doing we are also expanding into some of the other markets, including Southeast Asia. So I believe there is headroom for both top line growth and as the mix improves, the kind of an EBITDA improvement even in the international business. But I think having said all that, I think our Bangladesh business has been extremely resilient. We continue to grow double digits, and we are confident of growing double digits in that market.
And that's some optimism, Saugata. There is optimism all over your commentary in general as well. But aside of this optimism, is there any risk that you foresee?
Obviously, there could be black swan anywhere. I think that is something there. And obviously, we have to do a much better job on value-added hair oils. I think the others is about keeping the momentum and managing the medium-term, or rather the short-term margin pressures. But I think in India, one category we haven't done well is value-added hair oils. It has to get into positive. And I think international, we have to be careful about whether it's geopolitical or currency, those black swans, but we need to be careful about. But I believe strongly that in today's world, there would be, volatility, there would be, black swans you have to embed into the business, and ability to anticipate a risk or anticipate an opportunity and being resilient is a critical, differentiator for organizations.
Fair point there. Candid of you to admit that, value-added hair oils is where you have to do a lot more work. We'll talk about that at another date. But is there any other category that you're eyeing in the diversification strategy, or anything that you're actively pursuing?
One of the things we want to look at is in foods. We already present very limited. We are prototyping on snacking and breakfast. I think beyond oats and masala oats, which is now critical mass, we need to create some big scale in 1 or 2 of the categories, and therefore we have just about wetting our feet on snacking and breakfast. We have launched muesli. So these are the 2 categories we intend to grow.
And any inorganic opportunities in the near future, or your plate is full?
Enough on our plate right now, but we keep on looking. That's something is a part of life.
All right, we take that point. Thank you so much for joining in. Double-digit revenue growth with margin pressure alleviating from the first quarter of FY26 with tailwinds coming in from the budget. Things look good for Marico, but the company should be walking the talk from here on as well, and that's what the street will eye as well. Take a short break, come back at you more on the markets and stock-specific action on the other side.
Tonight, I am announcing Canada will be responding to the U.S. trade action with 25% tariffs against $155 billion worth of American goods. This will include immediate tariffs on $30 billion worth of goods as of Tuesday, followed by further tariffs on $125 billion worth of American products in 21 days' time to allow Canadian companies and supply chains to seek to find alternatives. Canadian energy powers American manufacturing, businesses, and homes. Of America's top 5 trading partners, Canada is the only one with whom the United States runs a trade surplus in manufacturing. And Canada buys more goods made by Americans than China, Japan, and Germany combined.
Presently, taxpayers can claim the annual value of self-occupied properties as nil only on the fulfillment of certain conditions. Considering the difficulties faced by taxpayers, it is proposed to allow the benefit of 2 such self-occupied properties without any condition. To streamline the process of transfer pricing and to provide an alternative to yearly examination, I propose to introduce a scheme for determining arm's length price of international transaction for a block period of 3 years. This will be in line with global best practices. With a view to reduce litigation and provide certainty in international taxation, the scope of safe harbor rules is being expanded. A number of
Welcome back. Still 210 points lower on the Nifty, but the broader markets too are in pain, particularly some of these capital goods stocks, and 3 names in particular that I would want to highlight: Thermax, Siemens, and of course some of the other capital goods stocks as well that are facing some pressure. And that is because Motilal Oswal believes that the industrial sector will face challenges in growing inflows at the pace it did currently. And Vamakshi is here with more details on what Motilal Oswal said and the subsequent downgrades on the stock as well. Vamakshi.
Well, absolutely, Hormaz. You know, all of these capital good names are under pressure today. When we look at the note from Motilal Oswal, they say that the capex growth is expected to be weak at 7.3% for FY25 based on the revised estimates, and 10% growth for FY26 as compared to 30% growth in capex that we had seen from FY21 to 24. They also add that private capex across base industries is yet to show signs of meaningful improvement, and they believe that the industrial sector is expected to to face challenges in growing inflows at the same pace at which they had been growing in the past so far. When we look at the order inflows, they're expected to be lower over the next 1 to 2 years, and in fact higher impact is expected for companies with high exposure to railways, water, road construction as well as private capex. But the companies which are more focused towards power, T&D, renewables, defense and high growth areas are expected to be better placed. Now what they say is that it is prudent to be selective now for the capital goods sector. They're baking in lower valuations mainly on account of lower government capex and lower than expected private capex so far. So basis that they've gone ahead and downgraded their rating on Hitachi Energy to sell as compared to neutral earlier. They've also cut the target price to 10,500 as compared to 13,300 earlier. Thermax, they've gone ahead and downgraded the stock to sell, cut the target price to 3,500, while for Siemens, they've downgraded their rating from buy to neutral. They've cut their target price down to 6,300 rupees per share. On the other hand, they are quite positive on L&T, ABB and Cummins in the large cap industrial space. For L&T, although they've maintained a buy rating, they've cut the target price to 4,100. For ABB too, they have a buy call but cut the target price down to 7,200. For Cummins, the buy call continues, target price cut down to 4,100. And in the defense space, they prefer Bharat Electronics. For the company, for the brokerage, the target price for BEL is at 360 rupees per share. They have a buy rating on this counter. So overall, it is mainly the lower expected order inflows that are expected to come through going forward, which is impacting the capital goods space as a whole.
Well, let me take that point. In fact, for the government shift from infra to consumption was logical, but it isn't a complete shift away from infra. That's the word coming in from S. Narain, who is the Executive Director and Chief Investment Officer at ICICI Pru. And he says that this phase of investing in gold and silver as a standalone investment is also over. Let's listen in.
Clearly, it was a budget which was focused on consumption for the middle class, and they gave money to the middle class. Whether they'll choose to save it, repay loans or consume, this is the question for which we don't have the answer. But having said that, that is what the budget is about. This kind of shift was very logical on the part of the government, and so we don't complain. And I don't think it's a total shift away. It is just that you have to always, I think both the government and the regulators have to keep on doing things to help the areas which are not doing well, and actually to not give further support to the areas which are doing too well. Contra theme has been asset allocation because no one was willing to invest in debt. Multi-asset is the only way in which we can think of gold now, because there's just too much of problems on the geopolitical side. Each country wants to levy duties on other countries. So at that point of time, some investment in gold is okay from an asset allocation standpoint. But would we like to recommend standalone investing in gold and silver at this point of time? I don't think so. I think that phase is over. That phase of being very positive on gold and silver standalone is over for us in our framework.
That's S. Narain there of ICICI Prudential on the investment strategies for gold and other precious metals as well. Take a short break. On the other side, Manisha Gupta joins in with Suankar Sen, who is the MD and CEO of Senco Gold and Diamonds. Stay tuned, we'll be right back.
Senior citizens have very old national savings schemes accounts. As interest is no longer payable on such accounts, I propose to exempt withdrawals made from NSS by individuals on or after 29th August 2024. I am also proposing to allow similar treatment to NPS Vatsalya accounts as is available to normal NPS accounts subject to overall limits. The middle class provides strength for India's growth. This government, under the leadership of Prime Minister Modi, has always believed in the admirable energy and ability of the middle class in nation building. In recognition of their contribution, we have periodically reduced their tax burden. Right after 2014, the nil tax slab was raised to 2.5 lakhs of rupees. which was further raised to 5 lakh rupees in 2019 and to 7 lakh rupees in 2023. This is reflective of our government's trust on the middle-class taxpayers. I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees. So, detail the indirect tax reforms and changes in direct taxes in Part B. Financial.
Right now, as we speak, we've seen a bit of a deepening in the cuts that we've seen in the capex space itself. We have Siemens, which is now down 9%, and from the peak, we've seen a near 27 point correction on Siemens itself. Actually, 36% now as we speak. The 27% was in the previous trading session, now down 10% for that stock. Hutco down 9%, NCC down 9%, Samvardhana Motherson down 8%. And the oil marketing companies as well. The belief is that, with no mention of under recoveries being alleviated out there, they would be left to fend for themselves. So we have a near 7% cut that we're seeing on HPCL as well, and BPCL, IOC, all of them follow. On the other hand, we have SRF, which is doing well. So a couple of these chemical names purported to be beneficiaries of the increased tariffs on China, and as a result of which, some shift coming into India itself, or maybe no crowding out of capacity from China as well, is doing well for them. And the rupee, which has now moved to another fresh low, upwards of 87.2, has some tailwinds for the IT space. So we have Wipro, which has moved to the high point of trade, Infosys, which has moved to the high point of trade as well. Alongside that, we have Manisha ma'am, who's joining in now. Manisha, there is the belief that, there was good announcements coming in from the gems and jewelry sector in the budget itself. No real changes out there.
Oh, well, absolutely. When you look at the markets there, and there's just so much confusion happening there. But what we understand from the industry, from various CEAs, analysts who've been looking at that report, is that this is just a different tariff line that is being created. Until now, you had gold coming in under just one HSN code. Now you have various ones there. So this is more to do with the structural change. This is more statistics than anything else. And this also would be done from 1st of May. So clearly no changes there. And the import duty on gold and silver just continues to be at 6%, as it has been the case. Is the reason we've seen all of that volatile move come into the market and then kind of stabilize there. But even more importantly, apart from budget, it is the tariffs that the markets are looking at right now. So you have the dollar index, which has run up so strongly, that has led to gold prices hit an all-time highs. But with that, now the belief is that you could be looking at lower, the interest rates not moving in like that, and that's led to some profit taking as well. So there's just so much to discuss about gold. Subankar Sen is MD and CEO Senco Gold, and he joins us to talk about all of that. Subankar, hi, the budget first, and do we understand it right that what we've seen in sense of budget is just a different tariff line being created, more HSN codes, and this is only being done for better statistical clarity, and nothing more?
Correct. So the good thing is that there has not been any kind of increase in terms of the duties. So we can already see that in the international markets, because of the uncertainties, the gold is moving upwards. So at least it's an effort from the government to not put unnecessary burden on the middle class and the consumers of India through an increase in the duties. So that is one good thing. And yes, as you rightly pointed out, that there were certain confusions, the ores and the dorés and the alloys. So now it is much more rational, so that there is no duty lost by the government by any kind of confusion happening at the import level. So I think that's a very good step that the government has taken. And the best part is, which is needed not only for the jewelry sector but for the economy overall, is the focus on consumption. So whether the effort to reduce the income tax rates or the investment in the agricultural sector, because we all know that the economy will run if the agricultural sector does well and if the monsoons happen properly. So we could see that a lot of initiatives have been at least planned in that level. The skilling aspect of it, I'm sure the way we are also suffering and having young people who are employable, be it karigars or workers, I'm sure all sectors are going to have a similar challenge. So skilling, agriculture, in the long run, I think those are very good things that we will see good results in the coming months.
So you see that positive for the industry. But I just want to come back to this HSN code scenario one more time. So we do understand that it comes in effect from 1st of May 2025. Does it mean more paperwork for you then? I do understand that this is being done to clear data, better statistics in sense of government as well. And as you pointed out, that there is no revenue loss for the government. You know exactly what purity is coming in and in what category, in what sentiment then?
Yes. So paperwork, I don't think it is all about defining the particular product that you're importing. So, usually you have a 4-digit HSN code or a 6-digit or a 8-digit. So I think that it is just that now I think everyone is becoming much more aware of the variety of products that can be imported. So not everything can be put under one umbrella name or an umbrella code, but there are more specific codes for the specific type of product. So it's nothing more paperwork. It is being more clear in terms of defining what you're importing. So I think that's it. So not too much of paperwork.
All right. So, Ankar, now to the other thing, and as you pointed out, it's about the tariffs now. And we've seen dollar index gain. We've seen the gold prices at an all-time high. And since then, we've seen a bit of a pullback as well as market continues to read into various scenarios here. I also do understand that for the Indian markets, we are trading into a discount of $30 to $35 an ounce right now. With these high volatile prices, discounts going in, markets still reading the budget and the tariffs, what really is the demand on ground?
So the demand on ground, if you really, analyze how the prices have moved up over the last 7-10 days, right, with the tariffs being announced by the US president. So consumers are a little kind of cautious currently that, suddenly there has been such a huge jump in terms of the gold prices for those who can postpone their purchases. But at the same time, we shouldn't forget that this January, February, March, up to, April, I think there are a lot of weddings that are still planned, and there are a lot of wedding dates, because after April and May, there is going to be a long gap of, in terms of number of weddings. And again, it will start happening in the post-Diwali Dhanteras time. So those who have their weddings are having to buy, and many people are just waiting and watching. At the same time, from a other perspective, we have Valentine's Day coming up in the middle of February. So there the focus for the jewelry sector shifts from gold to diamonds. So we all are trying to promote diamonds as a category in terms of...
So, Ankar, we've seen that. But how has the month of January been until now? The month of January, did you see...
January has been... I think it's only in the end of January that we could see the prices jump. But if we look at the overall whole of January, January has been a good month for sales. Even December last week has been a holiday season. But from the first week of January, everything had picked up. And it's only in the end of January that prices kept shooting up, and people are postponing it. But January has been a good month. Yes.
Fair point. So, Ankar, as always, thank you so much for joining in and making sense of what came in during the budget, and of course the tariff impact as well. The Indian demand in the month of January towards the fag end clearly has been slightly on the weaker side, but as he said, this quarter overall is expected to be positive. But with that, that's all the time that we have on the show. Business Lunch takes all the action ahead.
The FDI limit for the insurance sector will be raised from 74 to 100%. This enhanced limit will be available for those companies which invest the entire premium in India. The current guardrails and conditionalities associated with foreign investment will be reviewed and simplified. The services of India Post Payment Bank will be deepened and expanded in rural areas. NABFID will set up a partial credit enhancement facility for corporate bonds for infrastructure. Public sector banks will develop Grameen Credit Score framework to serve the credit needs of SHG members and people in rural areas. A forum for regulatory coordination and development of pension products will be set up. To implement the earlier announcement on simplifying the KYC processes, the revamped Central KYC Registry will be rolled out in 2025. We will also implement a streamlined system for periodic updating. Speaker, I present the budget for 25-26. This budget continues our government's efforts to A. Accelerate growth, B. Secure inclusive development, C. Invigorate private sector investments, D. Uplift household sentiments, and E. Enhance spending power of India's rising middle class. Together, we embark on a journey to unlock our nation's tremendous potential for greater prosperity and global positioning under the leadership of Honorable Prime Minister Shri Narendra Modi. As we complete the first quarter of the 21st century, continuing geopolitical headwinds suggest lower global economic growth over the medium term. However, our aspiration for a Vikasit Bharat inspires us, and the transformative work we have done during our government's first 2 terms guides us to march forward resolutely. Our economy is the fastest growing among all major economies. Our development track record for the past 10 years and structural reforms have drawn global attention. Confidence in India's capability and potential has only grown in this period. We see the next 5 years as a unique opportunity to realize Sabka Vikas, stimulating balanced growth.
Stocks fall across the world after US ups tariffs on imports from Canada, Mexico and China. In India, mid-caps feel the heat. Capital goods and utilities are the biggest drags. Rupee falls to 87.23 per dollar, even as most Asian currencies fall between 0.5 to 1% in response to imminent tariff threats by President Trump. Trade uncertainties triggers flight to safe havens in global markets, leading to sharp surge in gold and dollar index. Market mavens Ridham Desai, Neelkant Mishra, S. Narain, Sameer Arora welcome the budget and point to a strategic shift towards consumption as scope for government capex spend slims. They see the cut in tax as a better way to distribute revenue versus wasteful expenditure. Bajaj Auto and Hero MotoCorp see a decline in domestic sales in January, but strong growth in exports helped save the blushes. Premium bike maker Eicher Motor, however, revs up at home and overseas. Hello, good afternoon. You've tuned in to CNBC-TV18. You're watching Business Lunch with me, Vinny Motiwala. And I'm coming in from the Motilal Oswal studios. Look at the market right now. You know, not a pretty picture coming in for the market today. Nifty, we're seeing a sharp fall coming in. Almost near the day's lowest point is what it was managing to trade at. You know, so let's see what the Nifty is doing. We have even the Nifty Bank. That is down almost at 1.6% of trade is what I saw the decline coming in even for the Nifty Bank when we saw. So Nifty Bank, all of them seeing clear pressure. In terms of the Nifty wise also, contributors that are seeing a decline, we have the heavyweights, Reliance that's seeing a bit in terms of a drag coming in. We have L&T that's among the top drags for the Nifty 50. So yes, that's we are seeing in terms of a decline there. Mid and small cap, a sharper fall that we're seeing coming in for the Nifty mid as well as a small cap today. A bit of an underperformance on that side. Most of the sectors, I'm actually trading in the red. IT is something that is flip-flopping between the red and the green. So let's keep an eye out on that. And I can see it flashing at the bottom of the screens. We have DV's Lab that has reported its numbers. 2,319 crores is what the revenue of the company has come in at. Slightly better than what we were expecting. Profits also seem slightly bit better. 589 crores versus a poll of 507 crores. We're going to look out for in terms of internals, but that's the first cut coming in from DV's Lab. Keep an eye out on that as well. Nifty Energy, Metals, FMCG among the top sectoral drags that we're seeing coming in for the indices today. But let's get the show started and actually focus on an important topic today and the story for the day. That is US President Donald Trump has put on tariffs on Canada, Mexico, China, and they've triggered fears of a broad trade war and a hit that is taken by the global growth. The US has also said that they have imposed 25% tariff on imports coming in from Mexico and Canada and a 10% tariff on goods from China. We have NBC's Brian Shang, who's joining in with us to give us the details on this one.
Companies across the country bracing for tariffs, with a warning that it's the consumer that's going to pay the price.
It's everything that is at risk of becoming more expensive.
From Mexico, importers will now have to pay 25% more for items like fruits, vegetables, beer, liquor, and electronics. From Canada, 25% more for potatoes, grains, lumber, and steel. And from both, a big increase on pharmaceuticals and on auto parts. At S&S Automotive in Secaucus, New Jersey, more expensive imported parts means even pricier routine fixes.
Oil changes mainly. That'll be the first noticeable one. An average oil change on most vehicles now anywhere between $50 to $80. It's probably going to end up over 100.
And that means that you've got to raise the cost just to make sure that you can keep the lights on.
Right. And I don't like to do that because I've been in this town, like I said, 38 years. So most of my customers I know.
Experts believe it won't just be auto stores passing on the prices, but supermarkets as well.
So we could see upward pressure for meat prices, upward pressure for dairy prices. Those are the types of categories that directly hit consumers' wallets.
Tariffs are paid for by the importing country, meaning S&S Automotive suppliers would bear the costs. President Trump's tariff announcement targets America's top 3 trade partners, who accounted for 42% of all goods imported into the U.S. The president suggesting further tariffs are on the way, meaning those price increases may just be beginning.
It's just another headache because now I have to explain to somebody else why we're raising them even more.
And following the move, China has announced plans to challenge the tariffs through the World Trade Organization. Meanwhile, Mexico's president and Canada's prime minister issued sharp retaliatory tariffs on the United States. Let's in fact listen to their comments.
Tonight, I am announcing Canada will be responding to the U.S. trade action with 25% tariffs against $155 billion worth of American goods. This will include immediate tariffs on $30 billion worth of goods as of Tuesday, followed by further tariffs on $125 billion worth of American products in 21 days' time to allow Canadian companies and supply chains to seek to find alternatives.
This measure of 25% tariffs has effects for both countries, but it has very serious effects for the economy of the United States, to the United States. It's going to have 25% more cost. I also say that if they want to act, they should not set their sights on Mexico, but on their own country, where they have done nothing to stop the illegal sale of fentanyl and other drugs.
Also, U.S. President Donald Trump has responded to the retaliatory tariffs imposed by both Mexico as well as Canada. He said that the U.S. could see some short-term pain, but tariffs were necessary as America was, I quote, being ripped off by every country. Listen in.
We subsidize Canada by the tune of about $200 billion a year. And for what? What do we get out of it? We don't get anything out of it. I love the people of Canada. I disagree with the leadership of Canada, and something's going to happen there. But if they want to play the game, I don't mind. We can play the game all they want. Mexico, we've had very good talks with them. And this is retaliatory. We may have short-term a little pain, and people understand that. But long-term, the United States has been ripped off by virtually every country in the world. We have deficits with almost every country. Not every country, but almost. And we're going to change it. It's been unfair. That's why we owe $36 trillion. We have deficits with everybody. We help everybody. We've been helping everybody for years.
He also added that he would be speaking shortly to both of these countries' leaders and explained how they could get some respite from the tariffs imposed.
I'm speaking with Prime Minister Trudeau tomorrow morning, and I'm also speaking with Mexico tomorrow morning. And I don't expect anything very dramatic. We put tariffs on. They owe us a lot of money, and I'm sure they're going to pay. They have to balance out their trade, number one. They've got to stop people from pouring into our country, and we've stopped it. They haven't stopped it. We've stopped it. They have to stop people from pouring in, and we have to stop fentanyl, and that includes China.
Let's also listen into what other market experts and economists have to say on the tariff slap and its impact going forward.
The Fed should not react to the first round effects of the tariff, so the sort of the direct tax effect on the US consumer, because this is like any other sales tax or a VAT increase in Europe, for example. There's nothing the central bank can do about it, and of itself, this is a one-off price increase. But if we see some of those second round effects that I was talking about, profit-led inflation, reduced competition in the United States, leading to more inflation pressures, those long, complicated chains of price increases coming through, that the Fed needs to respond to, because that potentially is a longer lasting inflation shock.
Trump doesn't learn. He doesn't learn that this is telling him that the US economy is going to go down by at least 1% as a result of this tariff, that inflation is going to go up by at least 0.8%, and that these tariffs are actually a $1,000 per year tax on households. He doesn't learn this sort of stuff. So he's going to go on and say that the market is simply a temporary effect, that it's the result of people conspiring against him, blah, blah, blah. But you're not going to see a change in track, because he's tracking towards economic tariffs, foreign policy tariffs, tariffs for everything, including the common cold.
Okay, on that note, we're going to step into a very short break. We'll return and we'll tell you how tariffs imposed impact Indian rupee and other emerging market currencies. So stay tuned in for that.
The great Telugu poet and playwright Gurujada Apparao had said, "Deshamante matti kadoy, deshamante manushuloy," meaning a country is not just its soil, a country is its people. In line with this, for us, Vikasit Bharat encompasses zero poverty, 100% quality good school education, access to high-quality, affordable and comprehensive health care, 100% skilled labor with meaningful employment, 70% women in economic activities, and farmers making our country the food basket of the world. In this budget, the proposed development measures span 10 broad areas, focusing on Garib, youth, Annadata, and Nari, spurring agricultural growth and productivity, building rural prosperity and resilience, taking everyone together on an inclusive growth path, boosting manufacturing and furthering Make in India, supporting MSMEs, enabling employment-led development, investing in people, economy, and innovation, securing energy supplies, promoting exports, and nurturing innovation. For this journey of development, our four powerful engines are agriculture, MSME, investments, and exports. The fuel, our reforms. Our guiding spirit, inclusivity. and the destination Vikasit Bharat. This budget aims to initiate transformative reforms across 6 domains. During the first 5 years, these will augment our growth potential and global competitiveness. The domains are taxation, power sector, urban development, mining, financial sector, and regulatory reforms.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
Welcome back and thanks for staying tuned into Business Lunch on CNBC TV18. Even as Trump threatens Mexico, Canada and China with the imminent tariffs, the rupee fell sharply in sync with most emerging market currencies. Lata is here to tell us on the take coming in from the editor's side on why is this happening and what is the impact of these tariffs coming in. Lata, good afternoon.
Well, this is very much a global synchronized fall. Asian currencies have fallen between 0.5% and 1%, and that is almost mirroring the rise in the dollar. The dollar has risen by 1.25%. So it's almost a symmetric fall on the other side. And what basically this means is when there is global uncertainty, there is usually a flight to what you call safe assets, safe havens. And the dollar and gold are seen as safe haven. So both those have risen. The rupee in sync actually had one of its biggest intraday falls of about 70 paise. At one point in time, it cost 87.23 to buy a dollar. And then looks like there was some Reserve Bank support. There was some supply of dollars. So people cut their short positions on the rupee or the long unwinding on the dollar, and that gave some strength to the rupee. At one point in time, the rupee came down to 87.09 or thereabouts. But the important point is that going forward, the expectation is that there will be 87.50 looks very much on the cards, but it is not a one-way fall, as we saw from November onwards. The expectation is that even the dollar will start weakening at some point as the tariffs take impact and there is an impact on US growth as well. So there will be a two-way movement of the rupee itself. It may go all the way to 88, but it will also come back towards 86, 86.5, 86.6, thereabouts. A two-way movement and outperformance of the rupee is the longer-term call from economists.
Okay, Lata, thank you so much for that. But moving on, the other big story over the weekend was the union budget. While the budget had a lot of positives leading to gains for some sectors, there were some pockets that have put stocks under pressure. One such sector is the OMCs, as the budget had no mention of LPG subsidies. Sudarshan is joining with us to give us details on that front. Sudarshan?
That's correct. So budget did not have any mention of LPG subsidy, while estimates were of that budget would announce subsidy or compensation for LPG under recoveries of more than rupees 35,000 crores. So as of 9-month FY25, total LPG under recoveries of, if you add under recoveries of all the three OMCs, it comes to around 29,223 crore, of which 50% is formed by IOC, which has under recoveries of nearly 14,325 crore as of December 2024. HPCL had rupees 7,600 crore and BPCL had rupees 7,300 crore. Now, this is the part of under recoveries. But after that, Oil Minister Hardeep Singh Puri had a chat with CNBC TV18. He said, unlike petrol and diesel, LPG is regulated and government is committed to compensating losses of OMCs, and there is going to be enough provision for LPG. And he had a chat with CNBC TV18. Listen to what exactly he had to say.
Very clearly, we are committed to that.
Even when we got it from 28,000 crores, there was an under recovery on LPG. We gave them 22,000 crores. You don't need to make a budgetary provision. We can go to the finance ministry. Otherwise, if somebody behaves like a good corporate citizen, the OMCs, and they've had under recovery, we will compensate them. We are committed to that.
Also, the subsidy for PM Ujjwala has trended down, what we have witnessed so far, despite an increase in the number of beneficiaries. Also, do you feel there is going to be an increase in discretionary spend post the budget?
No, there is going to be enough provision for both LPG and that. Don't worry about it at all. You see, two things are happening. Insofar as natural gas is concerned, prices are coming down. Insofar as LPG, which is a product of a refinery, etc., we will look at that. There's no issue of no anxiety on that score.
Okay, on that note, we're actually going to submit a very short break, and on the other side, we'll continue with our focus on budget and listen into how market experts reacted to the announcements that were made.
Big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m. We are in.
Welcome back and thanks for staying tuned into Business Lunch on CNBC TV18. Now let's move on market gurus Ridhim Desai, Neelkan Mishra as well as Samir Arora welcomed the budget and the government's decision to boost consumption through relief in personal tax. Listen in to what they had to say.
I think we are now getting into a phase where growth will surprise to the upside. The budget reaffirms that. I think this is a growth-oriented budget. In fact, the phrase I've used for this budget is that it's a magic budget, and I'll come to that in a moment. And my expectation is that the monetary policy will back this budget, and the monetary policy will also become growth-oriented. So as far as India is concerned and what we control, I think things are looking up.
Well, I think it is one of the best budgets that we've seen in many, many years, and I tweeted it's a dream budget. So first thing is that you normally want money with the public rather than with government. It should just be the general thumb rule of looking at anything, that money with public is better than money with the government. You have not said that, oh, you cut a tax rate across the board, therefore the rich will get much more. It has come to the correct audience in that sense. So it has to be travel, it has to be savings, it has to be these car consumer durable types. As I said, we are not buying those, but they could.
They are continuing to focus on fiscal discipline and also acknowledging that there is a very limited space that they have. So I think extrapolating this to mean that, the whole economy shapes up because of, 0.3% of GDP moving this way or that would be very unwise. So I would recommend that we remain focused on because this is going to be an investment-driven recovery. The way you drive growth going forward, the only way to do that is to accelerate credit growth. If credit growth has slowed from 17 to 11, somehow getting it back to 14, 15% by using all the monetary tools available, macroprudential tools available. Those will be the channels through which growth happens.
And let's move on. India has marched to its second successive Under-19 Women's T20 World Cup title as it defeated South Africa in the lopsided final. India bowled out South Africa for 82 after the latter opted to bat first. Reliance Foundation chairperson Neeta Ambani congratulated the champions, and in a statement she said that what a phenomenal triumph. Your grit, passion, talent and hard work have made us all proud. And as we wrap up this edition of Business Lunch on CNBC TV, let's leave you with the news from the Grammys. Indian-American vocalist Chandrika Tandon has won the Grammy Awards for the album Triveni. Tandon won the award along with her South African and Japanese collaborators.
On what the government can directly do in terms of capex, and therefore the guidance from the government was that we will maintain capex as a percentage of GDP here onwards, that the scope for us to do more is now gone. So now they're experimenting with, for example, this 1 lakh crore that they've decided to spend on urban infrastructure. They have to find such avenues so that capex continues, but there is very little more they can do at the center level. Investment activity in the country is going to be a lot more dependent on how well the real estate cycle turns, how well the power generation cycle turns. And I think this almost obsession with waiting for the government to spend an extra 30,000-40,000 crores, in the larger scheme of things, these are all rounding errors.
I think FI selling is not beyond a point a big negative. It is that whether India is doing well or not. And then there is some correction of excesses and stuff like that, which clearly seems to have been done. One reason has to be India related, that Indian results came out very bad. Well, I think it is one of the best budgets that we've seen in many, many years, and I tweeted it's a dream budget. So first thing is that you normally want money with the public rather than with government. It should just be the general thumb rule of looking at anything, that money with public is better than money with the government. You have not said that, oh, you cut a tax rate across the board, therefore the rich will get much more. It has come to the correct audience in that sense. So it has to be travel, it has to be savings, it has to be these car consumer durable types. As I said, we are not buying those, but they could. The overall markets are down a lot, then India may outperform because A, it's not directly affected, and B, don't worry about markets like Taiwan because they have been closed for a week. So if you just look at how TSMC ADR was trading during this period because of Nvidia and others, and then the TSMC local fall. So don't get totally carried away. A little bit you're allowed to get carried away. But the point is that the budget was good and this tariff situation is bad.
There is a slight bit of an attempt to recover from the lows of the day, but will that recovery be sold into? We'll find out over the next 120 minutes. Good afternoon. You're watching Midcap Radar live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia. With me as always is Vivek Iyer. Vivek, good afternoon. There's a slight bit of recovery from the lows. There are certain pockets that are doing very well, but you can't say the same for a lot of these PSU companies.
Absolutely right, Hormuz. Good afternoon to you too. It's the financials that are making an attempt at a comeback, and they are the ones that are holding higher. A couple of stocks from the pharma pack, they're doing quite well on the back of results. Names like Divi's, Max Health continue to see gains. But overall, a muted side. If you look at the screen, the markets are still in the red. But we have quite a lot lined up on the show. Let's start off with the top headlines. Stocks fall across the board after US ups tariffs on imports from Canada, Mexico and China. In India, mid-caps feel the heat. Capital goods and utilities are the biggest drags. IT bucks the trend.
Capital goods stocks are under pressure after the government sets capex spending target at 11.21 lakh crore rupees for financial year 2026, which was a 0.9% increase from the budget outlay in the previous financial year. Siemens, Thermax and Hitachi Energy India have lost between 6 to 9%.
OMCs under pressure after there is no mention of LPG subsidy in the budget after Street estimated 35,000 crore rupee LPG subsidy for FY25. IOC and HPCL correct between 3 to 6%.
Auto ancillary stocks like Sona, BLW and Samvardhana Motherson are declining after US President Donald Trump imposed a 25% tariff on goods from Canada and Mexico. The Street is worried that the company's exposure to clients in Mexico could impact their revenue.
Divi's Labs in focus after the company reports its Q3 earnings. Net profit surges 64.5%, revenue rises 25% on a year-on-year basis.
A part of this recovery could also be attributed to the fact that the Dow futures are seeing some marginal recovery from the lows, if not a significant one. At one point, we're down 700 points. They're still down 600. There is no significant recovery, but still a move higher from the lows nonetheless. And of course, there are a lot of these capital goods names, these railway stocks, PSUs, they are continuing to see a bit of a sell-off. But of course, the consumption-oriented names were the stars on Saturday. They continue to be the stars in today's session as well. But what are some of these names that are doing well and are not so in the mid-cap universe? Vamakshi is joining in to take us through the mid-cap movers this afternoon. Vamakshi, good afternoon.
Well, good afternoon, Hormaz. Lots of mid-cap stocks that are declining in trade today as compared to the stocks that are advancing. Let us pull up the list of the top losers first. Let's look at Hudco. The stock is down nearly 9%. NCC, Elecon Engineering and RITES are some other counters that are seeing a very sharp fall in the trading session today. Apart from those, like you pointed out earlier, capital goods stocks continue to remain under pressure. They lost out some momentum on Saturday and they continue to decline in trade today, anywhere between 3 to 8%. Thermax, Hitachi Energy, CG Power and Cummins all of these counters are under pressure today. But on the flip side, the consumption names, like you rightly pointed out, Hormaz, were the stars of Saturday, continue to gain momentum in trade today. Look at Westlife, that stock is up nearly 3%. Devyani International, Voltas, Chalet Hotels, as well as Nykaa, all of these counters are up and away in trade today. Let's also look at some of the stocks that are reacting to their numbers. Anant Raj, the stock is seeing a downtick of almost 7%. Aarti Industries, GR Infra Projects are also down 2% and 5.5% respectively. And Neogen Chemicals reported a strong set of numbers. Net profit has increased from 1 crore to 10 crore on a year-on-year basis. The stock is up and away in trade today. And as far as top gainers are concerned, Saregama, that stock is up nearly 8%. Metro Brands, Jubilant Foodworks, Paytm, all of these counters are up and away in trade today.
Thank you so much for that, Vamakshi, for taking us through the list of moves that we are seeing as far as the broader end of the markets are concerned. Let's now slip into a short break. The management of Mahindra Lifespace Developers join us now to discuss their Q3 numbers and the way forward.
Tonight, I am announcing Canada will be responding to the U.S. trade action with 25% tariffs against $155 billion worth of American goods. This will include immediate tariffs on $30 billion worth of goods as of Tuesday, followed by further tariffs on $125 billion worth of American products in 21 days' time to allow Canadian companies and supply chains to seek to find alternatives.
Welcome back to Mid-Cap Radar. Well, Mahindra Lifespace Developers recently reported their Q3 numbers. Pre-sales declined 24.6% on a year-on-year basis, while collections dipped 5.2%. The company has also set a booking guidance of 8,000 to 10,000 crore rupees for FY28. To discuss more on this, Amit Kumar Sinha, the MD and CEO at Mahindra Lifespace Developers, joins us now. Good afternoon, Mr. Sinha. Thank you so much for joining us. Before we get to the results and the guidance that you've provided, just 10 minutes ago, we saw a notification to the exchanges, and we also saw the flash on our screens regarding redevelopment of 3 properties that you all have just won. This is in the Lokhandwala complex district of Andheri West in Mumbai. Give us a sense of this particular project. When does this particular project come on stream, and what is the revenue potential from this particular project?
Thank you for having me. I think this is an exciting development at our end and very timely for this interview. This is in a very premium location in the very west. We, as you know, focus a lot on suburbs of Mumbai, and roughly the revenue potential is, GDP potential is 950 crores, but we expect that to go up as we finalize the DA and the contractual obligations as part of this redevelopment. Exciting location, just came to us. We've been working for some time, so we're excited to have it as part of our portfolio. It will take roughly a 12 to 18 months to bring it to the market, as we call land to launch, when you kind of secure the land, because the society redevelopment is a very involved process with the residents. You have to make sure that all the approvals are there and they can vacate, and the construction then can start. So that's 12 to 18 months typically.
Amit, good afternoon. Thank you for joining in. Getting to numbers, then you just mentioned about the fact that 9 months you have done 1750 crore in pre-sales. With the current figure that you had in the third quarter, which was anywhere close to 330, 340 crore, do you think you'd still be able to achieve 2,500 crores by the end of the year? And if not, what would be the revised number for your pre-sales guidance?
We will achieve 2,500 crore because of our original guidance. Quarter 4 tends to be quite attractive in terms of the launches. So we have a healthy set of launches planned in the quarter 4. This business is, you can't launch anything till you have all the approvals in place. Quarter 2 and quarter 3, quarter 2 typically is seasonal low. Quarter 3, because of election setup, was affected. We already have gotten 2 out of 5 approvals that we expected to come through for this financial year. One came on 31st December, one came just last week. So this will anyway help us achieve our aspiration. We should be in good shape for 2,500 plus for this financial year.
Are you seeing that kind of demand on ground for you to do anywhere between 750 to 800 crores worth of pre-sales in a quarter? And do you have the pipeline in place for that kind of a pre-sale?
Yeah. I think quarter 4, FY24, we saw the similar. We had 1,000 plus crore last financial year. And even quarter 1 of this was very healthy for us. So we have seen that seasonality, and there is a healthy demand in Q4 and Q1 typically. We, as I said, 2 of our large launches, Mahindra Vista, which is in Kandivali East, we had done phase 1 launch, which did really well. Phase 2 has been brought forward to this financial year, quarter 4. It's the last stage of RERA approval. We applied for RERA already. All the approvals are in place. So that should give us a significant bump up. Ivy Lush, which is in Pune, previously it was called Ordean Crown in Bogoli. Phase 1 again was brought up in the last financial year. We have seen great response to it. 63% inventory already sold out. That also has been brought forward to this financial year, for which we already received RERA. So given these 2 large launches and Citadel, Tower I, there is 1 launch planned in Bangalore, for which we are in advanced stages of approval. All those should help us achieve our pipeline aspiration to cross as you asked.
Okay. Mr. Sinha, what we want to focus on is on execution. And also we understand that there were some on-ground delays, especially when it came to the Karnataka market in South India. We understand that registrations were delayed in Karnataka. Did it impact you in any manner? Did you have any launches that were up for going ahead and also up for revenue recognition in the Karnataka market? Secondly, give us a sense of how exactly collections are panning out as far as Mahindra World City in Chennai is concerned. How many of those leases are up for renewal? Are they happening at a higher rate?
Yeah, so you have 2 questions. One is respect to Mahindra World City Chennai, and second is respect to Karnataka. Yeah, so there have been some approval delays, partly linked to what you just talked about, but also partly linked to some of the other changes that have come in the urban city planning for Bangalore. So we are trying to address that. I think it should get resolved. I think it's part of the industry. We have to abide by all the regulations and the requirements of the government agencies, BBMP, BDMP. All those things are critical for us. So we will solve that. In Mahindra World City, Chennai, I think we look at our IC business overall. IC business is a healthy business. In our previous interview discussion, had given a guidance of 400 to 500 crore leasing across all of our IC locations, which include Mahindra World City, Chennai, Mahindra World City, Jaipur, Chennai, which received a very attractive support. Not to support, Sumitomo was already a partner for us, so they signed up to be a partner with us for Origins Chennai Phase 2A and also a MOU for Phase 2B. So across all of our industrial locations, we have a target of 400 to 500 crore and a healthy PAT that comes out of it. So I think we're on track. The first 9 months have been quite good, but some big transactions are in the pipeline for quarter 4. Some have already happened in January, which have been publicly announced. There are a couple of other transactions in the pipeline. So we will achieve our IC targets, aspiration that we have from our IC business, including Wall Street and
Amit, you have a bookings guidance of 8 to 10,000 crores by FY28. And even if we take your point that you will achieve 2,500 by the end of this year, that's almost a 4x jump in the next 3 years. How do you plan on achieving that, whether it is more launches that are in the pipeline, or are you looking at inorganic growth or more JDs? What's in the pipeline?
So this is a very interesting question. I think the first step in this industry to achieve the pre-sale guidance is to ensure that you have the raw material, which is the land bank. And we have covered a lot of ground in the last 18 months that have been around. This financial year alone, and we just announced like 15 minutes back a new transaction as we talked about in Andheri. If you include that, we would have done GDV of roughly 16,000 crore in this financial year. Last year full year was 4,400, and 4 years back it was less than 1,000. So we have scaled from 1 to 4x in 4 years, and from last year to this year we have scaled up 4 times just in 10 months so far. So we are really creating our land pipeline that allow us to do the launches in line with the aspiration that we have set out. So that's the first part, making sure that you have the GDV sources, GDV land banks locked in, and we'll finish the year very, very strong on that front. And then comes the part from land to launch, which is making sure the design, approval process are well done. And then comes the launch to OC, and construction. So we are solving each part of the puzzle very, very creatively, but also very diligently. And the first step is actually very much under control. So hopefully that answers your question.
Yes, that does. Thank you so much, Mr. Sinha, for joining us and giving us a sense of how Q3 panned by, how Q4 looks. And also, congratulations on the latest win when it comes to Andheri West location in Mumbai. Let's now slip into a short break. The management of Texmaco Rail joins us to discuss their Q3 earnings on the other side.
Canadian energy powers American manufacturing, businesses, and homes. Of America's top 5 trading partners, Canada is the only one with whom the United States runs a trade surplus in manufacturing. And Canada buys more goods made by Americans than China, Japan, and Germany combined.
Presently, taxpayers can claim the annual value of self-occupied properties as nil only on the fulfillment of certain conditions. Considering the difficulties faced by taxpayers, it is proposed to allow the benefit of 2 such self-occupied properties without any condition. To streamline the process of transfer pricing and to provide an alternative to yearly examination, I propose to introduce a scheme for determining arm's length price of international transaction for a block period of 3 years. This will be in line with global best practices. With a view to reduce litigation and provide certainty in international taxation, the scope of safe harbor rules is being expanded. A number of senior and very senior citizens have very old national savings schemes accounts. As interest is no longer payable on such accounts, I propose to exempt withdrawals made from NSS by individuals on or after 29th August 2024. I am also proposing to allow similar treatment to NPS Vatsalya accounts as is available to normal NPS accounts subject to overall limits. The middle class provides strength.
Welcome back. You're watching Midcap Radar on CNBC TV18. We are now being joined by Indrajit Mukherjee, who is the Vice Chairman at Texmaco Rail and Engineering. Mr. Mukherjee, good afternoon. Thank you for joining in. Before we get to numbers and to talk about the road ahead, I'd first like to ask you your views on the budget. The numbers that came in for the railways, the allocation when it comes to infra upgrades, rolling stock. What do you make of this, the allocation that has been made for you as a company?
I think this is what we were expecting. It is something not very unexpected because the total capital outlay has marginally gone up. But if you would see that the loading is also marginally going up, they are going to buy the procurement of wagons. In fact, have been up by 20% as we see as the estimate for the 25-26. The most importantly is that the railways have given an estimates of making positive cash flow for the year, and a major chunk of that cash flow is going to come from the freight cars revenue, which is going to be up by something like about from 180,000 to 188,000 crores. So which means that can only happen if there are more number of wagons coming and there are more transportation. So obviously, we expect that it's something like what we expected in line with the National Rail Plan.
Okay. Mr. Mukherjee, the other thing what we want to understand from you is, now given the budget, given the order book that you're sitting at a little over 8,000 crore, would you be able to quantify, number one, the order prospect pipeline for Q4 and FY26? And at the end of FY26, can you give us a guidance as to what exactly are the kind of order inflows you anticipate and where could your order book stand at?
You see, if you have to, let's do a little bit of math. Right. If our own company is concerned, so we are sitting on something like about 12,000 wagons order right now. And that's actually is we are producing close to 12,000, maybe slightly higher. So if you have to keep a similar kind of numbers, then we should have at least 1.5 times of the order book that we have today. And one very important thing is that if you strictly talk about the freight cars, which are the wagons, the orders are going to be from railways, but there are also orders going to come from the private players. So because the commodities have to move. So answering your question, that I would expect to end up 2026 with a order book on the number of wagons should be more than what we have today, and that's the kind of order that I think we should be able to procure. The market is pretty good. And I'm not even considering the markets which are also available outside India, the export market. I'm only talking of the Indian market, which consists of the purchase by the railways as well as by the private players.
So allow us to push you a little bit more. 12,000 wagons is where you are standing at currently. So FY26, what kind of percentage growth can we see? Domestic market, what will you anticipate? And export market, what can you expect?
Percentage growth of procurement by the percentage growth of national procurement, is that what you mean?
That's right, and depending on your order win ratio, yes. Yeah.
My own hunch, if I can do, it's going to be something like 15-20% higher than last year. I mean, but that's my own guesstimate.
But Mr. Mukherjee,
based on lots of data.
Right. And based on that data, then if you could tell us that 35 to 40% growth rate that you're expecting over the next 2 years, do you stick to that? Because your 9-month growth rate is fairly healthy. So do you expect to be between 35 to 40% conservatively, or would you want to?
We should be able to do that because it's just not the wagons that makes our business. The wagon is about 54% of our order book. So we are in jobs like electrification. We have the foundry. We are rejuvenating our EPC business, which was remaining flat for the couple of years. So that's a big area. And as you have seen, that there are so many tracks are going to be laid, and safety, coverage, all these are coming up in the budget for the next year's expectation. And we are one of the few companies we have got the credentials to do all this. So I think it's not going to be only wagon, but it's going to be combinations of so many other arms. So electrification business is doing very well.
Mr. Mukherjee, you've given us a good sense of the business. Now, the other thing that you've done, especially over the last year and a half, has been multiple corporate restructuring. Give us a sense of the potential demerger of the rail EPC business. What will be the order book that gets transferred over there, and what are the kind of targets you're setting for the EPC part of the business?
See, currently now the order book is not that high. It's going to be in the range of 8 to 1,000 crores level. We are executing a few very important projects. We are finishing the Western Dedicated Freight Corridor. We have in metros, a couple of metros like Bangalore, Bhopal, etc. But I would expect that our order book will be particularly on the track laying, signaling. We'll have substantial orders coming up.
All right, Mr. Mukherjee, thank you so much for sparing time, joining us today. Wish you good luck for the rest of the year as well. That was the management of Texmaco Rail, sharing light on the road ahead as well. With that, it's a wrap of this edition of Midcap Radar. From me, Vivek, and the team that put this show together, thank you so much for watching. On the other side, a very special edition of Market Masters when we return.
This government, under the leadership of Prime Minister Modi, has always believed in the admirable energy and ability of the middle class in nation building. In recognition of their contribution, we have periodically reduced their tax burden. Right after 2014, the nil tax slab was raised to 2.5 lakhs of rupees, which was further raised to 5 lakh rupees in 2019 and to 7 lakh rupees in 2023. This is reflective of our government's trust on the middle class taxpayers. I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees. So indirect tax reforms and changes in direct taxes in Part B. Financial sector reforms. The FDI limit for the insurance sector will be raised from 74 to 100%. This enhanced limit will be available for those companies which invest the entire premium in India. The current guardrails and conditionalities associated with foreign investment will be reviewed and simplified. The services of India Post Payment Bank will be deepened and expanded in rural areas. NABFID will set up a partial credit enhancement facility for corporate bonds for infrastructure. Public sector banks will develop Grameen Credit Score Framework to serve the credit needs of SHG members and people in rural areas. A forum for regulatory coordination and development of pension products will be set up. To implement the earlier announcement on simplifying the KYC processes,
let me welcome in Neelkant Mishra, Chief Economist at Axis Bank and Head of Global Research at Axis Capital, who's now with us. Neelkant, of course, is the number one voice that people sort of look to after the budget, and he's with us. So we're very pleased. Neelkant, good morning. Great to have you with us here. Thank you very much.
Good morning, Prashant. Thank you very much.
You know, there's so much to discuss. Let's keep it sharp and pointed. First up, is the interpretation that the government is moving away from infra and focusing on consumption correct? Because it's got implications for markets as such. Go on.
I disagree with that because the limitations on how much the government can do on capex was clear even last year. Remember that out of the 11.1 lakh crores, 9 lakh crores was stuff that the government could control. There was 2.1 lakh crores that they had no control over. So we are hitting the limits on what the government can directly do in terms of capex. And therefore, the guidance from the government was that we will maintain capex as a percentage of GDP here onwards, that the scope for us to do more is now gone. So now they're experimenting with, for example, this 1 lakh crore that they've decided to spend on urban infrastructure, but through a competition mode, so the states need to compete for it. They have to find such avenues so that capex continues, but there is very little more they can do at the central level. So I don't think this is a stepping away from capex.
Absolutely. Neelkant, in fact, if you could just elaborate on that point, another sort of, statement that's been doing the rounds, or calculation or thought process that's doing the rounds, is that if you add up capex from the states and the capex that will be done via PSUs, and maybe we're still talking about 20% growth, almost 19 to 20% growth, and not the 10%, which is direct capex, which is in line with nominal GDP. So how would you read into this, the form and format that capex will take from here on?
No, I think those are also very interesting points, but we need to take a step back here and figure out that if gross fixed capital formation as a percentage of GDP in India is 32%, and the central government spending is about 3.7%, or say 3.5%, 3.4%, how much more can it actually contribute? So this is effectively less than 10% of overall investment to GDP in the country. Investment activity in the country is going to be a lot more dependent on how well the real estate cycle turns, how well the power generation cycle turns. And I think this almost obsession with waiting for the government to spend an extra 30,000-40,000 crores, in the larger scheme of things, these are all rounding errors. Remember that the fiscal space for the government was very limited. In fact, in the preview session that we had in your studios, we had discussed this, that, all said and done, there is only about 1 lakh crores, which is less than 0.3% of GDP in FY26, is that the government has discretion on. I think it is unwise to expect the government to be doing everything. And I don't think it needs to be doing everything. If the real estate cycle turns, if the power generation cycle turns, and both seem to be turning, we will not be dependent on the government to drive up, say, the industrial stocks or the earnings for industrial companies.
You're sounding pretty satisfied with regard to what the government has done on the capex spend front. But what about the approach to markets? How would you alter the approach to markets? Given the consumption push, they've maintained capex reasonably, but we also have this threat coming in from Trump's tariffs. So your take on the equity markets from here on, post the recent correction?
Absolutely. I was waiting for someone to say that. So the budget is now in history, right? Budget was largely as expected. There was a 1 lakh crore of tax cut for the middle class. But remember that the government is still shrinking its fiscal deficit. And therefore, the aggregate impact or the demand on aggregate impact on aggregate demand is actually still negative. The Trump tariffs, on the other hand, are going to be, they have triggered something which is very substantial. See, normal wars, and especially if they are being fought in other jurisdictions can actually be accretive to earnings, and sometimes they support stock markets. Here, there are political objectives being met through economic damage. So knowing fully well that this will hurt the US economy, and that if there is retaliatory action, it will hurt many parts of the economy. And on top of that, to potentially escalate it to Europe and other parts, I think all of this creates significant uncertainty for the economic forecast. And that, I think, is terrible for markets.
But is there you would agree there is focus on consumption now, right? That you would agree with, Neelkant? And this is after some time putting more money in. And it's not just 1 lakh crore, it's not one time, right? It's recurring. And there is a broader, I don't know whether there's messaging or it's kind of, it had to be done. The move itself is one time, and whether we'll see more moves, etc. So from stock market point of view, consumption, where will this money go according to you? And is there anything investors can do based off this?
Yeah, so that is somewhat easier to quantify. So if you look at the number of people who disclosed income to taxpayers, see, if you're earning that much but you're not paying tax anywhere, you're not impacted. So we have to look at the people who pay taxes, so that this eases our job. The biggest impact is for people disclosing earnings between 12 lakhs and 50 lakhs. The number of people affected, because the last data we have is for FY23, was about 58 lakhs. If you extrapolate it to, say, FY26, maybe about 75 lakh. That's the number of people who will be the biggest beneficiaries of these tax cuts. And most of these people would be in the 90-95 percentile, maybe even higher. The higher ones, maybe the percentage impact will be lower. What is their discretion? What is their incremental demand going to look like? And that's mostly going to be discretionary. So I think that the impact of this directly will be mostly on the discretionary items. So jewelry, retail, and somewhat, the market has responding rightly to this on Saturday, cars, two-wheelers, etc. So at an aggregate demand level, remember that the deficit is still shrinking. So, and a large part of the space that is being created for these tax cuts are actually also coming from personal income taxes. Absolutely. So whatever you are seeing in terms of better compliance, more people disclosing higher incomes, is now the government has decided to take some bit of that and give it to what was becoming the pillar. So if you compare India's central government's fiscal math, FY19 to FY26, over 7 years, the government has so far seen a very sharp increase in personal income tax to GDP. A large part of that has actually gone into increasing capex because primary deficits are more or less back to where they were in FY19. And so going forward, if you have another lakh crores and there is no ability to spend it directly on the issues that you can control, on the areas that you can control as a central government, then you might as well give it back to the taxpayer, which was actually funding a lot of this capex. So that seems to be the political economy equilibrium.
It is the capex, it is the consumption side of the economy that suddenly gets turbocharged. Because I'm trying to understand from a portfolio shift point of view, what immediately happened on Saturdays, immediate herd mentality, right? Everybody is rushing to consumption, trying to sell out of capex. Now, do you see that only as a short-term market trade, market move, or do you think this will lead to structural shift in portfolio, especially for long-only funds, bigger institutional investors, where they need to now unload on capex a bit and go back to consumption, because you see that is as a medium-term 2-3 year cycle, perhaps?
Look, 1 lakh crore, which is less than 0.3% of GDP, being shifted to a tax cut should not drive a change in portfolios. I mean, I think that we have to keep in mind that, one, the impact of this can potentially be higher. So some amount of this will be saved. Remember that this is the segment which also provides a lot of financial saving. But the likelihood of, say, buying a car on EMIs, using this to buy an apartment, a bigger apartment, and therefore pushing up the real estate cycle, and that then driving another investment activity. So I think there are many ways in which this can be spent, and it would be quite myopic to actually limit it to just saying, oh, let's buy all consumption stocks. Frankly, there are other parts of the economy which are also likely to get affected. And I don't think this necessarily swings the government towards more profligacy. Or this is a sign that the government is starting to become more profligate.
Neelkanth, I'm in the mood to look ahead. So the budget we have discussed, it appears it's pretty satisfactory for you. Trump's tariffs could add an element of uncertainty, and for the time being, maybe the markets are ignoring that just for the time being, hoping that things don't get too bad. But let's talk about the RBI. That's the next big cue for the markets as well as for the economy. What are your expectations from the RBI in this uncertain backdrop? You have the rupee that suddenly moved to around 87 or it's showing some kind of weakness. Your take, expectations from the RBI?
So I think the RBI's job is unenviable. There is significant volatility in global financial markets, and I think that will only intensify, because now that once you've fired a salvo, it will be very hard for the US to backtrack. And if their closest allies in the NATO or in NAFTA, basically Mexico and Canada, they also retaliate, and they're threatening to retaliate, it actually emboldens everyone else that the US goes after this to actually do the same. So I think that economic uncertainty has just gone up dramatically. The US dollar appreciating, because that's a classic response when there is de-risking. Everyone jumps back into the US dollar, makes it much harder for the central bank. But let's look at what they should be doing. I think it is very important to inject back the durable liquidity that they took out, or they were forced to take out because of the FX intervention. So if there is, give or take 5 trillion rupees, 5 lakh crores that was sucked out because they had to sell dollars, at least that amount of liquidity has to be injected in one form or the other. They've started strongly with about 1 lakh crores last Monday. I think more needs to be done. Second, there needs to be maybe some moral suasion, maybe some backing off on, say, the restrictions on the credit deposit ratio, maybe even changing the macroprudential risk weights to target credit towards areas which are relatively safer today, like real estate. So these are areas where the RBI can and perhaps is likely to act.
Central KYC registry will be rolled out in 2025. We will also implement a streamlined system for periodic updating. Speaker, I present the budget for 25-26. This budget continues our government's efforts to A. Accelerate growth, B. Secure inclusive development, C. Invigorate private sector investments, D. Uplift household sentiments, and E. Enhance spending power of India's rising middle class. Together, we embark on a journey to unlock our nation's tremendous potential for greater prosperity and global positioning under the leadership of Honorable Prime Minister Shri Narendra Modi. As we complete the first quarter of the 21st century, continuing geopolitical headwinds suggest lower global economic growth over the medium term. However, our aspiration for a Vikasit Bharat inspires us, and the transformative work we have done during our government's first 2 terms guides us to march forward resolutely. Our economy is the fastest growing among all major economies. Our development track record for the past 10 years and structural reforms have drawn global attention. Confidence in India's capability and potential has only grown in this period. We see the next 5 years as a unique opportunity to realize Sabka Vikas, stimulating balanced growth of all regions. The great Telugu poet and playwright Gurujada Apparao had said, Deshamante matti kadoy, Deshamante manushuloy, meaning a country is not just its soil, a country is its people. In line with this, for us, Vikasit Bharat encompasses zero poverty, 100% quality good school education, access to high quality, affordable and comprehensive health care, 100% skilled labor with meaningful employment, 70% women in economic activities, and farmers making our country the food basket of the world. In this budget, the proposed development measures span 10 broad areas, focusing on Garib, Youth, Annadata, and Nari, spurring agricultural growth and productivity, building rural prosperity and resilience, taking everyone together on an inclusive growth path, boosting manufacturing and furthering Make in India, supporting MSMEs, enabling employment-led development.
Rhythm Desai is our next guest on the show, and of course their latest note is out. Managing Director and Chief Equity Strategist, India at Morgan Stanley. Rhythm, great to have you on the show. There's so much to talk about: tariffs, budget, capex, consumption. But you know what really caught my eye in that note of yours, that contrary to large pockets of the market, where people are saying go to safety, go to large caps, you are still retaining your bias for small and mid caps, and you still see scope in that side of things. So let's open with that, why you don't think that mid caps and small caps are flashing red.
Hey, thanks, Surbhi, and great to be on CNBC. So this has to be contextualized, and we have to bear in mind that the news from outside India is not so good. So keep that aside. We'll come back to that subject a little later in this conversation. But the news from India is going to get a whole lot better in the coming weeks. So we've gone through a mid-cycle soft patch, which has, I think, lasted for about 5 or 6 months. It was rather idiosyncratic, led by extreme weather in August, elections in the first quarter, lack of spending by the government, and a little bit of tightness on the monetary side. So all this has assimilated into a slowdown in growth, which hurts SMIDs the most. And of course, at the starting point, the SMID valuations were looking a little extreme, and that correction has happened. I think we are now getting into a phase where growth will surprise to the upside. The budget reaffirms that. I think this is a growth-oriented budget. In fact, the phrase I've used for this budget is that it's a magic budget, and I'll come to that in a moment. And my expectation is that the monetary policy will back this budget, and the monetary policy will also become growth-oriented. So as far as India is concerned and what we control, I think things are looking up. Of course, as I said at the outset, the caveat is what happens in the rest of the world, and we can come back to that conversation. So that's the reason why I think that after this steep correction, now SMIDs are looking better than they have been for almost 7 or 8 months.
Piece on consumption, really, Rhythm. How much will this help in your opinion, and what will see that lift and that help? Which subsectors within consumption, in your opinion?
That's a good question, Prashant. It's not as obvious as it seems. So let's contextualize this. This is about 10 million people, 1 crore people, who are getting this tax break to the extent of 1 lakh crores. And it's not necessary that they will take this tax break and buy soaps from it. Okay. So I think consumer staples is certainly not the place where we go to. Consumer discretionary, I think, is a much better bet. And even there, I think at the higher end of consumer discretionary is where I think you will probably see some of this tax saved being spent. Some of it can actually also come into the stock market. All of it will go to the banking sector. So this is how I would break it up. And that's, the dilemma always with tax cuts. It's hard to predict what people benefiting from a tax cut will do with that money. They could just simply deposit it in the bank, or they could go and buy shares, or they could use it to buy some high-end goods. And I think you'll get a mix of all of that. Now, the exact mix is very hard to predict, but it will be a mix. And all this is actually auguring well for the economy. When you've hit sort of a spending capacity limit and you don't want to do wasteful expenditure, and again, we should highlight this point, and I'll come to this in a second. So just give me a second. When you don't want to do wasteful expenditure, this is the best next alternative you have, which is give it to the people to spend. And that's what the finance minister has done. So kudos to her for that. Now on wasteful expenditure, again, yesterday's newspapers had no mention about this. The subsidy spending of the government has gone back to pre-COVID levels. It's now back to 1% of GDP. And we had achieved a multi-year low in 2019 at 1% of GDP. So it's, I think, 1.07 if I remember correctly. So the wasteful expenditure is, it's almost you're wringing the neck of your spending options. It's like you're tightening your purse strings. And at the same time, you're getting the private sector to increase its participation in the economy. The way I characterize this is that the government, and I think this is common knowledge now, the government did the heavy lifting coming out of COVID because private sentiment was weak. It is now stepping away and reconsolidating the fisc in a way, preparing for the next crisis moment. Because when another crisis moment arises, if it ever does, you need spending capacity in the government. So you need to be always prepared for it. And now the private sector takes over. This is incredible, actually, if you think it from a stock market perspective. Very few countries in the world have this flexibility which we have, which is we can take the foot off the pedal, consolidate our fisc, and create capacity to address any upheaval that can happen in the coming years. And that is why this budget is magic. I mean, just one of the reasons, there are plenty of reasons why it's magic, but this is one more reason why it's magic. And I'll come to a third reason a little later, which is the fine print of this budget.
You're sounding very, very optimistic about prospects, and that's good to hear. And in the finance minister, with regard to the budget, the expectations, they are factoring in STT to be much higher as well. So maybe they are factoring in a buoyant stock market as well. Give and take everything rhythm. How do you change your portfolio from here on? What are your top ads? What have you all deleted as well? I'm looking at it. I think HAL is something that you'll have pulled out, while Titan, Jubilant, those are the ones that you're relatively more optimistic on. So give us a portfolio construct.
Sorry, so I won't go into single stocks, but from a sector perspective, I think you want to buy the banks, particularly the private sector banks. I think that's the easiest trade in the market right now. The stocks are trading relatively attractively, and I think the environment is going to get more constructive for banks. So that'll be the easy one. Then I think you want to buy some discretionary consumption. As I mentioned to Prashant, this budget is, I think, built for an uplift to discretionary consumption, especially high-end discretionary consumption. I would still continue to back industrials. Though within that portfolio, you have to realize that there are some shifts that are happening with respect to the subsectors in which CapEx is taking place. So you may want to orient yourself to that. I think technology looks quite okay. We are getting into a period where spending cycles seem to be going up. Everything else, in my view, can be underweight in a relative portfolio. But this is one point that I will make, is that this market is transitioning from a macro one to a micro one. So since COVID, we've been driven by macro factors. And I think increasingly this is becoming a stock pickers market. So it's really not about the Nifty and where it heads. It's about individual stocks. And I think the dispersion of returns across stocks is likely higher in the next 12 months than it has been in the last 2 or 3 years.
You know, a large individual investor has messaged me and said, please ask Rhythm about when FIIs will return in the context of all the changes made in the GIFT Nifty. Quickly, if you can.
GIFT City, the GIFT City.
GIFT City, yes.
GIFT Nifty.
Yeah, sorry.
Every morning at 9:15, there's a $100 million bid that comes from domestic investors. To do a trade, somebody needs to sell. Either corporates sell through IPOs, and then they'll allow FPIs to buy, or the FPIs sell. So this is the technical point. Okay, the GIFT City changes, I think, are very encouraging, and it should assuage a lot of foreign portfolio investors with regards to taxation, and should encourage them to step in. And these are changes that market participants were pressing for, and the government has delivered. So I would be very optimistic, but I think you need a bit of supply of paper for foreign portfolio investors to turn. Mind you, this selling that we have seen over the past few weeks has little to do with India. It is largely an emerging market problem, and the emerging market asset class does look very vulnerable. We actually did not get to that at all. But what's happening over the weekend and what's likely to happen over the next few weeks is going to create volatility. So people have to be prepared for it. And India may outperform in this volatility, but the Nifty will struggle. If the world is not going up, it's impossible for the Nifty to do its own jig. It's a very large market now in a global context. So it cannot do its own thing if everything else is falling.
People, economy, and innovation, securing energy supplies, promoting exports, and nurturing innovation. For this journey of development, our four powerful engines are agriculture, MSME, investments, and exports. The fuel, our reforms, our guiding spirit, inclusivity, and the destination, Vikasit Bharat. This budget aims to initiate transformative reforms across 6 domains. During the first 5 years, these will augment our growth potential and global competitiveness. The domains are taxation, power sector, urban development, mining, financial sector, and regulatory reforms.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep? Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC-TV18 Motilal Oswal Budget Headquarters.
Well, there is some recovery. That was a day so far. Markets, of course, down about 100 points, which means it's looking much better. It is actually a green candle, which means that we are now trading above where we opened early in the morning. This is, of course, closing bell. We're coming to you from the CNBC-TV18 Motilal Oswal Budget Headquarters. I'm Prashant. With me, my colleagues Reema and Surabhi here in the studios, and Nigel is joining in from the newsroom floor. Guys, good afternoon.
Hi, afternoon, and much better when you compare it to the kind of cuts Europe is reeling under. Frontline European indices are down close to about 1.5%, and the Dow futures is down more than 500 points.
Yeah, absolutely. I mean, I think it's all rock and roll today. We'll see how it plays out and whether the impact is done in one day itself and what happens. And the bigger impact, because the mainland Chinese market, of course, was not trading today. That was not open. But we've seen a fair amount of, red across the rest of it. Having said that, for us here, it's been not that bad. The Nifty is trying to claw its way back up. Nigel?
Well, that's right. It's actually a pretty good-looking screen in comparison to what the globe is doing. And also keep in mind that in the month of January, India underperformed. So let's see whether or not we can give back some of that underperformance and outperform from here on. But the screen is looking good. 120 points down with 60 minutes to go. I think the bulls will take that. Though some of those stocks that rallied very, very hard on budget day, they're giving back some part of it. Case in point being a United Spirits, a Jubilant Foodworks, both of them currently at the low point of the day. But you can't complain when the Nifty is not down even around 0.5% or thereabouts.
Absolutely. And look at the market breadth for starters. Actually, market breadth is not too bad, too good. It's about 3:1 in favor of decline still. So broader market seems to be hurting a little bit more at this stage. Actually, why don't we just look at the small cap index? 2.5% lower. So actually, while the Nifty has recovered, the mid and small cap part of the market has not really. Mid cap index is off about 0.25% from the lows, but the small cap index has come up, is still at the low point of the day. So, just a couple of points. Risk off in markets, of course, on tariffs more than anything else. So the reason is not local. For once, it's global. Because so far it's all been local, and global markets have been sort of chugging along nicely till at least about a week and a half back. Now, I don't know if it's a tell, but just look at the Hang Seng market, right? Tariffs affect the market which is affected by tariffs, and Chinese, lots of Chinese stocks trade on Hong Kong. Actually, most of the bigger ones all trade on Hong Kong. So it had a shaky start, it had a down session, but it actually closed absolutely flat. And we've not heard anything very aggressive, basically because that market is not open. They're still shut for Chinese New Year, but we've not heard anything aggressive from Chinese. It doesn't look like they want to escalate. They want to de-escalate. Looks like it. I mean, of course, that does not preclude anything they may do from here on, but that's essentially the sense. So the Hang Seng actually closed absolutely flat, despite the 10% tariffs, and maybe there'll be more coming and all of that. So 0.5% lower, and I think a little bit lesser now. But it's the same kind of names which are up and down. Defense, PSU, energy, these are sectors which are taking a knock. And if you look at the consumer pack, that is up about 0.5, 0.6. And I think you can add the IT index to it as well, which is about 0.5% or so. So it's exactly kind of similar kind of stuff. Actually, IT was down on Saturday. That's the only difference. Otherwise, everything down on Saturday is down today. And of course, consumer did very well on Saturday, and it's up today as well. Reema.
But on consumer, the street is getting a little more discerning because the consumer staple companies, which largely gets reflected in the Nifty FMCG index, that's down nearly 2%. The Nifty FMCG index with names like HUL, ITC, Godrej Consumer, Marico, deep cuts, 3.5%, 4% gone on these, heavyweights in the consumer staple pack. So they're giving up some of the gains from Saturday. But on the other hand, perhaps the street believes that these budget cuts, that 1 lakh crore of saving is going to benefit these urban discretionary consumption stocks more. So Swiggy, Nykaa, Up and About, Eicher Motors, M&M, these are all premium discretionary plays, and these are stocks which are advancing. But again, as Prashant said, defense, PSUs, metals too, under pressure on the back of the global trade war, and capital goods and railways. That's the other pocket where you are seeing big cuts. So RVNL, IRCON, IRFC down deeply for the second day in a row.
Absolutely. I mean, the PSUs have been slammed hard, and it's cuts on decent volumes as well. HUDCO, RVNL, RailTel, and even in the private space, even stocks like NCC for that matter, TexRail, all of them are down pretty significantly, PFC, REC, so the entire works. But what is higher? Overall, the mid-cap index is still nursing a loss of over 1%. That hasn't changed. But what is higher? Consumption, in any way that you can play consumption. And in the financials, probably Bajaj Finance is, one of the best examples. 4.5% there on that large stock. But even others have been, consumer durable makers like Voltas doing very well. Your QSR stocks like Westlife. Westlife's up about 5% as we speak. Symphony is up. Many names out there. Sapphire Foods. QSRs in general doing extremely well. So it's pizzas and burgers and maybe hotels and movies, Nigel. Where are you spending the additional money?
Can't tell you.
I know, I should have asked. Silly question. Off-air conversation. I know the answer.
No. My money is going to go into SIPs. I've been telling you it should be that. And I'll, if there's any extra money, that's where most of my money goes on a monthly basis. That said, let's get in Mitesh Thakur onto the show. Hi, Mitesh. Good afternoon. Good to see you in. Mitesh, well, not so bad, right? I mean, at the start of trade, if someone said that we'll be down 120 points getting to the last 60 minutes, I guess the bulls will take it because we were down 250, 260 points as well earlier in the trading session. And the Nifty Bank has defended the 20 DMA as we speak.
So, actually, pretty good recovery from the lower levels. So, I think, the key was one, we even dipped to about a low of around 23,200, and yet we are now trying to get back and claw about 23,350. So I think closing about 23,350 should keep the confidence going on the upside. I think if we get a closing about this, then a retest of 23,530, 550 zones is very likely, and therefore the idea is to still wait it out and be on the long side, not panic or exit your positions. On the stock side, I have a buy on Crompton with a stop at about 360 for targets of 380. And the other stock which I like, that's a buy on DMart. It had a big breakout yesterday, rather on Saturday, and is now giving a pullback. So around these levels of 39.30 or 39.40, buy with a stop below 38.90 for a target of around 41.50.
Thank you very much for that. By the way, frontline European auto stocks are under severe pressure. So BMW, Volkswagen, these stocks are down close to about 4 to 5%. Renault is under pressure. And back home in India, it's the auto ancillary stocks. So Samvardhan, Motherson Sumi is also under pressure. The key reason is Trump imposing a 25% tariff on goods from Canada and Mexico. For more on the implications, Sudarshan joins in. And Sudarshan, there is an Elara note on this.
That's correct. So both these stocks, Samvardhan Motherson and Sona BLW, both stocks are under pressure. So Elara Securities has written a note on this. So saying that after this tariff imposition of 25% on both Canada and Mexico, basically how does it impact to both these companies? So Elara note says, Mexico and Canada produced contribution is at 30 to 60% for US sold vehicles, and contribution is highest for GM, Toyota and Volkswagen. It's 30 to 40% for GM and Toyota, and 60% it's for vehicle. Now coming to how did it impact to Samvardhana Motherson? Basically, Mexico contributes around 4% to its total revenue. And remember, all these like names, Volkswagen, GM, Toyota, all they are one of the basically major customers for Samvardhana Motherson. And that's the reason basically it gets the revenue, and its revenue contribution is around 4%. That's the reason you are seeing an impact, and stock is down 8%. Now coming to Sona BLW. For Sona BLW, Mexico contributes just 2% to total revenue. The note by Elara says, and bulk of the value addition of the products happens in India. Mexico is more used in assembly base, and if the end OEM shifts production to US, assembly base can be basically transferred to US facilities. So more impact is for Samvardhana Motherson, and it's very less impact for Sona BLW, but both these stocks are under pressure today.
Thank you very much for that. Prakash Diwan is now with us on the show. Prakash, these are well-flagged risks. We've been talking about the possibility of tariffs, which will hurt auto companies right from Trump's campaigning days. But it looks like it's finally here now. So from a stock-specific action implications, what are your thoughts?
Good afternoon, Rima. So, it's quite surprising that the market is kind of making it look as if this has come out of the blue. In fact, most of these tariff-related friction should have been there right after the 20th of Jan itself. But look at this is exactly what happens when the President of the United States is indulging in severe negotiation. Before coming to the office, he said there's going to be a lot of tariffs. We came to the office and probably mitigated a lot of the risk or sounded very complicit about it, or things placated a bit, and then he's actually started imposing those. So this is bound to happen. But the bigger worry is not from just these tariffs on Canada and Mexico. If you look at what's happening in Europe, particularly in the bigger markets like Germany and France, for example, the Mercedes management has actually gone on record and saying you should let Chinese companies come and sell entry-level cars because 80,000 euro cars are not going to be sold here, but they're going to be sold in China. So we need reciprocal this thing. So China will probably start negotiating with a lot of the other countries when the US behaves like this. So that's going to be a bigger concern, because if Chinese companies come into other markets because they're getting pushed out of other larger markets like the US and all, things could be very ugly for Indian ancillary companies. So best is to stay away from the timing. But there's a lot which is there in our ancillarization ecosystem, which is domestic oriented. So you'll make a lot of money there because they'll also come off a bit because of the rub-off effect. But two-wheelers, domestically oriented companies, I don't see much of issues. You could probably stick to that. But yes, the global ones like Samvardhana, even what the other one, Sona, BLW, these are likely to get impacted to some extent. But I hope it doesn't percolate to the rest of Europe, which is much bigger for these ancillary companies.
On EU, Trump has described the US trade deficit as an atrocity, and he's repeated his previous comments that the bloc had really taken advantage of the United States. But we'll wait by to see if that...
EU's turn will come. So it's only China, Canada, Mexico. But I think very, very likely. I mean, it's because he said it.
He said
he'll
it,
do
yeah. On UK, he said it's fairly balanced, the trade deficit.
But the EU is a
much larger
bloc. And there it'll... So there are only three reasons for tariffs, right? One is this fentanyl. The other is, the 30 years, he said, US has had trade deficits with the rest of the world for 30 years. So we need to correct it. That's structural. And the third is basically you impose tariffs to pay for tax cuts in the US. So, and that's the reason why, the current tariff, what has been imposed is not the two. It's essentially fentanyl, which can be, which is in a way easier to, hopefully easier to negotiate. The other two are more structural. And that's where both China and EU, at least Trump in his mind sees them as sort of clear culprits. So that EU thing will happen.
I just know one thing. We have not heard the last of this tariff talk.
Oh, last.
One day it's fentanyl, tomorrow it will be something. Today is just the day one. This is not going away anywhere. So markets will have to learn to trade with this excitement, I guess.
Absolutely. Well, I think let's bring in Aarti Industries, right, which is in focus in the back of a conference call post the third quarter numbers. Let's get some details going. Upasana is here with those details.
Well, certainly the numbers were a slight miss to our poll. Revenue and EBITDA margin was in line, while PAT stood much below our poll estimates. Now, company held its earnings call today morning, and here are some of the important highlights. Company has highlighted that the pricing pressure impacted the margins, which were down about 180 bips, despite the sharp ramp up in volumes. It has also said that the growth in energy business could have been better, but bulk large shipment order got delayed from December to Jan, which impacted the performance. Company seeing volume-led recovery in its non-energy segments. When it comes to agrochem, company says that it continues to see pricing pressure, and company has highlighted that polymers and additives continues to be on its recovery path. It has also said that January onwards, company is seeing gasoline naphtha spreads improving on a month-on-month basis. And it has also highlighted that the significant exposure of the company towards polymers and additives segment could see some tailwinds going forward, looking at the current market dynamics. Now, on US tariffs, the company has commented and said that all of us need to wait and watch to ascertain the US government's latest moves on tariffs. And company also needs to relatively look at the Chinese currency depreciation as compared to India, given the competitive pressure. In terms of exports, the company has said that the export for the current quarter stood at 1,000 crores versus 900 crores in Q2. And company has also highlighted in terms of its guidance that it is on track to meet its short to medium term guidance, and it targets EBITDA to range between 1,800 to 2,200 crores with a ROC in the range of 14 to 15% in 3 years.
Okay, all right. Upasana, thank you very much for those details there. So that's Aarti Industries in focus. Right now, the stock's still down about 2.5%. Prakash, hi. So we were discussing this, I remember last week as well, because a couple of the chemical companies just started reporting better numbers. SRF, it started with SRF and a bunch of others, Deepak Nitrite, etc. What do you think of Aarti, if you've had a look at the numbers? Any of the others in the bunch that you think have really turned the corner so one can take a positive call?
Yeah, so good afternoon, Sabhi. So I think Aarti numbers very clearly tell you the way things are in terms of transition, from a volume-led recovery to a price-led recovery, which should eventually happen. It's very simple. Aarti is the bellwether name, and the reason why the stock's not fallen in spite of them missing some of the metrics is it's just fallen 2%, which in today's market seems very nominal, is because at 16,000 odd crores market cap, it's very balanced in terms of its replacement cost itself. Look at where the trailing PE is. My sense will probably be about 35, 36. At its peak, it used to be about 1,160, 1,170 the price, which means it's available at a 65% cut from its all-time highs. So what's changed for Aarti is probably the trajectory, the volume shrinkage, the dumping from China. Some of the businesses that they got into were probably not the best of timing, but then they've built themselves to have a very significant global play and presence as things look up, particularly in Europe. So Brazil is the one that's taken off from what data we get from most of the chemical names. And I'm sure, if things look up on the other markets, which are bulk users or bigger users, things will look up on the agrochemical side for sure. So it's a good play. You just have to be patient for the recovery to happen. Now, whether you buy it before the recovery because it's available at lower valuation, or you let the valuation go up once recovery starts building in, it's a call that you have to take. But I think between SRF, Aarti, Navin Fluorine, you'll probably see DCM. You'll start seeing the semblance of change that's happening from the favorable side. But Aarti does stand out as a very well-integrated, balanced kind of a play. So definitely one of the best names. But timing, as I said, will depend on your risk, reward, and allocation perspectives.
Okay, all right, Prakash, just hold on to that thought. A few stocks in the last few minutes have moved to the high point of the day on very, very large volumes. Aditya Birla Capital, I think we should just pull up the intraday chart out there. That will tell you a better story. Big uptick is what we're seeing out there. They come out with a set of numbers. On the profitability aspect, it didn't look any great shakes. The revenue number was up by close to around 10%. And if I look at the AUM on the NBFC side of things, on the HFC side of things, there's a good growth out there. The mutual fund quarterly average AUM as well is up. So I think the share has taken a closer look into that. And that stock has moved to the high point of the day. And Jyoti Structure is another small cap company which has seen a big correction from the recent top. But the numbers that we flashed for you, well, they look pretty okay. And there appears there is some kind of recovery out there. Execution is picking up basically. So they delivered a big profitability number in comparison to a loss. So that's why one of the top volume gainers in the last few minutes. Any comment on either of these two, Prakash? AB Capital or Jyoti Structures?
So I don't track Jyoti Structures, and I know I've heard of this from a lot of social media chatter, but honestly speaking, I've never had a chance to look at it very actively. But on AB Capital, I can tell you this is exactly what BFSI names will actually start doing. It will start with the private sector banks, the larger banks, then the mid-sized banks, and then, of course, populate to the more healthier run NBFCs. But this is the space to be in. And I know it's almost sounding like a consensus call that, financials should do well going forward based on the budget and probably a imminent rate cut, which we'll just get to know in a couple of days. So I think AB Capital is representative of the change. Of course, it has its own structural changes that they've been able to bring in, and that's kind of helped improve the P&L individually for that company. But I'm quite positive on that space. My sense is you will have to allocate more money to the banks and NBFCs. Especially gold finance suddenly starts looking very promising given how gold is behaving, is likely to behave in this tariff war era. So yeah, that's a comment I would have, but nothing specific on Aditya Birla Capital to buy at this point in time.
Okay, all right. And we have Stofrost numbers as well that are flashing for our viewers. And those numbers, at least on a year-on-year basis, look pretty okay. Margins continue in double digits. And I think if I saw that number correctly, on the top line, there's a growth of close to around 8 to around 9% or thereabouts. We'll try to get you further details. Keep in mind, the stock has already had a good run. But Divi's Laboratory, that was a good set of numbers. Vinny joining in to dissect those numbers for us. Vinny.
Absolutely, a good set of numbers that was reported by Divi's Laboratories. Revenue, yes, that came in line with estimates, but margin much better than estimates. The profits of the company much better. So operationally, strong performance that has come in from the company. Let's look at the EBITDA margin of the company, 32% versus around 26.4% last year. So strong expansion in terms of margins, and we had highlighted it before also that the CS segment, that's the custom synthesis segment of the company, that is something that has been doing well, picking up pace. Now we're going to wait out for more details in terms of how has the growth been for that segment, specifically in the con call. But as of now, seems like that is working out for the company, supporting the margins, overall revenue growth of the company as well. Generic business overall, we know for most companies has been a bit under pressure, and even for Divi's Lab, it's expected to be a bit in terms of muted growth. Now, other positive trigger that one should be highlighting here is that Kakinada project of the company that has started the phase 1. Unit 3 has begun commercial production on 1st of January. This was one of the plants everyone was waiting for the operations to start for this plant. It was long due capex that the company had taken over the last few years, and that is why a big positive sign on that front is something that we're watching out for going forward in terms from the growth of the company point of view as well, and that is why Divi's Laboratories is buzzing in trade today.
Okay, all right. Thanks a lot for that, Vinny. Prakash, Divi's Laboratories seems to be getting its mojo back. You think so?
Oh yes, this is not the first quarter that things have started looking up. Even the previous 2 quarters did tell you very clearly that things are moving positively for them. Remember one thing, Nigel, the largest companies that are in this space are the ones who will benefit disproportionately and much earlier than the rest of them. So custom synthesis is not something which keeps going to everybody in the value chain. These are companies which have a very proven track record and capabilities to take on much more with very limited incremental capex. So that's what's happening. And imagine in 6 months, if Unit 3, what Vinny was referring to as the Kakinada unit, if that has to start contributing, you'll probably have even operating leverage coming. So very well poised at the current levels also. The risk reward is amazingly favorable. Where there are lots of other pharma companies which are still struggling to grow their this, especially the ones in formulations. But custom synthesis seems to be the buzzword, and there's no better play than Divi's in that scale.
Okay, all right. Prakash, we'll leave it there. Thank you very much for joining us. Always a pleasure getting your perspective on a variety of stocks and sectors. Thank you. We'll take a quick commercial break here, but just as we do that, leaving you with some sound bites. We spoke with Samir Arora of Helios earlier in the morning, and these are his views on these tariffs which have come through and implications. Slip into that break, see you on the other side.
The overall markets are down a lot, then India may outperform because A, it's not directly affected, and B, don't worry about markets like Taiwan because they have been closed for a week. So if you just look at how TSMC ADR was trading during this period because of NVIDIA and others, and then the TSMC local fall. So don't get totally carried away. A little bit you're allowed to get carried away. But the point is that the budget was good and this tariff situation is bad.
Businesses from top Indian honchos before putting your money on the line. How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
We are hitting the limits on what the government can directly do in terms of capex, and therefore the guidance from the government was that we will maintain capex as a percentage of GDP here onwards, that the scope for us to do more is now gone. So now they're experimenting with, for example, this 1 lakh crore that they've decided to spend on urban infrastructure. They have to find such avenues so that capex continues, but there is very little more they can do at the center level. Investment activity in the country is going to be a lot more dependent on how well the real estate cycle turns, how well the power generation cycle turns. And I think this almost obsession with waiting for the government to spend an extra 30,000-40,000 crores, in the larger scheme of things, these are all rounding errors.
I think FI selling is not beyond a point a big negative. It is that whether India is doing well or not. And then there is some correction of excesses and stuff like that, which clearly seems to have been done. One reason has to.
Welcome back. The Nifty IT index is one of the few, is perhaps the only index which is up in the green now, up about 0.5%, and gains visible in an Oracle Financial that's up 3.5%, Coforge, Wipro, Persistent. These are stocks with gains ranging between 2 to 3%, and on the way down, Zensar has seen a big cut, 8% lower on that. But let's continue with getting you more opinion on the budget. One day after, Neelkant Mishra, chief economist at Axis Bank and the head of global research, who joined us earlier to speak on the budget, he said, one should not ignore, the capex and the kind of stimulus that we've seen. Listen in to what he had to say.
We are hitting the limits on what the government can directly do in terms of capex, and therefore the guidance from the government was that we will maintain capex as a percentage of GDP here onwards, that the scope for us to do more is now gone. So now they're experimenting with, for example, this 1 lakh crore that they've decided to spend on urban infrastructure. They have to find such avenues so that capex continues, but there is very little more they can do at the center level. Investment activity in the country is going to be a lot more dependent on how well the real estate cycle turns, how well the power generation cycle turns. And I think this almost obsession with waiting for the government to spend an extra 30,000-40,000 crores, in the larger scheme of things, these are all rounding errors. The impact of this directly will be mostly on the discretionary items, so jewelry, retail, and somewhat, I think the market was responding rightly to this on Saturday. Cars, two-wheelers, etc. So at an aggregate demand level, remember that the deficit is still shrinking. So, and a large part of the space that is being created for these tax cuts were actually also coming from personal income taxes. I would expect direct impact on the segments which are affected by this. But overall, the questions on whether this increases inflation, whether this increases the current account, I don't think there will be any impact.
All right, Harsha Upadhyay is with us, CIO of Equity at Kotak Mutual Fund. He's joining us now to take some questions. Harsha, good to have you with us here. I trust you and your team have had, a day and a half more to look at the budget, analyze it, and sort of come up with conclusions, if I may use that word. This entire capex, infra, capital goods, power, that entire complex is coming down sharply today, and that was down sharply on Saturday as well. Is that a part of the market which will broadly underperform from here on? Can one go with that? Of course, I'm not talking about something exceptional happens. I'm talking about just the entire complex. What's your sense? I think the frame is frozen. Harsha, can you hear me?
Yes, I think.
Okay, he's back. Go on, Harsha. Go on. Yes, go on. We can hear you.
Yes, there has been some disappointment because compared to what the expectations were. I think the expectations from majority of participants was to see again government doing the heavy lifting in terms of the capex numbers. But I think given the fiscal roadmap and the fact that we have already seen a lot of investments from the government capex side in the previous few years, it was expected that it's going to be more or less around the nominal GDP growth. At least that was our view. And what has come out is also more or less in that range. What is heartening is to see that revenue expenditure has not grown as much as capital expenditure. And that's where I think government has used judiciously whatever the leeway that was available given the constraints on the fiscal deficit to spend that amount on the capital expenditure part. And hopefully our market will settle after a few trading sessions. It's not that it has been negative for the capital expenditure oriented businesses. It's just that it's been more or less similar to what we have seen in the past. There has been no increase as such. And whatever little bit of push that we have seen through personal income tax is for consumption-oriented businesses.
Okay. All right. Hi, Harsha. Good afternoon. Good to see you in. Harsha, if I remember correctly, you all had lightened your weight on industrials. Was that correct? Last couple of months?
Yes, we have been reducing our exposure to capital goods, engineering, and many other economy-oriented sectors.
Okay.
Yes, there is more to do with the profit giving high valuations in this segment. So to that extent, our portfolios have few quarters, I would say.
Okay, all right. So that's about the capital goods and industrial space. But I think you all were also optimistic on some of these quick commerce companies. And they've given you a big dip, if you look at it from the highs that we recently saw. And now you have, the consumption boost that's coming about as well in budget 2025. Good time to get into them? Harsha?
We continue to remain quite positive on the quick commerce space. Clearly, we continue to remain quite positive on the quick commerce space, and clearly this is one space.
Harsha, can you hear us? Okay, I think what we'll do is we'll try and connect Harsha. We seem to have Harsha on a pretty bad line. So we'll try and get him on a fresh line and see if we're able to do that. Markets down 130 odd points. Maybe we can use that time to just look at, the big volume-led sell-offs that we are seeing. So maybe you can just quickly follow me and look at these prices. HAL is the number one volume-led loser this afternoon. It's down 7%. Hoodco is down 9% on very large volumes. RVNL, again, very large volumes. There's a 6% cut. Siemens has been down 9% for the last few hours, actually. And again, big volumes. HPCL is down 6, 324 on HP. It's the biggest loser in OMCs today. Mazgaon Dock is down 6% to 2240. ABB is down 5.5%. Look at something like a REC, which sells off another 5.5%. I mean, both REC and PFC have corrected quite a bit. Look at Motherson. Motherson is down 8%. And of course, we highlighted that earlier. with our research team. Keynes is down another 6%. That's Keynes Technologies. JSW Energy is down 5.5%. In some way, most of these are old economy, manufacturing, industrials, capex, whatever you want to call it. NCC is down 6%. That's Nagarjuna Construction, 217. Look at CG Power, back at about 580 kind of levels. So 4.5% lower on CG Power. There is Anantraj, which is down 7%. Anantraj saw a massive decline, then a decent recovery. Look at Angel One, 6% cut, 23.36 on Angel One. Inox Wind is down about 6%. Motilal Oswal Financial Services, 620, 5.5 lower there. Garden Reach Shipbuilders, Rights, Railtel. Look at something like Texmaco Rails. All these railway names, once again after Saturday's session, are selling off. And there is, of course, Thermax, which is down about 8% as well. And all these have got humongous volumes. I mean, they're not selling off on small volumes or anything of that sort. These 15, 16 names, I think, that I just mentioned. I think Harsha is back with us, hopefully on a better line. Harsha, Nigel was asking you about the quick commerce companies and Zomato, etc., and they've corrected quite a bit. Your view now? I don't think... Harsha, can you hear me? Okay, I think Harsha cannot hear me. This is just a bad line, unable to get through. What we'll do is we'll take a quick commercial break here. Let's do that. We're going to come back and just listen to Rhythm Desai of Morgan Stanley. We spoke with him in the morning. He's calling this a magic budget. And he explained why he thinks so. He also kind of spoke about where this tax relief to the middle class may go, which sectors. Listen in.
I think we are now getting into a phase where growth will surprise to the upside. The budget reaffirms that. I think this is a growth-oriented budget. In fact, the phrase I've used for this budget is that it's a magic budget, and I'll come to that in a moment. And my expectation is that the monetary policy will back this budget, and the monetary policy will also become growth-oriented. So as far as India is concerned and what we control, I think things are looking up. So I think consumer staples is certainly not the place where we go to. Consumer discretionary, I think, is a much better bet. And even there, I think at the higher end of consumer discretionary is where I think you will probably see some of this tax saved being spent. Some of it can actually also come into the stock market. And all this is actually auguring well for the economy. When you've hit sort of a spending capacity limit and you don't want to do wasteful expenditure, and again, we should highlight this point, and I'll come to this in a second, so just give me a second. When you don't want to do wasteful expenditure, this is the best next alternative you have, which is give it to the people to spend. And that's what the finance minister has done. So kudos to her for that.
That Indian results came out very bad. I think it is one of the best budgets that we've seen in many, many years, and I tweeted it's a dream budget. So first thing is that you normally want money with the public rather than with government. It should just be the general thumb rule of looking at anything, that money with public is better than money with the government. You have not said that, oh, you cut a tax rate across the board, therefore the rich will get much more. It has come to the correct audience in that sense. So it has to be travel, it has to be savings, it has to be these car consumer durable types. As I said, we are not buying those, but they could. The overall markets are down a lot, then India may outperform because A, it's not directly affected, and B, don't worry about markets like Taiwan because they have been closed for a week. So if you just look at how TSMC ADR was trading during this period because of NVIDIA and others, and then the TSMC local fall. So don't get totally carried away. A little bit you're allowed to get carried away. But the point is that the budget was good and this tariff situation is bad.
Welcome back. The markets have recovered a little bit from the low point of the day. The Nifty is down 120 points, but keep an eye out on the broader markets. A few stocks have seen a good recovery. Varun Beverages, the stock went through a bit of a correction, a pullback from the recent peak. Now it's at the high point of the day, up close to around 3.5%. JSPL as well, I recall post the numbers, the street was a little bit skittish about the capex, additional capex that they announced. The stock was down close to around 10%. I think it's recovered close to around 70% of those losses. Currently, the stock at around 810 rupees at the high point of the day. The street is hoping to hear some kind of rationality with regard to the entire capex that they put out, because there's a big balloon up of close to around 16,000 crores of additional capex with no increase in capacity. But it seems there's a lack of communication that's played out there. That's why the street has bought into that dip, and that's one of the outperforming metal stocks after underperforming just last week. Mitesh Thakkar is back with us. Mitesh, what are the picks you have for us in terms of trading calls?
Nigel, I think, I would say while the overall closing is negative, the market has kind of shown some resilience. So, we'll try and look for long bets. Exide, after a good rally, has given a pullback and now, could complete a slightly bullish formation. So we'll take Exide as a BTST with a stop at 370 for a target of around 380 to about 382 for tomorrow, most likely. And the other one is GNFC, which I would recommend a BTST with a stop below 553 for targets of 566.
Thank you very much for that. Let's watch the oil marketing companies under severe pressure for the second day in a row as the budget makes no mention of LPG subsidies. Jefferies today has lowered the target price on the oil marketing companies too, as they believe the government has capped the profitability of these companies. Sudarshan is here with more details. Sudarshan.
So all the oil marketing companies are under pressure, and the reason is budget did not have any mention of LPG subsidy, while estimates were of that budget would announce compensation for LPG under recoveries of around rupees 35,000 crore or more than that. So as of 9-month FY25, total under recoveries for LPG are of rupees 29,223 crore, with IOC forming nearly 50% of that. So in 9-month FY25, IOC LPG under recoveries were rupees 14,325 crore, which saw an increase of 62% if you compare from the level that it had in September 2024. For HPCL, it was rupees 7,600 crore. For BPCL, it was rupees 7,300 crore. So this is the reason why these stocks are under pressure. But there is another part to this story. Oil Minister Hardeep Singh Puri had spoken to CNBC-TV18 after the budget, and he said, unlike petrol and diesel, LPG is regulated. So, and government is committed to making the payment for LPG under recoveries. Listen in what exactly he had to say in the conversation that he had with CNBC-TV18.
Very clearly, we are committed to that. Even when we got it from 28,000 crores, there was an under recovery on LPG. We gave them 22,000 crores. You don't need to make a budgetary provision. We can go to the finance ministry. Otherwise, if somebody behaves like a good corporate citizen, the OMCs, and they've had under recovery, we will compensate them. We are committed to that.
Also, the subsidy for PM Ujjwala has trended down, what we have witnessed so far, despite an increase in the number of beneficiaries. Also, do you feel there is going to be an increase in discretionary spend post the budget?
No, there is going to be enough provision for both LPG and that. Don't worry about it at all. You see, two things are happening. Insofar as natural gas is concerned, prices are coming down. Insofar as LPG, which is a product of a refinery, etc., we will look at that. There's no issue of no anxiety on that score.
Back to the markets then. The mid-cap index, which was down 1.5%, is down less than 1% now, so 0.9% lower. Even the small-cap index has managed to recover a tad bit. From being down 2.5%, it's now down close to about 2%, but still bleeding in terms of individual stocks and the cuts there. Sudeep Bandyopadhyay of IndiTrade Capital is now with us on the show. Sudeep, any budget bets, any stocks that you've recommended as buy based on the budget?
I think, while the budget was good and, market at some point of time did probably appreciate there being no fresh allocation or incremental allocation for capital expenditure by government. But the fact remains that the budget was good. We have been talking about FMCG for quite some time, and we had always recommended HUL and Dabur. So that continues to remain in our list. Apart from that, aside of the budget, I think we have witnessed and we have been talking about chemicals and specialty chemicals. I think after many quarters of underperformance, gross underperformance, if I must say, there are green shoots visible. I think a turnaround is going to happen soon. So one can look at, Aarti Industries, SRF, all these chemical and specialty chemical companies deserve attention. The valuation is definitely attractive, and the turnaround is round the corner. Now, whether it will happen in the next quarter or the quarter after, very difficult to predict. But if you are a long-term investor, I think it's worthwhile buying into these stocks at reasonable valuation.
Absolutely, and point taken there. Sudeep, hi, good afternoon. Speaking after a while, and lots moving, right? Things have completely changed around. Names like Voltas, etc. Sudeep, any thoughts here? When I saw Voltas and Orient Electric, some of these durable names, basically, we've heard that space being mentioned a few times since the morning.
Definitely, I think there is a propensity for the incremental income in the hands of consumers going for consumer durables. Staples and other basic things, incremental consumption will probably be limited. Where this money will go, it will be in consumer durables, maybe small cars, maybe towards hotel tourism. So obviously, I think these are areas, consumer durable companies, air conditioner companies, which will attract some of the incremental money, and their demand is expected to go up. So probably that's why some of these stocks got excited. As far as Voltas is concerned, I think the last quarter numbers were not very impressive. There has been some changes in the management as well. So we'll have to wait and watch. However, overall scenario for consumer durable companies definitely is going to improve.
Okay. All right. Hi, Sudeep. Good afternoon, and good to see you in. Sudeep, any view on JSPL? That's one of the biggest movers as we speak at the high point of the day. It was one of the big underperformers last week. The numbers weren't that great, to be the big outperforming stock for this quarter among fairest names. And now, in fact, they went ahead, they reported little disappointing numbers, and then the additional capex hurt them. But valuation-wise, it's still well placed. They still have capacity that's on stream. Maybe it doesn't come on stream in the next 3 months, but it comes on stream in the next 6 months. But it's coming on stream, so volume growth will come about. Your take?
Absolutely, Nigel. I think the performance was okay. And, the valuation, I think, is relatively attractive. Considering that there is going to be expectation of good demand, they will be in a position to cater to that demand through incremental volume from the additional capacity which is going to come on stream. So JSPL, definitely, if you are looking at a slightly long-term investment in this space, JSPL seems to be a good bet considering the valuation at which it is still available.
Were you recommending any defense stocks to your portfolio? And now, what would the advice be if someone has an HAL, BEL, BEML, or any of these shipbuilder stocks?
Well, I was not really disappointed with the budget as far as these stocks are concerned. Budget has maintained the allocation of government capital expenditure pretty much at the same level as last fiscal. So for us to get so disappointed, I think is a little unwarranted. Now, the other issue with these stocks predominantly was not, that they were not getting orders. When government has incremental capital expenditure allocation, the assumption is they will get more orders. Now, there was no dearth of orders for these companies. They were getting orders by tons. The question and the issue which was in everybody's mind was the valuation at which these were quoting, and the delivery, the efficiency and the delivery and the profitability. Now, these things remain still where they were, and the order flow, to my mind, will continue. So if you have to pick a defense stock, look at the valuation, look at the potential, and pick. I have been, advising buying into Bharat Electronics, BEL. I continue to remain positive there. And I think this correction which has happened over the last couple of days definitely is an incremental opportunity for accumulating this stock.
All right, Sudeep, we'll take a quick commercial break here. We'll come back. Stay with us. More questions coming your way. Markets down about 120 points. Stay tuned.
Tonight, I am announcing Canada will be responding to the U.S. trade action with 25% tariffs against $155 billion worth of American goods. This will include immediate tariffs on $30 billion worth of goods as of Tuesday, followed by further tariffs on $125 billion worth of American products in 21 days' time to allow Canadian companies and supply chains to seek to find alternatives. Canadian energy.
Welcome back. Well, let's hear out what S. Naren, Executive Director and Chief Investment Officer at ICICI Prudential AMC, had to say about the budget 2025.
Clearly, it was a budget which was focused on consumption for the middle class, and they gave money to the middle class. Whether they'll choose to save it, repay loans, or consume, this is the question for which we don't have the answer. But having said that, that is what the budget is about. This kind of shift was very logical on the part of the government, and so we don't complain. And I don't think it's a total shift away. It is just that you have to always, I think both the government and the regulators have to keep on doing things to help the areas which are not doing well, and actually to not give further support to the areas which are doing too well. We also have to be very cautious in sectors where things are very costly. So we have been cautious on small and mid cap, and we have been more positive on sectors which we used to be very negative on, like consumer staples, etc. So I think that's the way things should be, and that's the way I think long-term money is made, actually.
Okay, all right. Well, that's said S. Naren's views on the markets. Well, Sudeep is still with us. Sudeep, what about the capital market plays? Angel One, it was one of the outperformers on Saturday. It's corrected a fair bit from the top. The management, though, they have alluded some confidence that, they expect things to get back to normalcy. They're expecting a pickup in margins. And they say that maybe they don't have to take those price increases as well. But this one's come off drastically from the top. How do you play the capital market plays?
Well, I think capital market will have a lot of challenges in the near future. Look, very clearly, the market is going to be extremely volatile, and the upward momentum we had seen in the till about, let's say, September 24 is definitely missing. The way the global markets are positioned, the way the U.S. administration is going about tariffs and other things, I think we are in for a turbulent phase. So under the circumstances, if the equity market is not going to be in a real fast growth phase, some of these capital market intermediaries will not have a great time. So I don't think we should look at some of these stocks at current levels. Not that even now, after so much of correction, they are cheap. If you look at the PE multiples, they are at reasonable, very reasonable to high multiples. So my advice will be probably stay a little cautious there. If somebody is a long-term investor, some of the infrastructure, capital market infrastructure companies from a 3 to 5 year perspective does look good. Now, whether you buy now or wait for some more time and buy is a question which cannot be precisely answered. But the companies I'm talking about is CDSL, BSE, and the stocks like that, which definitely over a period of time will continue to reward shareholders.
Thank you, Sudeep, for that. Stay on. Divi's Laboratory is now piling on some more gains, 5.5% higher. Con call is underway, where the company says that Q3 has been a step forward in the positive momentum over the last few years. The generic portfolio will see additions given the upcoming patent expiries over the next few years. The stock is now at the day's high. But earlier today, we also chatted with Gautam Dugat, Head of Research at Motilal Oswal Financial Services. Listen in to excerpts from that conversation.
On balance, I think it was a pretty decent budget print. Numbers are quite believable, as they've been for the last 4-5 years for this government's budgets. Second, without impacting the fiscal consolidation territory, they've shifted the scales away from consumption, capex towards consumption. If you look at the percentage numbers between FY21 to 24, the capex compounding was 31% in terms of allocation, but the next 2 years now is about 9%. The consumer companies' numbers have been absolutely weak. This quarter, there is actually a decline in earnings for consumer companies. Very rarely you see consumer companies post a cumulative earnings decline. So that is happening right now in third quarter. I think the earnings can continue to remain weak for a quarter or two. But the multiples have been derated over the last 3-4 years for staple names, basically, not for discretionary names. Now that reversal can happen, and numbers, again, as I said, for capex can follow after 2 quarters in terms of moderation. For consumption, it can accelerate after 2-3 quarters. Retail, some bit of auto, consumer durables, jewelry, hotels, those are the companies where you might see probably slightly better, performance. We're still underweight on staples. Maybe we will also realign a little bit of a weight within the consumption pack. But at the moment, we are heavily overweight on discretionary or staples. Actually, it's Trent, Indian Opal, and Titan.
In conversation still with Sudeep, he's been waiting by. Sudeep, in an earlier chat, you had spoken about two-wheelers, and you seem to like some of the two-wheelers. Now, based on the January sales numbers, where would your preference lie? Today, you're seeing Eicher Motors rev up quite a bit, but your preferred picks?
My preferred pick then as well as now continue to be Bajaj Auto. I think they have a very balanced portfolio. Look, even the numbers which came out today, exports have done well. And remember, the exports have a significantly higher potential. And I'm sure at some point in time during the next fiscal, probably that will get realized. Nigeria numbers are still kind of reasonable. They can be ramped up significantly. And I'm sure the company is working towards that. So if I have to look at a one two-wheeler company, I think it will be Bajaj Auto. Remember, their EV also is doing reasonably well. And they are already number one in terms of the pecking order as far as EV is concerned. So we'll keep watching this space, but Bajaj Auto will continue to remain my favorite.
Bajaj will remain your favorite. No, point taken. By the way, when you said capital market infrastructure, CAMS included in that list as well. You mentioned CDSL, etc.
Yes.
Any specific thoughts on CAMS, which is also corrected quite a bit?
Yes, Prashant, CAMS and KFIN, both I think we should include in that bunch. In these cases, there is an additional, positive. Some of these companies are also venturing into, our neighborhood countries, Southeast Asia in particular, and the potential of earning fees there, the fee there is much higher. So if they can ramp up those businesses in these countries, I think their earnings will move up disproportionately. So from a long-term perspective, definitely CAMS, KFIN, BSE, CDSL, worth buying. But remember, you need to be an investor with patience, 3 to 5 year kind of time horizon you should keep in mind and buy. And don't definitely buy at one shot, buy over a period of time.
By the way, Bharti Airtel is up 1.7%. It reports numbers on Friday, and perhaps the money which comes into the hands of people will give the telecom companies more confidence to take more frequent tariff increases. So perhaps that explains the up move on Bharti. But all in all, down 0.5% on the benchmark indices. Not a bad outcome considering where global markets are trading, or some of them have ended, and the news flow that we had in the morning.
Here's the googly Rima. What if between now as we close and tonight when US markets open, Trump says, well, I've made a deal, no tariffs. So tomorrow, what will tomorrow look like? Well, that's the unpredictability, right? Last minute, something happens. It's, looking difficult, but nothing can be. You can never say no with these things. But 120 points lower is like any other normal kind of day. It's just that market has already been correcting quite a bit into the budget, out of the budget. The budget is not the reason. It's all these global market worries, etc., which have kept sort of risk at bay Although, just look at the kind of stuff which is corrected. And there, I think you can take away some, you can draw a line or a link to what the budget has announced, which is, focusing more on consumption, maybe focusing on infra as well, but more on consumption. And everything capex, infra, etc. has taken a bit of a backseat. Sharp cuts actually between 6, 8, 9% in many cases. 10, 15 names which have come off. These are well-owned, well-traded names which has seen this pressure. So that's the overall picture. The bell's gone off. It's a wrap on this edition of Closing Bell, and from all of us here, it's goodbye. Well, decoding the impact of budget with market masters, S. Narain and Samir Arora, that's essentially the show for you at 3:30 today. So stay with us. That's coming right up.
American manufacturing, businesses, and homes. Of America's top 5 trading partners, Canada is the only one with whom the United States runs a trade surplus in manufacturing. And Canada buys more goods made by Americans than China, Japan, and Germany combined.
Presently, taxpayers can claim the annual value of self-occupied properties as nil only on the fulfillment of certain conditions. Considering the difficulties faced by taxpayers, it is proposed to allow the benefit of 2 such self-occupied properties without any condition. To streamline the process of transfer pricing and to provide an alternative to yearly examination, I propose to introduce a scheme for determining arm's length price of international transaction for a block period of 3 years. This will be in line with global best practices. With a view to reduce litigation and provide certainty in international taxation, the scope of safe harbor rules is being expanded. A number of senior and very senior citizens have very old national savings schemes accounts. As interest is no longer payable on such accounts, I propose to exempt withdrawals made from NSS by individuals on or after 29th August 2024. I am also proposing to allow similar treatment to NPS Vatsalya accounts as is available to normal NPS accounts subject to overall limits. The middle class provides strength for India's growth. This government, under the leadership of Prime Minister Modi, has always believed in the admirable energy and ability of the middle class in nation building. In recognition of their contribution, we have periodically reduced their tax burden. Right after 2014, the nil tax slab was raised to 2.5 lakhs of rupees, which was further raised to 5 lakh rupees in 2019 and to 7 lakh rupees in 2023. This is reflective of our government's trust on the middle-class taxpayers. I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Well, let's welcome in our market master of the day is one of the largest fund managers in equity side in India, S. Naren, Executive Director and Chief Investment Officer at ICICI Prudential AMC is joining in. Naren, it's a great day to have you with us here on the program. Thank you very much. Great day not for the market, but important day, let me rephrase. Naren, how are things set up according to you? The budget, what were the two big sharp points that you took away from it? There's this tariff bit. Expectation is it'll blow over. It's not permanent. And of course, there's monetary policy ahead. Where does all of this leave markets?
No, clearly it was a budget which was focused on consumption for the middle class, and they gave money to the middle class. Whether they'll choose to save it, repay loans, or consume, this is the question for which we don't have the answer. But having said that, that is what the budget is about. And of course, today it has been taken over by what has happened in US on Saturday night. So we have a situation where the budget is no longer the central piece at this point of time. It has been taken over by that. But that's where we are. But having said that, this was needed because over the last 3 to 4 years, we have had a situation where the infrastructure and capex side of the economy has done very well, but the consumption side of the economy had not done well. So, as contrarians, we have always believed that, you will always have these cycles, and therefore the consumption side of the economy had to do better, and the budget gave that shift. So it's a very positive budget from that point of view, and it is the right thing to do at this point of time.
Naren, we had Neelkant earlier, who you know well. And I asked him whether the messaging from the government is shifting away, taking the pedal off infrastructure spending, because maybe that's not, the government can only do that much, the central government. Definitely it is focusing on consumption. As a money manager, Naren, what does it mean for portfolios, you think? You think there will be a difficult shift away out of these infra kind of names to consumption names? You've complained about the very high valuations, infra, capex, etc. kind of stocks have traded at.
Yeah, actually, for us, it was very logical that, for example, there was a time when we used to complain about very high valuations, consumer stocks. And for a change, we do have consumer stocks in our value fund, for example. So I would say that, this kind of shift was very logical on the part of the government. And so we don't complain. And I don't think it's a total shift away. It is just that you have to always, I think both the government and the regulators have to keep on doing things to help the areas which are not doing well, and actually to not give further support to the areas which are doing too well. I think that is the role of the government and the regulator, and that's what they've been doing. Last year, for example, the regulator actually slowed down personal loans. That was again a very good step. So I believe these kind of steps have to be done on a continuing basis. And as fund managers of public money, we also have to be very cautious in sectors where things are very costly. So we have been cautious on small and mid cap. And we have been more positive on sectors which we used to be very negative on, like consumer staples, etc. So I think that's the way things should be. And that's the way I think long-term money is made, actually.
So this is exactly what we were sort of discussing with Neelkant as well. The question is now, what is the change in the portfolio? And I'm not talking about short, tactical trades here and there. I'm talking about someone who's looking at least a 1-year portfolio, 2-year portfolio. Would you recommend that that person cuts down on capex a little bit and loads up on consumption, discretionary consumption? Or no, because you yourself are saying that it's not like the government is taking the focus totally away from capex. From a portfolio stance, 1 to 2 year view, what is the kind of directional change that you would recommend, if any?
See, I think from a portfolio stance, what we've been saying is it is actually small and mid cap, which is really very costly. And that is the area where over the last 1 year, we've been advocating people that they have to be cautious. So we closed our small and mid cap for lump sum investment as a result. And that is the area where I would say that even today, after the correction, valuations are still much higher than large caps. So that is the area where we would be even more careful. And I would say across various sectors, small and mid caps have got overvalued. And that is the bigger problem in the market than even large caps across. If you look at large caps, I would say there aren't too many large caps in the infra capital goods space itself, so that for us to actually really think about. And that is where we have been careful, and still I would say you have to be careful in small and mid caps in various capital goods space or infra space. In all these spaces, you have to still be careful wherever the valuation has gone up too much. But I would say you have to be careful in capital goods, in small and mid caps across sectors.
All right. Hi, Naren. Good to see you in. And you've been making this point, right? Cautious on the broader markets in comparison to the large cap names. Naren, you know, earlier this morning, we were highlighting a few of those stocks, like the chemical stocks, some of those molecules in the US, that they export out there, that could get a bit of a booster shot because if these tariffs are imposed on China. In that backdrop, I wanted to ask you, what is your contra play you're looking at? Is it chemicals? Is it metals? There's a lot of uncertainty out there. Or is it cement? Some of these sectors haven't done well. So that's why I'm just pointing out a few. But what would be the big contra theme that you're looking at?
See, clearly our contra theme over the last 1 year has been asset allocation because people are just not willing to invest in debt. Clearly, chemicals was one such contra theme also, but it is not a very large sector. But chemicals has done very badly in the last 3 to 4 years. So that it was a contra theme, if you ask me, but not a large sector from that point of view. But our contra theme has been asset allocation because no one was willing to invest in debt. And it was such a trouble to get people to think of even asset allocation and hybrid funds in a big way because people said we'll invest in small cap, we'll invest in micro cap, we'll invest in SME IPO, but we will not invest in asset allocation. So our big contra theme actually was to choose people to invest in asset allocation. And today, as we speak, it's very heartening to know that today many of the hybrid funds that we run have delivered as well returns as many of the small cap and mid cap over the last 1 year, primarily because of the last 1 month. And that's been a happy feeling because most of the time we used to be questioned as to why you are recommending cautious stances all the time. And that has worked luckily in the last 1 month.
And Naren, just to come back on consumption, where you've said that you recently started taking a little more positive stance on the sector. I'm just trying to understand what kind of re-rating or multiple expansion can we expect? Because the other argument is that, how much do you want to pay for, say, 4 or 5% volume growth? I'm talking about consumer staples. So do you see those multiples going back to the heydays of 60 times, 70 times? And again, if I talk about the other end of consumption, where growth is visible, now whether it's Trent or Zomato, these new age consumer stocks, discretionary consumption, jewelry companies, hotels, what is a reasonable level of PE expansion that you would be comfortable with?
This is a complicated question, and this is what we keep debating. Frankly, we are not yet in a situation where it's possible for you to actually bet that things will zoom up from here in consumption side. I think because the sectors have got re-rated already in 2-3 days significantly. So, we have to do a fair amount of bottom-up thinking. And I don't think we are in a situation where you can get big returns from the market at this point of time, which is why our recommendation has still been asset allocation over everything, large caps over mid cap and small cap. Clearly avoid SME kind of areas, avoid unlisted kind of areas. This is what we're saying. We're not in a phase where you can make mega returns. That doesn't mean that these stocks are going to fall from here. I don't think that is also true at this point.
Right. What about Naren? Asset allocation has been such a big talking point for you over the last year and a half, maybe 2 years. Gold has done so phenomenally well, Naren. This is amazing. Almost $3,000. What's your view from here, Naren?
It's impossible to tell people at this point of time when you're doing asset allocation, invest in gold on just like that, because gold is a phenomenal asset when you see the geopolitical problems at this point of time. That is why multi-asset is the only way in which we can think of gold now, because there's just too much of problems on the geopolitical side. Each country wants to levy duties on other countries. So at that point of time, some investment in gold is okay from an asset allocation standpoint. But would we like to recommend standalone investing in gold and silver at this point of time? I don't think so. I think that phase is over. that phase of being very positive on gold and silver standalone is over for us in our framework.
One sector, usually I don't ask sectors with you, but oil marketing companies, right? Look at HP, BP, IOC, the stocks will all come up. They're all down 6-7%. And the question many investors are asking is, I mean, looks like from what the numbers have been presented, they'll have to bear the LPG burden, the subsidy burden. Any thoughts? Have you looked at that? I mean, that risk is back.
Anything which falls off a cliff and companies with good amount of assets and oil marketing companies like that, if you take a view that oil is not going to shoot up, I think those are all sectors which are not that bad after a big correction. That is how we look at things from a contrarian framework. So if a sector has fallen off a cliff and, these are all companies which can't be created in India any longer. So I believe that's why we wouldn't be so negative after a big fall, clearly at this point.
Okay, well, that's the framework and always contrarian, one of the few true contrarians out there. Thank you very much, Naren. It's a pleasure having you with us here. Thank you for joining us here on the program.
So, detail the indirect tax reforms and changes in direct taxes in Part B. Financial sector reforms. The FDI limit for the insurance sector will be raised from 74 to 100%. This enhanced limit will be available for those companies which invest the entire premium in India. The current guardrails and conditionalities associated with foreign investment will be reviewed and simplified. The services of India Post Payment Bank will be deepened and expanded in rural areas. NABFID will set up a partial credit enhancement facility for corporate bonds for infrastructure. Public sector banks will develop Grameen Credit Score framework to serve the credit needs of SHG members and people in rural areas. A forum for regulatory coordination and development of
Let's get Samir back on, right? Samir Arora, founder and fund manager at Helios. Samir, good to have you with us here. Thank you for waiting. Appreciate it very much. So what is top of mind to you? Tariffs or the consumption boost here? And what will drive markets from here?
So on a relative basis, it will be the budget in the sense that actually the budget was good and we'll talk about it. But if the overall markets are down a lot, then India may outperform because A, it's not directly affected, and B, don't worry about markets like Taiwan because they have been closed for a week. So if you just look at how TSMC ADR was trading during this period because of NVIDIA and others, and then the TSMC local fall. So don't get totally carried away. A little bit you're allowed to get carried away. But the point is that the budget was good and this tariff situation is bad. But the tariff situation doesn't look as if it's going to be there for 6 months and 9 months. I mean, these guys have to be able to demonstrate a little bit about the demands of Mr. Trump on fentanyl and all. And I read that Canada is saying, see, we bought these 4 helicopters and we bought some drones and whatever else they can demonstrate. At least this doesn't look like this itself is a trade war forever because the ask is not related to trade as of now. It is related to reducing immigrants and drugs, which actually in theory are easier to show by saying we have, more forces, more tracking, more inspections, whatever.
So it's not permanent, and that's exactly the point that I was making earlier as well, that it's easier to do. I'm surprised why they've not done it. Put out a statement, strong statement saying that we're going to do everything, all of this. I don't know.
And I think it's because they are upset in general with each other. But actually, it's not started yet. It is supposed to start tomorrow. And I think Trump has just tweeted or whatever has commented that he's meeting them or talking to both these guys today. And China, realizing that this is just a bit of drama, has not said anything back. So it is bad, of course, but it's not like this is it and now, therefore, this is like 1930 when there were trade wars and markets fell. But right now, part will overshadow the fact that it was a good budget.
Samir, there is the immediate reaction to play out. Sort of, how do you look at that? Because for us, now I was trying to find silver linings. The only silver lining I could see for India was that finally the US market is buckling. Maybe for
That's
a short.
also one positive.
Yeah, so your thoughts on that?
No, so that is that is one of the points, but I thought we were talking budget first. But that is, of course, important because this obvious thing that you will sell emerging markets and go, of course, they will say even more improves because currency has strengthened. US and Indian currency right now looks like 40 basis points down, about 86.90 or something. So these things are now, you can spin it both ways. But in general, beyond a point that the fact that you can't put everything in one basket, particularly for A, global investors, B, long-term investors, and C, there are fund managers who cannot put it in US, they themselves. They will not go to their investor and say, please take my money and put it in US. So the emerging market fund, the Asian fund, the Asian emerging market funds, global fund. And then there is this other side of people saying US has gone up so far, too much, exceptionalism, US will not last. Ruchir Sharma keeps saying that there'll be some followers of that thesis also. So beyond a point, that trade is not so important that, people will take money from India and go to US. I think FI selling is not beyond a point a big negative. It is that whether India is doing well or not. And then there is some correction of excesses and stuff like that, which clearly seems to have been done.
All right. Hi, Samir. Good to see you. And Samir, since you spoke about FI selling, do you think it's getting to the fag end? That was the hope at the end of 2024. And bam, 2025, they're selling even more. Do you think,
so actually, if you look at it, look at it, September was a massively positive month for India, some 7-8 billion positive. And October was negative, some 10 billion. Then November was sort of zero-ish, 1-2 billion minus, and December was plus.
Yes.
And again, Jan is big negative. So now we have to make some story. We can't say random. So the story which has to be consistent is that in October, they were thinking that US positioning and, Trump winning and dollar strengthening and all that, which happened. Then December, they were positive again. And Jan, again, negative. One reason has to be India related. That Indian results came out very bad. Because if you see, Taiwan was not negative. It's an emerging markets. It is an anti-US. I think Korea was negative, but not a lot. Basically, the entire emerging market negative in January. I think January or maybe a little, February just started. So must be January. Was, I think, some $7 billion negative, and all of it was India. So now if India improves or it corrects or generally some stable thing is found, this continuous selling does not have to happen. Then it'll turn to buying also. So I'm saying the default in general is not that foreigners sell. The default is they buy and sell, but in the end, they mostly buy. Mostly means last 25 years, even if you see last year, there was sort of net zero. Now, why were they net zero? Because they sold in secondary and they bought primary. Now, why did they buy primary? Because the primary stocks are different. They are not the old banks, the consumer, the Reliance, the whatever. They are these IT type companies or tech companies, whatever, this consumer tech or fintech or whatever tech. And so out of your $800-900 billion, you have switched some $10-12 billion to the new age kind of stuff. So what is so unreasonable about it, except that is done between secondary and primary? If it was done between secondary and secondary, you would have said flows have been flat for last year.
Right. Got it. Samir, so for viewers who are watching, right, there is a boost to consumption. People are still invested in capex, infra type of names. There is one view which says that this could be, 6 months down the line, we could look back and say, well, this was the inflection point. Not because it is 1 lakh crore and is going to do, but basically it was a shift in focus, it was a shift in message. So the style factor will change from what you should look and do here. So I just wanted you to your comments on that, whether it will really be so.
I think it is one of the best budgets that we've seen in many, many years, and I tweeted it's a dream budget.
Yeah.
So first thing is that you normally want money with the public rather than with government. It should just be the general thumb rule of looking at anything, that money with public is better than money with the government. Number two, you have not taken money from one group and given it to the other, which would make it, that, oh, you are deciding. Here they are saying, you just give us less money. It's not that you've taken it from one, given it to the other. Third is, you have not said that, oh, you've cut a tax rate across the board, therefore the rich will get much more. It has come to the correct audience in that sense. Other than that, on infra and all, so then one more issue people I see in the reports that I get and on Twitter and all, oh, only 3% people are affected, only 4% are affected. So if the government announced that there'll be a new road being made between, I don't know, say Faridabad and Meerut, only 2% of Indians will use it. The South guy will say, how do I care? You made a road there. Everything that you do, only 2-3% people, 5% people are affected. But the reality is that there is no capacity to invest more in a road because the big roads are being made. And if anybody believes that a road that is not doing well, is not made well, is because of money, or is it because of management, or is it because of corruption, or is it? So learn from the US. I'm telling you, Donald Trump is going to be a massive positive influence everywhere in the world, including in India. Because you will realize that tax cuts and efficient government and cutting expenditure and all that. And secondly is, for whatever reason, which is now history, this year money could not be spent on infra and could not be spent maybe a little bit on defense. So now next year, what is the point of saying I will give 25% more budget to that section? It is better to say I will implement what has been done. But the reality at the end of the day is that money with the public is the best way. And in this case also, since there is a temporary or cyclical or short-term slowdown, it is better to deal with a temporary or cyclical or short-term up by saying, hey, take money.
All right, fair enough. Samir, thank you very much for joining us. Great speaking with you, as always, and, come back again.
Will be set up. To implement the earlier announcement on simplifying the KYC processes, the revamped central KYC registry will be rolled out in 2025. We will also implement a streamlined system for periodic updating. Speaker, I present the budget for 25-26. This budget continues our government's efforts to A. Accelerate growth, B. Secure inclusive development, C. Invigorate private sector investments, D. Uplift household sentiments, and E. Enhance spending power of India's rising middle class. Together, we embark on a journey to unlock our nation's tremendous potential for greater prosperity and global positioning under the leadership of Honorable Prime Minister Shri Narendra Modi. As we complete the first quarter of the 21st century, continuing geopolitical headwinds suggest lower global economic growth over the medium term. However, our aspiration for a Vikasit Bharat inspires us, and the transformative work we have done during our government's first 2 terms guides us to march forward resolutely. Our economy is the fastest growing among all major economies. Our development track record for the past 10 years and structural reforms have drawn global attention. Confidence in India's capability and potential has only grown in this period. We see the next 5 years as a unique opportunity to realize Sabka Vikas, stimulating balanced growth of all regions.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. The US dollar soars and stocks plunge across the world after US President Donald Trump puts pen to paper on the tariff threat, imposes a 25% additional tax on Canadian and Mexican imports and a 10% additional tax on China. Canada hits back with retaliatory tariffs. Mexico and China vow to do the same. The Indian rupee falls to a new low against the dollar, breaching the 87 mark for the first time. Sensex down over 300 points. Mid-cap sees sharper cuts. Shares of oil marketing companies slide after no mention of LPG subsidy in the budget, but Petroleum Minister Hardeep Puri says government is committed to compensating the losses, which is more than 29,000 crore rupees in the first 9 months of this fiscal. You heard the budget speech on CNBC-TV18. Now watch the budget makers decode it on India's #1 business news channel. North Block Secretaries live and exclusive from 4:30 p.m. on the budget verdict. Rahul Gandhi targets the government's economic policy in Parliament, says the Make in India initiative has failed and alleges that Chinese troops are sitting inside Indian territory. The BJP hits back as Lok Sabha sees heated exchanges. Volkswagen India challenges tax demand of $1.4 billion before the Bombay High Court, says the company will avail all the available legal remedies against the tax demand. Loudspeakers to go silent as campaigning for the Delhi Assembly elections come to an end today. Voting will take place across all 70 constituencies on the 5th of February. Aam Aadmi Party, the BJP and Congress are locked in a three-cornered race. Results on the 8th of February. The top story this evening, US President Donald Trump has kicked off yet another trade war. The US has imposed 25% additional taxes on imports from Canada and Mexico. Chinese imports have been hit with an additional tax of 10%. Canada has already retaliated with its own tariffs on US imports. Mexico and China have also promised to respond in kind. Trump has also threatened to impose tariffs on the European Union next, and the EU has also vowed to retaliate. All this has roiled the stock markets across the world. From Asia to Europe, stocks plunged in trade as investors came to grips with the potential consequences of an all-out trade war. The US dollar surged in trade, sending emerging market currencies into a tizzy. Here's a report on what promises to be another round of a trade war and its potential ramifications for the global economy.
Canada will be responding to the US trade action with 25% tariffs.
Canada and Mexico announced plans on Saturday to tax U.S. goods in retaliation to sweeping new 25% tariffs ordered by U.S. President Donald Trump on imports from their countries.
We subsidize Canada by the tune of about $200 billion a year. And for what? What do we get out of it? We don't get anything out of it. I love the people of Canada. I disagree with the leadership of Canada. And something's going to happen there. Mexico, we've had very good talks with them, and this is retaliatory. This is retaliatory to a certain extent. Millions of people flowed into our country through Mexico and Canada, and we're not going to allow that.
It's a move economists say could lead to a trade war that risks reigniting inflation, with Trump also ordering a 10% tax on products from China. At a news conference, Canadian Prime Minister Justin Trudeau said his country's tariffs on the U.S. would be similarly far-reaching, including everyday goods and consumer products.
Tariffs against Canada will put your jobs at risk, potentially shutting down American auto assembly plants and other manufacturing facilities. They will raise costs for you, including food at the grocery store, gas at the pump.
Mexico's President Claudia Sheinbaum said she's ordered her economy minister to bring in tariff and non-tariff measures to defend her country's interests without giving details.
This measure of 25% tariffs has effects for both countries, but it has very serious effects for the economy of the United States, as it's going to greatly increase the cost of all products that are exported from Mexico to the United States. It's going to have 25% more cost. I also say that if they want to act, they should not set their sights on Mexico, but on their own country, where they have done nothing to stop the illegal sale of fentanyl and other drugs.
The United States is by far Mexico's most important foreign market, while Mexico overtook China in 2023 as the top destination for U.S. exports. In contrast to Canada and Mexico's direct retaliations, China gave a toned-down response on Sunday. The Chinese government denounced Trump's trade action, but left the door open for talks with Washington that could avoid a deepening conflict.
So what are the goods that will be impacted by Trump's tariffs? Hormaz Fatakia is here to explain. Hormaz.
Well, in news that has or was anticipated, and there was still some hope against hope that it does not happen, the self-proclaimed tariff king, Donald Trump, imposed a 25% tariff on goods from Canada and Mexico overnight. Now, these tariffs will take effect at 12:01 a.m. on Tuesday night. However, some critical commodities like oil and electricity from Canada have been subjected to a lesser 10% tariff instead of 25%. Now, it is not as if everything is hunky-dory for the U.S. economy post the imposition of these tariffs. Majority of the imports coming into the U.S. are either manufactured in Canada or in Mexico. Now take a look at this. Now more than 1 in every 5 cars and light trucks that are sold in the US were built either of those two nations. Now, to put a number to that stat, the US imported cars and light trucks worth $69 billion from Mexico and worth $37 billion in Canada in 2023, according to S&P Global Mobility. Now, auto parts from Mexico are a big part of the US auto industry, and that $78 billion auto import bill can be under serious jeopardy if Mexico takes some decisive steps. Now, a better part of the US Midwest, the northeastern coast and other areas rely solely on Canadian crude for their energy needs. Now that explains the gulf between the $90 billion import bill from Canada in 2023 compared to $11 billion from Mexico. Now analysts believe that these tariffs from Donald Trump will increase US gasoline prices anywhere between 30 cents to 70 cents a gallon going forward. Now people in the US love to raise a glass of tequila or whiskey. But what they have to contend with for now is a raise in prices. Now, US imported nearly $5 billion worth of tequila from Mexico in 2023. Even mezcal, which is a plant used to make alcoholic drinks, saw an import bill of over $100 million. Now, some tariffs would definitely bring the spirits down. Now, Canada was not far behind in keeping the American spirits on a high, with exports of around $537 million, including $202 million worth of whiskey. Now, these tariffs have also left the farmers a little nervous because the US purchased $45 billion worth of farm products from Mexico in 2023 and another $40 billion from Canada. Now 63% of vegetables, 47% of fruits and 90% of avocado is imported into the US from Mexico. Now that was on the imports bit. Now how will Canadian and the Mexican economies be hurt post these tariffs? Canada mostly imported vehicles, machinery and most importantly aluminum from the US. The figures range anywhere from $3 billion to as high as $50 billion. It is also for that reason that the aluminum industry urged Trump to leave aluminum out of this tariff drama. Mexico has a similar picture, but what makes an appearance here is plastic, and that's worth a whopping $20 billion and another $7.5 billion worth of iron and steel. Now, experts believe that the tariffs will push both Canada's and Mexico's economy into recession, but both countries are grabbing the bull by the horn and giving a message to Donald Trump that they are no pushovers. The tariff man is back, as are the tariffs. They have sent the global markets into a turmoil, and the ball now lies in Donald Trump's court, because all the parties involved might end up asking each other, deal? Yeah, no deal.
Right. Thank you, Hormaz, for that comprehensive update on Trump's tariffs. Shifting focus now, as we were talking about Donald Trump, now the tariff war, the impact is being felt across the world, and as a result, CBIC chairman Sanjay Kumar Agarwal reacted to Trump's move, saying that most imports from the United States fall within the 10% duty range.
The optics have to be set right, because sometimes we are criticized that we have very high rates, but actually those high rates are there in the books, but items are importable at much lower incidence of duty at much lesser rate as per the notification rates. So we have corrected that situation. Most of the major imports from USA are within 10% rate.
Okay.
So it will not be correct to say that the tariffs are very high in India. Most of the items are in a narrow band from 0 to 10%.
Well, Trump's tariffs also weighed on the Indian rupee. The currency has fallen to a new low against the dollar, breaching the 87 mark for the first time. Lata Venkatesh is here with more. Lata.
Well, the rupee had to adjust because it was a global synchronized fall of all currencies versus the dollar. Dollar went up 1.25% from its Friday closing levels all the way to, almost 110, 109.7 thereabouts. So all currencies fell between 0.5% and 1%. And obviously, offshore traders simply adjusted the rupee to the new level. That's the uncertainty in the market as to what will happen in terms of trade, who are the winners, who are the losers, typically creates a flight to safe haven. So it flees from emerging market, smart money that is, flees from emerging market assets and goes towards so-called safe assets, which is dollar and gold. And both of them surged. Now, the rupee at one point in time when the RBI had a hands-off approach because they knew that it would adjust to the new global rhythm, the rupee went all the way down to 87.29. That's a fall of about 0.75%. Very, very rare that the rupee moves so much. But at that point, the Reserve Bank came in, after the first 45 minutes, 1 hour of trading. And then there has been relative stability, and the rupee even went to a high of about 87.09. Clearly now the rupee is trying to find a new support level, and we will have to see. It will be a very, very dynamic world. So no one is ready to call an immediate number. I mean, 87.5 will come, but what happens tomorrow, day after, depends so much on the global trade and tariff announcement from President Trump. All that dealers tell us is that this year there will be two-way movement of the rupee. It may go towards 88, but it may also come back towards 86. And more generally, the rupee will outperform other Asian currencies because we are a better growth story. But there is an immediate fall because at the moment, the growth story is not that bright. That's the message we got from dealers.
All right, thank you, Lata, for that. US President Trump's tariffs also pushed Bitcoin to a 3-week low. The cryptocurrency is now close to the $93,000 mark. Ethereum saw an even steeper drop of 24%, hitting its lowest level since September. Onto the energy markets, where oil prices gained as a threat of tariffs raised fears of crude supply disruption from Mexico and Canada. Prices were also supported by reports that OPEC Plus is unlikely to alter plans to raise output gradually. Meanwhile, gold prices fell from record highs after the dollar strengthened following Trump's tariff announcements. However, experts have said that the yellow metals decline is expected to be short-lived. Right, now to the stock market action back home. Sensex and Nifty declined by 0.5%. Sensex was down over 300 points. Nifty was down over 120 points. Mid-cap saw sharper cuts, with the mid-cap index was down nearly 500 pounds. Top investors Ridham Desai, Narain and Samir Arora have welcomed the announcements in the budget. Speaking to CNBC-TV18, all three experts said that the tweaks in the tax slabs point to a strategic shift towards consumption as scope for government's capex spend has reduced.
I think we are now getting into a phase where growth will surprise to the upside. The budget reaffirms that. I think this is a growth-oriented budget. In fact, the phrase I've used for this budget is that it's a magic budget, and I'll come to that in a moment. And my expectation is that the monetary policy will back this budget, and the monetary policy will also become growth-oriented. So as far as India is concerned and what we control, I think things are looking up.
Well, I think it is one of the best budgets that we've seen in many, many years, and I tweeted it's a dream budget. So first thing is that you normally want money with the public rather than with government. It should just be the general thumb rule of looking at anything, that money with public is better than money with the government. You have not said that, oh, you cut a tax rate across the board, therefore the rich will get much more. It has come to the correct audience.
Clearly, it was a budget which was focused on consumption for the middle class, and they gave money to the middle class. Whether they'll choose to save it, repay loans, or consume, this is the question for which we don't have the answer. But having said that, that is what the budget is about. This kind of shift was very logical on the part of the government, and so we don't complain. And I don't think it's a total shift away. It is just that you have to always, I think both the government and the regulators have to keep on doing things to help the areas which are not doing well, and actually to not give further support to the areas which are doing too well.
They're continuing to focus on fiscal discipline and also acknowledging that there is a very limited space that they have. So I think extrapolating this to mean that, the whole economy shapes up because of, 0.3% of GDP moving this way or that would be very unwise. So I would recommend that we remain focused on because this is going to be an investment-driven recovery. The way you drive growth going forward, the only way to do that is to accelerate credit growth. If credit growth has slowed from 17 to 11, somehow getting it back to 14, 15% by using all the monetary tools available, macroprudential tools available. Those will be the channels through which growth happens.
Shares of oil marketing companies continue to fall in trade after the union budget did not include compensation for LPG under recoveries. LPG subsidy for FY26 was pegged at 12,100 crore rupees. This is lower in comparison to the estimates for FY25, which was revised to 14,700 crore rupees. Now, Sudarshan Kumar joins us now with the details. Sudarshan, what does this mean for OMCs now?
OMCs or oil marketing companies were sharply under pressure in trade today, with stocks falling somewhere in the range of 4 to 7%. The reason? Budget did not have any mention of payment for LPG under recoveries, while estimates were of that budget would announce compensation of rupees 35,000 crore or more than that for LPG under recoveries. So in 9-month FY25, total under recoveries for these three oil marketing companies were of rupees 29,223 crore, with IOC forming nearly 50% of those. So for IOC in 9-month FY25, total LPG under recoveries were rupees 14,325 crore. That was an increase of 62% if you compare from the level of September 2024. Similarly, for HPCL, it was rupees 7,600 crore, an increase of 69%. For BPCL, it was rupees 7,300 crore, an increase of 77%. So the reason of budget not having mention of LPG subsidy, basically compensation for LPG under recoveries, that was the reason why these stocks were under pressure. But there is another part to this story. Oil Minister, while speaking to CNBC-TV18, said, unlike petrol and diesel, LPG is regulated and government is committed to making payment for the same. Listen in what exactly he had to say.
Very clearly, we are committed to that. Even when we got it from 28,000 crores, there was an under recovery on LPG. We gave them 22,000 crores. You don't need to make a budgetary provision. We can go to the finance ministry. Otherwise, if somebody behaves like a good corporate citizen, the OMCs, and they've had under recovery, we will compensate them. We are committed to that.
Also, the subsidy for PM Ujjwala has trended down, what we have witnessed so far, despite an increase in the number of beneficiaries. Also, do you feel there is going to be an increase in discretionary spend post the budget?
No, there is going to be enough provision for both LPG and that. Don't worry about it at all. You see, two things are happening. Insofar as natural gas is concerned, prices are coming down. Insofar as LPG, which is a product of a refinery, etc., we will look at that. There's no issue of no anxiety on that score.
Congress MP Rahul Gandhi has targeted the government's economic policy in Parliament. He said that the Make in India initiative has failed and alleged that Chinese troops are sitting inside Indian territory. The BJP hit back as Lok Sabha saw heated exchanges.
The fact of the matter is that wars are fought by industrial systems. The fact of the matter is that China has an industrial system that is far stronger, far bigger than our industrial system. And that is why they have the guts to come inside this country. The reason China is sitting inside this country is because Make in India has failed. The reason China is sitting inside this country is because India is refusing to produce. And I am worried that India is going to give up this revolution to the Chinese once again.
विरोध की कोई गरिमा होगी या नहीं होगी, और ये सवाल मैं बड़ी जिम्मेदारी से इस सदन में आज रखना चाहता हूं। महामहिम राष्ट्रपति के उस दिन के उद्बोधन के बाद एक विपक्ष की बड़ी पार्टी की बड़ी नेत्री ने क्या कहा उनके बारे में? पुअर लेडी ये शब्द है क्या? क्या मतलब है इसका? आज मैं बहुत गंभीरता से ये विषय उठाना चाहता हूं.
Finance Secretary Tuhin Kanta Pandey has said that the budget has given sufficient non-inflationary stimulus to the economy. Speaking at a FICCI post-budget interactive session, he said that any amount that the government borrows will go to capital expenditure.
In the budget itself, we have given that number. So let's not talk about 11.29. That's a direct central capex. There is an indirect central capex where is so 15.4. If we are able to do it, it's a very good capex. Your entire borrowings is going into capex. Normally, a lot of your borrowings go into your revenue expenditure. We are borrowing to build capex. Nothing could be better than this. It's a non-inflationary. We have a non-inflationary budget.
Telecom Minister Jyotiraditya Scindia has declined to comment on reports that suggested that the government is considering a 1 lakh crore rupee waiver of AGR dues. Speaking to Parikshit Luthra, Scindia said that he was not aware of any such reports.
The union government has been mulling a proposal to waive adjusted gross revenue for telecom companies, AGR dues for telecom companies. Could you give us a sense of where is this proposal right now?
I have no idea what you're talking about.
Okay, because there have been reports saying the government is considering a proposal to waive 50% interest and 100% of penalty interest.
I don't know which reports you're talking about. You will hear from me when it happens, if it happens.
So nothing as such under consideration?
I will not comment on that. The Supreme Court has passed a judgment. That judgment stands good.
Okay. Any plan of servicing the MTNL debt of nearly 8,000 crores? There have been reports about a package for MTNL as well.
What is very clear is, as far as MTNL is concerned, is all the operations as of 1/1/2025 have been moved to BSNL. There is going to be a huge amount of monetization of MTNL's assets.
Land assets?
Those assets, yes. And those assets will service whatever debt that is there that needs to be serviced.
The factory output hit a 6-month high in January, led by robust sales and export sales demand. As per the survey released by HSBC and S&P Global, manufacturing PMI rose to 57.7 in January versus 56.4 in the previous month. The report highlighted that strong domestic and export demand boosted growth in new orders. It added that employment in the manufacturing space aiding to growth in the sector. And staying with factory output, China's manufacturing activity slowed in January, largely led by the quickest fall in overall workforce in nearly 5 years. As per the S&P Global Manufacturing PMI slipped to 50.1 in January versus 50.5 in December. However, the report also highlighted that manufacturing production gathered some steam during the month, with total new orders increasing. The race to acquire stake in Religare gathers pace. Informing the exchanges, Religare said that US-based entrepreneur Danny Gaikwad has written to SEBI chairman seeking an exemption from open offer regulations. Gaikwad has written to the SEBI chairperson saying that he is willing to submit a genuine competing offer for 55% stake in the company. He added that he will establish escrow arrangements post the regulatory approval. And on that note, it's time for a short break. But coming up next, loudspeakers will go silent as campaigning for the Delhi Assembly elections comes to an end. We get you the latest from the national capital when we return.
The great Telugu poet and playwright Gurujada Apparao had said, "Deshamante matti kadoy, deshamante manushuloy," meaning a country is not just its soil, a country is its people. In line with this, for us, Vikasit Bharat encompasses zero poverty, 100% quality good school education, access to high quality, affordable and comprehensive health care, 100% skilled labor with meaningful employment, 70% women in economic activities, and farmers making our country the food basket of the world. In this budget, the proposed development measures span 10 broad areas, focusing on Garib, Youth, Annadata, and Nari, spurring agricultural growth and productivity, building rural prosperity and resilience, taking everyone together on an inclusive growth path, boosting manufacturing and furthering Make in India, supporting MSMEs, enabling employment-led development, investing in people, economy, and innovation, securing energy supplies, promoting exports, and nurturing innovation. For this journey of development, our four powerful engines are agriculture, MSME, investments, and exports. The fuel.
Welcome back. Volkswagen India has moved the Bombay High Court against a $1.4 billion tax demand that was issued by the government. The company told CNBC-TV18 that it was considering all legal remedies in response to the show cause notice as permitted under the law. They added that the company will ensure full compliance with the laws and are fully cooperating with the authorities on this matter. The Supreme Court has ordered a forensic audit of audio tapes which allegedly recorded statements by Manipur Chief Minister Biren Singh suggesting state's involvement in the ethnic violence. The Apex Court also told the Central Forensic Lab to submit the report in a sealed cover. The Supreme Court has termed the Mahakumbh stampede as an unfortunate incident. However, the Apex Court rejected a plea seeking an investigation into the matter. The court asked the petitioner to approach the Allahabad High Court as a judicial commission has already been constituted. Loudspeakers will go silent as campaigning for the Delhi Assembly election has come to an end today. The voting will take place across all 70 constituencies on the 5th of February. The results will be declared on the 8th of February. Both the Aam Aadmi Party and the BJP continue to trade barbs on the last day of campaigning. Listen in.
अब पूरी दिल्ली के माहौल से ये तो साफ हो गया है कि आम आदमी पार्टी ऐतिहासिक जीत की तरफ बढ़ रही है और भारतीय जनता पार्टी अपने एग्जिस्टेंस के सबसे बुरी हार की तरफ बढ़ रही है। तो भारतीय जनता पार्टी जाहिर तौर पे कुछ भी करेगी। जो बीजेपी के अंदर से खबरें आ रही हैं कि वो दिल्ली पुलिस का बेजा इस्तेमाल करने वाली है, सारे कानून संविधान एक तरफ ताक पे रख के दिल्ली पुलिस को पूरी गुंडई पे उतारा जाएगा।
8 तारीख को केजरीवाल खुद चुनाव हार रहे हैं, खुद चुनाव हार रहे हैं। बड़े मियां छोटे मियां की जोड़ी ने पूरे दिल्ली को ठगने का काम किया है, ठगने का काम किया है। जंगपुरा वालों, इस बार इनको ऐसा सबक सिखाना कि कहीं पर भी झूठा वादा करने से डरे।
Now, all parties announced free SOPs in the run-up to the Delhi elections to attract a key vote bank, that is 15 lakh slum dwellers. For context, Delhi has 675 slums and 1,700 hutments. Those living in the slums constitute 10% of the total electorate in Delhi. Abhimanyu Sharma travelled to the capital slum areas to do a mood check ahead of the elections.
Neglected by urban planners, dubbed as unauthorized and an eyesore by many, slums comprise of an important vote bank in this city-state of Delhi. In assembly elections dominated by 3 or even 4-way contests and thin victory margins, political parties are mindful of the fact that the next CM might be decided by the votes of those who are not sure of whether they'll have a roof over their heads tomorrow.
Approximately 80% of Delhi's 15 lakh slum dwellers had voted for Arvind Kejriwal's Aam Aadmi Party in previous Delhi elections. This time around, these residents are upset with political parties who are coming to their doors for votes. In the last 5 years, many slum dwellers have lived with a constant sense of fear of their homes being demolished. More than 30,000 demolitions have taken place in the past 5 years.
The Aam Aadmi Party has accused the BJP-led central government of demolishing at least 12 slums in the national capital.
पानी तो साफे नहीं आता है पानी का तो रोड भी बोला बना दूंगा कहाँ रोड बना रहा है
यहाँ कई बार झुग्गी टूटा है वो शौचालय वाला सब कहता है यहाँ का कर्मचारी को तनख्वाह नहीं मिला है
कुछ नहीं हुआ कभी उधर झुग्गी टूटती है कभी झुग्गी टूटती है सर्वे कागज हुआ था हमारे कहीं ये 7-8 साल पहले हुआ था
वादा तो कोई पूरा नहीं कर रहे हैं गंदगी और पानी दो चीज की परेशानी है
5 साल में वोट लेने और उसके बाद तो वोटें लेके बाद चले जाते हैं
गैस का सुविधा भी प्राप्त नहीं हुआ है
Rehabilitation of slum dwellers has been an election promise, but it's easier said than done due to 46 different land-owning agencies and court orders to clear encroachments. Arvind Kejriwal, in door-to-door campaigns, has focused on the Aam Aadmi Party government's schemes for free electricity, water, healthcare and transportation. He has warned voters that BJP, if elected, would demolish homes of slum dwellers. With these residents constituting 10% of the vote bank, there is a heated battle between the Congress, the BJP and the Aam Aadmi Party to win them over.
इनको चुनाव के पहले झुग्गी वालों के वोट चाहिए और चुनाव के बाद झुग्गी वालों की जमीन चाहिए।
पिछले 11 साल से अरविंद केजरीवाल चीफ मिनिस्टर रहे हैं दिल्ली के। एक अपार्टमेंट भी आज तक उन्होंने किसी गरीब को बना करके उसकी चाबी ना तो शुरुआत करी है ना तो उसके हाथ में कुछ मिला है आज तक।
PM Modi recently inaugurated Swabhiman Apartments in West Delhi, which is a slum rehabilitation project. Over the last 6 months, the BJP has conducted an outreach campaign to strike a chord with slum dwellers. Party leaders have stayed overnight in slum clusters to show their commitment to residents. But it remains to be seen how this group will vote in the 2025 Delhi Assembly election.
यहाँ पर हम लोग जुग्गी है वहाँ पर मकान दे दीजिए जिता देंगे आप लोग के जितना भी जुग्गी है सब
अरे बल्ब जलता घर में देख लो यार ये बुरी आदमी कमाने खा रहा कहाँ से ये जलाएगा बताइए हाँ सरकार का करे फ्री है बिल इस पर जी रहा मैं
केजरीवाल ने जो भी बोला है वो बात पूरी करी है उसने
उम्मीद देखिए हम बीजेपी से कर सकते हैं
डीडी की जगह थी वहाँ पे बीजेपी ने वो अभी झुग्गी वालों का अशोक नगर में 1576 फ्लैट दिए हैं।
Highly sought after as a vote bank by political parties, many slum dwellers view the act of voting as either pointless or as a transactional exercise to save their slums from being demolished. While all political parties are guaranteeing amenities and even rehabilitation, it would be a painstaking and a costly promise to fulfill in the national capital. In Delhi, this is Abhimanyu Sharma for CNBC-TV18.
All right, it's time for a short break, but don't go anywhere. News continues on the other side.
Reforms, our guiding spirit, inclusivity, and the destination Vikasit Bharat. This budget aims to initiate transformative reforms across 6 domains. During the first 5 years, these will augment our growth potential and global competitiveness. The domains are taxation, power sector, urban development, mining, financial sector, and regulatory reforms.
The verdict. Advisory partner Dhruva Advisors. Industry forum partner Startup Policy Forum. Please put your hands together for your host, Shivani Bazaz.
Good evening, ladies and gentlemen, and welcome to CNBC-TV18 Budget 2025, The Verdict, advisory partner Dhruva Advisors and industry forum partner Startup Policy Forum. Now, CNBC-TV18 Budget Verdict is India's most definitive post-budget analysis where the budget makers meet the India Inc. Every year, the union budget sets the course for the economy, but this year's budget is a game changer, offering massive tax relief for the middle class, ensuring more disposable income, and at the same time maintaining fiscal prudence while driving economic growth. It's a budget that doesn't just aim for numbers, it aims for impact. More money in people's pockets, more investments in key sectors, and a roadmap for long-term economic stability. But what went into crafting this vision? How does it translate for businesses, for investors, and you, the people? Today we bring you exclusive insights from those who shaped the budget and those who will be executing it. Before we begin our power-packed discussion, let's take a look at the special AV capturing the key highlights of Budget 2025.
It was a budget that put a big smile on the faces of India's middle class. In her 8th consecutive budget speech, Finance Minister Nirmala Sitharaman declared that an individual having net taxable income up to 12 lakh rupees would not be required to pay any tax.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees. So, average income of 1 lakh per month other than the special rate income such as capital gains under the new regime.
Under the new tax regime, the income tax slabs have been revamped to bring substantial relief to all taxpayers, with the threshold for the 30% tax slab now being raised to 24 lakh rupees. Calling the next 5 years as a unique opportunity to realize Sabka Vikas, the Finance Minister reiterated the government's focus on Garib, Yuva, Annadata and Nari. She also laid down the government's key priorities to steer the country on the path of continued development.
For this journey of development, our four powerful engines are agriculture, MSME, investments and exports. The fuel, our reforms, our guiding spirit, inclusivity, and the destination, Vikasit Bharat.
The budget's farm focus was evident in the government's commitment to develop 100 agri-districts, address underemployment in agriculture through skilling, investment and technology, and enhance loan limits for Kisan credit cards. The Finance Minister also announced significant enhancement of credit availability for startups and micro and small enterprises, customized credit cards for MSMEs, and a new term loan scheme for 5 lakh women, scheduled castes and scheduled tribes, first-time entrepreneurs. The budget also proposed expansion of seats in top engineering and medical colleges, a 10,000 crore rupee fund to strengthen India's startup ecosystem, and a 20,000 crore rupee allocation for a private sector-driven research, development and innovation initiative.
ये बजट एक फोर्स मल्टीप्लायर है। ये बजट सेविंग्स को बढ़ाएगा, इन्वेस्टमेंट को बढ़ाएगा, कंजम्पशन को बढ़ाएगा और ग्रोथ को भी तेजी से बढ़ाएगा।
Well, that was the budget at a glance. And with that, let's get straight into our first big conversation with the budget makers themselves, the key officials from North Block who played a crucial role in shaping the fiscal policy. They will be in conversation with Shireen Bhan, Managing Editor, CNBC TV18. Ladies and gentlemen, please put your hands together for the first panel discussion. Please welcome Tuhin Kanta Pandey, Secretary, Department of Revenue and Finance, Government of India, and Dr. Arunish Chawla, Secretary, Department of Investment and Public Asset Management. Ladies and gentlemen, a huge round of applause, please. Shireen, the floor is yours.
Thank you very much, Vani. Good evening, ladies and gentlemen. What an absolute pleasure it is to welcome you all here to the 11th edition of the CNBC-TV18 Budget Verdict. Yes, we've been doing this for a decade now, analyzing the fine print of the budget with the budget makers themselves in the first interactive session with leaders of India Inc. Many, many thanks to the Finance Secretary and the DPAM Secretary for joining us here this morning. As I promised, this is going to be an interactive session, so get ready with your questions here for those of you who are here with us at the Oberoi Hotel in New Delhi, and those of us who are joining us online on our YouTube channel and are watching us on television and tracking us on social media, send us your questions for the secretaries. We're starting now. Use the hashtag CNBC-TV18 Live and Budget with CNBC-TV18. We will take your questions to the secretaries live here on the CNBC-TV18 Budget Verdict. Gentlemen, before I talk to you about the budget, Mr. Pandey, let me talk to you about what we've seen happen over the weekend right after the budget speech was delivered by the finance minister. President Trump going through with his threats of imposing tariffs on Canada, Mexico and China. The global markets volatile, in fact tumultuous to say the least at this point in time. Commodity markets, currency markets reacting to the comments that have come in from the US and the tariff war escalation. Mr. Pandey, how worried should India be? What would your top concerns be as you see the threats that are playing out today on the trade front?
I think we recognize that there are geopolitical headwinds, and I think that was also stated by Finance Minister in her speech. This geo-economic fragmentation has been going on for some time. And when President Trump, when he was campaigning, he had also indicated what he will do if he comes to power. And I think he has gone along with whatever he said. Now the question is that we recognize that if we have escalation of tariff wars, then certainly there will be an impact on global trade and also on global growth. So this is something which we have anticipated it will happen.
You've anticipated it will happen, but how prepared are we to take measures, appropriate measures, to either retaliate if they were to impose tariffs on India, or to be able to make good of the current trade war escalation between US, Mexico, China and Canada to start with? These of course threatened Europe as well at this point in time. And linked to this, the question on what we have seen as far as the customs duty streamlining is concerned, also the cut in CBUs, both two-wheelers and cars and many other products. Are we trying to dangle a carrot, so to speak, amidst this trade war, sir?
First of all, I think the FM was asked this question yesterday, and she replied, and that's been reported in the papers. We should not really anticipate something which is not really stated. The kind of thing which you say, tariff against India. This has not been stated. I mean, if the US admin or anybody has not really stated, so why should we really be saying so? So that will be premature and not warranted, because these are different grounds on which the tariff is being put in. Maybe grounds on immigration, maybe with China on the old disputes regarding whether China is doing enough to do that and give market access to US. So far as we are concerned, we are a very open economy. If you really look at the US imports into India, most of them are into a very, the tariffs are very low. They're in the range of up to 10%. They are in 2.5 category, they are 0 category, 0%, 5%, 7.5, 10. Incidentally, if you look at our industrial goods, out of 8,400 odd tariff lines, 6,000 tariff lines are already below 100, close to the ASEAN rates. And these are MFN rates which are equally applicable to US as well. So therefore, India is not protectionist and neither intends to be protectionist. And therefore, I would say that this is an apprehension which is probably not warranted. The second point you mentioned about the BCD rate rationalization. Well, if you really, you may please recall July 24 budget, in which Finance Minister had removed 7 rates.
Yes.
And she had stated very clearly, we will do a comprehensive review of tariff rate structure, and we will go line by line, and we will bring it a reformed structure in 6 months. And that is what has been delivered in this budget. What we have done is, we have looked at our tariff schedule, and we have found that on a large number of items, although our tariff schedule is having a number which is much higher, the applied tariffs are much below that. For the information of your viewers,
Yes.
I would like to say that there are 3 things. First, there is a tariff rate, which we call it a BC rate in the tariff schedule. In that schedule, you have different rates. Now that is the maximum rate where we can go, and they are authorized by Parliament.
Right.
And we take it to the budget and put those things in the schedule. But then we have a notification powers on the which we apply the tariff rate, and we can go up to that rate. And that is what we call effective rate. And then of course there is what is called an import duty or effective incidence, where you add on the effective rate, which is an applied rate, you also add the cesses and the surcharge, whatever is applicable, and find out what is the total rate which will be applicable at the time of imports. So when we do that, when we are looking at the BCD rates in the schedule, they are different from applied rates. And when we have done that analysis, we have found that a lot of commodities we have had rates which are, actually applied rate is much, much lower. So what we have done is we have brought the rates and what we call it a tariffization.
Right.
We have brought it down, and 51 such tariff lines have been brought down to rates either 0 or 5 or 7.5 and so on, within that band of 0 to 100. The second thing what we have done is, we had some high rates, and they were just on very, very few items. Like 150 rates was just on one thing, that if you have a lab chemicals and you are using that as to reroute alcohol, which is in the agriculture side,
right,
into sort of misclassified route, then we had a punitive of 150 thing, and then we have brought down to 70. So we have now 25 rate has been removed, BCD rate in the schedule. 30 has been removed, 35 has been removed. We have also removed, 100, 125. All of these things have been removed. And now we have only 170 rate for those which is 40% and above. And the other one, we have brought it down to 20%. So we have now rate at 0, and then we have 2.5, and then we have 5, and then we have 7.5, and then we have 10, and then we have 15, and then we have 20, and a high rate we have only 1, which is 70. We don't have any more 150 rate. We don't have any more 125 rate. We don't have any more rate of 100. We do not have any more the rates of 25, 35. So this is a reform which we have done, which the exercise looking at 8,000 tariff lines.
And
so certainly it is not a reactive situation.
No, it isn't. It isn't, and it was promised in the last budget, and an attempt was made to actually start the streamline process in the last budget, which is carried forward this time around as well. Sir, if I could get a comment from you on where you see the currency today, new record low on account of, again, the trade war that is escalating at this point in time versus the US dollar. The impact and the implications, and how the finance ministry sees the rupee's movement from here on.
Well, I think, as I said there, this is a challenging time. And obviously, when you have a challenging time, when the markets are reacting over what might happen, I think the markets are looking at the risks to global trade and global growth. Obviously, to some extent, they will go for safe haven, like the capital moves pretty quickly between countries now. And so therefore, typically the people will look at safe haven and go to US, and some of the flows will actually move in. That's also happened in our stock markets, where FPIs have really parked themselves back there. and anticipating what might happen. This also happens when the Fed actions are anticipated. Like, if you recall,
Yes.
there were also similar situations post-Ukraine crisis. There was also a global inflationary pressures where Fed Reserve and several central banks, including RBI, hiked the rates. That time also we had these situations where capital was moving back and forth, especially safe havens. So it moves away from emerging markets into safe havens, and therefore, there will be a certain pressure on the currency. But this is something which the Reserve Bank of India, which is responsible for exchange rate management, and our management is rupee is on a free float. Rupee is on free float, so rupee is not really thing, but only we take care of, RBI takes care of macroeconomic stability and exchange rate stability to, stem any unwarranted volatility. But there are certain secular trends which are allowed to operate because that is how the system works.
No, fair enough, sir. I understand that the RBI will do what it needs to do or what it feels is appropriate as far as the currency market is concerned, and it is very clear that the RBI has decided not to intervene in the currency market at this point in time. But, from an import bill perspective, with the rupee now depreciating to almost 87.26, that was the last rate that I saw before I left the studio, the impact on the import bill specifically, sir?
There are a couple of, there are different moving parts into this. Now you have also, oil is one of our important, imports, and it is pretty inelastic. So if you have an elastic imports, they will actually adjust fairly easily. If you have inelastic imports like oil, we must have to import no matter what, at whatever price. Now there also, while, we have an exchange rate issue right now, that means rupee has depreciated. We have also a fairly good, prognosis, for the dollar rate for oil.
Okay.
Because oil is the way the US will produce more oil, and the way indications are that the oil prices will not really move up. So to that extent, at least the dollar price, we don't anticipate very high, upside. The second thing is that, you also have an impact on imports, exports. In exports also, to that extent of imported inputs, obviously the cost rises.
Yeah.
But some of those duties are given back because exports are exempt from duties. So therefore, there is a drawback where if the duty paid are extra duties are paid, and then they are also refunded drawback. Then the ROTTAP and ROSTL, those are the duties which are not linked to the import duties but the other duties. Those schemes also do remain. And exports actually also, into the extent of value added in the country, they gain the competitiveness.
Right.
It is like actually government giving them money in terms of if the exchange rate depreciation does take place. So therefore exports get more competitive. So I think overall we have to really see there are many moving parts into it.
I understand. So let me put it simply, sir, before I bring our guests into the conversation as well as Mr. Chawla, that would the depreciating rupee be one of the top concerns for you today?
I think it's a concern in terms of more in terms of, what's going to happen for the global trade and global growth. In the medium term, in the short term, that's more important. Because that is how, many of our trading takes place.
Yeah.
And India is a fairly open economy, so it's not really a closed economy of yonder years. It's really a very open economy. Imports and exports as a percent of GDP is pretty high.
Right.
So therefore, we are impacted by global developments, and we are watching the situation.
We are watching the situation. Mr. Chawla, let me come to you now, sir. As far as the disinvestment roadmap is concerned, what has been budgeted is 47,000 crore rupees. It's fairly modest. But I think the larger question that people want to know is there a lack of appetite at this point in time to move aggressively on disinvestment, and we've seen this number shrinking over the last few years. Is that because you believe that it's hard to disinvest, or you believe that there is no appetite for disinvestment? If you can lay out the roadmap as far as the disinvestment roadmap is concerned and the thinking behind that number.
Thank you. I would like to first clarify that there is a composite strategy as far as public undertakings, public enterprises is concerned. The whole idea behind bringing the Department of Public Enterprises and DPAM together was essentially to emphasize that corporate strategy and asset management go together, and that we should look at them in a composite way, so that public enterprises play their rightful role in the economy. We, of course, we have clearly said so, that private sector must keep growing and it must occupy a greater share of the economy. But public sector, being publicly owned, has a responsibility. It must become competitive and it must share its wealth with the Aam Aadmi, with the common citizens, with the ordinary investors, who is investing increasingly his hard-earned money and his savings into these assets and deriving returns therefrom. And therefore, our strategy is calibrated. And as part of this value optimization and value creation strategy, we follow four or five different things. And the most important being that with corporate strategy and asset management coming together, we are very careful about corporate performance. We have guiding parameters. We monitor the PSCs very carefully and advise corrective action wherever we think they're going off track. At the same time, as you know, CapEx just does not come from the budget alone. It comes from state governments, it comes from local governments, and it comes
PSUs.
from PSUs.
Yeah.
And if you see, almost 4 lakh crores of capital investment comes from PSUs. And it is one of our jobs to monitor that and ensure it is on track. Thirdly, we have to ensure a consistent flow of dividend so that the wealth in the public sector is shared with everyone and dividends flow consistently to all stakeholders, particularly the minority shareholders. Last but not the least, we focus on the strategy is calibrated asset monetization. For example, if we did not list the LIC, would you know its market value is 6 lakh crores? And therefore, it is important that you move in steps which are careful, which are calibrated to market, which maintain market value, which are careful about investor appetites, and most important, take care of minority stakeholders.
You know, they're all good points, sir, but if I may ask you a direct question before I get the audience in, what is the IPO pipeline that we can realistically expect as far as PSU listings are concerned? You gave us the example of LIC. What are we talking about as far as FY26 is concerned?
I would not prejudge or communicate market-sensitive information, but what is in the pipeline is already known. It is moving along track, and we'll make the right announcements at the right time.
At the right time. So very quickly to the both of you, and this is a question that's come in since you were talking about dividend. Dividend receipts have increased by 12% in FY26. Even if the RBI gives 2 trillion rupees again, it suggests an over 40% growth in non-RBI dividends. How does this math add up? Finance Secretary, would you like to start? And then I'll come to Mr. Chawla.
Well, if you really look at the dividend, as Arunesh mentioned, we are looking at consistent dividend, not maximization of dividend. Because if you maximize the dividend, you basically evacuate the money out, and then it doesn't help. for growth of the company. So there is a consistent dividend policy, and consistently also the targets of dividend are being met, because there is a growth in profitability and there is a growth in overall, in terms of absolute terms also the profitability increases. So if you really see the last few years, the CPSC, the dividends, they are always exceeding the targets. And this year the target is 69,000 crores, which will hopefully be met.
It will be met or bettered?
It will be met because it's a budget target.
Right.
Yes.
Mr. Chawla, you wanted to come in.
I just wanted to reinforce that point, that dividends, the public sector dividends were almost 1.25 lakh crores the previous year. We are seeing a sustained near 15 to 20% growth year on year. You would expect them to pay out dividends of 1,40,000, 1,50,000 crores, and only say half of it will go to the government. The remaining half will be shared with the people of India.
Will be shared with the people of India. The people of India have questions.
The people of India mean the shareholders.
Yeah, we got that, sir. We got that. Shareholders, taxpayers, we've got plenty of, perhaps both sitting here in the audience. Let me come across to you. If you could introduce yourself very briefly and ask your question, sir.
Hi, I'm Sandeep Bhalla. I'm from Dhruva Advisors, and there is one question which I have. Shin spoke about beneficial tax rate for new manufacturing units, and she spoke about how US is incentivizing corporate tax, reducing the corporate tax. Is there a thought process on why this was not extended in the current budget, or is there something which is we should be expecting soon?
So the expectation was that you'd bring back the concessional scheme, perhaps with 15% or 18%. The sun had set on it in 24, but you chose not to do that. Why not?
I think we don't want to create another scheme for that. We already have two. We don't want to create the third. I think that particular scheme of manufacturing companies was for a limited period it is a post-COVID issue when you wanted certain manufacturing to be quickly initiated. And that was initiated for only the companies which were incorporated fresh, which actually came into commercial production between that period. So it was for a particular purpose. Broadly, the corporate tax reform has already taken place in terms of, the reduction in corporate rates. If you see the new regime, the corporate rates have already been reduced. And it was reduced, in 23. And so therefore, the same system continues. Now, when you are, doing that corporate tax, you don't again create another subcategory of new manufacturing and old manufacturing. If you are manufacturing, you should be taxed the same way. Not that, you set up one plant and it will be taxed differently. And if you are in the old plant, that will be taxed separately. A company is taxed. So I think it was not really a very good way of complicating the scheme. We are for simplification. We want actually more and more new regime to come in. However, corporates are there in the old regime still. Some of the reasons are their own deductions which have been available to them, which are much larger. So slowly they are also coming over here. About 20% of the companies and 50% of revenue has already shifted to the new regime. And I hope that, this will be a gradual process. As far as the individuals are concerned, 75% people have also shifted to the new regime already. Yeah. And we hope that with the latest reforms in PIT, personal income tax, almost everyone will shift to the new regime.
Sir, a quick clarification from you. You talked about that concessional tax scheme, and when we saw the corporate tax reduction take place in 2019, the revenue foregone estimate that the government had put forward, what is the actual revenue foregone on the front of the corporate tax reduction that took place? Because there is some clarification required on that front, linked to the fact that you've budgeted 1 lakh crore rupees as the revenue foregone for personal income tax. The question is it likely to be much higher? Is this more conservative of an estimate that the government has put out?
Well, if you look at the receipt budget, we give a full statement of what is the revenue foregone and what for it is. So please refer to the receipt budget and you will know that if you have this deduction on account of that, how much is the revenue foregone. Coming to the PIT question, now 1 lakh crore is what we have said that we will actually not basically charge and then rebate it also, in some cases not charge. So 1 lakh crore is basically goes back to taxpayers.
Yes.
And obviously we have taken into account that while budgeting our revenue numbers.
So linked to that question is also the fact that are you concerned about the tax base erosion and the kind of pressure that this now puts on the even smaller tax base that you're going to have to work with? Yes, it's relief for a large population of the country and everyone is giving you 2 thumbs up for that. But as policymakers, are you concerned about the tax base erosion that this brings about?
We are not concerned because the point is that we have to collect the tax. We can't keep collecting taxes from this thing where we should not be collecting taxes. It is basically a public choice. It's a public choice. It's a political decision. It is a decision based on what income you are going to be taxing. So when you are saying we increase the tax base, number one, returns will have to be filed in any case. It's only up to 0 to 4 lakh category which is having a nil rate. They will be exempt not to file the returns. But anybody who is looking for rebate, the returns will have to be filed because then only TDS need to be refunded back. And we have a very good system where, the refunds can be pretty quick and, it's largely processed. For your information and information of your viewers, 99.7% returns today are self-assessed, both PIT and corporate put together. The onus is today, it is much like the new kind of governance, where most of the time, like earlier, you used to fill up a paper form and used to give on a window. And then the window will actually translate that paper form into its own system and make an entry, right? And most of the time, there will be some mistake in that data entry. And then you will be struggling to correct your name or this or that, because something which, is a process. That has totally undergone a change. Now, we are portal-based. You open a portal, you do that, and in income tax case, since the PAN number is there, the linkage is there, you don't have to even type your name. You simply get into the PAN, you go into your database, and you look at the AIS. And all in your AIS, you see all the transactions which is there. So we are able to, through a network of information, bring that information together for taxpayers. And it is like, producing a ledger for them. And it's such a good facility.
No, but I think the question that people are asking, and these are many questions that have come to me on this issue, is that instead of expanding the tax base, we're actually shrinking the tax base further. Your comments on that, sir?
Well, I would say that, certain number of taxpayers, say when we are saying that between 7 lakh, which was earlier not paying any tax, and between 7 and 12 lakhs, 1 crore more people will not have to pay any tax. So that part is there. But what we assume is that, okay, the incomes are also rising. The more number of people will graduate from which used to be earlier 12 lakhs and below into this category. And more people will be added, will also keep expanding the tax base. It is not good to really say that just because, you want a tax base, that you must tax the existing tax fellow again and again. You must bring newer tax people into the base, rather than trying to overtax the people who are already in.
Fair enough. Go ahead.
Good afternoon, sir. This is Vivek Gupta from Deloitte. First of all, I must commend you for an absolutely exciting budget. The concept of trust first, scrutinized later, I think stands very well with the taxpayers. There's one specific question that I'd like to ask you, though. There's been a lot of clamor around the fact that our tax law has a lot of provisions which call for artificial valuations. So, for example, when you're doing listed company transactions, depending on the date of signing and date of closing, there's some artificial valuation norms that are set out in the rules to the tax law, which actually are causing listed company transactions to become very difficult. We are all hoping that in the new tax bill that we see within a week, some of this will be addressed is the government also looking at reorienting the rules in order to simplify the multiplicity of these valuation norms, particularly when, sir, your own government has a tax law which, for the purpose of transfer pricing, for example, allows a fair value to be determined based on the facts and circumstances of the case. So there's a strong case to be made for these manifold valuation norms to go away from the rules in the Act. So if you have any comments on this in the context of introduction of the new tax bill.
Well, I think this is certainly a good question. I think the more complex things we make, the more difficult it is, the more interpretative it would become. So I think our efforts are really towards that, trying to simplify. Now, some of the elements of, like in the new law, new bill which we are bringing, some of these elements we have upfront addressed in this itself, rather than trying to really say that we'll just put it there and then, because it will take time, you know, to be deliberated and get passed. So like TDS, TCS thing, you know, we did some rationalization earlier. We did so many rationalization in this, budget itself. So that will be a continuous process of exchange. Even, for example, arm's length pricing also, many people have a lot of suggestions on us. That means how soon we do it. What is the time we take to do the ALP? What is the capacity we have to really conclude them quickly? So therefore, just because, you know, we have an ALP process, it doesn't mean, unless and until we make it efficient, unless and until we make it, you know, timely. So which means that we've got to be really doing the capacity building in our department to do the ALP commensurate with the demand.
Right.
And these are the issues, there's the capacity issues we must address. But all the simplification issues, I think, even if in the new bill, you will find that there are certain things which have been carried over. You will have every chance to give your suggestions, and also the standing committee would also be inviting suggestions from the public, and that those will also be examined.
Mr. Pandey, a lot of the tax experts who joined us on budget day say they might be out of a job if what you've promised of halving the tax code actually goes through. So can you give us a sneak peek of what we should expect, or what they should brace themselves for, sir?
Well, I do not know what is the outcome, because what we see will be simple. Whether it will be simple in your eyes or not, I think because it is the beauty lies in the eyes of the beholden, you know. Now the whole thing is, you know, we are making a very sincere attempt. This particular thing, in other sovereigns also, this has been attempted. Some people have taken years. 4 years, 5 years, to change the new law, to rewrite the law. We had some groundwork earlier in some committees, yes, which they did the work. But this work, this piece of the work, bringing it has been done in about 6 months. So obviously, you know, while we will say that we have done a great job, we don't know. I mean, so we have to, the suspense is, the jury will still be out.
Yes, the jury is out, and we'll have to wait for you to actually bring the bill.
But what I can say is that the words will be halved, chapters will be halved, redundant provisions will go. There will be a lot of these things which are clubbing, they will come. Speech will be direct, and probably what you call assessment tier or something may vanish. So what we are saying is like trying to say something very clearly, more directly, and that has been our, guiding principles. To what extent we have been able to actually work out, because it's a big team that works and there's so many people who work, and whether the whole guiding principles have been fully kept, I think we will be open to criticism also. But we are making a very sincere effort for reform.
Sir, I can tell you, I'm standing here in the middle of a room full of many experts, and many are tax experts. I could suddenly hear a sigh go out. I don't know what that indicates, but the minute you said chapters will be halved, words will be halved, I could hear the sighs increase here in the audience. But you had a question, so go ahead.
So my question is, I must compliment the way this exercise has been carried out in this budget, despite the fact the new income tax bill is in the offing. And one of the important changes you have made is that you, in the tax deduction at source, so wherever you're feeling that nitty-gritties and you have tried that TCs has been removed, only TDS will be applicable. So my question is, when we are trying to simplify the tax laws, tax deduction at source provisions have been introduced at many places not to collect taxes but to have an audit trail. And I believe now a lot of audit trail is available under the GST, because all goods and services are covered under the GST, and when you are filing your returns and documents, most of the information is available there. Is there any exercise on that whatever is being captured in the GST will be taken into consideration while drafting these provisions under the income tax, particularly on TDS and TCS, so there is no duplicity and no complexity, that same information is being is available in the government domain in GST, and the same is again being captured in the income tax.
Thank you, sir. Thank you so much. Go ahead, sir.
Well, that is a good question, and I think that is ideally we ought to be doing this. That means basically two different laws should be talking to each other in terms of also import. And I also agree with you, some of them were brought in because, we didn't have the GST, but in the GST that information is already built. I would say that although we have been trying to eliminate all those, but I can't guarantee that, some of it will not really pass on in the draft bill that will be there. But as I said, we will be really open to suggestions, and if we are finding out and the suggestion is that this is not really required here, so we will eliminate that also. Like for example here we have mentioned, there was a very big pain point, in the sale of goods beyond 50 lakhs, you had said TDS is, the law was all right. All what it said was, if TDS is not done, then the TCS will be applied. This iffy business is a very dangerous business because the point is, how the TCS fellow, he is independent, the TDS fellow is different. He says, how do I know he has not done TDS? So then I will be caught and I will be penalized, and there will be so let me also deduct. So therefore, if actually practically didn't work, so both started deducting. Now, our intent was only to track, I said, and we had only one person in mind, either or, but it became both. When it became both, then 1% plus 1%. So much of money will be blocked. We must realize the more money we block of business, the more uncompetitive we are making them to be, because every money has a cost.
That's music to industry's ears, sir. Not so sure about the tax lot, but it's certainly music to industry's ears. But we have more questions for you. Go ahead, sir.
Good evening all. My name is Sudham. I'm from Eastman Auto and Power Limited. We are manufacturers in the solar and the last mile mobility space. So first of all, thank you. Some of the announcements yesterday, or day before rather, were those that impact the industry positively. My question really was about the solar side of the things. Thank you again for the boost that the industry is seeing because of the initiatives the government has taken. The question really is that there is a significant power electronics side of the solar solution story. And there has been some anticipation in that regard from the industry. Has the government been thinking in these terms, particularly from the Make in India perspective, to help the solar manufacturers here in the power electronics side of the story?
I think that's a good question, and I can see sitting right in front METI secretary, who is one of the champions. So you say it and he's there.
Absolutely.
So आपने कोई compact किया हुआ है.
That is the power of that's the power of CNBC-TV18. You ask and we deliver. May I have Mr. Krishnan join us on stage, sir? Ladies and gentlemen, a big round of applause to the METI secretary, Mr. S. Krishnan, who joins us on stage. I don't even have to ask you a question, so the question has already been delivered. So the mic is yours, sir.
No, I think the power electronics bit, as far as METI is concerned, is primarily on the semiconductor side, especially silicon carbide and those set of chips which need to be made. That is covered under the India Semiconductor Mission. And we are pushing to see that we have more capacity in the country to handle that. Likewise, there's a lot of research which we're doing alongside various ministries, including Ministry of Heavy Industry and also new and renewable energy sources, on ways in which power electronics can be applied in this particular space. We have a whole project called NAMPET, which is basically on power electronics, and we believe that this is an area of great growth in the country, and we need to stay focused on that area to make sure that we support power electronics through a variety of schemes in the ministry. Some of these will overlap with what is being done in MNRE and what is being done in MHI, but we will iron out those issues and go forward.
Mr. Krishnan, many thanks for that, sir. But if I may ask you, the big expectation was that there would be a new PLI scheme for components that would find its way in the budget. But we're given to understand that that consultation process is still underway, and perhaps we will have to wait a little bit longer. Can you throw some light on that, sir? And also on the existing PLI scheme, in terms of disbursals, sir, there are some questions on the disbursals being slower than what was anticipated or what was expected. If you could clarify on both.
On the new scheme which relates to electronic components, there's a process that it has to go through in the government system. Just because it doesn't find a specific mention in the budget speech, it doesn't mean that it won't come up during the course of 2025-26. Sooner rather than later, I'm sure that the scheme will be underway. That's one part of it. And I don't think funding will be a problem. I think if you look at the budget numbers between 2023-24 to what it is in 2025-26, the budget has grown more than twice. It's more than 100% jump. So it's a huge jump from about 12,000 odd crores to 26,000 crores. So I think within that budget envelope, we should have no issue in supporting a new scheme also if when it actually comes up. On the disbursement side, the disbursement basically happens based on the claims which are filed by the companies, and on our side we try to process them as quickly as possible. The disbursement is basically in two schemes, one on the two PLI schemes, both PLI on large-scale electronic manufacture, which is basically mobile phones, and on IT hardware. PLI on large-scale electronic manufacture, which is mobile phones, is still the best performing PLI amongst all, and disbursement is continuing quite strongly. PLI on IT hardware, really the disbursements should commence only during 2025-26. That's what we were expecting, because the first full year of production was really 24-25, and only when that production is completed will we have claims coming in and companies claiming incentives under that. And many large companies, or not many, but a couple of significant and large companies are coming into the scheme only with effect from 1st of April 2025. So real claims will accrue only during 25-26.
A quick question on the budget allocation for the India AI mission, Mr. Krishnan. I was just taking a look at that. It's gone up from 173 crores to 2,000 crores. While that's a jump of 1,000%, but when you look at the numbers that are being touted about in the US, target billions, hundreds of billions of dollars, the same story playing out as far as China is concerned. Do you believe that this is going to be enough?
I think we need to understand that when Mayoshi Son talks about $500 billion, he's not talking about government money.
Yeah.
He's talking about private money over a period of time which comes in. And I think same is the case in India. The investment is being made. Government is playing the role of a catalyst here, and the investments are really being made significantly in the private sector. There is some government investment, of course, without doubt, but significant amount of investments are in the private sector. What we are supporting under the India AI mission, really, and the minister had recently made that announcement of about 18,000 GPUs being available for use, and that part, the AI compute element having been launched. So those investments are actually happening. Those are private sector investments where government is basically providing demand support. It's almost like a voucher-based system. It's an ability for us to buy the compute facility, and which is going forward.
Just on a note, as a joke, I would say that we should not finance enough to finance our own
Demise.
Extermination. Human extermination.
So which is why you've been stingy in your budget for the AI mission, sir. It's self-preservation. But that's
Humanity must preserve itself.
Yeah, absolutely. I couldn't agree with you more. Humanity must preserve itself. Shweta, go ahead.
Thank you so much. This question for Finance Secretary. I'm Shweta Rajpal Kohli. I represent the Startup Policy Forum. We're an industry forum that represents about 50 of India's largest startups. So one very long-standing demand of the startup industry has been around ESOP taxation. We all know the big concern, and especially considering the number of new age companies that will IPO, the taxation on ESOP triggers at the time of exercise rather than at the time of liquidity, and that causes a big pain point to many ESOP holders, thousands and thousands of them across the country. So I think that's been a pain point, and we're hoping it will get addressed in the next week when we're going to see some of those tax changes being announced. And also on share swap, similar problems. There is no liquidity, but there is a tax liability. Any thoughts on the government's thinking around it?
Well, I think in general, I think our ESOP taxation is as per the global best practices.
Okay. Sir, another question or more, actually. I think, again, it might be premature, but I'll ask nevertheless. The AGR dues for the telecom sector, a lot of reports suggest that the government is actively considering whether you could provide any further relief there on AGR dues. The matter will have to be, of course, cleared eventually by the Finance Ministry. Has it come to your table yet? Is it on your table? Are you looking at it, sir?
You will come to know when it comes.
So it hasn't come yet?
No, I mean, I think this has been under discussion, because unless and until it is decided, it's not decided. It has to be decided.
It has to be decided, but is it under active consideration today?
No, I think that much for today.
That much for today. Okay, I get my cue. But Mr. Chawla, let me come to you, sir. Because, one of the other aspects of this budget was that it has revived the idea of public-private partnership, something that, 10 years ago, the government had talked about. I still remember very clearly the idea of Triple P India was put forward. Can you explain to us why you felt the need to bring back public-private partnership? How is this going to be operationalized? What do you believe will be the road forward as far as PPP is concerned, sir?
If you noticed, apart from what is being talked about as a value creation strategy in the public sector, the new asset monetization roadmap, 5 years, medium term, has also been announced and mentioned. And that essentially is to re-energize the fixed assets which are there in the government sector and allied government sector and government agencies and authorities and like railways, highways, and so on and so forth. And the idea is that through various models, including public-private partnerships, land lease arrangements, InvITs, REITs, and so on and so forth, we will be able to reactivate this ecosystem. Some good work has happened in the past 5 years that has given us encouragement. We hope to build on it and do better in the next 5 years.
Now, even as far as asset monetization is concerned, a target of 10 lakh crore rupees the government has put out in this budget on asset monetization. Again, for the benefit of everyone who's watching, could you elaborate on what we should now expect in terms of next steps and how fast and swiftly we're expected to move on that front?
Want to take that?
Okay. See, the asset monetization is two kinds. One, is basically asset recycling. You have a certain assets, you part with it, and basically you part with the cash streams and then use those things upfront payment to build up more assets, capex. So there are two kinds of agencies. One is the NHAI or railways, which is the government agencies, where the government money is involved, so the asset belongs to the government. In which case, when you do the asset monetization, certain receipts will come back to you. Just to give you an example, if you have an NHAI and you have a road, you keep on building roads and then you have a certain cash streams which are settled. Then you have a TOT and then you put it out a bid and you say, okay, I write a concession for a certain period, and then you take the thing and you give me upfront payment. This money I will then use to do that, to build up more roads. Now, there is a certain level of asset monetization which is done by the companies themselves, which is the public sector. They are also counted in the asset monetization plan because they are done by the CPSEs. Now there it is, the money actually belongs to that CPSE. It doesn't come back to the government, but it is again the same thing. For example, if the power grid, if they were to have a transmission line where a stable revenues are coming, they were supposed to put that particular asset into an InvIT and let that InvIT be bid out and invite certain unit holders where, pension funds and others will also come and invest. That money the power grid can use to build up more transmission lines without debt. But in those situations, they have to consider their shareholders' interests the way they will like to do the asset monetization. Put together, the asset monetization is basically recycling of your assets in order to build more assets, and several things like NHAI, railways, and the NHAI is the most active in this area, and then you have others also. Arguably, you can do it even in FCI. You can have some land and all. Incidentally, this also includes the public-private partnership, because that is one way of writing concessions, which means inviting the people to invest the private sector money, and you write a concession if you have land or a concession and all that. In case of ports, for example, it is very easy to do that. Like if you have a landlord port like JNPT, they are building up new terminals, etc., with the help of PPPs. They bid out and then they say that one new, without their own investments, since they give you a waterfront, since they give you the access, they are able to bid out and based on a certain revenue share, get that particular thing built. This is also one category of asset monetization.
Okay. On land banks specifically, sir, we're again given to understand that companies like MTNL, etc., that have a large land bank, will those be up for asset monetization, Mr. Krishnan? If you'd like to take that, and you as well, Mr. Pandit.
No, I think that will be taken by Arunesh.
Go ahead, Mr. Jabla.
Thank you. We have set up a land monetization corporation, and it is essentially a service that we provide to all the public undertakings, because it enables a third-party independent valuation of assets and what is realistically expected, and that itself, is a big step forward. We are going to help MTNL and BSNL in monetizing whatever assets they have, so that the value that is locked in can be redeployed, the liability is cleared, and we can re-energize the sector.
And do you expect that to go through within this in the next financial year, FY26?
Touch wood.
Touch wood. Okay, that's an important headline coming in there. Go ahead, sir.
Thank you. My question is for the Finance Secretary.
Could you introduce yourself?
Yeah, my name is Rohinton Sidhwa. I'm from Deloitte. Sir, we've had this ups and downs on the global consensus with regard to the two-pillar solution for taxing MNCs around the world. And last year we withdrew the equalization levy on the presumption that there would be some consensus coming on Pillar 1. Pillar 1 doesn't seem to be headed anywhere. Similarly on Pillar 2, where unless we actually enact the law, we will not be able to collect any information for all the MNEs who operate in India. So any guidance on this? Why is there so much silence from the government with this particular part of it?
There is no silence. Nobody asks us.
Now you're being asked, sir.
No, see the BEPS 1 and BEPS 2. The BEPS 1 was widely, sort of accepted. BEPS 2, the Pillar 1, Pillar 2, there was a statement that, but India had some reservations on a few points. While we broadly agreed with certain principles, there was something on, the amount of compensation and how that compensation will get worked out. Now, given that, now I think the events have really overtaken. Now, the jurisdictions which have actually done the amendments of their laws, they may have to think whether it will be worth doing it. Because the US has said that we are not into it now.
Yeah.
So, I mean, all our big tech companies and others, where we had these issues where, you know, the profits, where were the profits going? Now, if US does not agree to it, then how do we really operate it?
Yeah.
So I think we are watching, but my sense is that unless and until this multilateral framework also includes, earlier US was in, but now they have said that they are withdrawing.
Right.
So therefore we have to wait and watch and see how it will be actually implementable. We have not actually taken up any taxation measures along those lines, but some other countries have.
Right.
And they will have to, in fact, review is whether it will be worth doing it.
Well, fair point. Mr. Krishnan, we've got plenty of questions here, but let me bung in a question here as far as the US itself is concerned and the escalation of the trade war, and specifically as far as the IT and electronic sector is concerned. Sir, how do you see this? Do you see this as a possible advantage for India? Do you see this as opening up further space for India? Or are you worried about the kind of volatility that this opens up as far as global trade is concerned? How do you look at it from your sector's perspective?
I think it's right now a wait and watch perspective. I mean, on the one hand, straight away you could say that it might be advantageous to us because tariffs may come down more heavily on other trade rivals, so there could be that issue. But if you look at it from another perspective, you could have a scenario where if the sourcing is from the same country, then will you have a problem in further exports? So we are not yet clear as to how this will play out, and we need to be prepared for all scenarios. I think there is reason for hope, and I think there is reason to assume that electronics as an export from India, which has suddenly become very big in especially what we send out to the US, we need to sort of ensure that we build the domestic value chain more significantly and increase domestic value add so that we protect ourselves against any possible pushback on the value addition point of what happens in India. That's the way we insulate ourselves in the electronic sector.
Hi, I'm Vineet Agarwal from Transport Corporation of India Limited. I want to go back to that asset recycling, asset monetization plan. In the last 6 years, the cost of tolls on highways has gone up on a journey cost from 5 to 7% to 15 to 20% of a journey cost. Now, my suggestion here is that let's not look at blindly recycling every single road asset that we have, because it is going to lead to some cost increases. On the one hand, we're talking about reducing logistics costs in the country. I can guarantee you this is actually increasing logistics costs in the country as we speak. So please look at it in a little bit more holistic manner. I know the new roads will get tolled, but let's not keep recycling all the old roads with toll one after the other. Thank you.
No, but the tolls are really not, they can't really have, it's not a free pass, you know, for increasing toll rates. Irrespective, the toll rates remain the same. No, number of tolls is also cannot be increased. The policy on tolls is very clear. Between one toll to another, there has to be a minimum distance. Whether this remains with the NHAI or whether it goes away out, to some other player, it doesn't make a difference. So what you are essentially suggesting is that NHAI itself should relax the policy, where it should, you know, charge less tolls and also maybe increase the length of the roads on which. But this is some point which we have to really see that, you know, when you have to maintain infrastructure of a very high order, I believe that if you don't do that, then you will end up in getting, you know, the poorer infrastructure and poor maintenance. That is also will not really be there. We have to take a very measured call on that.
Mr. Chandler?
Yes, I would supplement that. It's like the trade-off between a partial equilibrium effect and a general equilibrium effect. There was a time when in the PPP models we just had a simple BOT and annuities, but now we have a repertoire of different frameworks that have stabilized in the highway sector. And as very rightly you said, the TOT models, the toll operate and transfer models, have really taken off, and they're helping us, maintain our highways in good shape, and helping us redeploy both budgetary and extra budgetary resources into more areas, creating a greater network, which is a huge positive externality. So I would say in the long run, and if you see everything together in the economy, the logistics costs will come down.
Yes. Sir, this is Sukhjit Pasricha. I represent people side in the aviation sector. I work as HR head for Indigo. So my question to you, sir, is I'm very happy to see, in the budget that government has identified the development of 50 destinations for tourism. Please throw some light on larger vision to develop people and customer-centric skills that these goals are met.
Well, I think this is a very important part, of Honorable Prime Minister's vision, trying to, look at tourism in a different way and also involve states. In fact, there is some indication in the budget speech which Honorable Finance Minister delivered, is that, we have to involve states into doing several things, because ultimately tourism places are grounded there. Of course, there are many other network issues. One is the network itself, the airline industry. The second is the hotel industry, and it's also been announced that for the purpose of those destinations, there will be also, the hotel industries will be, in specific destinations, hotel industries will get infrastructure status in respect of those places. So that will also help them finance. It's been one of the very important and long-standing demand of hotel industry to be treated as infrastructure, just in case they can be facilitated for financing. So this is one focused approach that, how do we develop this thing. And then, of course, the states have to come in partnership. Then there will be also the central partnership so far as the monuments are concerned, because there is a lot of things which are dealt with the monuments in and around area. I think we have to really develop new sites, new things where, tourism can also flow in. And attendantly, we will have all those growth engines. These destinations will have the growth engines. But the details will be, released by the Ministry of Tourism in due course.
You wanted to come in, sir?
Yeah, with my experience in culture, I would just like to respond to that. The idea is to go by what is called the tourist footfalls. The tourists, the sites, the monuments, as well as the cultural economy that exists around it. This needs to be brought together, and in a way that all kinds of cultural products, cultural goods, and the creative economy that is linked to it gets linked to the tourist and their footfalls and their visits and their circuits. So that is the idea. The 50 destinations would be selected on that basis. An integrated whole of the government approach would be adopted, so that all agencies concerned, including clearances from the regulatory and protective agencies that I'm talking about, that comes together. And as Finance Secretary said, the tourist hotels and the facilities will be given the status of infrastructure so that we can realize the potential of our cultural creative economy.
Sir, I had one question. This is Mehul Beda here from Dhruva Advisors. Sir, there was this change in the mergers and acquisitions part where earlier when there was a merger of an industrial undertaking, there was a fresh lease of life given for 8 years, and which has now been changed to say that only it will be applicable for the original year. Sir, we always thought that the thought process was that these provisions where losses can be carried forward or again for 8 years was more as a measure for revival of the loss-making companies. but now the government seems to have rethought on this. Anything on that, sir? That was one. And secondly, sir, there was a mention by the finance minister in a speech that mergers will be fast-tracked, and maybe the thinking here was that NCLT has quite a bit of bottlenecks, and there was something where the fast-track merger scope will be increased. So, sir, any details on that? Thank you.
I think you're referring to 72A. See, the point is that the intent has been, that you carry forward. So you merge, the two people are coming together. Then also you can demerge. Again, in the reverse process will happen when new cases of demerge. So, I mean, it can't be really taken up very opportunistically. I mean, you're trying to bring, merger is your decision of bringing together and all that. Carry forward of losses, whatever the original intent is, that you carry forward for a certain number of years, that intent will be carried forward. So if there is some ambiguity in the law where some players think that actually they can get, start from the scratch and take another 8 years, that was never the intent. So the intent has been made clear, but it has been prospectively, not retrospectively. So if suppose that provision, we have been very careful in trying to do that, so that actually we should not be accused of really, like if it was subject to misinterpretation, then at least clarify going forward that from henceforward you will have that sort of thing. Yeah.
That's right. But I know, Mr. Krishnan, we have to let each one of you go, but let me start by getting closing comments from you. To start with, sir, we understand that Sam Altman is going to be paying you a visit sometime tomorrow or this week. What is that about, sir? What do you hope to discuss with him?
I don't think he's paying me a visit. He is expected to visit New Delhi, and he's expected to meet hopefully the Prime Minister or the Minister for Electronics. We presume it is to discuss on, what OpenAI can do for India and the kind of applications of OpenAI in the country, and how well India is equipped and what we can do to benefit from this. This we expect would be the areas of discussion, and this is what we would do.
Is there room for a potential partnership? The Minister has talked about a foundational model in the next 10 months. Is there room for a potential partnership or any kind of exploratory conversation with OpenAI on India and OpenAI working together?
See, I won't rule out any of that, but then the whole point is that OpenAI's model is not an open model.
Yes.
Right? So the ChatGPT is not an open model, so if at all we are going to build on models, it has to be on other open source models which we pick up and work towards. Already, as you are aware, we have put out the request for proposals for building India's own foundational models. We are expecting a number of responses, and many of those, and interestingly, I think what DeepSeek has shown us is that you can actually take a hybrid approach to this, that you can use an existing open source model, build certain parts of it, and then add other elements to make it even more effective. Of course, experts do give us certain cautions, because you really don't know what kind of data the original model has been trained on. So probably you'll have to do some more additional training to make sure that all the biases and prejudices which you fear the original model had are at least to some extent removed. But definitely the opportunity of building on something which has already been built helps us go a little further, and I think that is not something we are ruling out at all.
Not ruling that out at all. I mean, countries like Italy at this point in time have moved forward with a ban, but you're saying that India is not just open to working on DeepSeek, but it is open to hosting DeepSeek on its own servers.
See, our understanding on this is fairly clear. If you use DeepSeek as an app or as their portal, then the likelihood of your data actually going to where their portal, where their servers are is very, very possible. But it is again an open model, so you could actually pick it up and host it on a server here in India, and if it gets hosted on a server here in India, then the data doesn't go away to other places. Of course, there are risks in terms of, again, you don't know the precise data on which the model was originally trained on. There could be certain issues there, but at least you know that your your data is safe and it's not going out of the country. So that is an option which we can explore. There's no reason why it can't be explored.
No reason why it can't be explored. So many questions coming in. Once again, Mr. Pandey, I'll come to you on that. On the tax math, sir, and how confident do you feel about the fact that you're going to be able to get this 14% growth on income tax with the cut as far as personal income tax is concerned, and even on things like the securities transaction tax, now that the curbs have come in on the F&O side, a 40% increase, are you being optimistic on that front, sir?
I think if you really look at last three years, we have been growing at 20% on PIT side, which of course includes the STT. But one thing I would also like to tell, in the present data situation, we have actually the firms and BOPs, body of individuals and body of persons included in the data of PIT data. And going forward, I think we will like to really bring an accounting information separately for firms, because the firms are really taxed differently, and they are more akin to, to be put along with the corporates. And this information is currently not available because of the accounting thing we have. And going forward from 1st of April, we can bring a system where going forward this information on firms separately would be available, which will be then bifurcated from the individual's data. That will be a very good point, because right now, a lot of, things which we are ascribing to individuals are actually also relates to firms. But be that as it may, we have this 20% growth, and therefore, but we have assumed 14% going forward, so we have moderated it. And if you look at from the buoyancy side as well, the buoyancy used to be 2 plus, 2.5, 2, and we have assumed a buoyancy of 1.4 in this budget for the PIT. So therefore, we have taken on board that we are giving away this money. In fact, as I said, taxpayers are partners. We are partnering because we want this money to come back to us. Either you save, or you invest, or you consume. Either way, we are happy.
Either way, you're happy.
The decision making is transferred on this money from the government to the taxpayers.
To the taxpayers. Sir, a quick follow-up question. Again, this is a question that's just come in. The 8th pay commission, sir, that has also been set up. Any provisions on that account? Any thinking on the provisions that you will need to make on that account?
Well, that will be from 1st of April 2026. But normally, the report will come sometimes later. So I think the impact of, pay commission will be in the next financial year.
Next financial year. So another quick question, and then I will take final comments from you.
Good evening. I am Abhishek Rastogi. I am tax and constitutional expert and founder of Rastogi Chambers. So my question is this, that when we go to the courts and we settle the issue in the Supreme Court, then in the budget we get to know that there are retrospective amendments. So these retrospective amendments must happen in the rarest of rare cases. I think the endeavor of the government has always been to reduce litigation. If first round of litigation has happened and concluded, then sir, what is the need of such retrospective amendments when Supreme Court has already concluded on certain issues, Lord? So this was my first question. My second question is that most of the times in the budget is completely focusing only on the middle class. What about the rich? The wealth drain may happen, and there are surcharges which are imposed for incomes above 50 lakhs, 1 crore, 2 lakhs, and so on and so forth. We have seen with our experience that a lot of these people who are earning in high income group category are actually not motivated. They say that, 40%, approximately 39.37 or 42%, if the surcharge is at 37, would be taxed. So effectively, when they end up paying advance tax, more than a month's income, 40 days, 50 days income is going for a quarter in the advance tax payment. So sir, at some stage, and at any stage, they are in any case paying tax on a higher base, because for them the base is high. So sir, I think the surcharge must be looked into. I mean, I don't know, what are your views about it?
That sounds like an impassioned plea, Mr. Pandey.
I think when a tax advisor, a professional tax advisor of many years, is discussing with the Revenue Secretary who joined on 9th of this month, and he is asking me a very, very intricate tax question, God must have felt, okay, with this poor fellow, how will he reply? So he sent two Devdoots, Ravi Agarwal and Sanjay, both of them have come, Chairman CBDT and Chairman CBIC, so that, more proper explanation can be given. So that's what, I will just attempt as a very humble journalist, bureaucrat, civil servant. I would say, the rarest of rare. Some cases are rarest of the rare. The case you are mentioning is, it has never been the intent. First, this is not an autonomous decision of the central government. This has been passed by GST Council, and the GST Council has, you're referring to that decision only, no? So GST Council has already done it, deliberated. So this, we are now carrying out only an amendment because the GST Council has cleared it. All the states will have to do it. But what is the rationale for this? You have plant machinery, mentioned at n number of places. Intent of legislature was very clear. And some with quirk of typo, somewhere at one place or became and. And now, you have the tax advisors, they have a gala time. Oh, you can save, the ITC will be admissible to you when ITC is not denied, And so therefore you carry on, and this is technical matter. See, intent was not there. If intent were there, many people would have taken it. How many people have taken it? Tell me, how many people would have taken it?
We'll have to take this offline.
So it's a class action thing then.
Well, let me just say.
So I would say that I think that particular error has been corrected. GST Council has taken it, and this government does not believe in retrospective amendments. We have made it very clear. The very first question on 72A I answered. Yeah. We were very careful that we should not get into any situation where the people who have availed it because we also found that the law was actually ambiguous there. But in this case, the ambiguity was not there actually. The ambiguity was just at one place, this RM. But in many places, this is not there. Of course, much more details will be explained to you by Sanjay, who has appeared at the right time.
Clearly, the CBIC...
And on surcharges, I would say, we have not increased any surcharge in this budget.
Yeah. So let me end by asking each one of you, and I'll start with you, Mr. Krishnan, the headline that you will leave us with at the end of Budget 2025 and the impact that you hope it will have on the economy.
I think the key thing in the budget is there's an emphasis on promoting manufacturing, and electronics ends up being one of the largest manufacturing sectors as part of the overall manufacturing sector. And what has been done in terms of easing up the manufacturing process, particularly on the taxation side, has been tremendous work. Both the chairman of CBIC and CBDT are present here. So, the Department of Revenue, and both of them have been extremely accommodating on the series of issues and demands that we have come up with on the manufacturing side for the electronics sector. And I think that gets a bit lost in the fine print. But the industry, I know for a fact, is fairly happy and very elated. And I'm sure that now the ball is really in the industry's court to actually lift the manufacturing game in the electronics sector in India in 25-26.
Well, the baton moves now to industry to do more. Mr. Chawla, the headline for you, sir?
I would repeat what Finance Minister said yesterday. It's a budget by the people, for the people. The government has heard the voice of the people. It has responded to that. It's a budget which provides a balanced support to growth with sensitivity and inclusion.
with sensitivity and inclusion. Mr. Pandey, I'm going to give you the final word, and I have to say, sir, you're on fire today. I haven't seen you respond as you have in many, many years that we've had you here on CNBC-TV18. It's been an absolute joy to watch you, sir. So the headline that you're going to leave us with.
Well, this budget supports growth with fiscal consolidation, with kindness towards taxpayers.
With kindness towards taxpayers. Thank you very much for your generosity, gentlemen. Appreciate you joining us here on the CNBC-TV18 Budget Verdict. Ladies and gentlemen, a big round of applause for the secretaries for joining us here and taking our questions. Appreciate your time. Don't go anywhere. We'll be back with the Economic Affairs Secretary, Mr. Ajay Seth, the chairman of the CBIC and the chairman of the CBDT, both here with us, and the DFS Secretary, Mr. Nagaraju, join us on the Budget Verdict. We'll take a quick break and be right back with you. Keep those questions coming in. We're live and back in a minute.
Insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
I think FI selling is not beyond a point a big negative. It is that whether India is doing well or not. And then there is some correction of excesses and stuff like that, which clearly seems to have been done. One reason has to be India related, that Indian results came out very bad.
We are hitting the limits on what the government can directly do in terms of capex, and therefore the guidance from the government was that we will maintain capex as a percentage of GDP here onwards, that the scope for us to do more is now gone. So now they're experimenting with, for example, this 1 lakh crore that they've decided to spend on urban infrastructure. They have to find such avenues so that capex continues, but there is very little more they can do at the central level. Investment activity in the country is going to be a lot more dependent on how well the real estate cycle turns, how well the power generation cycle turns. And I think this almost obsession with waiting for the government to spend an extra 30,000-40,000 crores, in the larger scheme of things, these are all rounding errors.
I think FI selling is not beyond a point a big negative. It is that whether India is doing well or not. And then there is some correction of excesses and stuff like that, which clearly seems to have been done. One reason has to be India related, that Indian results came out very bad. I think it is one of the best budgets that we've seen in many, many years. And I tweeted that's a dream budget. So first thing is that you normally want money with the public rather than with government. It should just be the general thumb rule of looking at anything, that money with public is better than money with the government. You have
Welcome back to the CNBC-TV18 Budget Verdict 2025. And for our next powerful discussion in the next panel, please welcome on stage, and we have some of them on stage already, Mr. M. Nagaraju, Secretary, Department of Financial Services. Ladies and gentlemen, big round of applause, please. Mr. Ajay Seth, Secretary, Department of Economic Affairs. Mr. Ravi Agarwal, Chairperson, Central Board of Direct Taxes, and Sanjay Kumar Agarwal, Chairperson, Central Board of Indirect Taxes. Over to you, Shireen, for this panel.
Gentlemen, a big round of applause for the secretaries from North Block who join us here. And they've been very kind. It's been a very busy month for them, not just a busy week, a very busy month for them. So we appreciate you taking time out here to join us and answer questions that are coming in live on our YouTube page, on our social media handles, and of course here from our live audience. Economic Affairs Secretary, if I may start by asking you, sir, as we've been talking about it, this budget has really tried to address the 3 C's: consumption, capex, and consolidation, and it's done well on each of those fronts. It seems to have prioritized consumption at this point in time with the personal income tax cuts. If I could ask you about the concern perhaps that there has emanated on capex, and the question coming in, the capex to GDP has come down from 3.4% of GDP in the BE of FY25 to 3.1% of GDP in BE of FY26. Is this an admission of the execution limits of the government or the limits to the absorptive capacity of the economy? And I'll link this back to the point that was made by the former Finance Secretary here on the budget verdict last year, when he also said that there has to be a limit to how much you can expect the government to do as far as capex is concerned, and perhaps at this 10-11 lakh crore rupees is the peak that the government can do on capex. So if you can explain the rationale, the thinking, and the roadmap from here on.
Thanks for this question. I'll draw your attention to July budget, wherein Finance Minister said that we have brought the capex, public expenditure on capex, to a very high level, and moving forward, our endeavor would be to maintain it relative to GDP at that high level, and expect a similar amount to come from the state governments and thereafter private sector to chip in. Where we are in that one, till about 5 years back, we were 1.5% of the GDP. That used to be the capex from union budget. Today it is 3% plus. But if we add what the grants Government of India provides to states for providing for their capital expenditure, prime example, if you can say Jal Jeevan Mission, there's a huge amount of provision getting made there. The total provision is 15.5 lakh crore, which is 4.3% of the GDP. And please look at the number. Total fiscal deficit is 4.4%. Yeah. That means almost the entire borrowing of Government of India is going for capital expenditure. Since mid-70s, we never had a revenue surplus. So these are the limits of capital expenditure, what the government can do, union government can do. But even with reference to the revised estimates of this year, the increase, the total provision next year, 15.5%, is about 18% higher on an economy which will be growing at about 10% plus. So these are the limits, and by sure, it is not a reflection of implementation capacity, but the newer sectors have to be brought in. Newer sectors meaning urban infrastructure is a big sector, and this budget provides for additional 10,000 crore for them. Plus social sectors have to be brought in, plus public-private partnership where the push has to be given through the renewed effort on that part. Thank you.
On each of those issues, sir, and if I could, address something that you just spoke about, the Jal Jeevan Mission, for instance. The question is, grants for capex to states include schemes, as you pointed out. It includes the NREGS, it includes the Jal Jeevan Mission, the PMAY, etc. A lot of it, which analysts believe is not technically capex. Why would you then include this to look at like the capex budget, is the question, sir.
See, there can be an issues around whether an asset, rural asset getting created out of employment generation scheme, whether that is a typical infrastructure or not, there can be a different opinion. But rural water supply will run into as large as 5 crore, 10 crore, 20 crore, even a 50 crore scheme. These are very much capital assets. So the only thing is, these are not the capital assets which will be on the balance sheet of Government of India.
Okay.
So even if we leave around that part, just come to that what the numbers are. Government of India is spending 3% plus of GDP, plus CPSUs is spending almost another 4.5 lakh crore, which will about 1.5% of GDP, is a substantial amount. The government system, union and central PSUs is spending close to about 19.5 lakh crores, which is 6% plus of GDP. So this is a significant number.
So there is no deviation on part of the government strategy to address growth via capex. That policy objective, that policy intent is steadfast.
That is correct. And there where the balancing were to come in, that on one side consolidation is happening, as you said, a fine balance between consolidation, consumption and capex. That is a fine balance this budget tries to do.
On consumption, sir, and I think, there is unequivocal and unambiguous appreciation for what the government has tried to do to try and stimulate consumption and stimulate demand. But the question is, when do you expect this to kick off? When do you believe we will start to see the real impact of the measures taken by the budget to kick off and provide that consumption boost?
Other measures in the budget, whether it is on a capex or on reforms or several schemes, will always have a lag. But as far as consumption, the big tax relief, which is 0.3% of the GDP, 1 lakh crore, individuals get to know that from 1st April onwards, that is an extra money in their pocket. They may use it for saving, they can use it buy durables, they can buy it for another EMI, for a larger house, etc. So the impact starts immediately, the very start of the financial year, because that money is extra money is available for them to use it in a manner, or even taking the family out for a tourist site, and hopefully within India.
Hopefully within India, and those 50 tourist destinations that you're hoping to put in places to attract more tourism. But I come back and I asked you this question on budget day, sir, and I come back again to the estimates that you believe you're working with. Krishna, the former CA, said that he expects more than 2% addition to the GDP on account of the measures undertaken on the consumption side. Would you hazard a guess on that? I mean, is that something that is that a number that you're working with?
I have not attempted doing a modeling. This will be based on certain assumptions would be there.
Yes.
But I see that in terms of giving a boost to the economy, this is the fastest means available. And it helps the middle class having an extra income, they take their own decision in whichever manner. Even if somebody were to do the savings, it will remain with the bank or in the financial market, which will go on to the productive activities later on. So I see it as a very, very positive for the economy. Where the numbers are coming, normally we see it over a period of time. Any capital investment has a multiplier effect of 3, 4 or even 5, it can come in. What impact it will have, we will see that certainly in a high level of consumption. To that extent, the plant and machinery of the private sector get utilized much faster. Or if it goes for the tourism, then hotel occupancy goes up. And to that extent, those owners of those plant and machinery get enthused to invest in the next round of capital investment into the economy.
Well, that certainly is the hope. Mr. Nagaraju, let me come to you, sir, and address the issue as far as MSMEs go, because that was something that the government and the finance minister spoke about in the speech. You know, there was a question here specifically from one of our audience members on why the interest subvention for MSMEs, which was for a period of 5 years, has now been done away with. You know, they believe that it ought to continue. Your take on that, as well as some of the other measures that were announced by the budget, the enhancement of the credit guarantee for SMEs, etc. Do you believe that this will provide the much needed support, the much needed stimulus and shouldering for the MSMEs, sir?
Yeah, see, the MSME sector is one of the highest priorities for the government of India due to several reasons. One is, of course, employment generation, and the other is its contribution to the GDP and also to the exports markets. Now, this is where the highest potential exists in the country for creating additional employment. Now, if you look at the budget proposals that are proposed, there are several schemes to promote, incentivize, as well as give comfort for lending more to MSME sector. Now, the other scheme, apart from the MSME, there are several schemes for the MSME sector in this budget. The other thing we have revamped is the Stand Up India. Earlier it used to be Stand Up India to promote first generation entrepreneurs among the women, SC, ST. That limit has now been extended, and we'll be looking at a large number of entrepreneurs, first generation entrepreneurs, which will be again micro or small enterprises in the MSME sector only. So the government intention is very clear that whatever is the central credit guarantee schemes are there, they are going to lend to the MSME sector. And then the second one, which is of course the partial credit enhancement facility that we have proposed, and the NAFID, of course that is for the corporate sector. If they are going to issue the bonds, the credit rating will ensure that their credit rating is enhanced.
Okay, so the credit rating will be enhanced. Those are the measures for the MSMEs. But on the insurance FDI, sir, is there an expectation or an estimate of what that could mean potentially in terms of FDI inflow into the country? Are you aware of how many may be interested at this point in time? There are all kinds of numbers doing the rounds.
While I can't hazard the guess, let me give you the number. From 2000 to 2024, the total FDI flow into insurance sector is 82,000 crores. Now, 24 years, only 82,000. Whereas the country of our size, dimension, and challenges and potential, I think we should have actually attracted huge amounts of insurance FDI. Now, there are issues related to that. Those issues are being now addressed in the budget proposals of the finance minister. One is, of course, FDI enhancement. Technically, a owner can own more than 51%, and then he's a owner. It could be 51 or 70, 60, anything. Ownership-wise, there is no issue at all. But we want to give comfort that a foreign investor, if he bring in the FDI, he can hold up to 100%. That is a comfort we are giving. The second issue, which is interconnected, is the rules. Rules have some restrictive provisions which we follow. That rules we are going to review and simplify, ensure that the investor, the FDI owners have full flexibility in appointing the senior management personnel and also for repatriation of dividends if required. And of course, anyway, we have already mentioned in the budget speech and the condition that entire premium has to be invested within the country.
Yes.
That remains.
So we expect, there is a lot of enthusiasm during our consultations with the stakeholders. We see huge potential for FDI inflows.
How many companies, sir?
Many companies met, many companies have said, and we have to see ultimately when the bill is approved, notified, then ultimately the taste lies in the pudding, okay? But we have to see ultimately how many will come, how much it will come.
The pudding is being cooked, so to speak, at this
Yeah.
point in time. But Mr. Seth, since we're talking about FDI, if I could ask you about the FDI harmonization, sir, and where we actually stand on that front, and what realistically we should expect now in terms of timelines.
Last budget, February budget, the interim budget, Finance Minister announced that we will be signing more FDIs, more BITs, and for the two countries, UAE and Uzbekistan, those were signed. And the current model BIT template of 2014 had a legacy issue. We were suddenly seeing a spurt of litigations which we never thought BITs will be interpreted in a manner to get us over there. That's why a model BIT was brought in, and earlier BITs and BIPA were terminated. But the last 10 years we are seeing that a consistency of the policy, unidirectional, improving upon the policy, that gives us a lot of confidence that we can provide a better set of protection for foreign investors. So really the attempt is, and our conversation with those two countries as well as other jurisdictions, is what the investors are really looking for. So between the state interest and the investor interest, that's the one area to move forward. I will not like to judge into or say that what areas can be, but if you can cite just one example, model BIT says an entity-based protection, meaning one has to have an entity in India, registered in India to do so. Whereas investors are expecting an asset-based. Those who are coming through an FPI route should also be eligible for investor protection. That's one area we are actively looking for to get into, and there are several others.
Several others. Gokul, you wanted to make a point?
Thank you, sir. It's good. My name is Gokul from Deloitte. Glad to hear that the BITs are back on the negotiation table because investors have been asking for it. There was some amount of debate on whether tax as a subject will be included in the BITs or not. Is there been any sort of thinking on that topic?
When the Finance Minister said we'll make it more investor friendly and we will have a deep review. At this point of time, to get to say that what is on the drawing board would be rather premature. So allow the government to complete that exercise, but idea is complete it over next couple of months, maybe in about 2 quarters, and then come out with a model or model BIT which is suited for 2025 requirement. At the same time, there's a realization that the world has changed. There are so much of global uncertainty. We have to shift our game itself to attract more FDI.
Yes, we do have to bring in more FDI into the country, and I think that was articulated by the Finance Minister as well. But CBDT Chief, if I could come to you on the direct tax code, which the Finance Minister has promised will be presented in Parliament in a week's time, sir. And I think, the FS gave us an indication that it's going to be half the number of words, half the number of chapters, and hopefully half the pain that the industry has dealt with as well. So if you can take us through, in the last 6 months to be able to put this together, what it's actually taken the department to do, what has been the focus area, what you've prioritized, and what we should expect.
Well, yes, we did this comprehensive exercise of comprehensive review of the Tax Act as per the announcement which was made by the Honorable Finance Minister in July 24. And yes, it was a very involved exercise where we actually involved more than 150 officers of the department who worked on different themes and different chapters. The basic idea was to make the language simpler, to cut redundancies which had crept in over a period of time. This act is 1961 Act. We are in 2025, so more about 64 years. So some provisions had become obsolete also. So we identified those provisions, identified the gaps that had also crept in, redundancies and duplications were taken out. And as a result of this entire exercise in this 6 months, the act has been now, the proposed act would be about half. I would not say exactly half, but it will be about half. It will be about half because we have to take care of different situations, you see. The shift in approach is that, well, we have taken some provisions which were elaborated in the Base Act to the rules also. And also we took inspiration from the similar exercise which was done in other sovereigns. For example, UK, Australia, simplification exercise was done in those sovereigns also. They took substantial time, but we got some lessons from that exercise that was done. And going ahead, the approach is that how can we provide more clarity to the taxpayer, because that is very important to minimize litigation and to minimize that scope for multiple interpretations. Of course, when the language gets changed, the possibility of fresh set of interpretations also happens.
Yes.
But what we are actually looking at is coming up with the guidance notes also, and comprehensive answers to possible questions that may emerge, and for the taxpayers' benefit, so that that clarity is there, that when this existing language and the new language, how much of it is in sync and is in harmony.
How much is in sync and in harmony, and I would imagine that the iffy portions are being done away with at this point in time, as the FS told us. But we have a question here for the CBIC chairman as well. Anita, go ahead.
Thank you. So my name is Anita, I'm from PwC, and I have a question regarding tax certainty itself. Thank you so much for a lot of budget announcements which were really helping in this line, but I do have 3 suggestions, sir. The first is regarding customs. So, can we have something like an advanced customs valuation agreement similar to the transfer pricing where we have the APAs, so that the valuation of the goods which are imported in India, there is a certainty with the importers with regard to that, especially from the related party transaction perspective. So that's point number 1. And we do know that it happens in certain other countries, especially in South Korea. It has already happened, and it is working very well. So the second one is regarding GST. Now, I do know that GST is central and state, but my question, sir, is that we used to have a sectoral committee, around 18 of them, which were actually focused on the various nuances of the GST implications on the various types of transactions in that particular sector. And there were FAQs, questions, there were discussions with the industry, and thereafter they came up with that particular FAQ, etc. So can we revive that? Because I do believe that there are a lot of areas where those type of clarity is required, because GST is not same for everybody across the sector. And so the third one is that from a tax certainty perspective, again in customs, we have the Advanced Ruling Authority. We do have 2 benches, one in Delhi and Mumbai. But I do believe that India is such a large country, and I think we should be having at least a couple of more, whether in south or east, if those can be added, sir.
I don't even need AI to take my job. Anita's taken my job away from me. Thank you very, very much, Anita, for a very comprehensive set of questions. Mr. Agarwal, go ahead, sir.
You have mentioned about advanced ruling, and advanced ruling is operating from 2 centers, from Delhi and Mumbai. The number of applications which are received by the advanced rulings, we are finding that those are disposed of within very reasonable time. So there is no build-up of pendencies. But as you have mentioned that it can be created at other places, but now we are in the era where things are done online. Applications, because physical presence is not required. So documents are submitted online. Documents, and in case any kind of hearing is required, that it can also be provided online. In fact, we are emphasizing of conducting all sorts of hearing by adjudicating authorities online. We recently issued a circular in that regard also. So then I don't see any reason that we should create the authorities at different cities. So that is first thing. Second thing is that advanced ruling generally don't go into this related party transactions, because that is meant only mostly related to classification related matters. As far as related party transactions are concerned, we do admit that there is sometimes delay in finalizing the such kind of investigations which are carried out by the department. But now, as you notice, that in this budget we have brought a provision on of setting a time limit for finalization of provisional assessment. In fact, that will be a big relief and will provide certainty within a reasonable time of 2 years. The cases will be finalized, many will be in much shorter time, but the things which were dragging for years, that will not be the situation in times to come. That is one thing. The second thing which I would like to mention about, you mentioned about GST. In GST, the GOM, which has been set up to look into the rate-related issues, they are going into the rates on different chapters, different sectors. So they are going into all the details, whether litigation is arising, they are going into the slab rates, they are going into socio-economic issues, how the rates should be set. This exercise initially was conducted when the GST was introduced.
Yeah.
That time the exercise was mostly on the neutrality principle, that whatever is being imposed on a particular item will continue to be imposed at almost at similar rate. But now this exercise is more comprehensive. So that's why I can say that GOM is taking some time to finalize their report and present it to the GST Council. Thereafter, yes, it will be deliberated, a consensus will be built, and the rates will be notified.
So Mr. Agarwal, if I may ask you, as you said that, the rates when they were set earlier were set on the basis of a revenue neutral rate. So what will drive the rate rationalization exercise this time around? It has been, of course, pending. There have been, there was a first GOM and now there is an expanded GOM that's looking at this issue. But what is driving the rate rationalization exercise, and what do you believe will be a comprehensive rate structure that India should aspire for as far as the GST is concerned?
I would like to say that in this rate rationalization exercise, all the issues which are maybe related to number of tax slabs, maybe how the items are placed in these different tax slabs. So all this will be looked into, and now we have the experience of more than 7 years. The type of litigation which has arisen by such placement of items in different tax rates. So with that experience, we know that where the litigation is arising, whether it is arising on food items, whether it is arising on maybe automobile components, maybe in certain other sectors. So with that experience, I think we are now in much better position to decide the rates.
So do you believe that 28% slab, which was originally the slab as far as tin goods was concerned, but then saw a lot of additions coming in, sir, do you believe that there is a case now for significantly pruning and rationalizing the items that fall under the 28% slab?
So there I would also like to mention, I could not complete that what are the things before the GOM. One of the issues is how to raise the revenue also. So the items which are placed in the bracket of 28%, if that is brought down, as some time back FS was also explaining, that if something is brought down, something else will have to be raised. It cannot be one-way traffic, that everything is brought down. Then we'll be losing on revenue. Revenue is very important for states as well as center. And
so you're saying 28% might in fact be expanded to include more items?
No, I'm not saying that. But because how the rates have to be rigid, that is before the GOM. GOM will have to take a view.
But surely the fitment committee, which gets a lot of the proposals from your department as well, has a view on this, sir. So, what are we talking about? Are we talking about merging of 12 and 18, or are we talking about expanding 28? What are we talking about?
I would say that fitment committee does not play a role in this entire exercise, although the TRU, they provide the secretarial support to the GOM. But the decisions are taken by GOM, not by the fitment committee.
No, I understand, sir. But do you believe that there is a case to be made for pruning 28, or is there a case to be made for expanding 28 at this point in time?
Because once we do this exercise and reject, move some items from one rate to the other rate, we'll have to do lot of maths also, to see that the revenue which is getting collected does not come down. If it does not go up, but it should not come down.
Come down, yeah, fair enough.
So the thing is that whatever is on 28%, we cannot say that many will be moved to lower slabs, but definitely, yes, to reduce the litigation, items will have to be moved. Certain items which are of similar nature will have to be moved in one basket.
Okay, okay. We'll have to be moved in one basket. If I could ask both the CBIC and the CBDT chiefs 2 quick questions that have come in online to us. On litigations, in fact, just this morning or I think yesterday, the headlines on Volkswagen moving courts against a $1.4 billion tax notice. Between both direct taxes as well as indirect taxes, what are we talking about in terms of disputes at this point in time and the process of trying to resolve disputes? How much is stuck at this point? So if I can start by asking you and then I'll come to Mr. Agarwal.
Yes, so insofar as the disputes, the appeals that are pending on the direct tax side is concerned, so last post July 24 budget, we have increased the thresholds of filing the appeals. That is for ITAT tribunal it is 60 lakh, for High Court it is 2 lakhs and for the Supreme Court is 5 lakh. So the thresholds have been increased so that the appeals are brought down. There's a lot of pendency insofar as commissioner appeals at the first appellate stage is concerned. And therefore, in the last 6 months, we have actually ramped up the manpower. So the commissioners, in fact, the principal commissioners of income tax have also been given the responsibility of deciding the appeals. And that way, the disposal of the appeals is going up. We hope that when we end this year, we would end up with more disposal of appeals. The third initiative that was taken was Vivad se Vishwas scheme, which has just ended on 31st of January. And about 40,000 appeals, the applications have come on Vivad se Vishwas. So if we see the total pendency about 5 lakh and odd, so about 8% of the appeals which were pending, the taxpayers have opted for Vivad se Vishwas scheme for resolution. Apart from that, from the alternative dispute resolution perspective also, we are also setting up dispute resolution committees. So which would be actually taking up small appeals to take care of and to ensure that the small taxpayer whose demand is pending is actually taken care of. We have instructed Commissioner Appeals to also dispose of appeals which are pending for more than 2 years and which are high demand appeals. So that is also an exercise.
And how many would those be at this point in time?
Well, those are about 1 lakh or so. And so we have, as I mentioned, we have ramped up the manpower also. And
a lakh in the quantum or a lakh in terms of appeals?
In the numbers.
In the numbers. Okay. Yes. That's a fairly significant number.
Yes, that is a significant number, but we have done an ABC analysis. And what we find is that substantial demand is pending, is corresponding to about 15,000, 20,000 appeals.
Okay.
So that is being given a push first, so that we are able to take care of it.
Sir, for you and before I get the questions in. On the customs and indirect taxes side, sir.
Yeah, so on litigation front, as my colleague has mentioned about the direct taxes, under national litigation policy, the limits have been announced on customs side also, so that we can bring down the litigation at least from the government side. But from the trade side, they are free to litigate the matter as much as they want. The second thing which has been done in this budget, a time limit has been set for finalization of provisional assessment. That will be providing lot of certainty to the trade and will reduce the litigation. If you see, you mentioned about the Skoda case, Volkswagen case. I will not be going into the merit of the case because the matter is sub judice before the High Court. But I can say one thing, that earlier there was no time limit of finalization of provisional assessment. In that case, the provisional assessment remained pending for a very long time. Therefore, the demand is for a very longish period. So those kind of situations will not arise in future. So that again is a very significant step. The third thing I would like to mention is that to reduce the litigation or the procedural thing, in this budget a provision has been brought to declare on voluntary basis if certain material facts have come to the notice of importer post the clearance from the customs charge. So there, if it comes to their notice, then they can file a declaration, and in case some duty has been short paid, they can make the payment of duty along with interest without penalty. But this will not apply in case audit or investigation has already been initiated. Similarly, in case they have they have paid the duty in excess and they have to claim the refund, presently they have to go and file an appeal against their own self-assessed bill of entry. The appeal will take some time to decide. Then once they get a favorable appellate order, they will have to come back again to the department, seek an amendment in their bill of entry, self-assessed bill of entry, and then file a refund claim. This entire thing has now been short-circuited. Now they can file a declaration post-clearance. In case excess duty is paid, that itself will be treated as a refund claim. So this will also reduce lot of litigation which is arising because this facility was not available.
This is Sandeep Bhalla from Dhruva Advisors. One of the questions was, you mentioned about reducing litigation on direct taxes. There used to be settlement commission which has been abolished, or in some sense, that actually used to reduce a lot of litigation, particularly in search cases where, there were questions of facts, there were questions of law, which were also considered during this. So that was one. Is there a thought process to bring something like that back? There was a demand of the industry that wherever the appeals are pending for more than a year or more than a certain period of time, at least the first appellate authority is not passed an order, then at least allow the assessee to file an appeal suo moto to the tribunal, so that at least, because today the situation is that while the appeals are pending at the first appellate authorities, tribunals do not have enough work on their hands. So you file an appeal before a tribunal, it comes up for hearing within 3-4 months, mostly between 3-4 months. So is there a thought process on moving some of these appeals to the tribunal? So that's the second question.
Yeah, so insofar as the first issue is concerned, so that was a policy call that the settlement commission was done away with. But then simultaneously, as you would recall, that last July, and so far as the search cases are concerned, the concept of block assessment has again been brought, wherein as against the past where each of the years we used to be reopened under 148 and then would get time barred at different points in time, bringing in inconsistencies, because by that time the officer would also have changed and new set of interpretations would happen. So therefore now block assessment concept would perhaps, that would ease the process of assessment, and then also a 60% tax on the entire undisclosed income. That concept has been brought. So therefore, I think that is what we feel, that insofar as search cases are concerned, the process has been reasonably, streamlined or maybe made easier than what was there earlier. So that is point one. And then the entire search case would be actually considered in one go. The material would also be considered in one go, and that would, at least that would take care of inconsistencies in the approach, because the examination would be done at one point in time. And so far as the second point is concerned, that if there is a pendency with CIT appeals, then can it be actually escalated to the ITAT? At present, there is no move like that, because it has its own implications. Because when it goes to ITAT, whether it goes as a first appeal or it goes as a second appeal.
Yeah.
Right. So that is also an issue that one has to actually see. So that is not under examination at present.
Not under examination. DA Secretary, let me come to you on one of the issues that, of course, at this point in time is grabbing headlines world over, and that's the move on cryptocurrencies. And ever since we saw President Trump come to office, we've seen a rally in cryptocurrencies. Is there, at this point in time, I mean, work was on a cryptocurrency paper here as well, and of course we brought in the tax, but the RBI has been steadfast in saying no to cryptocurrencies. What is our approach likely to be now in light of the many global developments that have taken place on cryptocurrencies? Any change in stance, any change in thinking at this point in time, sir?
Cryptocurrency, as we are aware, we have done a discussion paper, including at the senior level participation from the Reserve Bank of India, and the committee had finalized the discussion paper. But thereafter we find that when it was about to be issued, that several jurisdictions, and you named one, but more than one jurisdictions have changed their position on crypto assets in terms of their scope, where they see the utility, including for settlement, multilateral settlement of payments, cross-border payments. So there's one side, they're saying that much stronger use of crypto assets as a stable coin, which will have a large implications for an emerging economy like ours. The second one, using it as a multilateral settlement mechanism, which will again has a very major implications that how the global systems are organized. So in that context, we are recalibrating the paper, because the purpose of that paper is to pose the right questions to the stakeholders so that we get the right answers in terms of an appropriate answer to inform our policy making.
But what does the recalibration mean, sir? Because at this point in time, the RBI was very clear. They don't believe that cryptocurrency is the road to take at all. Is there a change in approach, given the fact that countries like the US are now full-fledgedly moving forward with cryptocurrencies?
So I will mention it that in 2023, when India had the G20 presidency, at that point of time, the stances of various jurisdictions, and I'm using the word jurisdictions instead of using the word countries, was fairly well known, and there was a stable position each one of them have taken. And this is one asset class which doesn't believe in the borders. We have to, what others will do, we have to be fully conscious of before we decide our own policies. It is not just a stable coin. At the 2023 issue was only different jurisdictions were looking for crypto assets as a stable coin.
Right.
Which is not a stable coin, doesn't have any much value. But a stable coin can cause a significant risk for our economy, for all emerging economies. Then a new element has come in. Some jurisdictions talking about a cross-border settlement doing it here, which is altogether a new dimension being brought in. So that requires to getting back not from the ground zero, but certainly going to the last stages of the drawing board and saying that do we have to recalibrate few of the questions so that we understand the risks very clearly and what can be the possible policy responses.
So by when do you believe this recalibration exercise will be over? And I'll get Mr. Nagaraju to comment on that as well.
I'll say that soon, but it may take a couple of months, but not longer.
A couple of months, but not longer. Mr. Nagaraju?
I support him.
That's an easy answer, sir. That's an easy answer. But let me...
We speak on the same voice, okay?
But let me come to you, Mr. Nagaraju. Two questions, sir. And one, I think that consumers here will, and across India, will be widely tuning into this KYC updation business, sir. And you made some announcement on that central registry. What should we expect now on this KYC updation, sir, if you can clarify for us?
See, the KYC now is the most authentic repository of information and also identity for the country. It is widely used. Now, a lot of data there is a duplication, and incomplete data is there, and we have been trying to sanitize the data available. But it's not, till now, whole data we could not do that. Now we want to give a couple of things we want to do it. One is we want to use the AI. We also want to use face auth, and we also want to give verification view only to the clients, so that they will be verifying the data. And we want to do 100% and deduplication. That also we want to weed it out, so that the database is much more robust, much more authentic, and it could be utilized by all the FI agencies.
Okay. Quick question on banks as well as NBFCs, Mr. Nagaraju. And, you know, the pain on the unsecured side that was red flagged by the RBI, do you believe that that is now a thing of the past? It's behind us? Has it bottomed out, or is there a worry of higher defaults from here?
Yeah, it was some time ago, the RBI has expressed the concern. But if you look at it now, the net NPA of NBFCs is about 1.2, and the gross NPA is also declined. Now, unsecured loans depends on the exigencies of the citizens. If they require unscheduled expenditure, then only they take the unsecured loans. If they don't have, especially actually goes up during the agriculture season.
Yeah.
Now the agriculture season is over, they have a decline. That which is a normal seasonal thing. We don't see any actually risk, long, very sustainable risk for these loans for the NBFCs. They are okay.
They're okay, so you don't
Yeah.
believe that defaults are likely to move higher at this point?
I don't think so. There is, see, always there is a risk in the financial system, but we can't say that it doesn't exist. It exists, but we should be very alert.
Okay. And a quick follow-up question on the RBI's LCR rules, sir, on project finance. Are they likely to go forward? Are they on the back burner or are in the cold storage, sir?
I'm not going to second-guess the RBI, but RBI has issued the draft. And we have conveyed our views on that. Now, they have not issued the final draft, the regulations. So we will take at that line. Okay?
Is that on account of your persuasion or have they dropped the idea themselves?
They consult a large number of stakeholders.
You're the biggest stakeholder.
And the government is also a stakeholder because we have the responsibility of public interest.
Right.
And we don't want to lock up a lot of capital into this kind of ideal situation. So we have expressed our views based on the feedback we received from the industry. Okay. Now the RBI has not issued. So let us put a full stop there.
Let us put a full stop there. I get my cue, Mr. Nagaraju, but we've got a question here on MSMEs. Go ahead, sir.
Hello, sir. You answered about MSME, but it wasn't clear. Is the interest subvention scheme going to continue from 1st of January or it's still for MSME?
I think the DA Secretary is responsible for this. He is going to answer.
There's a scheme on for the exporters, that interest subvention scheme is there for MSME, and there's no budget provision from 1st April. So the answer should be very clear. So the idea is that when the resources are limited, choices have to be made where these can be most effective. So the idea is, should you facilitate more credit? If more credit has to be done, guarantees have to be provided. Those pools of money, the pools of insurance pools have to be, guarantee pools of money, capital has to be provided there. So government felt that that is a way to move forward, provide more credit, take the risk so that the risk is lower, bank charges it lower, rather than saying bank can charge because of a higher risk and then government will do the subvention. When we say that industry has to be more productive, it presupposes a question that government should also be very productive, efficient in use of taxpayers' money. This is one example.
Go ahead, Pratik. We're running out of time.
Sure. Sir, so my question is to CBIC Chairman about the GST collections estimates. Is 10.9% growth that we are projecting, that roughly is less than one of tax buoyancy. Now one would argue that 1 lakh crore of personal income tax which has been left in the hands of consumers will also lead to more consumption and perhaps more GST collection as well. So do you think that slowdown in GST collection is a concern, and therefore things like track and trace kind of a mechanism which has been talked about, do you think that that can be expanded to many other products to check the evasion?
Yeah, as far as GST collections are concerned, in this month the GST collection was very robust. In fact, it was 1.95 lakh crores and at the growth rate of 12.3%. So this is the second highest ever GST collection in the history of GST. So far the GST collection, as far as center is concerned, the net GST collection was growing at the rate of 10.2%. It was higher than the GDP growth, nominal GDP growth. But the ask rate of GST collection growth is 10.9% for center. And in the last quarter, normally the GST collection is better as compared to first 3 quarters of the financial year. And this month revenue collection gives us confidence that we'll be collecting the revised estimate, which is the same as the budget estimate for GST revenue collection, which is at the level of 10.62 lakh crores. So we'll achieve the target, and it is beyond the tax buoyancy, I can say, is around 1.12.
Okay.
So it is good tax buoyancy, and the tax compliance is going up because of the policy changes which have been brought and the enforcement actions which have been taken by the central department and the state departments.
Right. So that's as far as GST is concerned. We've got the last few minutes, so very quick questions. Go ahead, sir.
Good evening. My name is Dr. Umang Sahai. I'm a professional in healthcare and education based out of US. I've been looking at the healthcare in India, and I find, and my question is basically to all the architects of the Indian economy, that with the present 1.4 billion people living in India, you have a present multi-specialty bed ratio of 7,900 to one patient, and you have 90,000 seats in medical institutes, where the population of this country is 1.4 billion. Is it not the time to look at it for restructuring, re-engineering, revamping, and at both macro and micro level, so that you could provide sustainable medical and healthcare and education to the people of this country?
Thank you, sir. Economic Affairs Secretary, go ahead, sir.
So the numbers I see that in terms of super specialty treatment beds, I don't have that data, but number of seats 2014 were 81,000, both UG and PG seats put together. 2024, that number is 1.92 lakh. So it has more than doubled. 130% increase has happened. Plus, another increase of 75,000 has been announced, of which 10,000 is going to happen this year. So that plan to make it another big increase of 75,000, not just in the medical colleges, but also through the large hospitals, even the district hospitals, through our DNB seats, where they are qualified professionals are there, but they can't do the teaching. That is my understanding. Plus, in terms of reforms, opening up the medical colleges, what are the norms are there, that is a separate exercise going on. And just before coming over here, I was with a similar kind of a gathering done by CII, and where some of the participants were talking about that how the corporates would like to do open more medical colleges can be facilitated. Just give an example. Government of UP came out to the market for 6 district hospitals saying that upgrade the hospital, run a medical college along with that, give 50% seats for Ayushman Bharat, and out of 6 districts, they could succeed in getting an entrepreneur and medical institutions for 4 districts to do that activity. This is another way of increasing medical education in India.
So unfortunately, we're out of time, but I'm going to take one last question here before I get wrap-up comments. We've got the Defense Secretary, the Labour Secretary, and the Consumer Affairs Secretary waiting by patiently as well. So one last question, sir. Go ahead.
Thank you. This is Mahesh from Deloitte. Good evening. It was a blockbuster year in 2024 for GST, so the expectations are now only higher. I just had 2 suggestions and 2 questions. The suggestion is that, if a little more focus on export-related transactions which are getting taxed, if some clarifications can come out, like it did on the data hosting and advertising, that will be a welcome one. And so on the MSME front, if we can look at more rationalization on the registration, I know it's a balancing act between keeping, tracking what the sellers do and all of that, but we could start either with e-commerce and some sectors where we could have checks and balances. My 2 questions were from the AEO scheme. Is there anything that we can expect? I don't think it's a budget. It can even come during the year. You all had set up a committee to have enhanced experience for AEOs. And the second is whatever potentially may have got missed out in the council meeting, which needs a legislative change. Does industry have to wait a year? Or like the online gaming, can we expect something during the year? Thank you.
Go ahead, sir.
Yeah. So you have mentioned about there certain services where the transactions happen across the borders. So to bring better clarity, this issue was taken up before the GST Council, and because this, in certain situations, the default rule of determination of place of supply is not applicable. It is in case of, say, intermediary services. So there in the GST Council, a decision could not be taken. An issue has been deferred. So the issue which you have raised, those kind of issues will be taken care once a decision is taken in GST Council. Second thing about the GST you mentioned is registration. For that also a council paper was presented before the GST Council, because we also feel that as we noticed that there are fake entities which are entering into the ecosystem. So we tightened the registration process. In the process, maybe we started asking for documents based on the risk approach. Taxpayer, the potential taxpayer or the new taxpayer has to go to the biometric Aadhaar authentication centers. In certain situations, the premises were marked for physical verification. So we tightened the registration process to keep these fake entities from outside the system.
Right.
Because it was creating problem for the buyers, suppliers, and the entire ecosystem was getting vitiated. So this registration process was tightened. But in the process, we noticed that there are certain taxpayers who may not be passing on the ITC. So for them, they may be mostly having the B2C transactions.
Right.
There the process can be simplified. So a concept paper towards that has been presented before the GST Council, and it emerged from the Council deliberations that we need to work further on it. So in principle, yes. So it will have to be further fine-tuned, and then maybe in the next GST Council meeting, before that, that report will be ready.
Okay.
A decision can be taken so that process can be simplified for certain types of entities, and which may be a huge chunk of entities which are entering into the GST ecosystem. Then you mentioned about customs AUO, whether more things can be provided to AUO so that they are encouraged to join, new entities or new businesses are encouraged to join the AUO ecosystem. Yes, we are working towards that. Maybe certain more benefits can be extended to the AUOs so that it can become more attractive. And you...
So that's it. He had a long list of questions. You've answered all of them. 10 seconds to each one of you, and I'll start by asking you, how confident do you feel about meeting the numbers that you have spelt out in the budget, sir, given all the global uncertainties that we're also going to be dealing with? I'll start by asking you, confident?
Yeah. So for RE, which has been set in this year for indirect tax collection, we are definitely, the ask is 7.1%. We are sure that we'll be achieving those targets. And the B, which has been set for the next year, that seek us to grow at the rate of 8.3%. We have done our math in projecting those figures, and we are confident that we will be achieving those unless, due to the global uncertainties, there is impact on GDP growth.
Okay. Ms. Agarwal?
Yes, we are very confident. The way we are growing in this year at the rate about 14.5%, I am confident that we will close this year with the targets that we have been given. So far as the next financial year, we have done our maths right, and I am very, very hopeful that we should be able to meet the target.
Beat the target, not just meet or beat?
Well, at least meet the target.
At least meet the target. Mr. Nagaraju, the headline from you, and also lots of questions coming in. One final question. Will the MDR rules change? Will it be the end of zero MDR anytime soon, sir?
That is under consideration. We will let you know the policy decision when the decision is taken.
But anytime soon, sir?
Yeah, soon, this year.
This year. Mr. Seth, I'll close by asking you, growth 6.8% now, doable on the back of the measures taken?
Certainly. Given that what the external environment today is, presuming that this remains as it is at the moment, we expect the next year growth to be towards the upper limit of the band which have been suggested in the
economic survey, which is 6.8%. Ladies and gentlemen, a big round of applause for the Economic Affairs Secretary, the DFS Secretary, the CBIC Chairman and the CBDT Chairman. We truly appreciate you joining us here. We are going to do a quick change in our cast. We have the Defense Secretary here with us, also the Labour Secretary and the Consumer Affairs Secretary. May I request them to join us on stage, and may I request the team from North Block. Thank you very, very much for joining us here this evening, ladies and gentlemen. Appreciate you joining us. No, we're not. There's no time to leave the room. I'm sorry. We're live. We're not leaving the room. We're starting the next session right away. May I request the secretaries to please join us on stage. Mr. Singh, could I request you to join us on stage, please? Mr. Singh, may I request you to join us on stage, sir? Thank you so much. Thank you. Appreciate it. Thank you, Mr. Nagaraju. Appreciate you joining us here today.
That, oh, you cut a tax rate across the board, therefore the rich will get much more. It has come to the correct audience in that sense. So it has to be travel, it has to be savings, it has to be these car consumer durable types. As I said, we are not buying those, but they could. The overall markets are down a lot, then India may outperform because A, it's not directly affected, and B, don't worry about markets like Taiwan because they have been closed for a week. So if you just look at how TSMC ADR was trading during this period because of Nvidia and others, and then the TSMC local fall. So don't get totally carried away. A little bit you're allowed to get carried away. But the point is that the budget was good and this tariff situation is bad.
More modest increase of about 5.5%. But I want to emphasize that what matters in defense is not really the annual allocation. What matters is the number of contracts you are able to sign up and thereafter fulfill, because that really determines your pace of expenditure. And in that, let me assure you that we are on pace right now to sign the largest number of contracts ever in our history.
Okay.
The largest last year was another high of 1,08,000 crores. This year we've already hit 1,15,000, and my intent is to double last year's number before the end of this financial year, and the result in terms of expenditure will follow thereafter.
So doubling by the end of this financial year, sir?
Yes, I intend to cross 2 lakh crores and maybe even more. Coming back to the other issue of reforms, from day one, after I've joined this ministry, my focus has been on procurements. That's an area which has always been bedeviled by delays. We've identified where the delays are. The delays are in a lot of, in 3 specific areas essentially. In terms of the delays in finalizing the documents, the RFPs, delays in the field, what they call the field evaluation trials, and thereafter the delays in what they call the cost negotiations. All of them take years at a time. And those are the areas where we are going to ensure accountability in terms of much shorter timelines. And that is why, as I said, I intend to ensure that our contracts this year will be double, if not triple of last year. And we intend to ensure that order books are full across the board in the defense industry so that everybody has visibility, everybody from the OEMs down to the component manufacturers, that their order books are full for the next 4 to 5 years and everybody is on the same page when it comes to fulfilling our capability gaps.
Well, that's quite a headline, sir, when you're talking about doubling and tripling and order books being full for the next 4 or 5 years. But if I may extend this conversation to react and respond to what has happened globally, and the comments coming in from President Trump saying very specifically that India needs to do more by way of procuring security equipment from the United States. I was just taking a look at the numbers, sir. India's already bought defense technology worth over $25 billion from the US since 2007. So when you hear President Trump saying that we need to do more in terms of procuring US security equipment, what does this mean? What should we realistically expect? What's on the table?
So first of all, of course, this has nothing to do with the budget.
No, it doesn't. But it's linked to the overarching landscape that we're dealing with.
Sure. So we do have some procurements which are on the anvil where American companies would be in the picture. And as long as they are able to meet our requirements in terms of quality and in terms of certain levels of indigenization, of course we'll be, those are carrots that we will be able to dangle before the Americans. And hopefully we'll be able to give some of those contracts. Let me stress that India has already ordered some 1,500 odd civilian aircraft from both American and from Airbus about one and a half years back, over the last one and a half years. which means in a sense that we've lost some leverage there. We've also already ordered these Predator drones a few months back. So yes, we are already, meeting a good proportion of our requirements from capable American companies, and we intend to continue doing so. There will be significant buys, and some of that will go to the US as well.
Could you lay out for us where the conversations are on any specific contracts or any specific, items at this point in time, sir?
See, we've already ordered these Predator drones. We have these engines that are already ordered, which in fact the delays on their side in terms of meeting some of those timelines, although now they've given us a revised timeline where it starts from March and then they start delivering about 12 next year and 20 every year thereafter. So yes, I mean some of those delays also on these Apache helicopters, the delays are on their side actually. On the anvil, there are some other potential areas where we can talk to them in terms of transport aircraft, maybe some infantry vehicles, and possibly some additional reconnaissance aircraft as well. So yes, there are some potential buys there where their companies can be contenders. That is all I would be able to say at this stage. But yes, there are areas of interest where we can engage with them and possibly find common ground and win-win solutions with the new US administration.
Common ground and win-win solutions. I appreciate you being able to share what you have been able to. I know that this is a sensitive issue, Mr. Singh, but let me get the Labour Secretary into the conversation as well. Thank you very, very much for joining us. The last budget had put together a scheme as far as internships and so on and so forth was concerned, and this budget is ostensibly taking that forward through the National Manufacturing Mission, through what they're attempting to do as far as MSMEs are concerned and so on and so forth. How does this open up the employment and the labour market, and what do you foresee is the impact and the implications of the budgetary announcements?
You see, the employment-led development theme of the budget shows how it prioritizes employment and job creation. And in fact, if you search for the word employment across the speech of the Honorable Finance Minister, you'll find it appeared multiple times, 17 when I counted it. So when we look at this closely, this builds on what was announced in July last year, the employment-linked incentive, which was one of the schemes under the Prime Minister's 5 package, creating opportunities for skilling, internship and employment for the youth. It's very interesting when we look at the budget document, how in various sectors, in multiple initiatives, job creation has been prioritized and intertwined with growth and investments and with the institutional mechanisms. So when we look at the focus on MSME, the limits which have been increased, the investment and turnover to enable them to grow faster, and also the credit availability for the MSME. And MSME, we know, is a major growth driver of jobs in the country. So that's a very major initiative. Something like 25 crore people are already employed by almost 6 crore MSMEs in the country. So this is definitely going to bring more quality, more production, and more exports. Similarly, there's the labor-led sectors, manufacturing sectors, footwear and leather alone is expected to create 22 lakh jobs, and then there'll be the indirect jobs, and of course making India the global hub for toy manufacturing. And when we look at food processing, the focus on food processing in the eastern part of the country is going to bring a multiplier effect on jobs, whether in the logistics sector or production sector. Then again, there's tourism, hospitality, Heal in India. There is the social security coverage for gig workers. And the platform economy is an emerging major driver of employment. And of course, there's the shipbuilding, which again will have direct, indirect impact. You want me to go on?
No, that's a long list. Since you mentioned gig workers, I have someone here who's been waiting to get in on a question on gig workers. Go ahead.
Yeah, thank you. Good evening. My name is Prashant Singh. I represent Avigna Enterprises, which is India's largest gig platform. And we have been closely looking at the budget for gig, and there was a mention of social welfare scheme for gig. But the definition of gig, ma'am, is not very clear in terms of who should be registered on e-Shram, and then how the insurance will be taken care in terms of multiple employment for the gig. So we would like to know more, if you could please throw some more light on this, that how it would be taken care for the gig workforce. And last but not the least, also how, being an MSME and a fastest growing startup in this domain, what benefits the companies can get from this. Thank you.
Thank you so much. Go ahead.
Yeah. See, there is a difference between gig work and platform work, and the platform worker is also a gig worker, but on a digital platform. And the scheme which has been announced is for the platform workers on the digital, work space. And as we know, the digital workspace has created a plethora of employment opportunities for the people, for the young people, and this is a very flexible work area, very flexible workspace. Also very distinct from traditional employment where there are work contracts and there's social security and so on and so forth. At the same time, the platform workers face a lot of challenges in terms of their work schedules, the flexibility, the algorithms, and so on and so forth. Giving them social security coverage has been a priority of the government. If you recall the Social Security Code, which was passed by Parliament in 2020, that defines gig and platform worker for the first time. And I would say that this is one clear definition that India has actually given in the world. We are the first to clearly define that these are workers who are outside the traditional employer-employee relationship, which also makes them vulnerable, and which is why this is a very significant milestone that the budget has announced. Social security coverage under Ayushman Bharat, Prime Minister Jan Arogya Yojana, which will give them 5 lakh rupee coverage for secondary and tertiary treatment for the year, and it will bring access to thousands of, of course, they'll be staying in one place, but the PMJY gives you access to more than 30,000 medical facilities, institutions in the country. I think that's a big step, and what is going to happen now is that we encourage the aggregators to get onto the e-Shram. We've already been working with them, register the platform workers, they get identity cards, and then they get access to the PMJY, the Ayushman Bharat medical healthcare scheme.
Right.
And that is going to happen in a stepwise manner, but very fast. We are going to move very fast.
Thank you for giving us clarity on that. But let me come to the Consumer Affairs Secretary as well. Ma'am, it's a volatile environment as far as commodities are concerned, but specifically on the back of the domestic challenges as well as the global challenges, what do you believe the budget has been able to prescribe to be able to cope with some of those?
So I think the budget actually, a very encouraging effort was, the announcement of a 6-year mission on Atmanirbharta in pulses. And this is something which is very important because over the past 2 consecutive years, we've been seeing the impact of El Nino effect, which actually brought down the production and productivity of both, pulses, cereals and vegetables. So the retail, the average general retail inflation, we can see that, although it is declining, and the food inflation has also come down and will be further, decline. But I think this self-sufficiency in pulses is something that, it will basically increase the affordability and the availability of an important food ingredient. So I think a very important step has been taken up in this budget announcement.
Yes, a very important step indeed. But Mr. Singh, if I can come back to you again, sir, and I was just again taking a look at some of the numbers. There's been a significant jump of 43% in the capital budget related to the BRO. There's also been a hike of, I think, 12% as far as R&D is concerned. And also in terms of, the roadmap for the next financial year, if you can lay out a little bit more color on the indigenization front as well, sir.
Yeah, so under the leadership of the Prime Minister, we've basically decided that we are going to spend most of our defense money within the country. And in the current year, the breakup is about 75% within and 25% outside. We are going to double down on those indigenization efforts as part of our moves towards Atmanirbharta and to preserve strategic autonomy by ensuring that our supply chains are robust and to the extent possible within the country. So along with the focus on indigenization and what I mentioned in terms of streamlining procedures and timelines, we also want to ensure that many of these DRDO-led technologies that they can license to the private sector. There are 2 or 3 different modes there. There is a development cum partnership model. There is a strategic partnership model. Some of them have been successful, and we intend to sort of expand those further to ensure that the private sector gets access to DRDO's technology and DRDO gets access to private sector efficiency in terms of providing the manufacturing muscle for taking these technologies to the benefit of the services. So those are the kind of areas we are going to really focus on as part of the year of reforms that you mentioned earlier. I also want to mention that you've seen templates like the C295 where even when there is a foreign OEM which is coming in, we take a very limited quantity from them, and the rest of it he has to really make in India, preferably with either a public or a private sector partner. Those are the kind of models and templates that we'll sort of insist on in the future. As I said earlier, we've got one of the most liberal FDI regimes now in the world when it comes to defense. 74% is automatic. Our message to the OEMs is pretty clear, foreign OEMs in particular, that if you want a slice of India's defense pie, you'll have to be here making in India. And of course, you can make in India and make for the world as well.
Speaking of making in India and making for the world, sir, on the export aspiration and the export ambition, if you can lay out for us, what we should expect, what the priorities are. For instance, as far as the BrahMos missile exports to Indonesia is concerned, what is the realistic plan going forward as far as the export ambition goes, sir?
So our exports have gone up about 10x in the last decade. It's reached 21,000 crores now. It's still a small slice of the overall global arms trade, about 1.5%. Obviously, there's tremendous room to grow. Now that we have a fairly large, expanding private sector ecosystem as well, let me stress that a lot of these exports are being done by the private sector. Public sector also, because of geopolitical conflicts, many of our public sector units, including Munitions India in particular, have also started getting a lot of export orders as well. Their order books, as I mentioned earlier, are full, and in fact they are finding it difficult to meet domestic needs at times. But geopolitical conflicts aside, there is a tremendous scope for a lot of Indian technology in areas like missiles that you mentioned, and also in land systems and artillery, where we have a lot of good domestic capacity now, also in ammunition and shells. These are areas where there is a lot of potential, particularly for friendly foreign countries in Asia and Africa. We intend to focus on those markets, and some of those steps are going to be sort of some of the facilitation you'll see as part of Aero India in Bangalore in the near future, when a lot of, I think, 60+ countries are coming, and obviously we'll hard sell some of these products to them and hopefully find more and more buyers for our defense industry, both private and public.
On the defense PSU side, sir, in terms of capital infusion, in terms of expansion plans to meet the kind of requirements, both domestic as well as the export ambition that you spoke of, what should we expect on the road ahead from a defense PSU perspective?
Yeah, so defense PSUs are, as you're aware, in 2 categories. There are these newly created defense PSUs from the old ordnance factories. They still need some capital support to expand, even to meet their new export obligations. The older ones, which includes many of the shipbuilding firms, their order books are quite good, quite robust. And when it comes to shipbuilding in particular, we do have a tendency to support our public sector more, although in the future we will rely on some of the emerging private sector capacity as well. So for them, for the old PSUs, the focus is on giving them enough orders so that they have a good visibility in terms of the next 4 to 5 years. For the new PSUs, there would continue to be some level of budgetary support. Some of that was announced in the budget as well.
Labour Secretary, if I could get an update from you. It's been a couple of months now since the budgetary announcements of the last budget were operationalized. On the internship scheme, for instance, where do things stand? I know we've already expanded the universe of companies that are now eligible to partake in the scheme. Give us a rundown, a status check of how this has panned out so far.
I can give you a status update on the employment-linked incentive. That's what our ministry is dealing with. But the internship scheme is with the Ministry of Corporate
Affairs. Yes.
So I'm as good as what comes in the papers.
Okay, so give us an update on the employment-linked